So hi guys, welcome to the marathon lectures from Sreshta for CA and CMA by Sreshta faculties. Okay, so right now you may be watching the accounting or auditing or law, whatever the subject. Out of 8 subjects, you may be watching any subject. I don't know. This is just an introduction video from me. Now, what important thing that you need to do right now is don't directly skip to the subject. Don't directly fast forward the video. Please watch this video without any interruption. Even when you're watching the marathon, we have given below the description timestamps. If you click on a particular timestamp, you will go to that particular chapter. But what I sincerely advise you, please watch this entire marathon in the same order. Suppose we uploaded 12th hour, don't directly go to the 5th hour and start watching. Watch in the same order because there is a structure that we follow so that you get the best understanding. Getting it? And further, after this 1 or 2 minutes, getting it, there is my another video which is merged, which is already merged. Please watch that also because that is an instruction to be followed while watching the marathon, what material to be used, all that also I covered. So the initial 5-7 minutes of my content, please do not skip. Please do not skip. So you're going to get some guidance on how to watch this marathon. Then you can directly start with the subject. That's it. Getting it? So take care. Continue watching. And please do not watch at higher playback speed. Some students think watching at higher speed, 1.5 times, 2 times the speed, dangerous approach. See, your objective of listening to the marathon class is not to listen, but to learn something. Learning, you should not make it fast. If at all we can cover the video in 5 hours, we would have covered in 5 hours, no? See, suppose I uploaded 10 hours marathon. If at all we can cover it in 5 hours, we would have taken it in 5 hours, right? Why the hell we take 10 hours? Why the hell we take 20 hours? So if at all you're watching at 2 times the speed, 1.5 times speed, you are not actually learning. You're only listening to the words. You are not learning. You're not analyzing. Analysis will not transmit. Understanding, you'll not get the emotion exactly. Whatever the emotion or intensity the faculty is teaching, if at all you're watching at higher speed, higher playback speed, you will never get that intensity. You will never get that connection. You just listen and leave. See, this is the reason why students, in spite repeat many a times, they still do not recollect. They still do not understand the content. Some students say, sir, some students may be faster in learning. If at all you are very fast in learning, try to listen the song at 1.5 times speed. Take any one particular song, try to listen at a higher speed. See whether you are connecting or not to it. You are listening, no? Music is audible, song words are audible, vocals and music, everything is audible. But why you are unable to connect? Connection is required with the subject. In order to establish that connection, please listen to the subject at standard speed. Even though you may be very smart, you may be very intelligent, just try that intelligence while listening to the songs also. Listen to a song at 2 times the speed. Emotion is important. In anything, any work you do, emotional connection is required. So please watch the entire content at standard speed. And I'm telling you, if at all you want to try 1 hour, if 1 hour you watch at standard speed, another 1 hour you watch at higher speed, you check back yourself where you are learning better. I think that is the best judge, that is the best decision. Just try that and then do. Because many people in YouTube are misguiding students saying, listen at higher speed, revise more number. No, that's not. Listen at standard speed. Your revision, number of times revision will naturally reduce. That's it. So continue watching the video. Thank you. Have a nice time. Bye-bye. So, hi guys. First of all, thank you very much for, encouraging our institutes, rest of us CA and CMA to this level. Anyhow, so here is a good news for all of you. From Sreshta, again in respect of November 2022 exams, we are going to upload again all updated marathon classes, revision classes. Okay, we are once again uploading the videos or revision videos for November 2022 exams. And we are doing it for all 8 subjects. So who are the faculties that first of all taking all these marathon revision classes? And myself, I will take audit and I will take some 2 or 3 important chapters of company law. And so nothing but P5, mainly I'll focus on, paper 6. And Satyaraju sir will focus on paper 1 and paper 5. So you'll be getting approximately 20 plus 20, 40 hours of marathon for accounts and advanced accounts put together. Then Subramaniam sir will be taking paper 2 part A, company law main chapters. And Harish Krishnan sir will be taking paper 7, which is EAS and SM marathon. And Vikita madam is taking paper 2B, other loss marathon. And Samba sir is going to take paper 4, income tax, separate marathon for 12 hours. GST some 10 hours, separate marathon. And Srinivas Reddy sir, paper 3, costing marathon, approximately we are going to upload for 15 hours. And coming to our another faculty, paper 8 part B, Naga sir is going to take economics marathon. And same Samba sir is going to take paper 8 part A, financial management marathon class. So from the entire Shrestha team, we are going to give you all 8 subjects revision marathon classes on YouTube. Now, first thing that you might get a doubt. So what are the things or what are the materials that you are going to use for these marathons? So before that, where you will find this marathon on the YouTube? Very simple. You just open CA Ram Harsha. Okay, there is a YouTube channel. So go to that home videos and there is a playlist. Here you will find a playlist separately for November 2022 marathons, revisions, CA, Inter. So in this playlist, you will find all 8 subjects. Now immediately you might get a doubt. Are all 8 subjects uploaded right now? No. By 10th of the September, you may be watching this video. You may be watching this video, on the date on which it was uploaded, or even maybe later. I don't know. Getting it? By 10th of September, all subjects except auditing, we will upload. Audit subject new marathon, we will upload after September 20. After September 20, audit related subject marathon will be uploaded. And you know what? The all revision classes, entire revision marathons are absolutely in English. Because we Shrestha is having 1500 plus students across 20 states in India. Not 20, I can say 26 states I think we have covered. Some 2 or 3 northeast states only we have not covered, but 26 states we are having admissions. So obviously, for us, the students across India, we can't use any particular regional language. So we have to stick to English. So entire explanation will be in English. Now, coming to a few questions which you need to understand. Okay. One. We have uploaded in May 2022 exams some video classes, marathon classes. I am telling you the same revision classes with slight modifications we are uploading. Some for few chapters we re-recorded like 1 or 2 chapters wherever there were amendments. But actually speaking, for May attempt and November attempt, the subject, the material, everything is exactly same. Because right now we are in September month 2022, right? If at all you go and check ICA website, what is the latest material available? November 2021 edition, October 2021 edition. So typically for May attempt, whatever material we are using, the same material we are going to use for November. I hope you are getting it. And now so we are using a particular material, right, for marathon, where you can download this marathon, where you can download this particular material which is used in the marathon classes. So there is an app in Shrestha for SHRE, Shrestha for CA and CMA. There is an application called Shrestha for CA and CMA. You will find right side, above me, there are 2 logos. First logo is there white color logo. That logo. If you type this name in the Play Store, you will get that logo. Getting it? Only from Android you can download the material. Suppose if you do not have an Android phone, please use somebody's Android phone and download the material. Okay, so in this application, you just download and log in. We have given in the main menu. If you go to the application, there is something called main menu. Just after opening the app, left side top, you will find main menu. Click on that, you will find study material. Inside that, November 2022 and May 2023, there are materials. Please download the materials. PDF copies, please download and keep it with you, so that it will be useful when you're watching the revision class, so that whatever faculty is actually using the material, so it is with you in hand. That's it. If at all you want to have a hard copy, you can buy that hard copy on the same application. But I don't think you require a hard copy, because it's a revision class. So whatever you already have gone through, whatever material you already learned from, please stick to that material. Take our revision classes as a additional guidance. And I'm telling you, you're going to enjoy the subject like anything from, See, generally in YouTube, you'll find many subject related marathon, but for all 8 subjects at a single place with a particular standard, uniform standard, you'll rarely find. So here, our institutes, rest of us CA and CMA is giving you that option. Getting it? So I hope you understood what we are going to deliver. Now, what are the topics that we are going to cover approximately, if at all you ask me? So if you look at paper 1, accounting, we are going to upload 2 videos. Approximately both the videos put together will be 20 plus hours. So these are the chapters: fundamentals, incorporation, introduction to accounting standard frameworks, AS2 and AS12, financial statements of company, bonus, investment accounts, redemption of debentures. That's it. We are not covering anything else from accounts subject. And paper 2A, company law, if you look at, me and Subramani sir, both of us are taking in this case the classes. Like if you look at accounts of companies and dividend, audit and auditors, these 3 chapters related revision I will take. Rest of the chapters, basic, incorporation, share capital, deposits, charges, these chapters revision will be handled by Subramaniam sir. Then other laws, all these topics are being covered by Vikita madam. And paper 3 costing, all these topics, 100% of all the chapters are being covered by Srinivas Reddy sir. Okay. Then part 2, see, costing video will be uploaded in 2 parts. Both together will be 15 to 16 hours. Then paper 4A, income tax, we are going to cover 5 heads of income, clubbing provision, set up and carry forward, chapter 6A, return of income, TDS and TCS. And GST, we are going to cover almost all the chapters. Then advanced accounts, introduction, few accounting standards, amalgamation, reconstruction, liquidation, partnership, consolidation. All these topics we are going to cover as part of revision. And accounting, advanced accounting is also being uploaded in 2 parts. Accounts, you will have 2 parts videos. Advanced accounts, you will have 2 parts videos. Sorry. Company you will have 2 parts. Sorry. Costing, you'll have 2 parts videos. Then coming to auditing, ignore auditing right now because I have not yet uploaded the, marathon. Then paper 8A, financial management, these chapters. Paper 8B, these chapters. Even paper 7A, paper 7B also, we are going to upload all the subjects. I told you where you will find all these videos. You will find that in the Play Store. Open CA Ram Harsha, open playlist. Inside that you will find November first playlist, November 2022 marathon. So in that playlist you will find all the 8 subjects video. By the way, you will find all these videos by 10th September maximum. Getting it? So actually I'm recording this video on 4th September. So right now after this video I'll be uploading the marathon videos. And this video will be a common video in all in all marathon videos, whatever I'm going to upload, 12 hours videos. In all the videos, this video right now whatever I'm recording will be a common video, so that every time whoever is watching a new revision class will not miss all this. Now one more important thing, now who should not watch this marathon class? If at all you are a first time learner. Now many people will ask me, sir, is it useful for a first time learner? No, this is not for first time learners at all. This is for those who are going to write exam. Okay, those who are just about to go and write the exam. No, for them only this is. See, a subject is completely covered in 20 hours. 100 marks paper is hardly being covered in 20-24 hours. A regular course will be 120-150 hours. Imagine we are reducing 1/5 time. It's a revision. First of all, understand revision is useful. Revision class will be useful only for those who already prepared the subject once. You may have prepared in self-preparation method or you may have taken coaching. That doesn't matter. That doesn't matter. But those who already prepared once, only for them this is useful. For others, strictly I'm saying not at all useful. Because don't waste your time. But I'm telling you, those who already have gone through books, who already wrote 1 or 2 attempts, getting it, or who are a first timers. Maybe you are first time you're writing in November, but you already gone through the coaching. For you, these marathons are going to be a best, thing, in your preparation. Definitely after watching this marathon, you will definitely get a new look on the subject, new idea, new perspective on the subject, so that within next 1.5 months, you can plan your preparation perfectly. That's it. Okay. Take care. Have a nice time. So continue the classes. Getting it? So this is an intro video. First I'll upload this normally. Then again I'll upload this as part of the revision videos. Getting it? So continue. Thank you. Have a nice time. Bye-bye.
Now we are in the chapter liquidation of companies. In generally, the word liquidation and winding up, we are using synonymously. But literally there is difference between liquidation and winding up. What is the difference, sir? Liquidation is a process or procedure adopted by the liquidator to close the company. I mean, if a company, let us assume Rani Limited, if it wants to decide to liquidate, then the liquidator will be appointed either by the court or the shareholders or by the creditors or by the National Company Law Tribunal, depending upon the type of the liquidation. Once the liquidator is appointed, he will realize all the assets. He will make settlement to the different liability holders in a particular order. To complete all such activities by the liquidator, it will take some time. The entire procedure to complete such activities legally we are known as liquidation. It will take some time to complete the entire procedure of realization of assets and make payment made to different liability holders. It may take certain number of years for a joint stock companies like listed companies like Reliance Industries Limited, TCS. It will take so much of time to close the business itself. But winding up is an event. It is a process, but it is an event occurred at the time of closure of the company. Once after completion of entire activities by the liquidator will submit a final statement, and it is ultimately submitted to the court. Once the court, after seeing the final statement by the liquidator, it will pass an order. That order is known as the winding up order. Then the register of companies will struck off such company from the database of ROC. That's why liquidation is a procedure, but winding up is an event. But to be frankly speaking, in the entire Companies Act 2013 or in the chapter, we synonymously using both the words. That's why either liquidation or winding up both are same, but literally or conceptually both are different. Okay, fine. Sir, coming to the legal aspect, either liquidation or winding up, the procedure should need to be made as per the Companies Act 2013 or as per the Insolvency and Bankruptcy Code 2016, whichever is applicable. I will tell you earlier scenario at the time of, as at the time of my student is, there is only one act, which is Companies Act 1956. We made the liquidation proceedings entirely based on the Companies Act 1956. But after introduction of Insolvency and Bankruptcy Code 2016, the scenario of the winding up is outrightly changed. Now, this diagrammatic representation will depicts the clear picture. I mean, in which type of winding up, which act is we are in generally using, you can clearly appreciate. So let us have a look quickly. Compulsory winding up, that is mandatory winding up. If that compulsory winding up is due to inability to pay debts, if the company is unable to make repayment to their liability holders, that is simply saying if the company is insolvent, then Insolvency and Bankruptcy Code Rules 2016 is applicable. If the company is insolvent, due to which the company is wound up, compulsorily, then Insolvency and Bankruptcy Code 2016 rules are applicable. Due to any other reasons, that is other than insolvency, if the company need to be wound up compulsorily, then Companies Act 2013 is applicable. That too, in other circumstances, when Companies Act 2013 is applicable, it should be ordered by the National Company Law Tribunal. Sir, can you please elaborate certain circumstances in which a company is being to be wound up, that is other than due to the insolvency? Yes, if the company affairs are against the sovereignty and integrity of the country, I mean, company is maybe in the business of providing weapons to our enemy country, which is quite against to the sovereignty and integrity of the country, then the National Company Law Tribunal may order for closure of the company. If the company affairs or the company is incorporated to deceive the public, or the company affairs are in the fraudulent manner, then either ROC or the representative of the central government will make a petition to the National Company Law Tribunal. Then the tribunal may order for wound up. Are the companies defaulted in filing their annual returns and the financial statements continuously for a period of 5 years? You know, as per the compliance system of the Companies Act 2013, once the general meeting is over, then that company within 30 days, it should need to file the AOC4, which related to the financial statements. And within 60 days, it should need to file either MGT7 or MGT7A, which is with respect to the shareholder information and all other particular information of the company, which is known as annual return. If the company is making default, or if the company is default in filing their annual returns and financial statements for a continuous period of 5 years, then the National Company Law Tribunal may order for wound up of that company. And National Company Law Tribunal, just it is decided that on sumoto basis, it is justifiable to wound up rather than continue. On equitable basis, just the NCLT may order for wound up, or the company by passing a special resolution, if it make a petition to the NCLT, then at that circumstance also NCLT may order for wound up. These are the certain circumstances in which a company is going for compulsory wounding up by the order of National Company Law Tribunal. Then Companies Act 2013 proceedings are applicable for winding up of that company. Sir, coming to the voluntary winding up, before 31st March 2017, Companies Act 2013 is applicable. But right now, after 1/4/2017, the entire voluntary winding up proceedings, Companies Act doesn't applicable. IBC voluntary rules are applicable. Insolvency Bankruptcy Code voluntary rules are applicable. Sir, what is this IBC, sir? Number of times you are telling IBC, IBC. What is this IBC is all about? If I open IBC here, let us go to the IBC official website. This is Insolvency and Bankruptcy Board of India. The full form is Insolvency and Bankruptcy Board of India, IBBI. Okay. If you check about us, about the IBBI, if I click, so where it was established on 1st October 2016 under the Insolvency and Bankruptcy Code 2016 code. It is a key pillar of the ecosystem responsible for implementation of the code and consolidates and amends the laws relating to the reorganization and insolvency resolution of the corporate persons, partnership firms, and individuals in a time-bound manner for maximization of the value of the assets of such persons to promote entrepreneurship, availability of the credit, and the balance interest of all the stakeholders. So simply he is telling that why this board is initiated by the central government to provide the justice among all the stakeholders of that particular entity at the time of liquidation of such company. If the liquidation proceedings are happened at a most faithful manner or in more ethical manner, then most of the stakeholders will get the benefit. Okay, it is a unique regulator. It is a unique regulator, regulates a profession as well as the process. And you know, this board, IBBI board, have the capability to appoint a liquidator. If the liquidation proceedings is initiated through the IBBI, then IBBI have a panel of members who act as a liquidators. Maybe here, service providers. Okay, so here it is there. If you check, insolvency professionals, those are known as insolvency professionals. Those are nothing but liquidators. Insolvency professionals are also appointed by the IBBI. Okay, come back. Fine, sir. Now we can understand the legal procedure if in case of compulsory winding up due to insolvency of that particular company, then IBC Code 2016 rules are applicable. Due to any other reasons through order made by the NCLT, then Companies Act 2013 proceedings are applicable. Now the voluntary winding up proceedings are almost in the hands of IBC voluntary rules, but Companies Act 2013 doesn't applicable in case of voluntary winding up after 1/4/2017. Okay, sir, but this entire chapter we are going to learn the liquidation proceedings based on the Companies Act 2013 only. Very few issues we are going to learn. The procedural issues we are going to learn with respect to IBC voluntary rules. IBC voluntary rules. We are not at all discussing anything related to Insolvency and Bankruptcy Code 2016 in case the company became insolvent. We are not at all dealing anything. We will deal these rules in procedural way, that is the legal point of view, but the real accounting perspective The entire chapter is based on Companies Act 2013 proceedings only. That is compulsory winding up. In case of order made by NCLT only, we are going to see. Okay. For the time being, first let us have a look with respect to IBC voluntary rules. What are such rules? What are the procedural issues need to be followed by a company in case if it wants to winding up voluntarily? Let us have a look first. Please all of you concentrate. IBC Code 2016 voluntary regulation. If a company who wants to liquidate voluntarily, then majority of the directors of such company may provide a declaration along with an affidavit that our company does not have any creditors, or if creditors exist, the company is capable to pay debts out of the proceeds through sale of assets. I mean, the company is not became insolvent at any particular situation. The declaration is provided or that guarantee is provided by the directors, then only the company can go for the voluntary winding up. So why the declaration and affidavit? This declaration and affidavit will provide that to confirm the solvency, of the company. Solvent means from the realization of the asset, company have the capability to repay all their liabilities. Then the company is said to be solvent. That solvency guarantee is given by the directors in the form of declaration and affidavit. Along with that, the director should also present 2 years preceding audited financial statements and operations of the business, along with that valuation of assets and liabilities made by the registered valuer. Sir, just now we seen registered valuers are also available in IBBI board. So though here registered valuer is there. Institute of Chartered Accountants of India is also providing the registered valuer course. If you want, I'll open registered valuer as per ICAI. Yes, if you check here, the ICAI Registered Valuers Organization is a Section 8 company formed by Institute of Chartered Accountants of India to enroll and regulate registered valuer as its members in accordance with the company's rules 2017. The organization can carry the functions with respect to the valuation issues. Okay, so what the issue is all about, sir? Sir, with respect to the IBC voluntary regulations, those regulations are applicable once the company is solvent, if the company go for the voluntary liquidation. To prove such applicability of voluntary liquidation provisions, board of directors should provide a guarantee in the form of declaration and affidavit that company does not have any creditors, or if at all creditors had by the company can able to repay such all the liabilities out of the proceeds through realization of assets, and 2 years audited financial statements along with the registered valuer certificate of the valuation of assets and liabilities should be provided to the insolvency and bankruptcy board. And within such 4 weeks of the declaration, the entire declaration should be approved by the shareholders by passing a special resolution. If creditors are exist, 2/3 of the existing creditors should also give approval for that. Then from the date of approval, we can assume that liquidation proceedings are initiated by the company. Within 7 days of such resolutions, the voluntary liquidation procedure is initiated by the insolvency and bankruptcy board, and such information will also send to the ROC as well as board. Board means insolvency and bankruptcy board. Then the board will appoint a liquidation professional. Just now we've seen as per the IBBA, certain professionals will be there which are insolvency professional. That name actually I wrote here as liquidation professional, or you can call it as a insolvency professional. Okay, he will be appointed. He is nothing but the liquidator. Now, once the liquidation procedures are over as per that specific board, then liquidator will submit a final copy to the adjudicating authority. Adjudicating authority means, which is again IBBI. So IBBI is a newly structured company. IBBI is a newly structured board. On that board, maybe different authoritative entities may be there. One of that is adjudicating authority. Adjudicating authority is a common word, guys. which might be a court, which might be a person. Okay. Then the final copy will submit to the court. The court is working within the purview of IBBI. Now, the adjudicating authority, after verification in the proper manner, they will pass a winding up order and it will be sent to the ROC within 14 days to struck off the company from the database. If you observe, all these are the procedural issues in case of voluntary winding up proceedings, IBC voluntary rules. In case of voluntary winding up under IBC voluntary rules. But I already told you, we are seeing this entire chapter in purview of the Companies Act 2013. When a company is going to liquidate compulsorily through order made by the NCLT, then Companies Act 2013 provisions are applicable. Then at the time of making petition to the NCLT for the purpose of compulsory winding up, the company should attach the statement of affairs. At the time of making a petition to the NCLT for the purpose of compulsory winding up, then the petitioner should need to attach, along with the petition, he should need to attach statement of affairs. Sir, what is this statement of affairs is all about? Please consider, all of you. Statement of affairs is a statement prepared by the board of directors, which contains all estimated realizable value of assets as well as estimated realizable value of liabilities. And this statement of affairs is ultimately sent by NCLT to the liquidator. For example, if NCLT straight away appointed a liquidator without knowing any proceedings of the company, how the liquidator can realize the assets, how the liquidator can make payment to the liability holders in a particular order. First, the liquidator will have a quick glance about all the assets and liabilities. You should need to know the quick summary about what are all the different assets and what are all the different liabilities exist in their entity. To provide such information, NCLT will definitely ask the board of directors to provide the statement of affairs. Such statement of affairs is giving a quick insights about all the estimated realizable value of the assets. Maybe certain assets are there. If you are sale in the outside market, at how much value you can fetch. Those are nothing but estimated realizable value of the assets, as well as estimated realizable value of liabilities. Also, they are clearly given. Then that document is ultimately handed over by the NCLT to the liquidator. Hope you understand. Okay. Once the liquidator is appointed by the NCLT, then board of directors will lose their rights and duties. I mean, now the board of directors will not conduct any of the affairs of the company. They will not involve into the decision-making process of the business. Now, who is the captain of the company? Liquidator is the captain of the company. At that particular scenario, shareholders are also known as contributories. Shareholders also lose their rights and duties. Shareholders are also known as contributories. Now, entire affairs of the company is in the hands of the liquidator. Then what is the duty of the liquidator? Liquidator will realize the assets and make payment to the liability holders based on the information given in the statement of affairs by the board of directors. Now, after realizing the assets, making settlement to the liability holders in a particular order, liquidator will prepare a liquidator final statement. Liquidator is going to prepare liquidator final statement. What is the meaning of liquidator final statement, sir? Which is a quick summary of receipts and payments of the company from the date he is taking in charge of that company, from the date of taking in charging position of that company, what are all the different receipts realized by the liquidator and what are all the different payments made by the liquidator. He will make it present under a quick summary as a receipts and payments account. It should be ultimately submit to the court. After watching that liquidator final statement, the court will pass a winding up order. Such winding up order is ultimately sent to the ROC. Then ROC will struck off that company from the database. This is the procedure we are in generally adopting in case of compulsory winding up under the Companies Act 2013. Now, this is relevant for our chapter. This is relevant, our chapter, the entire discussion of chapter we are going to make based on these procedural issues. Sir, you mean what are the different problematic issues you are going to discuss, sir? That is statement of affairs, which is prepared by board of directors ultimately for the purpose of submission to the liquidator. That part we are going to discuss. Once the liquidator will realize all the assets and making payment to the liability holders in a particular order, liquidator will prepare the liquidator final statement. That liquidator final statement also we are going to discuss. Apart from that, we are also going to discuss list B contributories. Sir, you told that once the liquidator is appointed, shareholders are known as contributories. Then what is list A contributory? What is list B contributory? We are going to discuss in the problematic area. And one more important issue, which is section T26 and section 327. 326 is with respect to overriding preferential payment, and section 327 is with respect to preferential creditors. Also, we are going to discuss another problematic issues. But the importance wise, how we are going to discuss, the first and foremost important phase is liquidator final statement. Then the second importance you can given to 326 and 327, and third importance you can given to list B contributory, and the final importance you can given to the statement of affairs. Hope you understand. Okay, fine. Sir, I will discuss the statement of affairs almost at the end of the chapter. That one also I am telling you, if time permits for me, I'm going to discuss the statement of affairs. Otherwise, I will simply ignore as well. Because for importance by the statement of affairs, I can give the last importance. So that means no need to prepare for our examination. I'm not telling like that. So the level of importance while compared with the other topics is low. Okay, fine. But one thing I want to clarify you regarding the statement of affairs. Statement of affairs is prepared by whom? Board of directors. For which purpose it is going to be prepared by board of directors? Because once if the liquidator is directly appointed by the NCLT without knowing anything, he can't do the proper realization of assets, and he don't know what are all the different liabilities he need to be discharged. To provide such information, board of directors will ultimately prepare the statement of affairs in a particular format. There is a particular format which guided by the Companies Act 2013. In that particular format, they are going to prepare, and it is ultimately submitted to the NCLT. NCLT will provide such document to the liquidator. Then based on that document, the liquidator will start realizing the assets and making payment to the liability holders. That is the objective of statement of affairs. Now, one thing I am clarifying with respect to statement of affairs, format. In statement of affairs, assets, liabilities, and capital are going to be presented in the following lists. Here I'm not revealing the format, but I am discussing about different lists, how the statement of affairs are in the statement of affairs, how each and every particular asset or liability component and the capital component is going to be presented. Just I want to going to discuss. Assets are broadly categorized into ANSP, ASP. ANSP stands for assets not specifically pledged. Assets not specifically pledged means those assets are not offered as a security at the time of availing any loan, and such assets are not offered as a security for any of the creditors as well. Assets specifically pledged means those assets are offered as a security at the time of availing any loan facilities, which are known as assets specifically pledged. ANSP is categorized under list A, ASP is categorized under list B. A category assets are ANSP, B category assets are ASP. Now consider all of you. Coming to liabilities and capital, liabilities are termed as creditors. Creditors are divided into two things. One is secured creditors, another one is unsecured creditors. And the secured creditors are again divided into two things. One is secured creditors with fixed charge. I not wrote under creditors. I secured creditors with fixed charge wrote under the below of ASP. The reason is secured creditors with fixed charge is also coming under list B only. I will tell you the reason, just hold for some time. Now secured creditors with floating charge and unsecured creditors are again divided into two different types. One is preferential creditors and other one is other unsecured creditors. And the capital is divided into two different types. One is preference share capital, another one is equity share capital. Now consider it all of you. Out of the creditors, first we should make payment to secured creditors with fixed charge. What is the meaning of secured creditors with fixed charge, sir? For example, if you took a loan from the bank, let us assume the loan is taken from the SBI, and the SBI clearly told that at the time of offering loan, they took one of the machinery of your company as a security. The machinery was identified. The machinery location is identified. Which machinery we are taking as a security also they identified at the time of availing the loan. Now the machinery is treated as asset specifically pledged, and the loan which we availed by offering such machinery is known as security creditors with fixed charge. That's why the asset as well as related liability, both we are shown under list B. That is nothing but security creditors with fixed charge. Sir, what is the meaning of security creditors with floating charge? What is the meaning of security creditors with floating charge? Floating charge means we are offering the group of assets as a security. Earlier, I told you one of the asset which is identified asset is given as security, which is security creditors with fixed charge. Floating charge means just like that we are giving the plant as a security. Just given that we are giving machinery as a security, but which machinery you are giving as a security, we are not identified. At the time of availing the loan, we are not identified such machinery or such plant or such asset. Then the liability is known as security creditors with floating charge. Is it okay, guys? Next, unsecured creditors divided into two different parts: preferential creditors, other unsecured creditors, right? Sir, what exactly the meaning of preferential creditors are? Preferential creditor is a unsecured creditor, but still we are giving preference before making payment to the secured creditors with floating charge. Anyway, the first and foremost choice we are giving to the secured creditors with fixed charge. The reason is we are directly offered one of the asset as a security at the time of availing this credit facility. But preferential creditors is having a preference before making payment to the secured creditors with floating charge. We will give preference to the preferential creditors. So those are unsecured creditors now. Why still you are giving the preference? We will discuss entire story under section 327 of the Companies Act 2013. That is one of our requirement. Under section 327, we are going to discuss things related to preferential creditors, where I clearly discussed what is the meaning of preferential creditors. Even though if it is unsecured creditors, why we are giving preference before making payment to the secured creditors with floating charge, why we are making payment to the preferential creditors. All such issues I will discuss. Sir, next, after preferential creditors, the next preference is secured creditors with floating charge. Then I will make payment to the other unsecured creditors. In the same manner, they actually made a titles as well. That's why preferential creditors is list C, secured creditors with floating charge is a list D, other unsecured creditors is list E. Then preference share capital is list F, then equity share capital is list G. That means with respect to the creditors, the order is secured creditors with fixed charge, preferential creditors, secured creditors with floating charge, other unsecured creditors, preference shareholders, equity shareholders. List A, assets not specifically pledged. List B, assets specifically pledged as well as secured creditors with fixed charge. List C is list C is for preferential creditors. List D is with secured creditors with floating charge. List E is with unsecured creditors. List F is with preference shareholders. List G is with equity shareholders. This is the presentation we made under the statement of affairs under the different lists. Here we are not discussing anything with respect to the statement of affairs. Just I discussed what are the different lists present under the statement of affairs. We are going to discuss things related to the statement of affairs at the end of the session. Next, come down. Liquidator final statement is very much important issue here. And it is very much important issue in the chapter liquidation of companies. Please, all of you come to the liquidator final statement. You know, I already discussed liquidator final statement is prepared by whom? Liquidator. It is a summary of receipts and payments account. It is ultimately submitted to whom? Court. Then court, after due verification of such liquidator final statement, it may order for winding up. Then accordingly, it may pass information to the ROC. Then ROC may struck off such company from their database. This is the procedure we already explained. Now, how the liquidator final statement is prepared by the liquidator, let us have a quick look. It is a simple receipts and payments account. Under left hand side receipts and right hand side payments. Under the receipts, ANSP, assets not specifically pledged. Those are the pure A category assets which not offered as a security at the time of availing any loan facility. Next, ASP, asset specifically pledged. Asset specifically pledged is in general related to list B, na? But here we are not representing with the name of lists, but still just I am linking with list for better remembering one. That's it, nothing else. Okay, so ASP, out of that asset specifically pledged, if any secured creditor with fixed charge liability is there, you should need to reduce the remaining surplus amount only you can show under the amount figure. For example, guys, machinery is there, which is realized for 10 lakhs. But the related liability is bank loan is there for 8 lakhs, then 10 lakhs minus 8 lakhs, remaining 2 lakhs only you need to show under the net figure. Next, call money from partly paid up shares. If the existing cash balance with the liquidator is insufficient to make payment to the liability holders or other shareholders, then liquidator have a right to ask money from the partly paid up shareholders. Because as per the Companies Act 2013, the liability of each and every shareholder is to the extent of the face value of the share. If they already paid up certain extent, then liquidator cannot ask that amount again back. Then the remaining unpaid value, if anything is there, then during the process of liquidation, if the liquidator is equipped with insufficient funds, then he may make a call from such a partly paid up equity shareholders. So that's why I added the word call money from partly paid up equity shares. If it is necessary, he will ask, otherwise he may ignore. Fine. Now this is very much important, guys. Payments. In which order liquidator should need to make the payments? First, he should incur the legal charges. Legal charges means the stamp duties and all such things. Then liquidator remuneration. Liquidator will not offer their services at free of cost, whether he appointed by the Companies Act 2013 or whether he appointed by the Insolvency and Bankruptcy Board. It is the duty or the responsibility of the company to discharge the liquidator remuneration as well. Okay, so regarding one by one issue, in detail discussion is there. First, let us have a look regarding the order of making payments. Then liquidation expenses. That is, liquidation expenses means maybe regarding sales commissions or advertising charges or any other expenses. Next, secured creditors with floating charge. Sir, you told that first we should make payment to preferential creditors. After that, we are making payment to secured creditors with floating charge. But first, why you wrote secured creditors with floating charge? Here, you should need to observe one thing. After making payment of liquidation expenses, we will make payment to preferential creditors only. After that only, we are making payment to secured creditors with floating charge. But why I presented secured creditors with floating charge first, after preferential, after that, I presented the preferential creditors? Do you know the reason? The reason is, I want to show unsecured creditors at a single place. I want to show secured creditors at a single place. But if you would present the secured creditors with floating charge after presentation of the preferential creditors, then unsecured, secured, unsecured, the presentation will look like be there. The presentation will be zigzag manner. So that is the reason why the guidance is provided by the Companies Act 2013. First, you can present secured creditors with floating charge. After that, you can present the preferential creditors. But at the time of making payment, first you can make payment to the preferential creditors. After that only you can make payment to the secured creditors with floating charge. Hope you understand. Then unsecured creditors, then preference shareholders, then equity shareholders. This is the order of making payment. You should need to remember legal charges, liquidator remuneration, liquidation expenses, preferential creditors, then secured creditors with floating charge, then unsecured creditors, then preference shareholders, then finally equity shareholders. Now let me discuss certain important issues with respect to this liquidator final statement regarding one by one payment. Okay, whenever necessary, whenever there are certain important points exist, then such points I am going to discuss below. The first and foremost issue. Sir, how much call money I can make it happen from the shareholder? How I know, sir? How much call money liquidator can be made from the shareholder? How we can know, sir? Let me take a small example. Sir, unsecured creditors are there 10 lakhs. In our company, unsecured creditors is there for 10 lakhs. In the liquidator hand, cash in hand with the liquidator is there for 4 lakhs. This is the scenario. Cash in hand with the liquidator 4 lakhs is there. Unsecured creditors existed 10 lakhs. Now, the existing equity shares are there which are partly paid up, and preference shares are there which are also partly paid up. Face value is 10 rupees, paid up value is 6 rupees, unpaid value 4 with respect to equity share. Preference share face value 10 rupees, unpaid value is 5 rupees, and the paid up also the 5 rupees. Now, number of equity shares are 1 lakh. Number of preference shares are also 1 lakh. Just this is all our information just I am giving. Now, if liquidator he wants, he can ask money from equity shareholders as well as preference shareholders. But out of the two parties, liquidator first will ask whom? If liquidator want to settle the amount, then first he will settle to the preference shareholders. But at the time of asking the money, first liquidator will ask money from the equity shareholders, because preference shareholders will have a preferential right to get money from the company, but not at the time of making payment to the company. That's why if any circumstance which leads to make payment to the company, then first equity shareholders will make payment. That's why we will ask money from equity shares. That is 1 lakh into 4 rupees, which leads to 4 lakhs. Now already cash in hand with the liquidator is 4 lakhs. Then from equity shareholders, we are getting another 4 lakhs. So then the total amount will be 8 lakhs. Am I right? Now still to make settlement to the unsecured creditors completely, I require 2 lakhs. That 2 lakhs I can ask from the preference shareholders. That is from each and every shareholder, I will ask 2 rupees. That is 1 lakh into 2 rupees, 2 lakhs. Like that, you should need to check how much amount I can make it call from the equity shareholder as well as a preference shareholder. Is it all of you okay? Next, come to the next important issue. This is regarding the liquidator remuneration. Sir, how to calculate liquidator remuneration? That is depending upon the terms and conditions agreed in between the company and the liquidator. If the liquidator remuneration is based on percentage of value of the assets realized, if the liquidator remuneration is based on percentage of value of the assets realized, then liquidator will get remuneration based on the amount of realizations he made from such assets. Let me take one example for better understanding. Sir, commission to the liquidator is agreed at 5% on the assets not specifically pledged. Sir, the liquidator totally realized from ANSP was 5 lakhs. Then how much amount we need to pay to the liquidator? Simply 5 lakhs into 5%, which is 25,000. First, he should need make payment to the liquidator remuneration to the extent of 25,000. Next, certain times the liquidator will also get remunerations based on percentage of payments made to the various parties. Now let me explain through small example how it should work out. Commission to the liquidator is 2.5% on payment distributed among the shareholders. If amount distributed among the shareholders is 1 lakh, then liquidator will get 2,500. That is the term. Am I right? Now, the information given here is preference share capital is for 5 lakhs, equity share capital is for 4 lakhs, cash on hand with the liquidator before making payment to shareholders is 6 lakhs. Now, cash on hand with liquidator is 6 lakhs, amount payable to preference shareholder 5, amount payable to equity shareholder is 4 lakhs. Now, he can able to make payment to preference shareholders in the order of making payment. Yes, sir. He can able to make payment to preference shareholders because with the liquidator 6 lakhs cash is available, preference shareholders payment is only 5 lakhs. Then once before making payment to preference shareholders, first we should make liquidator's commission. Am I right? So if you are going to distribute 5 lakhs among the preference shareholders, then commission is 5 lakhs into 2.5%, which is equal to 12,500. 12,500 is the commission and 5 lakhs amount is the preference shareholder. Total 5 lakh 12,500 you need to reduce. Then the remaining cash balance is 87,500 before making payment to the equity shareholders. Now the question is it cash is sufficient to make payment to the equity shareholders? No, because the amount payable to equity shareholders is 4 lakhs, but the amount of cash available with the liquidator is 87,500. For example, if the entire 87,500 if they given to the equity shareholders, then how much they can give to the liquidator as a commission? They are unable to give any rupee. But if you know how much amount they are distributed among the equity shareholders, then you can find out the liquidator remuneration. Am I right? That means this 87,500 is available both for liquidator commission as well as distribution among the equity shareholders. For both, you should need to utilize. I know one thing. Let us assume 100 be the amount payable to the equity shareholders. Then liquidator commission will be 2.5. Then 102.5 is the cash available before making payment to the liquidator as well as before making payment to the equity shareholder. This 87,500 is equal to 102.5. Then for 2.5 commission how much? Then for 100 payment made to equity shareholders how much? Whenever the cash balance is insufficient to make payment to particular party as well as liquidator, then at that particular point of time, liquidator remuneration should be calculated below. That is cash available before making payment into rate of commission divided by 100 plus rate of commission. That is cash available before making payment to persons is equal to 87,500 into rate of commission is 2.5 divided by 102.5. If you made the cross multiplication, the same thing will occur. If you made the cross multiplication, that is 87,500 into 2.5 divided by 102.5, then automatically you will get 2134. So which is the standard formula? Whenever the cash is insufficient to make payment to the liquidator, whenever the cash is insufficient to make payment to the liquidator remuneration as well as to the other parties, then you should apply the formula cash available before making payments into rate of commission divided by 100 plus rate of commission. Fine. This is the second important issue. Based on percentage of payments made to various parties is a little bit tricky here. Next, come to point number 3. Secured creditors with floating charge. Most of the times in a company, secured creditors with floating charge is coming under debenture holders. I mean, debenture holders are in generally treated as secured creditors with floating charge, because at the time of issue of debentures itself, the company is entered into agreement with trustees of the debenture holders that we are offering a floating charge of security on all the assets. So that's why in generally debentures are the classic examples for secured creditors with floating charge. Now I'm not talking about the debenture holders. I'm talking about interest on the debenture holders. Now my question is, sir, is it interest on debenture holders to be payable at the time of liquidation? Yes, up to the date of liquidation. Up to the date of liquidation, the entire interest on debenture holder should need to be repaid by the company. Interest outstanding up to the date of commencement of liquidation should pay along with the debenture principal to the debenture holders. I mean, here in my basic example where it is there here, if the liquidation proceedings is initiated here, then the entire outstanding interest up to the date of commencement of the liquidation should need to make pay along with the debentures principal. But after the date of liquidation and up to the date of settlement of such debenture holders, after the date of liquidation but up to the date of settlement of such debenture holders payment, if any debenture interest accrues, then what is the treatment, sir? Interest after commencement of liquidation and up to the final settlement. If the company is solvent, then company will pay such debenture interest. No, if the company is not solvent, then the company will not pay. What is the meaning of solvency of the company? From the realization of assets, if company is able to make payment to all other liability holders, then company is said to be solvent. I mean, after making payment to unsecured creditors, up to unsecured creditors only liabilities are there now. After making payment to unsecured creditors, still liquidator is having certain cash, then liquidator have the liability to make payment to the interest after commencement of liquidation or up to the final settlement as well. Because after making payment to the unsecured creditor, still the liquidator is having cash, means the company is solvent. Do you understand? If the company is not solvent, I mean the cash is insufficient to make payment to unsecured creditors itself, then company need not make payment to the interest on debentures after the date of liquidation and up to the date of settlement. That point you should need to remember. Next, come below. Arrears of cumulative preference dividend. If there is a provision in articles of association to pay the arrears of preference dividend at the time of liquidation, then before making payment to the preference shareholders, liquidator will make payment regarding the arrears of cumulative preference dividend. If articles of association doesn't have that provision, then no need to make payment with respect to the arrears of cumulative preference dividend. Hope you understand. Next, come below, guys. Sir, this is a different case. The next case is regarding distribution of surplus among the different types of shareholders. This is not with respect to distribution of among the liability holders. This is with respect to distribution of surplus among the various equity shareholders. Let me take one example. After making payment to all outside liability holders as well as preference shareholders, surplus available with the liquidator is 5 lakhs. Now, how this 5 lakhs should need to be distributed among the various types of equity shareholders? One equity shareholder, that is one type of equity shareholders are 10,000 shares they had, face value is 100, paid up value is 100. And another type of shareholders are face value 100, paid up value 50. And another type of shareholders are face value 100 and paid up value is 20. Now the question is how you can distribute this 5 lakhs among the various equity shareholders. There are two methods available. There are two methods available to distribute such 5 lakhs cash among the 3 different types of the shareholders. Please, all of you observe the method number 1, which is directly given in the ICA study mat. Method number 2 is actually created by me. And that method is also actually followed while resolving the problem sometimes in the ICA material. That's why whether you can follow method number 1 and method number 2, that is up to you. Both the methods are valid methods only. Come to method number 1, distribution of surplus among the various types of equity shareholders. First, you can start with number of shares, 10,000 shares, 3,000 shares, 1,000 shares, total are 14,000 shares. Face value is how much? Just you can represent the face value. Paid up value also you can represent. This is the important factor for us. This is the important factor for us. This is the paid up value. Sir, 10,000 into 100, 10 lakhs is the paid up value. 3,000 into 50, 1,50,000 is the paid up value. 1,000 into 20, 20,000 is the paid up value. Total paid up value is 11,70,000. Now the cash available with the liquidator is 5 lakhs, but the total paid up value of the equity shareholders is 11,70,000. What is the meaning of that? If cash available is 5 lakhs, but the amount payable to the equity shareholders is 11,70,000 means the difference itself is deficit. Deficit means liquidator is unable to make payment among the equity shareholders. The deficit you can consider, the deficit you can distribute among the equity shareholders in their shares ratio. Now the deficit is, the difference is 6,70,000. The deficit of 6,70,000 you can distribute in the equity shares held by them in the ratio, that is 10,000 is to 3,000 is to 1,000, that is 10 is to 3 is to 1. If you make distribute, then you will get the balance like this. This is known as balance. What is the meaning of this, sir? What is the meaning of this balance, sir? If a particular type of shareholders is end up with positive balance, that means such type of equity shareholders will get money from the company to that extent. If a particular type of shareholders is end up with negative balance, what is the meaning of that, sir? The type of equity shareholders should introduce cash to the company. Now, after making this, the 1,000, that is class 3 type of class 1, 2, 3. Let me give some names. Class 3 type of shareholders should need to introduce 27,858 as a cash balance to the company. Already existing cash balance with the liquidator, how much? 5 lakhs. If class 3 shareholders introduced 27,858, then the total cash balance will become 5,27,858. Now, out of this 5,27,858, you can make payment to the class 1 for 5,21,429, and for class 2, you can make payment for 6,429. Then with the liquidator, the balance will become nil. That is the beauty of this method. That means with the balance of the liquidator, if you add if you add the cash which is introduced by the particular class, then the total cash available with the liquidator, then from where you can distribute that cash among the different class of shareholders according to the balance appeared as per that method. Now, how much amount of cash should need to make call from class 3 shareholders? How I know, sir? The total I should make call for 27,858. The number of shareholders are 1,000. Then per each and every equity shareholder 27.858 I should make it call. Then under receipts and payments, if it is the liquidator final statement, then here call money from partly paid up equity shareholders at the rate of 27 point so and so. I'll ask from 1,000 shareholders. Then I will distribute in the form of payments, payment distribution to equity shareholders like this. For class 1, this much, and for class 2, this much. Class 1, 5,24,429, class 2, 6,429. Do you understand? The same distribution I can also explain through different method, but don't be confused. Whichever is suitable, you can follow that method. So what is method number 2 is the conceptual method. Please concentrate. Existing cash in hand with the liquidator, how much? 5 lakhs. Now, what is your problem? How this 5 lakhs should be distributed among these equity shareholders? That is your problem, right, sir? That is my problem. But you cannot distribute equally. The reason is paid up values are different. The reason is paid up values are different. For the time being, let us make all the paid up values are same. To convert the 50 rupees paid up value into the 100, I'll make a notional call. I'll ask 50 rupees money from this class of shareholders. To convert 20 rupees paid up value, to convert 20 rupees paid up value into 100 rupees paid up value, here I will make a notional call of 80 rupees. I'm really not asking any money, just for the paper, just I make a notional call. Now, if you make a notional call, then 3,000 shareholders multiplied with 50,000 shareholders multiplied with 80, you will get this much of amount. The total amount available with the liquidator right now is 7,30,000. 7,30,000 you can distribute among the equity shareholders equally. Now the total number of shares are 10 plus 3 plus 1, total 14,000. Then each and every equity shareholder is getting a surplus of 52.1428 per share. What is the meaning of this? Please, all of you concentrate. We are making a call money. From class 1 shareholders, nil. From class 1 shareholders, nil. But from 3,000 shareholders, that is class 2 shareholders, we are making a call money at the rate of 50. From 1,000 shareholders, we are making a call money at the rate of 80. This is asking money from the shareholders. Giving money, that is surplus, we are giving everywhere 52.1428, everywhere 52.1428. From this, what we can conclude? From class 1 shareholders, we are not asking anything, just we are distributing 52.1428. From class 2 shareholders, we are asking 50, we are giving 52.1428. Rather than asking, you can directly distribute the surplus, which is the difference 2.1428. From class 3 shareholders, you are asking 80, you are giving 52.1428. Rather than the difference of amount, you can ask from the class 3 shareholders, the difference is 27.8512. Now, if you observe this, what you can conclude, class 3 shareholders should introduce the cash of 27,857. Then class 1 and class 2 shareholders will get like this. The same thing actually we got in the method number 1 as well, which is 5,21,429. They got for class 1 here in and around same. For class 2, they will get 6,429. Yes, here also the same thing. For class 3 shareholders, we asked 27,858. Here also the same figure. That means how we should need to distribute among the various types of equity shareholders if paid up values are different and face value is same. Just now we work out to the illustrations under method number 1 as well as method number 2. In method number 1, we should need to find out the difference between the total paid up value and the existing cash. The difference of deficit you can distribute among the equity shares ratio. Then the balances which you got are the final balances. In that ratio, you can simply distribute among the various equity shareholders. If a particular class of equity shareholders end up with negative, they should need to introduce. If a particular class of equity shareholders is end up with positive, then they will get money from the cash. Fine. Under the method number 2, we will make a notional call. Then we will compare that particular class, how much they should need to introduce, how much is given by the company. We will compare the net amount only we are going to settle. Like that, we are going to distribute the amount among various types of equity shareholders. Fine. Another issue also I am going to explain. Please allow me concentrate. The issue is there is a difference in face value. There is a difference in face value as well as paid up value. If you observe, last problem face value is same. Face value is same. Face value is same. But the paid up value is different. Here, face value is different as well as paid up value is different. Then what can I do, sir? You can equal the face value. How I can make it equal, sir? Here face value is 100. To make it equal, I should multiply with 10, right? That means number of shares I will convert as divided by 10. Number of shares are 300 shares. Equivalent number of shares at the rate of 100 were 300 into 100, which is equal to 30,000, or 3,000 into 10 also equal to 30,000. Here make it divided by with 20. 20 means here they will come 50 shares at the rate of 100. Now if you check 1000 shares at the rate of 100, 300 shares at the rate of 100, 50 shares at the rate of 100. Now the problem is converted like this, right? The problem is converted like this. Then you can apply the same system, but on behalf of the number of shares, you can consider the equivalent number of shares. Now here I consider the equivalent number of shares. If you observe 10,350. Now I check here in the same manner the balances. If you observe the balances, here it is come across as all are positive balances. All are positive balances. What is the meaning of that? No class of shareholder need to introduce the cash into the company. All the class of shareholders, they will get the money. For class 1, divided by 100, 3.3389. Sorry, not divided by 100. For class 1 shareholders, how many number of shareholders? 10,000. Divided by 10,000, then each and every shareholder, how much they will get, you know. For class 2, don't division with 300 because the actual number of shares are not 300, 3,000. You can division with 3,000, then you will get each and every equity shareholder how much they will get. For class 3 shareholder, don't divide it with 50 because the actual number of equity shares are 1,000. Division with 1,000, then class 3 shareholder, each and every share how much they will get, you know. If different face value is there, you can apply the concept of equivalent number of shares by equaling the face value of all type of equity shares. Then you can apply the procedure as like above. So these two issues are pretty much important. These are in very delicate mode. Actually, we need to deal, because if you made any mistake, distribution of cash among the various equity shareholder may go into the different direction while resolving the problems. This is all about liquidator final statement, guys. I discussed the format of liquidator final statement. I discussed the concept behind the liquidator final statement with respect to each and every single component. Without wasting any time, let me take up one problem, guys. Based on the liquidator final statement, first let me take up one problem. Then you will get a better confidence as well. Oh, okay. Just wait. I can't directly take the liquidator final statement. Let me move upon with some other concept as well. After completion of that concept, then I will take up the liquidator final statement. That is the better idea, I think so. Okay. So after discussing section 326 and 327 concept, then we can take a problem on liquidator final statement, as well as we will also consider problems on these sections as well. Okay, fine. Coming here, section 327 is related to preferential creditors. We already seen at the time of discussing a liquidator final statement. Section 326 title is overriding preferential payments. By seeing the title itself, you can easily understand that 326 is a overriding provision while compared with 327. Overriding preferential payments means we should give preference over and above the preferential creditors as well. Over and above the preferential creditors as well. It's quite interesting. Don't be confused. In the normal course, first we will make payment to creditors with fixed charge, then preferential, then with floating charge, then unsecured creditor, then preference, then equity. But whenever section 326 is applicable, we should give first payment as per section 326 only. We will give first payment as per section 326 only. Then I will follow the order. What is that order actually? Legal charges, liquidator remuneration, liquidation expenses, then preferential creditors, then creditors with floating charge, then unsecured creditors, then preference and equity. Hope you understand. Come down. Sir, what exactly tells section 326, sir? Or who I can call it as overriding preferential creditors? Payments related to workman dues. Payments related to workman dues is a overriding preferential payment. And one more thing, just first of all, before discussing about the overriding preferential payment, first let me discuss one important provision. This is not with respect to overriding preferential payment. As per the Companies Act 2013, whenever workman dues are exist, you know, workman means workman, those covered under Industrial Disputes Act. Those are labor, daily wages on basis they will work. Unskilled labor, that is not also skilled labor, unskilled labor. Such persons are covered under workman dues. So it is equitable and justice that if the company is going to the liquidate, or the company is under the liquidation process, even though amount payable to such workman is unsecured in nature, we should give the prima facie importance to them. We should give the primary importance to them. Don't check whether it is secured or unsecured, nothing, because those are the daily labor. They are completely outrightly depending upon your company, but due to liquidation proceedings started, they might lose their opportunity to work with you. Then they're on daily basis, food, shelter, and clothing itself is going to be impacted. That's why first you should give importance to make payment to such workman dues. But how such workman dues you can make payment to? You can make payment, right? You should give equal importance to such workman dues along with secured creditors with fixed charge, because a machinery is there in your company which is offered as a security, at the time of availing a bank loan. Then that bank loan is a secured creditors with fixed charge, right? If you directly give amount to the workman dues, then the bank loan holder may lose the amount. Am I right? So that's why if you realize the amount from the machinery, how you should going to distribute among the workman due and secured creditors with fixed charge, let us have a look. In their outstanding balance proportion, we need to distribute the cash realized from that security among the workman due and secured creditors with fixed charge. This provision is not relevant. This provision is not explaining what is the meaning of overriding preferential payment. This provision is a standard provision and which is a privilege available to the workman due whenever a proper security, whenever a proper secured asset is realized in the outside market during the process of liquidation. Now let me take one example here. Sir, a machinery which is realized in the outside market for 1 lakh, that machinery is offered as a security at the time of availing the bank loan. The bank loan is a secured creditor with fixed charge, which is 1 lakh. And the workman due is also there for 3 lakhs. Now, as per the provisions of Companies Act 2013, we should need to distribute this 1 lakh among workman dues as well as security creditors with fixed charge in the proportion in which the outstanding balances exist. In which proportion the outstanding balances exist? 3:1. That's why 1 lakh into 3/4, 1 lakh into 1/4. Now, out of this 3 lakhs, workman people will get 75,000, and out of this 1 lakh, security creditors with fixed charge, banker will get 25,000. Is it okay? Now, after distributing this 1 lakh of surplus arised from the machinery, still the balance of workman dues is 3 lakhs minus 75,000, which is 2,25,000. That balance of workman due is overriding preferential payment. That balance of workman due is the overriding preferential payment. Not only that, due to making pari passu payment with the secured creditors with fixed charge to the workman due, due to making pari passu payment to the workman dues, how much amount is foregone by the security creditors with fixed charge? If workman dues are not exist, then the entire amount of 1 lakh we make it repayment to the banker. But due to making payment to the workman dues to the extent of 75,000, security creditors with fixed charge is foregone that 75,000. Now the remaining amount of 1 lakh minus 25,000, 75,000 is foregone by the security creditors with fixed charge, right? That foregone amount by the security creditors with fixed charge is also treated as overriding preferential payment. That's why the total overriding preferential payment here is 2,25,000 plus 75,000, which is equal to the 3 lakhs. Now the same thing, let me explain here. Come above the concept, come to the overriding preferential payments. Section 326, consider all of you. In the winding up of a company, the following debt should be paid in priority to all other debts as per section 326. Workman dues. What are these workman dues? Balance of workman dues. Balance of workman dues, not the total workman dues. What is that balance of workman dues? After making pari passu payment with security creditors with fixed charge to the workman dues, the remaining outstanding amount payable to workman due is there, na? That workman due is a overriding preferential payment. Where a security creditor has realized a secured asset, yes, I realized a secured asset to the extent of 1 lakh. So much of the debts due to such secured creditor as could not be realized by him. How much amount of the secured debt I unable to realize? 75,000, because I only realized 25,000. In pari passu with workman dues, in making equal payment with the workman dues, I foregone this amount. I unable to realize this amount of 75,000. That 75,000 is treated as overriding preferential payment. That's why simply overriding preferential payment is nothing but balance of workman dues and security creditors with fixed charge to the extent of the amount he is not realized due to making pari passu payment with the workman dues. Both combinedly we can call it as overriding preferential payment, which is highly important, guys. Next, come to section 327, which is preferential creditors. I thought of last examination, they asked the question from 326 and 327. They covered both the sections and they asked the question from the liquidation of companies for 5 marks, I think so. Okay. Anyway, that question we are not trying to cover in this marathon because there is a separate session I'm going to take in. There is a separate session I'll take exclusively on examination issues. Okay. That lecture is also coming soon. That will be also uploaded in the YouTube in the respective platform. Okay, fine. Come to the preferential creditors for section 327. Now, why you are giving preference over the security creditors with floating charge? Before making payment to the security creditors with floating charge, why you are making payment to the preferential creditors? Now you can appreciate here. Will pay preference among all the creditors subject to the section 326. Subject to the section 326. Subject to the section 326 means first 326 after the 327. Who are all such creditors? Government taxes, duties, cess, etc. to be payable preceding 12 months from the date of liquidation. From the date of liquidation in the preceding 12 months, what are all the government taxes, duties, cess you need to be payable is coming under the preferential creditors. Compensation in case of death or disablement of employee, not the workman, death or disablement of employee compensation, which is also a preferential creditor. Employee salary or wages within a period of 12 months preceding to the date of liquidation. Out of such 12 months, 4 months salary you can categorize it as a preferential creditor. But that 4 months salary should not exceed 20,000 rupees per employee. But such 4 months salary should not exceed the 20,000 rupees. That means in the preceding 12 months salary, 4 months salary, you can categorize as a preferential creditor and that salary should not exceed 20,000. And the holiday remuneration payable to the employees is also categorized under preferential creditors. PF, gratuity fund and ESI payable to such employees is also categorized under preferential creditors. any investigation expenses payable to the investigation authorities like CBI, and such all authorities, if they incurred any such expenditure, we should need to categorize as a preferential creditors. That means all these preferential creditors are unsecured creditors, but still we are giving importance at the time of making payment during the process of liquidation of the company. That is government taxes, duties, as compensation at the time of death or disablement of employee, out of preceding 12 months salary, 4 months salary, holiday remuneration, PF, gratuity, ESI fund, investigation expenses are coming under the preferential creditors payment under section 327. That's it. Fine, guys. Now let us have a look for some problems, guys, for better understanding. Let me took the problems based on this 326 and 327. Yeah, please all of you come to problem number 2, which is quite interesting problem. Amount payable in winding up of a company are as follows. Security creditors 1,25,000, workman's due is 2,50,000. Show the payments made and a treatment of the balance in the following two instances. The first instance is security realized is 2 lakhs and the second instance is security realized is 1 lakh. Let me explain the entire problem through my power notes. Come to problem number 2. Okay, the first situation, security realized is 2 lakhs, right? Workman due how much? 2,50,000. Security creditors with fixed charge how much? 1,25,000. Now this 2 lakhs is going to distribute among the workman dues and security creditors with fixed charge in the ratio of 2,50,000 is to 1,25,000. Now I distributed to the workman due for 1,33,333 and for security creditors with fixed charge is the 66,667. Then the balance of workman due here is 1,16,667. And the balance of security creditors with fixed charge is 58,333. Now, let me calculate the overriding preferential payment as per section 326. Balance of workman due is anyway overriding preferential payment plus to the extent of security creditor unable to realize the amount due to making equal footing with the workman due. How much amount is foregone? If the entire amount of 2 lakhs realized is given to the security creditor with fixed charge, then he will get entire 1,25,000. Am I right? But due to making payment to the workman due, he is unable to realize to the extent of 58,333. Such 58,333 is also treated as a overriding preferential payment. That's why the total overriding preferential payment is 1,75,000. That is case number 1. Come to case number 2. Please all of you concentrate. Please apply the attention a little bit here. Security realized is 1 lakh and the workman due is 2,50,000 and the security creditors with fixed charge is 1,25,000. Can you please tell me all of you one thing? Sir, security creditor with fixed charge is 1,25,000, but the related security if realized in the outside market, I got the 1 lakh. Then to the extent of 25,000 is unsecured straight away. How it works, you know? I took a loan from the bank for 1,25,000. The security offered is machinery. Machinery book value is there for 2 lakhs. Then banker would thought that, okay, in the outside market, if I realize, I will get the 2 lakhs. But during the process of liquidation, if I realize that machinery, I got only 1 lakh. Now, the loan is 1,25,000, but the security realized is only for 1 lakh means to the extent of 1 lakh only, I can categorize it as a security creditors with fixed charge. What about remaining 25,000? Excess of loan over the security is straight away unsecured. 25,000 is straight away unsecured. Now, this 1 lakh should need to be distributed in the ratio of workman's due and the security creditors with fixed charge on their outstanding balances. That is 1 lakh into 2,50,000 divided by 2,50,000 plus 1,25,000. Here 66,667. Here 33,333 in the normal manner. Please all of you concentrate. What is the balance of workman due? 1,83,333. What is the balance of security creditors with fixed charge? 91,667. But out of that 91,667, 25,000 is unsecured. And the remaining amount, 66,667, he is unable to realize due to making payment to the workman due. How much amount he made to the workman due? 66,667. To that extent, only he is unable to realize that amount, only the overriding preferential payment. Therefore, overriding preferential payment is 183,333 plus 66,667. The total will be 2,50,000. Then what about this 25,000? The 25,000 will be unsecured. Do you understand, all of you? This question actually in the previous examination they tested in another manner. Okay, but I don't want to take it that problem. I already told you I'm going to explain through that examination analysis lecture. Okay, now let me take up a problem which is based on liquidator final statement. So this type of models we already covered, that is face value is same but paid up values are different, and face values and paid up values both are different. Then we covered everything. That's why I don't want to take up under the problems. So many problems I covered in the marathon itself. Okay, fine. Now let me take up a basic problem of liquidator final statement. Here I'm explaining the method of conducting the problem. I'm not explaining each and every adjustment. Please concentrate. Omega Limited resolved on 31st March 2011 that company be wound up voluntarily. The following was the trial balance extracted from its books as on that date. To be frankly speaking, in case of voluntary liquidation, now Companies Act 2013 is not applicable. But I told you still we are conducting the problems based on Companies Act 2013 only. What is the information given here? Property, plant and equipment is given, which is PPE. Inventory is there. Book debts is there. Cash in hand. Profit and loss account debit balance is given. 6% preference shares of rupees 100 each fully paid up given. Equity shares of rupees 100 each fully paid up given. Equity shares of 100 is 75 paid up given. Loan from the bank on security of the stock. Loan from the bank means this is a secured creditor with fixed charge. With fixed charge. This loan is a secured creditor with fixed charge. Okay. Trade payables are given. The assets realized the following amounts after all costs of realization and liquidators remuneration amounting to 5,000 paid out of cash in hand. That is simply telling that liquidators commission is 5,000 and liquidation expenses also 5,000. Both are inclusive. He is not giving separately. Property, plant and equipment realized at 1,68,000. Inventory is realized at 1,10,000. Trade receivables realized at 2,30,000. Out of which inventory is assets specifically pledged, because we are offered this inventory against the loan which was taken from the bank. Next, if you observe, 2,000 equity shares are partly paid up shares. Calls on partly paid up shares were made, but the amount due on 200 shares were found to be irrecoverable. They made a call out of the 2,000 equity shares, but they are able to recover from the 1,800 equity shares only at the rate of 25 rupees. That is the information he is given. You are required to prepare the liquidator's final statement of account. We need to prepare the liquidator final statement of account. Let me explain liquidator final statement of account to my power notes again. Please come all of you here. Liquidator final statement of account as on 31st March 2011. As on 31st March 2011. Now on the left hand side receipts, right hand side payments. Start with assets not specifically pledged. PPE, book debts, cash in hand. Those are the assets. PPE, book debts, cash in hand. PPE trade receivables realized value you should consider 1,68,000 and 2,30,000. And cash in hand it is directly given, which is 40,000, which are assets not specifically pledged. Come to assets specifically pledged. Stock. Stock, how much you realized? 1,10,000. The related loan is secured creditors with fixed charge, which is for 1 lakh. 1,10,000 minus 1 lakh. The surplus is only 10,000. Is it okay? First, you should need to work out realization from ANSP and net realization from ASP. Okay. Don't directly go for the call. If liquidator feels that if the cash is insufficient, then he may ask money from the partly paid up equity shareholders. Otherwise, he may not call. Then you can start conducting the payments among the various equity shareholders in the particular order. So first, from the given information, you may incur the liquidator's commission, that is liquidator remuneration is 5,000 directly outrightly given, no need to calculate. And sometimes what they will provide the information for calculation of remuneration, but in this problem not provided. Next, in the order of making payment, first, preferential creditors. Is there any preferential creditors like government taxes, bonus to employees and PF to employees, compensation at the time of death or disablement of employees? Nothing is there. Am I right or wrong, guys? So that's why you can go to the unsecured creditors. Unsecured creditors here is trade receivables. Sir, creditors is unsecured creditors. Sorry, trade receivables is debtors. Payment unsecured trade payables. Trade payables. Unsecured creditors amount is 3,50,000. Now you can make for payment to the trade payables. There is no other liability exist. Next, preference shareholders exist. Before making payment to the preference shareholders, how much cash is available? Can you check once? Here 4,38,000 ANSP plus 10,000 from ASP minus 5,000 minus 3,50,000. Before making payment to the preference shareholders, cash availability is 93,000. I got the same figure, 93,000. Now, is it this 93,000 is sufficient to make payment to the preference shareholders? No. Then the liquidator have an option to make a call from the partly paid up equity shareholders. Then liquidator made a call. Liquidator made a call from the partly paid up equity shareholders. Only out of 2,000 equity shareholders, only 1,800 equity shareholders responded and paid. That's why made a notional call, not a final call. Made a notional call. Method number 2, guys. Made a notional call at the rate of 25 rupees each from 1,800 partly paid up equity shareholders. 1,800 into 25, which is 45,000. Now 93,000 plus 45,000, I got 1,38,000 cash with the liquidator. Now out of this 1,38,000, liquidator will make payment for the preference shareholders 1 lakh. Still with him surplus is there for 38,000. Now after making a call, class 1 equity shareholders 1,000, class 2 1,800 equity shares, both are same, not 2,000, because 200 equity shareholders are not responded for the call. 1,800 plus 1,000, all are fully paid up. Now the number of equity shares are 1,000 plus, sorry, these are preference shares, I'm so sorry. These 2,000 equity shares plus 1,800 equity shares, 2,000 plus 1,800, 3,000 equity shares, you may distribute equally. 38,000 divided by 3,800, each and every equity shareholder will get 10 rupees per share. That means type number 1, we are not making any notional call, but we are giving a surplus of 10 rupees. But for type 2, we are asking a notional call of 25 rupees, but we are issuing 10 rupees. Now type number 1, you can directly distribute 10 rupees. Type 2, you are asking 25, you are giving 10 rupees back. The net difference only we are asking, which is 15 rupees we are asking. That is the reason why under receipts, I made a real call of 15 rupees from those 1,800 equity shares at the rate of 27,000 rupees. Then you can make payment to the remaining 2,000 equity shareholders, 2,000 into 10, 20,000. Sir, you are getting 27,000. Why you are paying 20,000? You may have a doubt. Don't be confused. Sir, before making payment to the preference shareholders, I have 93,000, right? Now I got 27,000 amount. If you got 27,000 amount from at the rate of 15 rupees, then the total amount will become 1,20,000. Out of this 1,20,000, 1 lakh you are making payment to the preference shareholders. Now you are still having 20,000. Such 20,000 you can make it payment to the 2,000 equity shareholders. That is the mechanism of distribution among the various equity shareholders. You can complete the distribution among the various equity shareholders by applying method number 1. If you want, you can apply the alternative method number 2. That is actually we learned under method number 1. How? That is the deficit we are need to distribute among the various equity shareholders. Then at that particular circumstance also we got in the same manner 10 rupees for class 1, 15 rupees they need to introduce for the class 2 type of equity shareholders that I already explained previously. With that, liquidator final statement is over. Next concept, guys. If you check the problematic issues, under the problematic issues, just let me open the problematic issues. Where it is there? Yeah. I completed liquidator final statement and I completed section 326 and section 327 as well. And the next issue is list to be contributory. Concept is very much easy and it is not that much of big. We can try to complete within fraction of minutes the concept of list to be contributories. Now let me start the concept of list to be contributory. Please all of you come below. Yeah, where it is there? Yes, here. Please come to list to be contributories. First, who are known as list B contributories, sir? Who are known as list A contributories, sir? Who are all the shareholders exist at the time of liquidation of the company are known as list A contributories. Who are all the shareholders transferred their shares to the another shareholders during a period of 12 months preceding to the liquidation date is known as list B contributories. One more time I'm repeating. Who are all the shareholders exist at the time of liquidation is known as list A contributories. who are all the shareholders transferred their shares to the another shareholders during the preceding period of 12 months from the date of liquidation is known as list B contributory. I mean, list B contributory is nothing but from the date of liquidation preceding 12 months, if any particular shareholder transferred his shares to the another shareholder, then the transferor shareholder is known as list B contributory. Then next question coming into my mind is, why you are talking about list B contributories liability? Is it list B contributories are still liable even though they are transferring their shares to the another shareholder? Yes. When the list B contributory liability will exist? That is the $1 million question. First, we should need to know the answer about that. If list A contributories are unable to make the call money, in the earlier problem, we seen out of the existing 2000 equity shares, only 1800 equity shares are reacted, 200 equity shares are not provided any call money. At that particular circumstance, liquidator have the right to ask money from the list B contributory. The existing cash balance with liquidator is insufficient to make payment to the liability holders, and the existing partly paid up equity shareholders are unable to make call money, then liquidator can ask money from the list B contributory. And the next question coming into my mind is, how much is the liability of the list B contributory? How much is the liability of the list B contributory? I'm directly revealing the provision. Creditors exist as on date of transfer and continue to exist as on date of liquidation, or unpaid value of the shares transferred, whichever is lower, is the maximum liability of the list B contributory. If I directly tell, you may not appreciate anything. Let me take certain figures. Face value is 10 rupees, sir. Paid up value is 5 rupees, sir. In the preceding 12 months, I mean, I am as at 31st March 2020, which is date of liquidation. Preceding 12 months means after 1/4/2019. As on 1/5/2019, shareholder A transferred 5,000 shares to the B. At the time of making transfer of such shares, creditors balance was 6,000. And the same creditors also exist as on date of liquidation as well. Now, on these 5,000 shareholder, on these 5,000 shares, unpaid value, how much? 5 rupees is the paid value. Paid up value means other 5 rupees is the unpaid value. That 5,000 shares into 5 rupees. That 5,000 shares into 5 rupees, which is 2,500. Unpaid value of the shares transferred, which is 2,500. Or outstanding creditors exist as on date of transfer, which is 6,000. Whichever is lower is the liability of list B contributories. Now you can appreciate it is justifiable to ask the list B contributories if the existing list A contributories are unable to make the payment. That too, we are not asking the list B contributories big amounts. We are asking the list B contributories to the extent of creditors existing as on date of transfer, or to the extent of unpaid value of the shares transferred, whichever is lower only. Do you understand? Okay, fine. My another question is, sir, if more than one list B contributories are there, then how you can work out the liability of the list B contributory? Let us have a look through this illustration. Please all of you concentrate. This type of questions may also tested in the examination. Once upon also it was already tested. There may be a scope to ask such type of questions in the future as well. So date of transfer 1/5/2019. The same example I'm going to continue. A to B, 5,000 shares transferred. Outstanding creditors are 6,000. As on 1/7/2019, C transferred to D 10,000 shares, and outstanding creditors at that point of time is 8,000. As on 31st December 2019, E transferred 3,000 shares to F, and the outstanding creditors are 9,000. As on 1st February 2020, G transferred 6,000 shares to H, and the outstanding creditors is 12,000. For all the transfers, unpaid value is only 5 rupees only. Then what is the liability of list B contributory? First, you should need to know one thing. Now, on these 6,000 creditors, who are all responsible, you know? A is responsible, C also responsible, E also responsible, G also responsible. Because this 6,000 creditors is there at the time of transfer of shares from A to B. The same 6,000 is also there at the time of transfer of shares from C to D, at the time of transfer of shares from E to F, and at the time of making transfer from G to H. That means on the 6,000, A, C, E, Z all are responsible. Sir, in which proportion they are responsible, sir? In which proportion they transfer the shares? On the 6,000, A, C, E, Z are responsible in the ratio of 5:10:3:6. Then coming to the 8,000, you can only check the incremental figure 2,000 because A is only responsible for 6,000. For the incremental 2,000, who are all responsible? You know, C, E, G. So C, E, Z are responsible in which ratio, sir? 10:3:6. On the incremental 3,000, 8,000 to 9,000, 1,000. On the incremental 1,000, E and G are only responsible. That is 3:6. Now the incremental 3,000, only G is responsible. Now the same thing I mentioned here. Statement showing the liability of list B contributors A, C, E, G. For the 6,000 creditors in the ratio of 5:10:3:6. And for the incremental liability of 2,000, only C, E, Z 10:3:6. And the incremental liability of 1,000 3:6. And the incremental liability of 3,000 only G. Then I work out the gross liability. Whichever is lower, na, this is the outstanding creditors existing as on date of transfer or unpaid value of the shares transferred. Unpaid value of the shares transferred were 5,000 into 5. Here 2,500. Here 10,000 into 5, 5,000. Here 3,000 into 5, 15,000. Sorry, 1,500. Here 6,000 into 5. 6,000 into 5. How much, guys? 30,000. Tell me, guys. Figures are correct only, right? 1 second. 5 rupees, correct? So 5,000 shares means 5,000. Just a second. So sorry, guys. Here actually wrong figures were given. A clerical mistake. What is that? 5,000 into 5 is 25,000. 10,000 into 5 is 50,000. 3,000 into 5 is 15,000. 6,000 into 5 is 30,000. Whichever is lower. So ignore the figures. Only concentrate on the concept. Whichever is lower means whichever is lower. 1,250 or 25,000. Whichever is lower. 1,250. Here 3,553. Here 1,399. Here 5,798. You can make it total. Then the total liability is 12,000 only. Maybe here some clerical mistakes were made. Therefore, net liability A or B, whichever is lower, which is 1,250, 3,553, 1,399, and 5,798. So whichever is lower means 12,000 is the lower liability. That's it, guys. This is the discussion I made with respect to the liability of list B contributory. Maybe here zeros are missing. Just I added that one as well. Fine. Sir, after list B contributories, only one concept is ignored by me, which is statement of affairs. I don't want to cover the statement of affairs concept under the marathon. I already told you, if you are already my regular student, then I already covered the statement of affairs. That is list A, assets not specifically pledged, list B, assets specifically pledged. Then the liabilities, how we need to clearly adopt, I already covered in my regular course. You can ignore for at the time of revision if you're already there in my regular course. Okay. That's it, guys. That is with respect to the liquidation of companies. That is more than enough. Important content or the concept only covered except the statement of affairs. Still, we have 2 chapters pending in our marathon session, friends. One is partnership accounts. Another one is consolidated financial statements. You know, both chapters weightage is huge, and the content wise also, those are very big chapters. Am I right? Sir, in our regular course, partnership accounts and consolidated financial statements put together, we will spend approximately 35 to 40 hours. You know, those chapters are such a big chapters. So that's why I have very good idea. I am not covering any problems with respect to partnership accounts and consolidated financial statements, except 1 or 2 important problems. Okay, remaining, I don't want to touch any of the problem. And one more thing, I will only try to cover the pure theoretical aspects, and the application part you already come across in your regular courses. You know, this is a pure a revision session. So that's why I will only try to cover theoretical issues. Uh, true. To cover the theory itself, it will take approximately for each chapter 4 hours. It will take put together 7 to 8 hours we require. Okay. Hope you understand. So the remaining all lectures are with respect to partnership accounts and consolidated financial statements. Hi friends, very good morning. So most awaiting chapter for all the students is partnership accounts. In previous lecture, we completed S24. With that, the entire accounting standard portion is over. Still the pending chapters in entire group 2 advanced accounting is partnership accounts, consolidated financial statements, buyback of equity shares, employee stock option plan, banking company, non-banking financial corporation or non-banking finance companies. Including partnership accounts, we have still 6 chapters is pending. Okay, right. Without wasting much time, let us entering into the chapter partnership accounts. Now, in our material, the entire partnership accounts is going to divide into 2 parts. If you observe index, the entire partnership accounts is split into 2 parts. Part number 1, part number 2. Okay. So the chapter is very big. To put it as simple or in the best possible manner, just I divided into 2 parts. First, we will see things related to part 1. After completion of entire discussion related to part 1, we will entering into part 2. In part 1, the following components we are going to discuss. So, as usual, before entering into any chapter, we are seeing overview. So for all accounting standards as well as other chapters till now. So in the same way, just now before proceeding with the main concept, first let us have a look what are the different components or what are the different concepts we are going to learn in this chapter. So part 2, the learning aspects I don't want to discuss right now. Only now I'm discussing part 1 learning aspect. Okay. We started with the simple dissolution. I mean, first of all, I need to tell this. Part 1 is purely related to dissolution of firms, dissolution of partnership firms. Sir, what about part 2? I already told you, I don't want to touch it all. Okay, come to the part 1. So first here start with simple dissolution. Simple dissolution. Then Garner versus Murray's English case law we are going to discuss, which is also related to dissolution, but a special type of dissolution. I mean, a special type of provisions need to be applicable if the particular criteria is satisfied. Okay, so Garner versus Murray's case law we will discuss. That is a famous English UK case law. Then, if all partners insolvent, if all partners insolvent, what is the situation we will see. After that, we will discuss about the concept of piecemeal distribution. Then part number 1 will end with concept of limited liability partnership. Limited liability partnership. So just these are different concepts we are going to cover in part number 1. Okay, put aside. Apart from all these things, partnership accounts is not a new chapter to you. Maybe probably you came from either foundation curriculum vitae or you came from the graduation, that is in the direct entry scheme. Whatever the case may be, partnership account is not a new chapter. Sir, altogether, the partnership accounts, what you learned is quite different from the partnership accounts you are going to learn in CA inter syllabus. How it is different from what you learned, I will explain here. Please, all of you concentrate. So now, the partnership accounts, the concept of partnership accounts. So previously, you learned the following issues. You learned the following issues. Here, just I am emphasizing the things what you learned. You know, after constitution of partnership, you seen how to prepare financial statements. After constitution of partnership, how to prepare financial statement, you've seen. Whenever there is a change in existing relations among the partners, which in generally we will call it as reconstitution of partnership. Now, once the partnership is constituted, after that you prepare the financials, and apart from this, just a moment, sorry. Apart from this, you also learned the concept of reconstitution of partnership firm. Reconstitution of partnership firm. I mean, we can call it as reconstitution of partnership firm, or the another name is dissolution of partnership. Another name is dissolution of partnership. Sir, what is the meaning of dissolution of partnership or reconstitution of partnership firm? So the difference is when reconstitution of partnership is going to occur, you know, in case of change in profit sharing ratio, or in case of admission of a partner, in case of retirement of any partner, in case of sudden death of any partner. In case of sudden death of any partner. So then the existing agreement entered among the partners is going to end, and the new terms and conditions will be coming to the picture. So such a process is known as reconstitution of partnership firm or a dissolution of partnership. That is not the dissolution of partnership firm. It is only the dissolution of partnership, right? Such all things you already learned, you already seen all these things. You already learned in your previous stages. Am I right, guys? Tell me, all of you. Even though if you learned such things in the previous stage, just I will brush up such things. You know why? Maybe sometimes without having any proper knowledge on the basics, you may not understand the advanced things, even though there is no relationship exist in the current chapter. What we are going to learn, that is dissolution of partnership firms. It doesn't have any relationship, but still I want to take it for the discussion. Okay, but I am not spending much time on that because we have to see so many other issues. We are having so many other issues. That's why I don't want to put much time on explaining the things on this. Okay, sir, now currently what we are doing, what we are seeing, just currently what we are seeing, now. So to be learned issues, first, without explaining all those things, first you should know what we are going to learn, right? So that's why I'm telling. Here you are going to learn dissolution of partnership firm. Sir, what is the difference between dissolution of partnership and dissolution of partnership firm? What is the difference? Okay, the difference is, in case of dissolution, just a moment. Okay, I'll change like this. So what is the difference? What is the difference, sir? In case of dissolution of partnership firm doesn't comes to an end. Only the existing partnership agreement comes to an end, and new partnership agreement will be entered among the partners. There is a continuation of the firm. Firm is not closed. But in case of dissolution of partnership firm, both the relations among the partners is going to end, along with the partnership firm is also going to end. It is a simple closure of the partnership business. It is a simple closure. How in case of amalgamation, the selling company will close its books of account, in the same way, in case of dissolution of partnership firm, simply it will close the entire partnership firm books. But in case of the dissolution of partnership or reconstitution of the partnership, the existing agreement is going to close, but the partnership firm still continue with the new terms and conditions agreed among the partners. Do you understand first this difference, all of you? So the things what you learned in the past, you never come across with the situation of dissolution of partnership firm. Now such a situation arise, what is the accounting treatment we are going to see as a part number 1. But you already seen what is the accounting treatment. If the existing relationship among the partners change due to change in profit sharing ratio, due to admission of your partner, due to retirement of the partner, due to sudden death of the partner, you would have already seen in your foundation or in other curriculum vitae as maybe. Okay. Now, apart from all these things, let me start with from scratch. Partnership is altogether, it is a different type of organization from company. Partnership is an agreement entered between 2 or more persons. A partnership is an agreement. That agreement may be in written form or maybe in oral form. Maybe in written form, maybe in oral form. That is different case. Because as per Partnership Act 1932, even oral agreements are valid. So that's why you can just decide yourself, then you can start the business of partnership without having putting any terms and conditions on the paper. But in practically, such things are not possible because no one have belief on other. So that's why in generally people are willing to put such terms and conditions on the paper. So that's why partnership is an agreement entered between 2 or more persons. Maybe there is no necessity to conduct all such persons. Maybe there is no necessity to conduct the business activities by all such persons. Maybe some of them can acting, maybe some of them conduct the business, maybe remaining members can act on behalf of such persons. That means why I put such point as well. Maybe some of the partners only the active partners, maybe some partners maybe the sleeping partners. That is also possible. But they are entering in such agreement with sharing of profit and losses in a particular ratio. That should be required. So to put it simply, partnership is an agreement entered between two or more persons, and they will sharing their profits or losses in an agreed ratio, and some of the partners may conduct the business and some of the partners may acting for the remaining people, then such particular agreement we can technically call it as partnership agreement. Okay, now once after constitution of partnership firm, the entire terms and conditions is depending upon the partnership deed. After constitution of partnership, the entire terms and conditions agreed among the partners is depending upon the partnership deed. What it is the partnership deed, sir? What it is altogether? Now, partnership deed contains how we are going to distribute the profit sharing ratio. Is there any partner is eligible? Is there any partner is eligible for interest on capital? Certain capitals contributed by the partners, right? Maybe such partners may not involve into the business, but maybe sometimes they contribute the huge capitals. So that's why altogether they are definitely awaiting for the interest. They are definitely expect some interest, because on behalf of investing in such partnership firm, if they would invest in any other business, they will get interest apart from profits. I'm talking apart from profits. Yes, if such term is there under the partnership deed, then partnership should pay interest to such capital holders. Now, if any right is given by the partnership deed to the partners to withdraw cash from the partnership, then they can withdraw, which is technically known as drawings. So that's why partnership firm can also have a right to charge interest on drawings. Partnership firm can collect interest on the drawings made by the partners. Maybe if any partner who is in generally active, he will come to day to the office, then while compared with other partners, we may offer certain salary. Partner salary is also allowed to some of the partners. Maybe some partners is in the processing of grabbing the clients. Maybe the major sales of the entity is only generated due to such partner. He is having very good contacts. At that point of time, we may offer certain commission to such partner. Do you understand what I'm telling? All such terms among the partners is completely depending upon the partnership deed. Why I mentioned that point, the accounting treatment is also depending upon the terms and conditions entered among the partners. Simply to say, the entire accounting treatment in case of partnership books is depending upon the terms and conditions agreed in the partnership deed. That's why the accounting treatment is not in structurized way. Depending upon the terms, you need to provide the accounting treatment. Do you understand that part first of all? Okay. Now, sir, we constituted the partnership. We entered into the agreement. We put all such terms and conditions into the partnership deed along with the profit sharing ratio. Then 1 year over. Now, what I should need to do? We should need to prepare financials. Am I right? We should need to prepare financial statements. Sir, how to prepare financial statements? Can I follow Schedule 3 format? No. So Schedule 3 format is not applicable for partnership type of organizations. They will simply prepare in the horizontal format. In the horizontal format of P&L, that is T-shaped P&L, just they will simply prepare. Now, to know the performance of the partnership, they will prepare profit and loss account. Super. For example, if they will get net profit after tax, for example, if they will get net profit after tax, this net profit, they may not directly distribute among the partners. This net profit, they may not directly distribute among the may not directly distribute among the partners. Do you know the reason? This net profit is derived only due to the operating activities and investing activities and financing activities of the enterprise. No doubt about it. This net profit, they are generated from all such activities. But out of such profit, they need to pay interest on capital, they need to pay partners salary, they need to pay partners commission. Do you agree? They need to incur interest on capital, partner's salary, as well as partner's commission. Why, sir? You can charge it in the profit and loss account itself. Then the remaining net profit you can directly distribute among the partners. That is not possible. The reason is as per the Act, as per the Partnership Act 1932, if the partnership firm attained sufficient profit to discharge the expenses like interest on capital and partner's commission and partner's salary, then only there is a obligation to pay such amounts by the partnership firm. Do you understand? That means if the company is not getting any profits, then there is no need to pay salary, no need to pay commission, no need to pay interest on capital. That's why first you should need to check whether we are achieving the profit or not. After that, if the profit is sufficient, then we will make payments to different partners other than profits distribution. Such concept is known as charge against profits, and appropriation of profits. That concept is technically known as charge against profits and appropriation of profits. Now all of you concentrate here. So in profit and loss account for the financial year, I prepared the profit and loss account. So after preparation of profit and loss account, sir, still we not yet entered in the current chapter. I already told you. So first I am brushing up your basics. So after preparing the profit and loss account, you will end up with profit or loss, whatever the case may be, right? This is net profit or loss. Okay. So such net profit or loss from which what you should need to do, you should need to pay, you should need to incur interest on capital, partner's salary, partner's commission, or any other remuneration which is applicable to the partners. So now, which is net profit, then here you will get net profit brought down. This is net profit brought down. Am I right? So from this net profit brought down, you need to incur interest on capital, partner's salary, partner's commission. These all are expenses. The income is interest on partners drawings, which is an income. Such income is also not included in the P&L. Actually, after knowing the net profit only, you can do all such things. That is interest on partners drawings. You should need to enter. You should need to enter. So you should need to enter all such things. Okay, right? I entered all such things, right? Then after that, what should I need to do, sir? Now, after paying such things, still if partnership firm contains any profit, such profit you can distribute among the partners. You can distribute among the partners, which is distribution of profits. Now you can distribute such profits among partners, guys. Just a moment, 1 second. Sir, do you know this account is known as, after knowing the net profit, we are distributing different payments among the partners, right? Such distribution is known as profit and loss appropriation account. Profit and loss appropriation account. Simply, I can call it as P&L appropriation account. Simply, we can call it as P&L appropriation account, guys. This is nothing but P&L appropriation account. Consider it. This is nothing but profit and loss appropriation account. So that means certain items may be charge against the profits. Now, if you write any expenditure which is known as charge against the profits, charge against the profits. If you write any items in the profit and loss account which are known as appropriation of profits, appropriation of profits. Sir, actually both are expenses. Both are expenses only. Both are expenses to the partnership firm. But certain expenses may be charged against the profits, but certain expenses may be appropriation out of the profits. I can give certain examples. Sir, charge against the profits. For example, I am paying interest on partner's loan. Our partnership firm took loan from the partnership firm. This is apart from capital. There is no relationship with respect to the capital. Apart from this capital, we are taking loan from one of the partner. So as per the loan agreement, we need to incur certain interest expenditure. Then such interest should be treated as an expenditure, need to be payable to the partner irrespective of the fact whether the partnership firm get profits or losses. Do you understand? So partner will not take risk on such loan. So you can treat that loan is altogether. If you took such loan from an outsider, how you will treat, in the same way you can treat that loan as well. So that's why interest on partner loan, we can treat it as charge against profits. So remaining all salaries paid to the employee, electricity expenditure, purchases made, okay, rental expenditure incurred, all such expenditures are in generally charge against profits only. So that's why I'm not mentioned here. Only with respect to the partnership, the special point only I'm mentioning. Okay, sir, we understand. Now, once you get the profits, such profits should be distributed among the partners. That means simply such profits you should need to add to the partner's capital. Simply you should need to add to the partner's capital accounts. So whenever you are using the word capital, now capital once coming, capital we can broadly categorize into two types. Consider guys, capital we can broadly categorize into two types. Just here I am writing. Capital accounts can be maintained in two ways by each and every partnership firm. They can adopt any method. Both the methods are correct only. Number one, fixed capital method. Fixed capital method. And another method is fluctuating capital method. Fluctuating capital method. In case of fixed capital method, capital account represents by maintaining two different types of accounts. One is capital accounts. Another one is current accounts. One is capital accounts. Another one is current accounts. Sir, in capital accounts, what we will write, in capital accounts, we will write introduction of capital, introduction of capital. Okay, just a second. I'll write, I don't have space. I'll write introduction of capital or further introduction of additional capital. You will write through capital accounts. Remaining all adjustment, I will made through current accounts. Sir, what are all the remaining all adjustments? For example, you need to pay interest on capital to the partner. What is the journal entry, guys? Actually, interest on capital is an expenditure, right? Expenditure to creditor. The entry expenditure to creditor, that is interest on capital account data to creditor, means to whom I should need to pay? Partner. That is interest on capital account data to partner's capital account. So interest, the entry at the time of incurring interest on capital is interest on capital to partner's capital. But if you maintaining the fixed capital method, you should write interest on capital account data to current account. That is interest on capital, partner's salary, partner's commission, partners profits of partnership firm. Next, interest on drawings. Interest on drawings. Such all things need to be adjusted through current accounts only. Such all things need to be adjusted through current accounts only. That means except introduction of capital and further introduction of capital, remaining all adjustment will need to be made with current accounts only. Now, in case of fluctuating capital, all the adjustments, sir, introduction, further introduction, interest on capital, interest on drawings, partner salary, partner's commission, all adjustments should need to happen through capital accounts only. Only here capital accounts are only maintained. Here only capital accounts are maintained. That's it, guys. So that is two different types of methods of capital in generally maintained by each and every partnership firm. Now still not at over. My discussion is not at over. No consider here. Okay, sir. Partners distributed their profits. Partnership firm ultimately distributed profits among the partners. Now what should they need to do? They should need to prepare balance sheet, right? They should need to prepare finally balance sheet. Yes. You know, we are not following schedule 3. I already told you. Sir, now in case of balance sheet, they will write all assets. That is, I can put it as all sundry assets, not an issue. They will record capitals of different partners. Capitals. If they followed fluctuating capital, they will only maintain capitals. If they followed fixed capital methods, they will record capital as well as current. Just for the time being, I'm recording, just I am assuming I'm following the fluctuating capital. So that's why only capital accounts are maintained. For example, 3 partners are there, A, B, C. Am I right? Next. Any partner's loan from partnership firm took any loan from the partner, you can represent separately. That is partner's loan. Let us assume we took loan from A, partner loan A. We took loan from A. Okay. Next, remaining all liabilities we are going to record here. All liabilities. Then you will get total of the balance sheet. Now here, you should need to understand one thing. Capitals of the individual partner, we need to derive before preparation of the balance sheet by preparing separate capital accounts. How we are getting the capital account balances? We need to prepare capital accounts separately. Sir, the preparation of capital accounts is in generally will start with opening balances of capitals, interest on capital, anything is there, we will add. Interest, partner salary is anything is there, we will add. Sir, if partner's commission is there, we will add or we will reduce here for interest on capital and a partner's salary and partner's commission. We will reduce partnership from expenditure. Okay, sorry. Okay, if there is any interest on drawings is there, we will reduce. Sir, if you distribute any profits among the partners, you will add to the partner's capital. Then you will get the closing capitals. Just I'm mentioning for the time being, please all of you concentrate. If it is partners capital accounts, there are no current accounts. Let us assume I am following the fluctuating capital method. How in generally we need to prepare, guys? How in generally the partners capital accounts need to be prepared? So just you can assume this is a partner's capital account. So for the time being, only 2 partners are there. Let us assume only 2 partners are there. Okay. All right, concentrate. So we'll start with opening balance. Then appropriation items one by one. For example, in the current year, I will start with the chronological order. In the current year, if they made drawings first, if they made the drawings, what is the journal entry? So for the purpose of withdrawals, for drawings, the entry is drawings account data to partners capital. So I need to write here drawings, two drawings, anything is there. Yes. So due to drawings, the capital account is reduced now. If it is added, it should be credited. Otherwise, it should be debited. Okay. Next, in the appropriation, interest on capital to partners capital, right? So interest on capital, what I should need to do? Sorry here. Entry interest on capital to partners capital and a partners capital law. Sir, earlier might be I used wrong words. Please ignore me. What is that? Sir, due to interest on capital, partners capital is increased, but due to interest on capital, current year partnership firm is decreased. So in my mind, actually, P&L was, I explained it right. I am using the same terminology. I'm so sorry. So due to interest on capital, due to partners commission and partners salary, the partners capital got increased. Partners capital got increased. Due to interest on drawings and drawings, the partners capital got decreased. But due to partners salary, interest on capital and partners commission, the current year profits got decreased. Due to interest on partners drawings, the current year profits got increased. That is the thing. Okay, hope you know all such things. But earlier, I might use the wrong words. Maybe in my mind, I correctly thought. But anyway, come back here. So now interest on capital. Now you can add here by interest on capital, by partner's salary, by partner's commission, right? Next, interest on drawings. You should reduce. Reduce means debit. Then you should distribute the profits among the partners now. That is by P&L appropriation. By P&L appropriation. Then you will get closing balance. That is closing balance. That is if the balance of credits is more than the balance of debits, which is two balance carried down, which is a positive balance, you will get it as a balancing figures. Now this closing balances you need to represent under the balance sheet as a closing capitals. Do you agree, all of you? So this is how in generally you are preparing the financial statements of a typical partnership firm. You know such thing, that is continuation of the business. Now, if at any point of time, now during such continuation, if at any point of time, reconstitution of partnership or dissolution of partnership occurred, then what are the adjustment I need to made? Now come below, all of you. Till now, I not yet started the dissolution of partnership at all. Okay. I'm talking till now, I not yet started the dissolution of partnership at all. After seeing the dissolution of partnership, we have to know about the dissolution of partnership firm. That is actually the main topic. Now, first I'm seeing dissolution of partnership. First I'm seeing dissolution of partnership. Concentrate. Sir, in case of dissolution of partnership, you know, either change in PSR or the admission of the partner or retirement of the partner or death of the partner, anything we can call it as dissolution of partnership. In case of dissolution of partnership, the following adjustment need to be done. The following adjustment need to be done. What are such adjustments, sir? What are such adjustments? Such adjustments are, you need to check new profit sharing ratio and also calculate sacrificing and gaining partners. Also calculate sacrificing and gaining partners. Sacrificing or gaining partners. So simply, you should calculate the new profit sharing ratio and you should need to identify which partner is sacrificing, which partner is gaining, and how much he is sacrificing, how much he is gaining. We need to check. That is the first and foremost adjustment. Next, the second adjustment is we need to make. The second adjustment is goodwill adjustment. Goodwill adjustment. The third adjustment is reserves and surplus. Reserves and surplus. The fourth adjustment is revaluation. And the last adjustment is capital adjustment. So, right, consider all of you here. In case of dissolution of partnership or reconstitution of partnership firm, the following adjustment needed. What are such adjustment, guys? So you have to find out the new profit sharing ratio. Apart from that, you need to identify sacrificing and gaining partners as well as their shares. Then you need to adjust for goodwill. You need to adjust for reserves and surplus. You need to adjust for revaluation. You need to make it, if at all there, then you need to provide capital adjustment as well. Okay, now concentrate one by one. Let us discuss one by one. Sir, whether the reconstitution is due to change in PSR or maybe due to admission of the partner, maybe due to retirement of the partner, maybe death of the partner, whatever the case may be, these all adjustments are necessary, right? In all the cases, all adjustments are necessary. I can't take one by one reconstitution and I can't apply this adjustment. So I will tell all the adjustment in common parlance. I'm mentioning one more time. I will check all the adjustment in common parlance. This is applicable in all types of reconstitution. In case of change in PSR, in case of admission, in case of retirement, in case of death, in all the cases, by seeing in bird's eye view, I'm telling the adjustments. Now, sir, let us assume partners A and B are there. Partners A and B are there. One more partner, let us take C is also there. Partners A, B, C are there. So first type of reconstitution, existing PSR, the existing profit sharing ratio is there, which is 1:1, 1:1, which is the existing. And the new profit sharing ratio, just they want to make it as a 3:2:1. This is the new profit sharing ratio, just they want to change among themselves. Now this leads to the reconstitution of partnership firm. Now what you should need to do first, new profit sharing ratio directly given, which is 3:2:1, which is the new profit sharing ratio directly given. Then you need to identify sacrificing and gaining partners. What is the meaning of sacrificing partner? After changing the profit sharing ratio, who lose his share is known as sacrificing partner. After changing the profit sharing ratio, who gained his share among the profits is known as gaining partner. Now the existing share is 1/3, 1/3, 1/3. The new share is 3/6, 2/6, 1/6. You can check existing minus new, or you can check new minus existing. That is all depending upon you. I will not interact at that point of time. So you can do it existing minus new or new minus existing, but accordingly only you can check the sacrificing and gaining partner. If I take existing minus new, let us assume E minus new, then 2/6, 2 minus 3 minus 1/6. You can multiply all existing ratio with 2. 2/6, 2/6, 2/6, right? 2 minus 3 minus 1/6. 2 minus 2, here 0. Here 2/6 minus 1/6, here 1/6. Am I right? Now by this, if existing minus new is negative, means he is gaining partner. Sir, new is more than existing. Am I right? If existing minus new is positive, means is sacrificing. Or if you want to do, you can do in other way as well. If you want to provide new minus existing, that is also possible. Then here positive will come, then here negative will come. Am I right? Now, if it is positive, then he can call it as a gaining partner. If it is negative, he can call it as a sacrificing partner. That is up to you. But just now I identified A is a gaining partner and C is a sacrificing partner. Am I right? Okay. Sir, after this, what I should need to do, sir? Now, the first step is over. Now, goodwill adjustment. What is the adjustment of goodwill? Now, all of you Please concentrate things related to the goodwill. You know, we completed already accounting standard 26. There is no scope as per AS 26 to record internally generated goodwill into the books of accounts. Am I right? Why? So to recognize any intangible asset as per AS 26, it should be identifiable, non-monetary, and having no physical substance. But which is non-identifiable, non-monetary asset. So that's why goodwill will not be, I mean, not the entire goodwill, internally generated goodwill. Sorry, internally generated goodwill. I'm only talking about internally generated goodwill should not be recorded into books of accounts. If the goodwill is a purchased goodwill, it may be recorded in the books of accounts. There is no doubt about it. But in case of the partnership firm, due to huge experience of the partners or maybe their brand loyalty, most of the times they have certain internally generated goodwill. Goodwill is nothing but their profits. So the profit achieving capability of the entity is nothing but goodwill. Sir, how to calculate goodwill of the firm is the first question. How to calculate the goodwill of the firm is the first question. Maybe different methods you would already learned in your lower sessions. That is, goodwill can be calculated by applying normal profits, or goodwill may be calculated based on super profits, or maybe goodwill can be calculated based on capitalization method, or maybe goodwill can be calculated based on present value of money concept. But I don't want to put it here. Just the basic concepts are net profits, sorry, normal profits, super profits, capitalization method. Am I right? Sir, in case of normal profits, how to calculate goodwill? In case of normal profits, how to calculate goodwill? We will take certain future profits. Just we will multiply it with number of years for which such profits are going to continue. Simply, goodwill is equal to average normal profits into number of years of purchase. Why you are taking average here? Just you are thinking that in future our profits trend will be like that. For example, in the next coming 3 years, our profit will be 10 lakhs, 12 lakhs, 15 lakhs. So then which profit can I consider right now? You can consider the average profit, but you can assign the weights as well. 1, 2, 3. So like that, you can assign the weights as well. Okay. So according to the weighted average net profit also, you can consider, that is not an issue. In case of super profits, what is the valuation mechanism? Super profits into number of years of purchase. How to calculate super profits? Super profits is nothing but excess of the normal profits. So super profits is the difference between, just here I am writing, concentrate. Super profits is the difference between average future maintainable profit minus normal profit. What is your entity profit? That is your average future maintainable profit. If you can compare it with the normal profits, then you will get super profits. If it should multiply with the number of years of purchase, then you will get goodwill under super profits method. So I already told you, I cannot tell each and every issue in pinpoint. I am already discussing all the issues in a broad manner. Okay. So hope you already know such all things. Just I am remembering such issues again. That's it. In case of capitalization method, what is the formula for goodwill? The formula is average future maintainable profit divided by normal rate of return. I mean, just a second, just a moment. So just a moment. Here the goodwill calculation is actually actual capital employed minus normal capital employed. This is the formula actually. Normal capital employed. Okay. Capital employed is nothing but assets minus outside liabilities. But how you will get normal capital employed? Earlier I wrote now the formula average future maintainable profits divided by normal rate of return. is the formula for normal capital employed. If you compare actual capital employed with normal capital employed, then you will get goodwill in case of capitalization method. But most of the times we are using either normal profits method or super profits method for all our problems in generally. Okay, but if it is the capitalization method like this, we need to calculate. Sir, how it is coming? Can you please explain, sir? I can't tell all these things at this point of time. Lot of issues I need to discuss. And one more, if you really see, this is not my cup of tea. You already learned it. And this is my cup of tea. Okay, now come here. Now the point is, in case of reconstitution of partnership or dissolution of partnership, why you should need to adjust the goodwill? So every student have that question in his or her mind. So the reason, now there is a change in profit sharing ratio in 3:2:1. Goodwill is nothing but which is related to the profit earning capability of the entity. Profit earning capability of the entity means we are already having certain goodwill, means such goodwill should be need to distribute among the old partners, right? In old ratio. From now onwards, if any goodwill arises in the future, such goodwill we can be distribute in the old, such a goodwill can be distributed in the new profit sharing ratio. The goodwill arised up to the current period belongs to the old partners in old profit sharing ratio. Goodwill arised after reconstitution should belongs to the new partners in new profit sharing ratio. That is the justice, right? So that's why the existing goodwill first you need to find out. Such existing goodwill you can distribute among the existing partners in their old PSR. That's that point you should need to do. Now consider all of you. Now after finding the goodwill, what I should need to do? I should raise the goodwill, because which is an internally generated goodwill now, still no not recorded in the books of accounts now. So that's when now I raised the goodwill, which is an unrecorded asset. Now I recorded such asset, which is asset account debtor, goodwill account debtor. Now you should make credit to different partners, that is to A's capital, to B's capital, to C's capital, which is the rising of the goodwill. Okay, why you are rising, right? Why you are rising? Till now, which was not recorded, but right now I want to distribute goodwill arised till now in my books, till now by the business. Just I'm going to distribute among the partners. In future, if any goodwill we are deriving, such goodwill we can distribute in the new profit sharing ratio. That's why I am just simply distributing such goodwill among the partners. Let us assume the goodwill of the partnership firm is 60,000. So the total goodwill of the partnership firm, just now I checked, which is 60,000. Sir, 1/3, 1/3, 1/3 means for each and every person he is getting 20,000, 20,000, 20,000. Now, the next question, the next question coming into my mind is, sir, which is internally generated goodwill, na? Which is internally generated goodwill, na? But should not be recorded in books of accounts, na? But you are recorded here, right? But you are recorded here, right? So that's why, as per the provisions of AS 26, we should not record the internally generated goodwill. That's why I will nullify such goodwill. I will nullify such goodwill. I'm nullifying, right? 60,000. But the nullification or the set off should be happen in new profit sharing ratio. In new profit sharing ratio means that is only to A's capital and B's capital only I will give. A's capital and B's capital only I can give. Then A will get 30,000. B will get, sorry, A and C right here. A and C, yes, not for B. Because B is having how much? Yeah, sorry, ABC, total 3. Total 3 in the new profit sharing ratio. A's capital, B's capital, C's capital. In the ratio, can you please check here? Here it is there. 1/2. 1/2 means 30. Here 2/6. 2/6 means 1/3, which is 20,000. Next here 1/6. 1/6 means here 10,000, which is the new profit sharing ratio. So if you check, which is old PSR. If you check this, new PSR. Now you may have a doubt. Sir, for rising, you are rising in the old PSR, but for cancellation, you are cancelling in the old new PSR. What is the reason, sir? The impact is very simple. Sir, due to change in profit sharing ratio, what happened actually? What happened actually? C sacrificed and A gained. So if C given, sorry, C sacrificed, A given, A gained, right? So the gaining portion, if it is compensated to C, it is more than enough, right? Then no one is having any problem, right? No one is having any problem. Partner A is gaining and partner C is sacrificing. If I compensate the gaining portion by the gaining partner to the sacrificing partner, then C will not bother about anything. So for B, there is no issue. Before profit sharing ratio 1/3, after profit sharing ratio is also 1/3. He is very much stable. He is very much stable and neutral. Okay. Now, the same thing happened here. After passing these two entries, what is the net impact? You know, just I will write the impact of these two entries here. Please concentrate. This is the net impact. So the net impact is, one thing is sure, goodwill raised, goodwill cancelled. Next, A's capital 20,000 credit, A's capital 30,000 debit. So net debit is capital account debtor. Net debit how much? 10,000. B's capital 20,000 credit, B's capital 20,000 debit. No impact, just nullifying to each other. C's capital 20,000 credit, C's capital debit only 10,000. So net credit to C's capital, which is 10,000. So, oh my God. So due to rising and cancellation, on behalf of that, I can pass directly this entry. Automatically goodwill is adjusted. What is the goodwill adjustment? Adjustment of goodwill meaning is nothing but, sir, the gaining partner should need to compensate the sacrificing partner to the extent of the goodwill he is foregoing by the sacrificing partner. Now, here, who is the sacrificing partner? C. We are compensating. C's capital credit means we are compensating. Who is the gaining partner? A. That's why A's capital debited. So, which is known as adjustment of goodwill. Adjustment of goodwill without rising and cancelling the goodwill, or we can call it as adjustment of goodwill through partners capital accounts. Do you understand, all of you? So which is known as adjustment of goodwill through partners capitals, or adjustment of goodwill without rising and cancellation of goodwill. So if you pass the entries, this is also correct only. This is only the net impact. You can pass like this also, but you are rising, then you should cancelling. This is nothing but adjustment of goodwill. How to calculate goodwill we've seen. How to adjust the goodwill during the process of reconstitution also we've seen. Now coming to the reserves and surplus, all of you. Sir, why the reserves and surplus adjustment need to be discussed during the process of reconstitution? Again, the same logic. Sir, reserves and surplus is nothing but the profits or the worth of the partners. Such reserves and surplus earned in the past. That's why we need to distribute such reserves and surplus in old profit sharing ratio. As like how you are goodwill, distribute in the old profit sharing ratio first. In the same way, the existing reserves and surplus should need to be distributed among the old partners in old PSR. It's very simple. The adjustment is existing reserves and surplus distribute among old partners in old PSR. That's it. Such a simple adjustment. That means reserves and surplus accounted are to partners capital account. Over. Now coming to the next adjustment, which is revaluation. Please, all of you come here. Next, I'm talking about revaluation adjustment. Now you can thought in the same way, guys. Sir, our existing assets are not showing at fair value. Those all are at book value. If I took land, land we purchased long back at the rate of 1 lakh, but in the outside market, the land is at the rate of 50 lakhs. So almost 49 lakhs increment is there, right? So which is nothing but revaluation profit. So one of the revaluation adjustment is nothing but revaluation reserves and surplus only. How you are distributing the reserves and surplus among the old partners and old PSR. Now you can find out the revaluation impact as well. Now you can find out the revaluation profit or the revaluation reserve. Such revaluation reserve also you can distribute among the partners, whether it is profit, whether it is loss. That means you need to find revaluation profit or loss by preparing revaluation account, through preparation of revaluation account. So after knowing the revaluation profit or loss, such revaluation profit or loss need to be such revaluation profit or loss need to be distribute among old partners and old PSR. Am I right? But due to which what happened, the existing assets and liabilities values are revalued. All are revalued. That's actually correct process. Revaluation should be needed. But sometimes the partners want to decide that don't go for revaluation. Let us show the historical figures only. But revaluation adjustment need to be happen. Certain times partners just thought that, sir, if you go for the revaluation adjustment by showing the revalued figures, then which is very simple process. You need to find the revaluation profit or loss. You can distribute such revaluation profit or loss among the old partners in old PSR. That's over. Scenario is over. But if partners decided that partners decided not to show revalued figures in books of accounts. If partners decided not to show revalued figures in books of accounts, then what I should need to do, sir? Then how the revaluation adjustment need to done? Please, all of you, remember the concept of goodwill. Sir, as per AS 26, goodwill should not be recorded in books of accounts, but goodwill adjustment need to be done. Adjustment of goodwill through partners capital occurred or not. In the same way, adjustment of revaluation can also occur through the partners capital accounts. I mean to say, now just I am telling for the time being, let us assume revaluation profit is there. Let us assume revaluation profit is there. How the revaluation profit will occur? All the assets are increased. Now you are having revaluation profit. So if it is upward revaluation, the entry is assets to revaluation. Let us assume liabilities, there is no revaluation occurred, the same values we are continuing. Assets account data to revaluation, which is the revaluation profit, right? Now such revaluation profit should be distributed among the partners. How you can distribute the revaluation profit? The entry is revaluation account data. The entry is, now the revaluation reserves can be distributed among the old partners in old PSR. Old partners in old PSR. Okay. That is actually if revalued figures want to show in their books of accounts of the balance, in their books of accounts or balance sheet, whatever the case may be. But if partners decided not to show such revalued figures in books of accounts, then what I should need to do? The revaluation impact should be nullified. The revaluation impact should be nullified means here revaluation profit, right? Now what I should need to do? Revaluation account should be credited. Earlier debited, now credited. Now new partners in new PSR, I should need to debit. New partners in new PSR, I should need to debit. With this, what happened? Revaluation account closed. Then new partners, new PSR to old partners, old PSR means like this it will come. Like this it will come. The entry is gaining partner capital account data. Gaining partner capital account data. As like here, who is the gaining partner? A. To sacrificing partner capital account. To sacrificing partner capital account. That means without impacting the revaluation, we can simply adjust the revaluation through partners capital accounts. Sir, how much, sir? How much I can put? Gaining partner share. Let us assume The revaluation profit, just for the time being, I'm telling you, let us assume the revaluation profit is 50,000. For the time being, you can assume. Now, with how much amount I can put this entry, sir? Now, 50,000 is the total amount. Out of such 50,000, how much is gained by a 1/6? Let me put the correct, I mean, very simple figure for calculation, not 50,000. I'll put it as 36,000. That's the better thing. Concentrate. Now 36,000. Sir, out of such 36,000, how much gained by a 1/6? 1/6 into 36, which is 6,000. How much sacrificed by C? 1/6. 36,000 to 1/6, which is also 6,000. So now the moral of the story is, if partners don't want to record the goodwill into books of accounts, or if the partner don't want to show the revalued figures in the books of accounts, the adjustment is same. That is, gaining partners capital account to sacrificing partners capital account at their respective sacrificing or gaining shares. Do you understand, all of you? Okay. So the next issue, guys, revaluation adjustment is also over. The next issue is capital adjustment. Sir, capital adjustment is not a mandatory adjustment. If partners want to adjust their capitals, then only we need to adjust. If partners decided to adjust their capital, then only we need to adjust. Sir, what is the meaning of capital adjustment? Capital adjustment, nobody can tell. I mean, sir, this is the capital adjustment. It is altogether depending upon their terms and conditions. For example, partners decided like this. So after completion of all these things, our capital should be in profit sharing ratio. The partner's terms and conditions is, after completion of all these adjustments, our capital should be in profit sharing ratio. What is the profit sharing ratio? In new profit sharing ratio, 3:2:1. Let us assume that is the terms and condition for the time being. So just I'm writing what is the terms and conditions agreed among the partners with respect to the capital. Capitals need to maintain in PSR. So this is the term and condition. Let us assume. Now, after all adjustments, partners A, B, C. Partners A, B, C. How the capitals are there? Let us assume the capitals are there. A for 50,000, B for 60,000, and C for 55,000. Let us assume like this partners capitals are there. Or let me put the simple figure here. Okay, 50, 60, 40,000. That is better thing. Okay, like this partners capitals are there. This is after all adjustments. After all adjustments. Now, is it in profit sharing ratio? 5:6:4. But how I required in profit sharing ratio, which is 3:2:1. Now you can club the total first. The total is 50 plus 60, 1,10,000, 1,10,000 plus 40. 1,50,000 is the total. Total amount is 1,50,000. Now the required capitals are 1,50,000 into 3/6. 1,50,000 into 3/6 means 75,000. 1,50,000 into 2/6 means 50,000. 1,50,000 into 1/6, which is 25,000. Now, if you observe here, the required capitals are 75, 50, 25. But the existing capitals are 50, 60, 40. What should I need to do? From 50 to 75, I should need to introduce 25,000. I should need to introduce. A, I will ask to introduce 25,000. B, I will ask to withdraw 10,000. C, I will ask to withdraw 15,000. This is nothing but capital adjustment. The red portion numbers are there now. That means A's capital should be, A should need to be introduced bank to A's capital. B should withdraw B's capital to cash. C should withdraw C's capital to cash. Such thing is known as capital adjustment. Do you understand, all of you guys, what exactly the meaning of capital adjustment is? Okay. So maybe The capital adjustment is in different types, guys. Just I provided a small example for capital adjustment. Okay, hope you understand. Now, till now we discussed about dissolution of partnership, right? Whenever reconstitution is occurred. Now, whether in case of change in PSR, whether at the time of admission of the partner, whether at the time of retirement of the partner, whether at the time of death of the partner, you should consider all these adjustment. You should consider all these adjustment. Then you can prepare your capital accounts. Then such capital accounts need to be shown after reconstitution at the time of preparation of balance sheet. Do you agree? Now, how the problem will be there as per your previous knowledge? The partnership firm is going to continue their business. Suddenly reconstitution occurred. Then they asked to prepare the financials. Up to such part only you learned how to prepare the financials. Then the continuation of the business you should need to apply. Sir, if it is continuation, how the partner's capital is there, you already seen. Now, if suddenly reconstitution occurred, then different entries you should apply. Now, the impact of such entries also you should give to the partner's capital. Am I right? Then after completion of such issues, you need to prepare the balance sheet. Up to this part, you would already learn it in your either foundation or either in your graduation, guys. Okay. One more important concept just I want to tell you. I don't want to put it in detailed manner again. You know the joint life policy concept, right? JLP. So just I'm putting here for the time being the concept of JLP. What is the concept of JLP, sir? Sir, joint life policy is a insurance policy. Joint life policy is an insurance policy. Taken by whom? Insurance policy taken by partnership firm on lives of all the partners jointly. So joint life policy is an insurance policy, which is also a life insurance policy. I already put here, right? Life of. So joint life policy is a life insurance policy taken by partnership firm on the lives of all the partners. I mean to say, if any partner died suddenly, then the sum assured on such joint life policy received by the partnership firm. So on such sum received, who have right? All the partners will have right. On such sum assured, all the partners have right in their profit sharing ratio. So whenever a partner died, then definitely partnership firm will receive sum assured from the insurance company. On such sum assured is available for distribution among all the partners. So to put it simply, at the time of death, sum assured will be distributed among all partners in profit sharing ratio. That means bank account data to partners capital accounts. Such a simple journal entry. Bank account data to partners capital accounts. You know, some partnership firms may show JLP account in the books of accounts. Some partnership firms may not show the JLP account in the books of accounts. Like that, they will maintain. Am I right? You would already learn different types of maintaining the JLP account. So for me, there are only two things are there. For me, just here I am explaining only two things. What are that? If JLP exists in books of accounts, that means JLP is maintained in books. I'll write like this. Okay. If JLP is maintained in books of accounts, and another one is if JLP not maintained in books of accounts. If JLP not maintained in books of accounts. So for example, if JLP maintained in books of accounts, now at the time of receipt of sum assured, at the time of death, what is the journal entry, sir? If JLP not maintained in books of accounts, now at the time of death of any partner, if you are getting any amount, what is the journal entry, sir? Now concentrate. If the JLP is not maintained, then you are receiving the amount, right? Bank account debtor. It should be distributed to partners. Partners capitals, capital accounts, old profit sharing. I mean, simply only after death means only profit sharing ratio. Profit sharing ratio. You should need to distribute. If JLP is maintained in books of accounts, let us assume, consider all of you. Sir, in my books of accounts, JLP balance is there at 1 lakh. But right now, the sum assured I am getting, the sum assured I am getting it as a 1,50,000. Now you are getting 1,50,000, right? Bank account debtor. How much you are getting? 1,50,000. Am I right? To asset is how much? 1 lakh only. You can simply thought that, sir, we are selling the asset, 1 lakh asset, but we are getting 1,50,000. How much profit you are getting? Excess 50,000. Such profit, you can make it transfer to partners capital accounts, which is 50,000. Now you can put it under profit sharing ratio again. That is the entry. That's very simple. At the time of creation of JLP means to the extent 1 lakh, you already would transfer to partners capitals previously. So that's why now the excess amount of 50,000 only you need to transfer to partners capital accounts. You can simply thought that now you are selling such JLP in the outside market. Now, if you sell it, you are getting 1,50,000. Do you understand what I'm telling? Now, bank account are to JLP to partners capital. Now you are total getting 1,50,000. So 1 lakh is goes to the JLP asset cost. Then the remaining 50,000 you can treat it as a profit. Such profit you can simply transfer to the partners capital accounts. Such a simple concept, guys. So sometimes the JLP may be surrendered, not happen death, but partnership firm required money. So a very tight liquidity position, then partnership firm required money. Now, if you can surrender, how much amount you will get, sir? Sir, if I surrender, let us assume I will get 50,000. Now, such 50,000 you can distribute among the partners. That's it. Such 50,000 you can distribute among the partners. If JLP is not maintained, bank to partners capital account. If you maintain the JLP in the same way, if you are getting 50,000, right? Bank account debtor to JLP, sir, in books of accounts, which is 1 lakh, sir, but I'm only getting 50,000, sir. Then 50,000 loss, such loss you can give into the partner's capital at that point of time. Do you understand? So at the time of death, if it is matured, which type of accounting treatment you followed, that is other than that, if you want to make it surrender, the same accounting treatment you need to follow. Just I will mention that point. I mean, at the time of maturity of JLP and at the time of surrender, no change in accounting treatment. No change in accounting treatment. Just I am mentioning. So at the time of retirement, how you are thinking, in the same way you should need to think at the time of surrender as well. At the time of surrender as well. Okay. So this is the concept of JLP as well. So now hope till now what I discussed, which are all are completely related to your basics or your foundation or in other graduation what you learned. Am I right? So now this concept is technically known as dissolution of partnership. And our topic is not dissolution of partnership. Our topic is dissolution of partnership firm, which is closure of existing partnership firm. We are going to see the real dissolution of partnership firm in the next video lecture, guys. Until that, so please revise all the content before watching the next lecture. Bye-bye. Have a nice day. Hello, friends. We are in the chapter partnership accounts. We completed lecture number 1. A small recap related to lecture 1. So we started our journey by discussing the concept of constitution of partnership firm. After constitution of partnership firm, the partners will continue the business activities. Then they will prepare the financial statements. Along with the profit and loss account, they will also prepare the profit and loss appropriation account for the purpose of recording interest on capital, partner's salary and partner's commission and interest on drawings. Then the remaining profit they will distribute among their partners according to their profit sharing ratio. Then they will prepare the balance sheet as well. But before preparation of balance sheet, they will finalize the capital accounts closing balances as on balance sheet date by preparing a separate capital account. Apart from this, if at any point of time there is change in the existing terms and conditions among the partners, we can call it as a reconstitution of partnership. Then the old partnership deed comes to an end and new partnership deed will take place. Such concept is technically known as reconstitution of partnership. So in generally, in case of reconstitution of partnership, either change in PSR or admission of the partner or retirement of the partner or death of the partner situations will arise. At the time of arising such situations, the following adjustment we need to adopt. That is profit sharing ratio adjustment we need to adopt, goodwill adjustment, reserves and surplus, revaluation adjustment, and capital adjustment. In case of profit sharing ratio adjustment, we need to find out the new profit sharing ratio. Also, by comparing new profit sharing ratio with old profit sharing ratio, we have to identify the sacrificing and gaining partners and their respective shares. Goodwill adjustments, without raising the goodwill and cancellation of the goodwill, the entry is gaining partners capital account to sacrificing partners capital account according to their gaining and respective shares. In case of reserves and surplus, the existing reserves and surplus should be distributed among the old partners in their old profit sharing ratio. In case of the revaluation adjustment, if partners can decided to show the revalued figures under the balance sheet date, then the revaluation surplus or loss they can distribute among the partners in old profit sharing ratio. If partners don't want to show the revalued figures in books of accounts, you can adjust the revaluation through their partners capital accounts, as like in case of goodwill, that is gaining partners capital account to sacrificing partners capital account. Am I right? So we've seen a goodwill capital adjustment as well by giving an example. So they may thought that the capitals would be in their profit sharing ratio, or they may give that you can take as a base as one of the partners capital and you can adjust the remaining partners capital according to their respective shares. So like there, so many adjustments might given with respect to capital as well. Next, joint life policy concept also I discussed, but all such issues are completely related to dissolution of partnership. But our chapter name is dissolution of partnership firms. So in the last lecture, I not yet started content related to the dissolution of partnership firms. This is the time for current chapter dissolution of partnership under part number 1. So what exactly the meaning of dissolution of partnership, which is closure of firm? How it is different from dissolution of partnership? In case of dissolution of partnership, the existing partnership firm not comes to an end. It will continue their business activities, but with the change of the terms and conditions, with the change in the terms and conditions. But coming to dissolution of partnership firm, it is altogether closure of the company, which is quite different from dissolution of partnership. Do you understand? Now our entire syllabus is based on dissolution of partnership firm, but to safeguard ourselves, certain adjustment may come across or may come over in the future lectures. That's why I taken the entire dissolution of partnership firm partnership also for our discussion. Okay, all of you please concentrate here. So at the time of closure of firm, which type of accounting treatment I need to adopt? That's very simple. In case of closure of the company, which type of accounting treatment you adopted? In anywhere we seen the closure of the company? In amalgamation chapter, in the books of selling company, at the time of closure of books of accounts, we followed certain mechanism, right? 5-step approach. In the same way, in case of dissolution of partnership firm also, we are going to follow certain mechanism. There is no difference in between closure of a company and a closure of partnership firm. Both are same. But in case of closure of the company, where in case of amalgamation, another company so-called as purchasing company take over. But here, in this case, no company, no other company is going to take over our existing partnership firm, or there is no other firm is going to take over existing partnership firm. Our firm itself is going to dissolve. Our partnership firm itself is going to dissolve. Our partnership firm is willing to close their business. Then the next question coming into my mind is, before seeing the accounting treatment at the time of closure of partnership firm, why a company want to close its business activity? If company attaining a continuous losses, then they are not willing to continue further, thus just they want to close. Maybe a partnership firm is constituted for a particular purpose, they achieved the purpose, then just they want to dissolve. Maybe partnership at will. In the deed, we clearly mentioned that only for 5 years we are continuing the partnership firm. After that, just we want to close it. Maybe certain point of times a court may order to close your partnership firm. Sir, in which situation a court may order for the partnership firm? We will see it later. Before that, can you give some more circumstances, sir? So a closure of partnership firm is going to occur or is going to happen. For example, if all the partners are insolvent, what is the meaning of insolvency? They are unable to repay their debts from their existing assets. They're unable to repay their liabilities through realization of their assets. Then we can said to be such party is insolvent. Now, if all partners became insolvent, means partnership firm itself is insolvent. Or except one partner, all partners became insolvent. Then if a single person cannot continue the partnership firm, at that point of time also there is a necessity to closure of the firm. Do you understand? That means various circumstances prevailing in the market which leads to the closure of the company. I told you earlier one more important scenario. If court orders for the dissolution, then the partnership firm should go for the dissolution, right? In which circumstances in generally a court may order. Out of the existing partners, if any of the partners became unsound mind, maybe literally they are right now mentally not in conscious. Okay, so at that point of time, unsound means they are not having a knowledge to take a right decision. At that point of time, the court may order. Maybe the partnership firm is conducting the business activities in such a fraudulent manner that the entire society at large is losing due to the activities of the partnership firm, or such partnership firm is constituted only for the purpose of making the fraudulent activities or to deceive the public. At that point of time also the court may order. The activities of the partnership firm is against the sovereignty and integrity of the country. Sovereignty and integrity of the country means maybe in the war declaration, at the time of war declaration, maybe the central government may ban to export certain goods to the other country, but still you are exporting your goods to the other country, then maybe at that point of time court may order for dissolution. So such all things are actually causes, are the reasons, are the situations which needed for dissolution of partnership firm, which cause for dissolution of partnership firm. Do you understand? Okay. Sir, whenever a partnership firm decided to dissolve, then which type of accounting treatment we need to follow? This is all about this chapter. The dissolution mechanism you need to be follow. The accounting treatment need to be follow for the purpose of closure of the firm. We are going to see in this particular chapter. So before seeing that, first let me check with the text. Up to this, we discussed the various reasons, right? First, let us cross check with my text. Then I'll go with the exact accounting treatment. Next, come here, which is partnership accounts. I divided into two parts, you know already, which is part A. related to dissolution of partnership firms. Sir, overview I already given in lecture number 1. Simple dissolution, Garner versus Murray case law, all partners insolvent, piecemeal distribution, limited liability partnership. Dissolution of partnership. First is discussed about dissolution of partnership. In event of dissolution of partnership, the business will be continuing the as usual, but the partnership is reconstituted. The partnership deed or the agreement is going to change, but the business will continue. There can be change in profit sharing ratio or admission or death or retirement partner, which leads for the reconstitution of partnership. But coming to dissolution of partnership firm, dissolution of the firm implies that the entire firm ceases to exist. Ceases means close, including the relation among all the partners, including the relation as well as firm itself is going to cease. Circumstances leading to dissolution of a partnership. Certain circumstances is given. Partners agree that the firm should be dissolved. Just they agreed in such a way that, so maybe the time period is over. Just they mutually agreed to close the business. All partners except one partner become insolvent. I already explained. Such partner cannot continue the business activity, right? For partnership, for minimum 2 partners should require. The business becomes illegal. Maybe till now the business is legal, but due to certain changes under the law, maybe the way of conducting the business or the products which we are offered or the services which we are offered become illegal. At that point of time, there is a necessity to close such business. In case of partnership at will, a partner give notice of the dissolution, and will means if any partner don't want to continue further, then he will provide a notice to the firm, then the partnership firm will automatically close. With that term and condition, only such partner added into the partnership firm. That is nothing but partnership at will. So if partner give notice, then firm is going to close. The court orders for dissolution. Maybe if at any point of time court is order, also we can go for dissolution. In which circumstances court may go, in which circumstances the court may order for dissolution. Circumstances in which court may order for dissolution. Where a partner become unsound mind, I already told you. Where a partner suffers from permanent incapacity. Permanent incapacity means he is not capable to enter into the agreement. Where a partner is guilty of misconduct of the business. Guilty of misconduct of the business means he is not conducting the business activities with a proper conduct. He is always doing certain internal frauds. Then at that point of time, the court may order for immediate dissolution. Where a partner persistently disregards the partnership agreement. Persistently disregards the partnership agreement means, so is continuously violating the provisions of the partnership agreement. Then at that point of time, the partners may apply for the court, then the court may order for dissolution. Where a partner transfers his interest or share to a third party. Maybe one of the condition is all the partners should continue in the partnership firm. No one partner should give their shares to the another one. Yes, like that also they may would impose certain conditions, because if he transfers his share to the another partner, then the other partner may not be a good person. Then how can we sustain? So that's why at that point of time also the partners will approach the court, then the court may order. Where the business cannot be carried on except at a loss, that is continuous losses is occurring, where it appears to be just and equitable, it is better to close the company rather than continuing. At that point of time also court may order. But apart from all such things, whether it is order of the court or in any other circumstances, at the time of dissolution of partnership firm, what are the different things I need to follow and what is the accounting treatment I need to follow, I'm going to see in this chapter. Now concentrate. Sir, we already seen the closure of a company in case another company is going to take over. That is in the amalgamation chapter in the books of selling company. If purchasing company takes over the selling company, how to close the books of accounts of a selling company, we already seen. So the difference is here in case of dissolution of partnership firm, no other company is going to take over our existing partnership firm, or no other entity is going to take over the existing partnership firm. Our partnership firm itself is going to dissolve due to the various reasons. Just now we seen such reasons. Now at that point of time, how to close your books of accounts is a matter of discussion. Am I right? The only difference is here you are going to sell your individual assets and you are going to settle your individual liabilities. There, the group of assets and group of liabilities are taken over by the purchasing company. That is the only difference. Except that, what is the accounting treatment you followed in case of closure of a company, the same accounting treatment you can apply at the time of closure of partnership as well. Do you understand what I am telling? That means dissolution of partnership firm is not a new concept. It is not at all a new concept. So the only difference is there the selling company is ultimately taken over by the purchasing company. Here the partnership firm itself, they can sell their assets and liabilities individually. That is the only difference. So to tackle this situation, I adopt a particular procedure. The procedure name is, or the approach we are going to follow is DTS approach. The approach is DTS. The approach is DTS approach. What you listen is correct. The approach name is DTS approach. D D T T S. DDTTS approach. In shortcut, I can call it as DTS approach. D stands for dismantling of balance sheet. Where also we learned, we started with a dismantling of balance sheet. Here also we started with dismantling of balance sheet. Then another D for disposal of assets and liabilities. T stands for takeover of assets and liabilities by partners. T for transfer of realization, profit or loss to partners' capital. S for settlement to partners. So the DDTTS approach is almost look like the 5-step approach what we followed in case of selling company books. Am I right? So why internally some changes are occurred? I already told you the difference is in case of amalgamation, a purchasing company is going to take over the selling company, but here there is no other entities taken over the existing company. That is the only difference. That's why some certain internal changes are there. That's why directly entering into the concept as well. Okay, now concentrate. Sir, an existing balance sheet is there. An existing balance sheet of a partnership firm is there. Now such partnership firm want to close their books of accounts. Now first, what should I need to do, sir? Now, you should close your books of accounts means the ledger, the different ledgers you have, assets as well as liabilities, outside liabilities. First, you should need to transfer to realization account at book values. All the assets and all the outside liabilities except cash balance, because cash you cannot sell in the outside market, right? It was already in the realized form. All the assets and all the liabilities, you can make it transfer to realization account at book values. Assets and liabilities transfer to realization account at book values. Am I right? So, but cash you cannot transfer to realization, right? That means cash account open separately. Cash account open separately. Next, please consider all of you. Sir, in case of partnership firm, we already seen apart from assets and liabilities, partners loan will also be there, right? In yesterday's class, I showed here, partners loan will also be there. Partners loan under liability side means We took loan from the partner. We took loan from the partner. Now, during the process of dissolution, you should need to repay amount to the partner, amount to the partner's loan as well. Am I right? So that's why the partner's loan, no need to transfer to realization account. If partner's loan is there under liability side, you can open separately such partner's loan as well. Just I'm mentioning, if at all partner's loan is there, partner loan account related to liabilities, open separately, open separately. Okay. We'll see one problem, then you will get the clarity. No issues. First, let me allow to discuss all such issues. Sir, you are recorded it as a liability. That means, is it asset is also possible, sir? Is it asset is also possible? I mean, under the all assets, is there any asset is possible? Partner loan under asset is possible? Yes, absolutely. Why not? Our partnership firm, if provided loan to the partner, then we can call it as a partner loan as an asset. We need to recover. Now, during the process of dissolution, we need to recover such amount from the partner. For example, if we ask the partner what he will do, you should need to repay in the form of capital. Now we are in the closure of the partnership firm. Then if you ask such amount from the partner, then partner will tell that you need to pay in the form of capital to me, right? Now you can set off the remaining amount only you can pay at the time of dissolution. That's why partner loan, if anything is given as an asset, it should be need to transfer to partner's capital. Now come here. In case of dismantling of balance sheet, all of you, balance in partner's capital, reserves and surplus, miscellaneous expenditure not written off. That is, I can put it as fictitious assets. I can put it as fictitious assets. Fictitious assets. Partner loan as an asset. Transfer to which account, guys? Transfer to partner capital accounts. Partners capital accounts. So if you really remember the concept of accounting treatment in the books of selling company, we do the same thing. What we did actually at that point of time, assets and liabilities which are taken over by the purchasing company transfer to realization at book values. Here all the assets and liabilities. Simply you can transfer to realization at book values because you are selling all such assets and liabilities. Cash already in the realized form you can open separately. Partner loan is a liability, you can repay separately. That's why open separately. Now there, equity share capital, reserves and surplus, fictitious asset, you transfer to equity shareholders account. Here simply you transfer to partners capital account. That is the only difference. There is no difference at all. Okay, do you agree, all of you? Now coming here, disposal of assets and liabilities. Now you are slowly selling your assets and liabilities. For example, you are selling your assets. All of you concentrate. You are selling your assets. Now here there is a difference in the books of selling company and in the dissolution books of a partnership firm. Do you know the reason? Where assets and liabilities are taken over by a partnership, where assets and liabilities are taken over by a purchasing company, here assets and liabilities we are disposing in our own. Now in generally at the time of disposal of assets, what is the journal entry? Bank account debtor to assets account, right? To assets account you need to write, but already assets were closed and transferred to realization account. Tell me guys, already assets and closed and transferred to realization accounts. That's why you can write bank to realization. The entry is bank to realization account. At which value, sir? At the rate of market value. I mean at the rate of realizable value. Okay, next. Sir, no, liability we are making a payment, sir. Liability we are making a payment, sir. What is the journal entry, sir? The normal journal entry is liability to bank, but liability was already closed and transferred to realization account. That's why on behalf of liability I can put realization account debtor to bank account. So simply in the books of selling company, what you made right at the time of disposal of assets and liabilities, purchasing company to realization, purchasing company to realization. On behalf of the purchasing company, just I wrote bank to realization, realization to bank. The net amount you actually made it as a purchasing company to realization, but here individual assets and individual liabilities you are disposing. That's why at the time of disposal of assets, bank to realization, at the time of making payment to the liabilities, realizations to bank. At which value? Always realizable value, or at the date of discharging value. If it is liability, at the rate of discharging value. At which value you are paying, at such value you should need to record. Do you agree? Okay. Now I have one doubt. Sir, maybe if any unrecorded assets or unrecorded liabilities are exist, if we dispose of such unrecorded assets and unrecorded liabilities, what is the journal entry, sir? Now, we already seen such issues in case of internal reconstruction. Do you remember? Such all concepts are over, guys, already, such all chapters. In case of internal reconstruction, if you dispose of any unrecorded asset, the journal entry is bank to reconstruction. Here, very simple, bank to realization. Sir, if you are making payment to any unrecorded liability, the entry is realization to bank here, there reconstruction to bank. How it is possible, you know? Just I will write the approach here. Please concentrate. So just now I'm talking about unrecorded assets and liabilities disposal. Unrecorded disposal of assets and liabilities. Just I'm writing disposal of assets, liabilities. Okay, guys. Sir, unrecorded asset we are now disposing. Sir, which is unrecorded, right? First you need to record. For example, if you need to record, which entry you need to pass, you know, you are going to record, right? Asset account debtor. Asset account debtor. Actually, you need to give a credit to P&L account. Already P&L account itself is already going to close it to the partner's capital. Whatever the profit or loss do you derive during the process of dissolution, such profit or loss you can make it transfer to realization account. The same concept what I discussed in internal reconstruction, the same I am continuing here. So at the time of recording, asset to realization. Now let us assume the asset value was, book value was, let us assume at the rate of 10,000. At the rate of 10,000. Now you are disposing. That means selling such asset, right? You are disposing at the rate of 12,000. Now what is the journal entry, sir? Bank account debtor. How much you are getting? 12,000 to asset account. Asset is there, right? Asset you can write off, which is 10,000. The remaining profit is how much? 2,000 to realization account. How much, guys? 2,000. Now after recording and disposal, if you check the net entry, what is the net entry, you know? Sir, asset and asset here cancel to each other. Am I right? Now the entry is bank account debtor. How much? 12,000 to realization. Here 10,000 plus 2,000, total 12,000. I told the same thing, right? Sir, at the time of disposal of unrecorded asset, the entry doesn't change. Bank to realization. In case of internal reconstruction, bank to reconstruction, the same bank to realization. The same which is bank to realization. Now, in the same way, I don't want to write the entire thing here. The same way, at the time of discharging the unrecorded liability, the entry is, all of you, please tell me, participate, realization account at R2. This is the total entry, or if you want one by one entry, I will record, because record disposing and net entry I given, right? So here also I will record, just a moment. So if I record first realization to liability, then if you discharge liability to bank, then the net entry is realization to bank. If liability gone, then the net entry is realization to bank. So at the time of disposal of unrecorded asset, the entry is bank to realization account. Book value is irrelevant. At which value you are going to realize is relevant. In case of unrecorded liability, at the time of discharging, the entry is realization account that are to bank at the rate of discharging value. Do you agree? Okay. Now coming here, all of you, takeover of assets and liabilities by the partner. Now, a particular asset is taken over by the partner. Please, all of you, concentrate here. I'll give one example for better understanding. In my books, machinery is there. Machinery is there. The machinery worth is 1 lakh. The worth of the machinery is 1 lakh. So which is machinery. Worth of machinery is 1 lakh. Now such machinery is taken over by one of the partner. Let us assume partner A take over such machinery. Partner A take over such machinery at the rate of 1,20,000. He is taken over. Let us assume he is taken over at the rate of 1,20,000. Now, what is the general entry I need to pass it here, sir? Concentrate. What is the general entry I need to pass? Now, one thing first, the machinery is book value 1 lakh, but is going to take over at the rate of 1,20,000 means what happened actually? There is a rise in the value of the machinery. There is rise in the value of machinery. Already in book 1 lakh is there. Right now, he is taken over at the rate of 1,20,000 means to the extent of 20,000 upward revaluation is there. During the process of upward revaluation, first the entry machinery account debtor to realization account. The profit or loss, whatever the case may be, just you can transfer to realization 20,000 upward revaluation, right? Now the machinery is showing in your books at 1,20,000, 1 lakh plus 20,000, 1,20,000. Now such partner is taken over, right? Sir, such partner is taken over means to the extent of the amount you are discharging to the partner. To the extent of the amount you are discharging to the partner means you will ask the partner, you can decrease your capital. So I will not pay at the time of repaying the capital to the extent of the amount. So that's why I will make it debit such partner capital account. That is partner A's capital account debtor. How much amount, guys? Total 1,20,000. Now you can credit the machinery, which is 1,20,000. This is one approach. This is one approach. All of you concentrate in this. All of you concentrate this approach. This is one approach, sir. But in case of dismantling of balance sheet, we already transferred this machinery to realization, right? We already transferred this machinery to realization. So just for understanding purpose, I told all such purpose first without inculcating the thing. Now come to the real process. This is the real process. This is the process in generally how a particular machinery is taken over by the partner. This is in general procedure we need to adopt at the time a particular asset is taken over by the partner. But now we are in the process of dissolution, right? But now we are in the process of dissolution. Please, all of you concentrate. I'm rubbing these journal entries, all. Sir, now during the process of dissolution, this machinery is already transferred to realization. All the assets and liabilities transferred to realization at book values. We already transferred to realization. But now this particular asset is taken over by partner. Then what you should need to do, such particular partner capital you need to debit. Partner's capital account debtor. Now at which value he is going to take over? 1,20,000. Am I right? To already where the asset is there, it was already transferred to realization account. Right now, I can't make it credit machinery because machinery was already transferred to realization. On behalf of machinery account, you can give credit to realization account. You can give credit to realization account at the rate of 1,20,000. Sir, but the book value is 1 lakh na. But you are debiting the capital, you are crediting the realization at 1,20,000. How it is possible, sir? Just let us assume if the same machinery, if you dispose it at the rate of 1,20,000, what is the entry you will write? Bank to realization, right? Bank to realization at the rate of realizable value. Right now, also you are recording on behalf of bank. Just now you are debiting the partner's capital. On behalf of selling to the outside person, just you are selling this machinery to the partner. That is the only difference. If you are selling to the outside party, you are receiving the bank. But if you are selling to your partner, you are debiting the partner's capital. But at which amount? At the rate of realizable value. That's why book value is irrelevant. There is no change in the entry. Bank to realization here. Here partner's capital to realization account. That is the only difference. Do we agree, all of you? Now, in the same way, at the time of discharging the liability, for example, a particular liability is discharged by the partner on behalf of the partnership firm. A particular liability discharged by the partner, or such particular liability is taken over by the partner. Then what is the journal entry, sir? Same realization account debtor. Here, same realization account debtor. Realization account debtor. 2. On behalf of bank, I should need to give to that particular partner capital credit. That is the entry. That is in case of liability. This is in case of asset. This is in case of liability. Hope you understand, guys. Okay. So earlier the entries which I passed, not in the case of dissolution. In the normal case, if a partner taken over the asset, I passed at that point of time. But now during the process of dissolution, how such entries are look like, we already seen. Okay. Is it okay, all of you? Now, the next question coming into my mind is, sir, if such an unrecorded asset is taken over by the partner, what is the journal entry, sir? If such an unrecorded asset is taken over by the partner, what is the journal entry, sir? If such unrecorded asset is disposed, what is the journal entry? Bank to realization, partner's capital to realization. If an unrecorded liability is disposal, what is the journal entry? Realization to bank. If such unrecorded liability is paid by the partner, what is the journal entry? Realization to partner's capital. I mean to say, sir, whether the asset is recorded or unrecorded, whether the liability is recorded or unrecorded, the entries are same. In case of disposal or in case of takeover of assets and liabilities by the partner, whether this asset is recorded or unrecorded, entry is same. Here also the asset is recorded or unrecorded, the entry is same. Here the asset is recorded or unrecorded, the entry is partner's capital to realization if such asset is taken over by the partner. If the liability is recorded or unrecorded, the entry is realization to partner's capital account. I already proved here the same entry, bank to realization. Here also the same entry, bank to realization. Do we agree, all of you? Yes, these all adjustments are in generally form part of the problem. So we will see one problem, then all your myths are automatically got resolved. Okay. Next, still not at over, guys. Now, after completion of all these things, sir, dismantling of balance sheet over, disposal of assets and liabilities is over. During the process of disposal, some of the assets or liabilities may be taken over by the partners. Such adjustment also we made. Then you should need to close the realization account for the purpose of finding profit or loss through realization. That is, if you close the realization account, you will get some balance, right? If you get balance under credit side, then which is a profit situation. If you get balance under if you get balance under debit side, which is a profit situation. If you get balancing figure under credit side, which is a loss situation, then what is the entry? Whether you are getting profit or loss, the realization profit or loss should be need to the partner's capital now. If it is profit, entry realization account debtor, realization account debtor to partners capital accounts in their profit sharing ratio. The realization profit you should need to distribute among the partners in their PSR. Next, realization profit also you transfer to partners capital. Now you will only have two different accounts balances. One is partners capital, another one is the resource you have. Which resource you have? You are disposing different assets and liabilities, right? You have cash. So just now you can settle the balance availability of cash with the partners, then automatically all partners capital accounts gone. Then in case of settlement of partners, the entry is partners capital accounts data to cash account. Oh, just a second. Partners capital account data to cash. I don't have space. Just a second. To cash account. Yeah, that's it. That is the journal entry, guys. So that is the journal entry at the time of settlement of partners. Now the approach is D, D, T, T, S. Whenever you are doing a problem related to the dissolution, if you can simply put such concept in your mind, you can easily resolve the problem. Dismantling of balance sheet, assets and liabilities, all you can simply make it transfer to realization account at book values. Cash, no need to transfer to realization because you can open separately. It was already in the form of, it is already in realized form. Maybe if partner's loan is there under liability side, you can open it separately. You can make a repayment. Am I right? Next, that is partner's capital, reserves and surplus, and partner's loan as an asset. Partner's loan as an asset, you can make it transfer to capital. Why partner's loan as an asset you can make it transfer to the capital? Partner's loan as an asset means partner took loan from our partnership firm. If we ask such amount, he will tell that you can reduce it from my capital. So that's why I will make it transfer to the debit of the partner's capital, such loan. Now, one thing you should remember, sir, at the time of disposal of assets, there is no order. At the time of disposal of assets, there is no order. But at the time of disposal of liabilities, that is discharging amount to the liabilities, particular order you should need to follow. You know such order. That's why I don't want to repeat here. What is the order in case of making liabilities, guys? First, realization expenses. First, realization expenses. Then, if liquidator is there, we should need to provide the liquidator remuneration as well. Here, actually, for the purpose of dissolution, maybe some of the parties may acting as a liquidator. If it is there, then you can pay. Okay, first realization expenses. After realization expenses, secured creditors, then unsecured creditors, then partner's loan, then partner's capital. So just I'm writing here. I'm not getting a space here. Yeah, here my space is here. Space is there. Please concentrate. So what I want to explain here. So just it is order of making payment to different parties during the process of dissolution. Order of making payment. So first, realization expenses. So then liquidator remuneration, if at all is there. Then secured creditors. Then unsecured creditors. Then partner's loan as liability. Partner loan, all are payments. Partner loan as liability means, so partnership firm took certain loans from the partners. That is sixth. Finally, partner's capital. This is the order you should need to follow. Sir, for realization expenses, what is the journal entry? In case of amalgamation in the books of selling company, what is the journal entry? Realization to cash. Here also same entry. Here also the same entry, which is realization account data to cash. So just nowhere mentioned. Here I'm mentioning. The entry is same, realization account data to cash account. So in case of incurring realization expenses, that is the journal entry you need to follow, guys. Yeah, right. So this is the process I need to adopt in case of simple dissolution. In case of simple dissolution. So the DTS approach we need to adopt in case of simple dissolution. The first method is ours is only simple dissolution. If you check here under the overview, so first we are considering the concept of simple dissolution. First, let me check in my text what are the issues actually discussed here. Accounting treatment in case of dissolution of partnership firm related to a simple dissolution. So a partnership firm simply is going to dissolve. What is the treatment I need to adopt? D, D, T, T, S. The approach name is DTS approach. DD, TT, yes. Just for remembering, we can call it as DTS approach. D for dismantling of balance sheet. Another D for disposal of assets and settlement to liabilities. T for takeover of assets and liabilities by partner. Another T for transfer of realization profit or loss to partners. S for settlement to partners. In case of dismantling of balance sheet, all assets, including goodwill. Sir, when goodwill is there in books of accounts, if it is purchased goodwill in the partnership firm, maybe goodwill is there in the books of accounts. Do you agree, all of you? If the entity is having goodwill in their books of accounts, means that goodwill may be a purchased goodwill, because internally generated goodwill we cannot record as per the standard of AS 26. Am I right? So that's why if at all goodwill is there, like other assets how we are disposing, such goodwill is also need to be transferred to the realization account. But other than cash and fictitious assets, you need to transfer. And all outside liabilities will also be closed and transferred to realization account at their respective book values. Cash account, partners loan under liability separately open. I already discussed. Partners capital, reserves and surplus, including profit and loss balance, fictitious assets, partners loan under assets side, partners loan under assets. That means we are asking money, but he will not pay. He will tell that you can reduce from the capital. That's why I'm transferring to the debit of the partner's capital. Will be closed and transferred to partner's capital account. Then disposal of assets and liabilities. Practically, assets will be disposed in their order of solvency. In their order of solvency means, sir, if stock is there, we can easily realize. Building is there, we can't realize in such a speedy manner as like how we realize the stock. Do you agree? So stock, we can easily realize within 10 days, 15 days like that. But for the purpose of realization of building, it will take much more time. So practically, if a partnership firm is going to dissolve, then first it will resolve the highly liquid assets like current assets. After that, it will start realization of non-current assets like PPE, intangible assets, blah, blah, blah. Okay. Next, as per section 48, liabilities will be settled in the following order. Okay, what is that order? Realization expenses, liquidator remuneration, secured liabilities, unsecured liabilities, loan taken from partners, final payment to the partner's capital. So I also made the discussion in the same way, right? Tell me, guys. Here, the same way, order of making payments. Next, journal entries. At the time of incurring realization expenses, realization to bank. Yes, I mentioned here realization to cash or bank. At the time of disposal of assets, bank to realization. Actually, bank to assets was already closed and transferred to realization. That's why on behalf of crediting the asset, we are directly making credit to the realization account. At the time of settlement to liabilities, realization to bank. Sir, disposal of unrecorded asset or liability, also the same entry, there is no change. Bank to realization or realization to bank. The same entries we made, but at the rate of realizable value. Takeover of assets and liabilities by the partner. If asset is taken over, then the entry is partner's capital to realization. If a liability is taken over, then realization to partner's capital. Partner's capital to realization, realization to partner's capital. So don't by heart anything, just you can apply the concept. Sir, if an asset is taken over by the partner means, we need to reduce the partner's capital. In general, partner's capital having a credit balance, reduction means you need to debit. Sir, to asset, that asset will already closed and transferred to realization. On behalf of making credit the asset, you can directly make it credit the realization. Like that, the entries are going to occur. Next, transfer of realization profit or loss. After completion of all dissolution activities, before making payment to partner's capital, find the realization profit or loss and make it transfer to partner's capital. If it is profit, realization to partner's capital. If it is loss, partner's capital to realization in their profit sharing ratio. Final settlement to the partners, just to distribute the cash balance available among the partners according to their outstanding capital balances. Then automatically dissolution is over. Am I right? Hi, soldiers. We are in the chapter partnership accounts. In last lecture, we discussed about simple dissolution, and problem on simple dissolution also completed. So now, as per our overview, the next concept is Garner versus Murray's case law. Please, all of you, put the heading Garner versus Murray's case law in your notebook. Garner versus Murray's case law. Yeah. Concentrate. So before dealing with Garner versus Murray's case law, so just I want to share with you a life incident which has happened at my childhood. This is no par relation with my concept. I mean, relation with the partnership accounts. This is altogether a different issue. So just actually happened at my childhood. Do you know, in generally, the people are playing most of the times at the childhood cricket, right? So the only one end game. So in generally, people are using to play is cricket. So, but at that point of time, we located in a small village. So our cricket is gully cricket actually. But how that gully cricket is in generally going to happen? I'm in the process of completion of my schooling. I think so. I'm not having exact idea at which age it is. So, but probably it might be a 5th class or 6th class like that. So as on every Sunday, so the matches are going on in between one street to another street. So there is another street is there in my village. So between the game is happening in between two different street. But you know, for playing cricket, minimum 11 members should be required, right? So we will go to the ground at that point of time, and the 11 members, how we will pick in villages, it is very difficult situation to pick the players itself. So altogether different age groups are possible. Maybe they are related to different sectors as well. I mean, some of the persons were related to the agricultural background, maybe some are the students. Okay, maybe some of the persons just they are doing the here and there small works. So different age groups and different income group of persons just put together, we are going to play with the other street guys. So actually every time the game is happening for money, that is a betting game, not at a free of cost. So at the end of the day, it is matters, right? So when we will get a seriousness, when such a game is happen for better money, then every person or every player will perform individually according to his best. Now, but according to our financial structure, we are not cope up with to put a money into the bet. So that's why on behalf of all the persons, some persons may be in the earning stage, right? At that point of time. So they will make a put the money on behalf of all the players, just we will play such game. So like that, our childhood is happening in generally. Okay, just the story is still not end. Now the reality is started right now. I mean, the reality means the material things actually started right now. So this is not I'm creating as a story, guys. This is the real thing what happened to me at my childhood, just I'm sharing. Now one day what happened, so ball pass on to one fielder. He's also one of my friend. Okay, he's my classmate as well. A ball pass ons in front of him, but he's unable to field it properly. Actually, I think so, which is field or catch. Somewhat he dropped it. Then person who made a bet is really angry. Is really getting angry against that person, because if we lose the match, who ultimately losing the money? Person who made a bet, persons who made or who put money into the bet. Am I right? Then he thought that, sir, if every time I am putting the money, but no one is serious about the game, so all are simply dropping their catches and the fieldings. So to create a seriousness, he made a decision and he made a resolution that all persons should contribute equal money. The entire 11 members, for example, if you put a bet of 150 rupees, all persons should contribute the equal money. He simply said such, he simply passed such resolution. He's actually the captain of our company. Sorry, he's captain of our team. Okay. So that's why he passed a resolution. Then from next day onwards, the calculation started. Actually, we are in schooling, right? We required some money. So each and every day, our parents will give certain money for the purpose of our expenses and eating and for such all things, right? Then we will save such money as a pocket money. We will save at that point of time. Then whenever weekend comes, we are also putting such money, equal money, irrespective of their income levels. Then how each and every person will act in the field, so they are running like anything. They are running like anything, because if we lost the match, then entire our money gone. So that is the major issue here. Okay, that's fine. One sudden day or one sudden weekend, what happened? My friend actually bought a new watch. At that point of time, the cost of the watch is approximately, I think so, 450, like that. 450. It's very costliest watch at that point of time. So it's almost been approximately 20 years back, I think so. Okay, then you can thought 15 to 20 years back. So 450 means it's absolutely more than 5,000 right now. Okay, fine. His father actually bought that watch to him. Then he came along with his watch for the match. Then that watch actually is very costlier. So that's why he just left the watch along with all our accessories and all our bags. Just he put that watch there. Then we went to the field at that point of time. Then suddenly, after completion of the game, whenever the game completed, just we see that watch, but the watch is not available on that playground. So maybe somebody actually stolen that watch. Just he lost that watch. But the problem is here, once if the issue is known to his father, the problem is he will not come to the match anyway. But at the same time, he will ask when you lost that watch, at which premises you lost that watch. He will ask. Then suddenly he will roaming and jumping onto our houses, and he will fight against our parents and against ours as well. From the next weekend onwards, the matches will not going to happen. That is a major problem. You know in generally how the village people will behave, right? So that is the problem. So here and there, so many other problems are created for the purpose of conducting our matches probably in the future. So that's why our captain give again one more good idea. He's the uh, boss of our captain, and he is the boss of our ideas as well. He gave a beautiful idea that, sir, how we contributed in the match, in the same way, let us contribute equal amount. Then we will bought a watch, then just give it to you. So you can manage for 2 to 3 days. We will bought a new watch, the same watch. Then the issue will be automatically closed. That is actually the plan behind our captain. Okay. Then so many persons of our team, like me, at that point of time, we are not earners. Sir, that is, my dear captain, to contribute 5 rupees or 3 rupees itself is a biggest task for us. But how you can imagine that we can able to contribute that much of big amount? It is not at all possible. But you are the earners. You're already having certain earnings, right? So according to our financial status, we will contribute lesser amount. According to your financial status, you can contribute much. This is not a game. This is not a game. This is the thing outside the game happened actually. According to, by considering that is by taking the consideration of the financial status, the real financial status, the real individual financial status and economical issues, we can contribute each and everyone. Then the captain agreed. So we really surprised why the captain is agreed as well, because he also known at that point of time we are not having any earnings. So just we bought it, and the person, my friend, is happy, and my friend father is also happy, and we are also very much happy because our process of playing the games is still continued. Now I will tell you why the reason at the inception of the class itself I revealed that much of big story. After listening the case law of Garner versus Murray's case, the first and foremost thing I remembered my childhood. Not from now. Whenever I used to learn the subject as a student, So whenever my faculty taught such concept, Garner versus Murray's case law, so I remember the concept of, I remember actually what happened at my childhood. So just I want to share with you. These are highly connected things. That's why. Okay. Without wasting much time, let us entering into the topic, Garner versus Murray's case law. Once, if you listen the conclusions of the case law, you will definitely connect it with my story. Then you can understand the beauty of my story and the beauty of the conclusions of Garner versus Murray's case law as well. Okay, sir, this case is actually a historical case, which was happened in the country England. Okay, which is a business country. You know, the business itself is completely born and brought in UK, United Kingdom, which is England. Most of the cases with respect to the contract and businesses and all historical cases are only happened in the country UK. So this is also not an exception. Garner versus Murray's case law is happened in England. What happened? First, I will tell the situation. What happened? First, I will tell the situation. So actually total 3 partners are there. One is Garner, another one is Murray. I don't know another partner name. Let me take the partner name as X. Let me name the partner name as X. Another partner is also the total 3 partners are there here actually. Now the problem is partner X became insolvent. Partner X became insolvent. You know the meaning of insolvency, right? Partner X unable to repay his personal debts itself. Then how you thought that he can able to repay the partnership firm debts? Partner X is unable to repay his personal debts as well as debts owed to the partnership firm as well. Now let us assume now during the partnership firm operations, X is having a debit capital. X is end up with a debit capital. Let us assume for the time being, partner X is having a balance in capital. Balance in capital, which is a debit balance. Let us put 10,000 debit. 10,000 debit. Sir, their profit sharing ratio, how it is there? The profit sharing ratio is 1:4:3. So this is the profit sharing ratio. 1:4:3 is the profit sharing ratio. Okay, do you understand? The profit sharing ratio is 1:4:3. Now the balance in capital of X is 10,000, right? Now, which is insolvency loss? Which is insolvency loss? Sir, whenever a partner is insolvent, he is unable to continue the partnership from, no doubt about it. We want to close, we want to settle his account. We want to settle his account. And the partnership firm also want to go to dissolve. Now, partnership firm want to also go to dissolve. Let us assume, because the partner is insolvent. Sir, if a partner is insolvent, the remaining partners, if they want, they can continue the business as well. But just Garner and Murray also decided that, so such partner is insolvent, and just we can also close the business. Now, the question is, the problem is, this is insolvency loss, right? Balance in capital 10,000 debit means after all completion of all adjustment, I am telling at the end, balance in capital is 10,000 debit balance means now such insolvency loss, which is nothing but insolvency loss, which is nothing but insolvency loss. Such insolvency loss should be borne by whom? Garner and Murray. These are solvent partners. Both are solvent partners. He is a solvent partner. He is also a solvent partner. You know, because, sir, why the insolvent partner loss we will bear, sir? Sir, in case of partnership firm, the liability is jointly and severally. You learn such concept in your foundation itself in the Partnership Act 1932 under the paper law. Jointly and several liability means if partner X is unable to make payment to the outsider, then Garner and Murray should need to compensate such amount to the outsider. The outside party as a creditor, he may ask that amount from partnership firm or any of the partner as well. Am I right? So that's why this loss should be borne by whom? Garner and Murray. Now the point is, how such insolvency loss should be borne by Garner and Murray. Garner is simply telling that, okay, this insolvency loss 10,000 is there now. This 10,000 we can contribute in our profit sharing ratio simply. That is 10,000 is there. Such 10,000 we can contribute in the ratio of 1:4. In the ratio of 1:4 means this 10,000 loss, you will contribute, I will contribute 1/5. You can contribute 4/5. Simply he made a statement. That is 1/5 into 10,000 means he will give 20,000. Murray 4/5 means, sorry, 1/5 means 2,000. 1/5 means 2,000. For here 4/5 means 8,000. How many of you, sir, you can feel that it is justifiable? How many of you can feel that it is justifiable? You can think in my angle. How many persons you can tell that which is justifiable? Sir, if the loss is a business loss, I too agree, and I too ready to distribute such business loss among the partners in their profit sharing ratio. This loss is altogether not at all related to the business. This loss is related to insolvency loss. In my game, if we lose the match, then we will lose the bet money. No doubt about it. Then all the entire loss we got should be distributed in equal ratio according to the contribution ratio, according to the contributed ratio. We will ready. But if a watch lost in the ground, how you can expect that we will compensate in the equal ratio? That is means in the profit sharing ratio, how we can compensate? You can check the actual economic condition of such person, actual economic outside financial status of such person. Actually, Murray, I'm talking about Murray. Murray outside assets are only to the extent of 1 lakh only, but Garner outside assets are almost, he is having 1 crore. 1 crore assets he have outside. I'm telling, not here, not in the partnership firm. Outside, he's financially fit. Garner is very much financially fit. Garner is very much financially fit than Murray. So the financial fitness, how we know, sir? Then financial fitness, whether it is financially fit or not, how we can know? We can know simply based on the capitals. Let us assume the capitals in Garner, in capitals in this partnership firm. Just I'm telling here, the capitals are, capital for Garner is 5 lakhs and capital for Murray is 1 lakh. Let us assume. Sir, if Murray introduced the capital 4 lakhs, then how you are giving the 1:4? That is four shares of profit. How you are giving to the Murray, sir? Maybe Garner is a sleeping partner, Murray is an active partner. Yes, that is also possible. He made the more investment, but Murray is actually conducting all the business activities. That is also happening. Now, the Murray argument is with the judge, sir, you are only seeing the profit sharing ratio, which is 1:4. But if you see the capitals, that is Garner contributed more, but Murray contributed less. The financial status of Garner is much more better than financial status of Murray, sir. My financial status is that much of worst while compared with Garner. Then how you can feel that I can contribute in the profit sharing ratio? Then judge gave a remarkable judgment in the entire history of the partnership firm. That is, the insolvency loss caused by the insolvent partner should be borne by the solvent partners in their capitals ratio, not in their profit sharing ratio. How? At that point of time, my captain made a resolution that, yes, we bought this watch not at equal contribution according to the economic condition of each and every player. In the same way, judge gave a remarkable judgment. What is the judgment? Can you please all of you participate here? What is the such judgment, guys? Insolvency loss. Insolvency loss caused due to insolvent partner should be bared by solvent partners in their which ratio? Capital ratio or profit sharing ratio? In their capital ratio. This is the first provision of the Garner versus Murray's case law. This is actually judgment conclusion. Just such judgment conclusion we are using at a provision. Insolvency loss caused due to insolvent partner should be bared by solvent partner. Should be bared by solvent partners in their capitals ratio. In their capital ratio, not in their profit sharing ratio. Not in their profit sharing ratio. That is the point you need to remember. Next, one more thing, guys, all of you. Sir, whenever a partnership firm end with losses at the time of realization, I mean to say, when the partnership firm is in dissolution process, but it end up with losses at the time of realization of their assets or their liabilities, then definitely cash crunch is there. I mean, all the assets are sold at less than their book values. The liabilities are also discharging at their book values only. So assets we are realizing very much lesser amount. Maybe certain realization expenses also incurred. Ultimately, we are end up with realization loss. Ultimately, we are end up with realization loss. Then as per this law, to avoid such cash crunch, partners having, I mean, solvent partners having either debit balance or credit balance should need to contribute cash to the partnership firm to that extent of the realization loss. But literally speaking, they will not contribute any cash in practically. But we are making a notional entry. We are making a notional entry that to that extent of realization loss, to that extent, this is only applicable in case of loss situation, not in profit situation. If partnership firm during the process of dissolution, it end up with loss, that is realization loss, then solvent partners having either debit balance or credit balance, they need to contribute in the form of cash to the extent of realization loss. To the extent of realization loss. Okay. Now let me put the second provision as well. Then we will see it later. So the explanation we will see later. First, let me put here. What is that? Solvent partners having either debit or credit balance. Solvent partners having debit or credit balance need to introduce cash to that extent of realization loss. This is only in case of realization loss. What is the impact? I will tell you here. All of you, please concentrate. Sir, we know the concept of DDTTS. That is, in case of the dissolution, just we are following the DDTTS. If we are applying the Garner versus Murray's case law, to the given problem, then how the problem is going to resolve? That is, how we are going to resolve. Number one, concentrate all of you. The flow is, we will start with DDTT. Then you should apply Garner versus Murray's case law. Second rule first. After that first rule, DDTT, yes, then final settlement. So first D, next D, after that T, after that again T, then Garner versus Murray rule, then you can apply settlement, which is actually settlement, guys. This is the method we are following in generally. So that means first dismantling of the balance sheet as usual, disposal of assets and liabilities as usual, takeover of any asset or liability of the partner, we will give the accounting treatment, transfer of realization profit or loss to the partner's capital. Now you will check the realization whether you are getting profit or loss, right? If you are end up with realization loss, to that extent of the realization loss should be contributed by the solvent partners having either debit balance or credit balance. He should only acting as a solvent partner. That's it. Sir, in the outside, he can able to repay his debts, sir. Then he become the solvent partner. Whether he is having debit balance or credit balance, which is irrelevant, all the partners who are solvent should contribute in the form of cash to the extent of the realization loss. Except insolvent partner, remaining all partners should need to contribute, guys, to the extent of the realization loss in the form of cash. Then first rule, after that, after application of that, the first rule, you can check the insolvent partner loss, na, that is insolvency loss, na. Such a insolvency loss caused due to insolvent partners should be borne by solvent partners only having credit balance. This is only having solvent partners only having credit balance. That means if a particular solvent partner having a debit balance, we cannot tell that you should also need to contribute. Just we can assume that we can avoid such solvent partner who is having the debit balance. First, we are telling that solvent partners who is having a credit balance only should need to contribute the insolvency loss. Do you agree, all of you? Do you understand the provisions? If you still not understand the provisions, just allow me to discuss some other issue before discussing the problem. Then you can easily understand each and everything what he discussed in case of Garner versus Murray's case law. That means then you can apply the first rule. That is insolvency loss should be knock off with the solvent partner's capitals. After that, you can make the final settlement with the available cash. That is the DDTT, Garner versus Murray's case law. Second first rules, then settlement. That is the concept in general we will following in case of Garner versus Murray's case law. So I told you, just allow me for some time, right? For which purpose, you know? For calculation of capital ratio. So what is the meaning of capital ratio here? What is the meaning of capital ratio, sir? Concentrate. Capital ratio is depending upon which method of maintaining the capital you are following. I mean, are you following fixed capital method? Are you following fixed capital method? Or are you following fluctuating capital method? Fluctuating capital method. If you are following the fixed capital method, for the purpose of computation of capital ratio, then ignore the current account balances. Capital ratio is nothing but capital, capital ratio is nothing but balances exist in capital accounts only. Balances exist in capital accounts only. I mean, balances exist in current account, you should not consider. So in the capital accounts, how much balance is there? With that balance, you can simply compare to get the capital ratio. But one thing you need to remember here, if any partner's loan is there as an asset. If any partner's loan is there an asset. What is the meaning of partner loan under asset side? Sir, we are giving loan to the partner. Then if I ask money from the partner, what he will tell? You can reduce from my capital, right? So that's why if any partner's loan is there under assets side, just I'm mentioning, if any partner's loan is there under assets side, then it should be reduced. It should be reduced to know the balance of capitals. But you never consider the balances under current accounts. You should never consider the balances under current accounts. Such all things are clearly intimated in the judgment itself. Okay, next. In case of fluctuating capital, what exactly the meaning of capital ratio? Here the capital ratio means capital in balance sheet. Here you need to adjust the following. That is, if interest on capital is there, then interest on capital you should need to add. Sir, partner salary is there. Partner salary you should need to add. Partner's commission is there. Then you should need to add. Okay. For example, if interest on drawings is there, you need to reduce. Tell me guys, due to interest on drawings, capital increased or decreased? Decreased. Then you will get certain capitals, right? Under fluctuating capital method, you are getting certain capitals, right? Such capitals you can compare among all the partners, then which you can treat it as a capital ratio. That means in case of fixed capital method, if you are following, capital ratio is nothing but balances appearing the capital after adjustment with the partner's loan as an assets. But in case of the fluctuating capital, the capitals need to be adjusted with interest on capital, partner's salary, partner's commission minus interest on drawings. Then you will get the capitals ratio under fluctuating capital method. So this is the concept of Garner versus Murray's case law and the flow we need to follow at the time of conducting problems. Sir, before seeing the problem, first let me check my text, all of you. Garner versus Murray's rule. Consider all of you here, guys. Garner versus Murray's rule. When a partner is unable to pay his debt due to the firm, that is, if at any point of time such partner is ending up with a debit balance, when there is a necessity to pay amount by the partner to the firm, if his capital became a negative balance, right? If positive balance is there, firm should need to payable to the partner. Firm should need to be payable to the partner. But if partner's capital is having the negative balance, that means partner is unable to pay his debt due to the firm. He is said to be insolvent. Then whenever he is having a debit balance, and if he is unable to give such balance to the partnership firm, then he is said to become insolvent. And the share of insolvency loss is to be borne by other solvent partners, either having debit or credit, only having credit balance. Here guys, first rule, only having credit balance. Solvent partners only having credit balance, following the decision in the English case of Garner versus Murray. Provision number 1, insolvency loss caused due to insolvent partner have to be borne by solvent partners who are having credit balance after all adjustments in their capital ratio. Only having credit balance. Solvent partners having the credit balance only need to contribute. Solvent partners having debit or credit balance should bring cash to that extent of realization loss in their profit sharing ratio. Solvent partners having debit or credit balance should bring cash to that extent of realization loss in their profit sharing ratio. That means all the solvent partners, whether they're having debit or credit balance, should brought up certain cash to that extent of realization loss. In actual practice, they will not be bringing any cash, only a notional entry will be made. Do you understand? Okay. Next, one more thing, guys. The important issue actually I forgot. First, you should know, sir, in which situation I can apply the Garner versus Murray's law. That is also very much important, right? Sir, for each and every situation, Garner versus Murray's case law is not applicable, friends. For each and every situation, Garner versus Murray's case law is not applicable. Sir, when Garner versus Murray's case law is applicable, sir? minimum 2 solvent partners should be required. Minimum 2 solvent partner, and at least 1 insolvent partner should also be required. So to apply the Garner versus Murray's case law, when the question is when we can apply, sir? When we can apply? The answer is minimum 2 solvent partners and minimum 2 solvent partners and at least 1 insolvent partner. You know why? For example, 1 insolvent partner is there, 1 solvent partner is there. Why Garner versus Murray's case law is not applicable, sir? Dispute is not erased, na? Then the solvent partner should bear the insolvency loss. That's it. He is the only option. There is no other partner available. Or, sir, if 2 insolvent partners are there, only 1 solvent partner is there, sir. Then what is the situation? The entire 2 partners insolvency loss should be borne by the 1 solvent partner. So that's why the prima facie condition is to apply the Garner versus Murray's case law. Minimum 2 solvent partners should exist. Minimum 2 solvent partners. Then only dispute will arise. Am I right? Then they will apply the Garner versus Murray's case law. And at least 1 insolvent partner should be required. All are I am telling the minimum figures. So maximum insolvent partners, any number they can. Maximum solvent partners also any number they can. But minimum 2 solvent partners and at least 1 insolvent partner should be required to apply this case. Okay. So the same thing here I explained. Concentrate. Garner versus Murray's rule is applicable only if at least 2 solvent partners and 1 insolvent partner exist. Capital ratio on insolvency. What is the meaning of capital ratio here? Fixed capitals given in the balance sheet will be the base for calculation of capital ratio. Current accounts will be ignored. Sir, if any partner's loan under the asset side is there, you need to adjust, but here not given. Under the fluctuating capital method, capital account balances as per balance sheet, you can take in. Oh, I forgot to add reserves and surplus here. Just a second. You can add if any of the reserves and surplus given in the balance sheet as well. Just a moment. Note is hanging. So right, guys. So capitals in balance sheet, if any reserves and surplus is there, you can add. And if any drawings is there, also you can less, guys. Interest on drawings, you reduce, right? Drawings also I forgot. Drawings is there, you can reduce. Okay. So now see here, all of you, what exactly the meaning of capital in case of fluctuating capital method? It is given. Capital accounts balance as per balance sheet plus reserves and surplus plus interest on capital plus partner's salary plus partner's commission minus drawings minus interest on drawings. Then you will get certain capital. With that capital, you can compare to know the capital ratio of the solvent partners. Okay. So with this base, all partners insolvent. Please concentrate. The next topic is all partners insolvent. So the method of or the type of problem is all partners insolvent. You know, if all partners became insolvent means partnership firm itself insolvent. Now, till now, the problems we made up to problem number 1 to problem number 3, our partnership firm went to the dissolution not due to insolvency of partnership firm. Partnership firm is solvent. Maybe 1 or 2 partners are insolvent. That is different story. But here all partners became insolvent. So the first and foremost thing you should need to remember, if all partners are insolvent, partnership firm also insolvent. So partnership firm insolvent means firm is unable to repay. Firm is unable to repay amount to all liability holders. Firm is unable to repay amount to I can write like this. Firm is unable to repay amount to total of the amount to total of liabilities. So firm is unable to repay amount to total of the liabilities. I mean, we can repay up to certain portion of the liabilities only. Now, how you can close the books of accounts, sir? Now consider all of you. This is the partnership firm, right? This is the partnership firm. Okay. If this is the partnership firm, we have two sides, left hand side as well as right hand side. We have two sides. One is left hand side, another one is right hand side. What is this left hand side and right hand side, sir? One side, consider all of you, one side, we are unable to repay liabilities. We are unable to repay certain portion of liabilities. Certain portion of liabilities. But the other party unable to collect. He is unable to ask. Why? Because your private assets are not enough to repay your private liabilities itself. Then only all partners became insolvent. Then only partnership firm is insolvent. So literally, if you are unable to make payment to any other party, means which is profitable situation or loss situation? Profit situation, guys. Sir, liability is vanishing. You are unable to make payment means liability got vanished because you are insolvent. The other party do not have a right to ask. Why? Because you already made an insolvency petition in the court. That means for partnership firm point of view, sir, if you no need to pay money to any person, then which is profitable? Loss. That is profitable situation. So this situation will leads to profit. This situation will leads to profit. Next, in another angle, what happened? Partners are there, na? Partners capitals having debit balances, na? Now, if you ask money from the partners, partners will not repay. Partners unable to repay. Why partners unable to repay? All partners became insolvent. All partners became insolvent. So due to insolvency of partners, due to insolvency of partners, we may not recover money from partners. We may not recover entire money. I will put like this. We may not recover entire money from partners. Maybe some portion they can give if they are 1/4 if their estate can able to pay, or 10% if they can able to pay, they can pay. But entire amount we may not recover. So due to non-recovery of amount from the partners, which leads to loss situation. So now, due to unable to making payment to the certain creditors, we are achieving the profit. Due to unable to recover amount from the partners, we are achieving the loss. The profit is exactly matched with loss, then books of accounts are closed. This profit, we are going to make it transfer to deficiency account. This loss is also make it transfer to deficiency account. Then automatically deficiency accounts also got closed. So that means we are not following DTS approach here. No, still we are following DTS approach. Disposal of assets happen. First dismantling of balance sheet happen. Disposal of assets happen. Disposal of liabilities happen. But one thing, we are unable to repay all the liability holders, right? So that's why in the order of preference, you may not transfer the entire liabilities to the realization. Certain portion of the liabilities you can put aside. Because we are paying only certain portion only. What really happening we can see in that particular account. So for that purpose, we are make it separate that particular portion of the liability. Now you are unable to make repay to the entire liability holders, right? Certain portion unable to repay. That portion you can make it transfer to the deficiency account. The same way, partners capital account you are open. Partners capital accounts also you are open. So D, D, T, T. Anyway, partner unable to take over any asset or liability. So transfer of realization profit also we will make. Then finally, at the time of making settlement to the partner's capital, we may not recover certain amount from the partner's capital. That amount also you can make it transfer to deficiency account. Then partner's capital accounts closed. The portion of the creditors which they are not getting the amount also closed with the deficiency. Deficiency account also closed. So all the such things, I make it imagine in the air. I can understand from your point of view. Without putting any figures, it is so much of difficult task to understand. So my logic is, the portion of the creditors for which you are unable to make repayment, that portion you can make it transfer to deficiency. The portion of the amount of the capital need to be recovered from the partners. If you are unable to recover that portion also, you can make it transfer to the deficiency. Then capital account closed, that liability account closed, deficiency account also closed, because the profit you are enjoying from the non-payment to the liability holders is exactly as equal to the loss you are incurring due to non-recovery of amount from the partners. Such things are automatically nullified in the deficiency account. Do you understand? Now, such all things I am going to see through problem number 4. So just I'll write here one line, then I'll go to problem number 4. What is that? The line is, the conclusion is, profit from non-payment to certain liability holders, match with or nullified with loss from non-recovery. So loss arised due to non-recovery from partners. So such both the things we are making transfer to deficiency, then automatically deficiency account got closed. Such all issues, let me see through the problem, which is problem number 4. Consider all of you, problem number 4. Come to problem number 4. Amal and Bimal are in equal partnership. Equal partnership means profit sharing ratio 1:1. 1:1 is the profit sharing ratio. Their balance sheet stood as under 31st March 2011 when the firm was dissolved. Plant and machinery given, furniture given, data, stock, cash, Bimal's drawings, creditors and Amal's capital is given. That means Bimal's drawings is given, means that is Bimal having a debit balance in capital account. You can call it as capital account debit balance or drawings, anything is same. So Amal's having credit balance in his capital. Next, the assets realized are as under plant and machinery, we get something, furniture, debtors, stock is also given. The expenses of realization amounted to 175. Amal's private estate is not sufficient even to pay his private debts, whereas Bimal's private estate has a surplus of 200 rupees only. He is having a surplus of 200 rupees only, means, for example, if Bimal's need to pay more than 200 to the partnership firm, then Bimal is also become insolvent. His private estate having surplus of only 200 na. For example, in our partnership firm, Bimal's having a debit balance of more than 200, then we can tell that Bimal is also became insolvent. Show the necessary ledger accounts to close the books of firm. That means indirectly he is telling that Amal and Bimal both are insolvent. All partners are insolvent. Sir, how you know, sir? Right now itself, Bimal is also become insolvent. If you are not having a confidence while doing the problem, you can easily find that. Okay. So now let us start the problem in our OneNote, which is problem number 4. So come here. Problem number 4 answer. Show the necessary ledger accounts. You can start with realization account. Another account is cash account. Sir, here if you see only one liability is there, which is creditors. Don't transfer creditors to realization because we are unable to make repayment to the creditors. You know, if all the partners are became insolvent, means firm is also insolvent. Firm is unable to make repayment to the creditors. So that's why you can open the creditors account separately. Open creditors account separately. So apart from that, only 2 partners are there, right? You can open the partners capital accounts as well here. If I open partners capital accounts, just a second, I'll adjust here, no worries. So I'll open creditors account here. So partners capital accounts is here. Partners capital accounts. Particulars. Amal. Bimal. Okay, right? Right, consider guys. These are the partners capital accounts. So all of you please start the format from your side. Right, no consider guys. Oh, here other accounts are also need to draft, right? So which is realization. So here which is cash account. And it is creditors account. Right, concentrate one by one. Start with DTS approach, all of you. So disposal of assets. What are all different assets are there? Plant and machinery, furniture, debtor, stock, except cash. So cash first you can start here. To balance brought down directly, which is 200. Then remaining assets you can make it transfer to realization. I can put simply to sundry assets. To sundry assets. How much, sir? Total assets is 5,550, out of which cash we already transferred separately, which is 200. And Bimal's drawings, that is capital account debit balance, is also not an asset, which is 550. Remaining all are assets, right? Now sundry assets figure how much? 3550 minus 200 minus 550. Sir, multiple times I'm telling, don't put like this in the examination. You can write one by one asset, which is 4,800 under realization. Next, coming to the liability, creditors we open separately here. Buy balance brought down. How much? 4,800. Next, guys, Amal's capital and Bimal's capital. Amal's capital, here you can put buy balance brought down, positive figure. Amal, how much? 750. Bimal is to balance brought down. Bimal is to balance brought down. How much? 550. Hyphen. Dismantling of balance sheet over. Disposal of assets. So it is clearly given, while disposing the assets, you will get buy bank to realization. In bracket, you can mention plant and machinery 1250, furniture 150, debtors 400, stock 500, make it total 1250 plus 150 plus 400 plus 500. I got total 2300. In realization by bank, in cash account, that is by cash, in cash account to realization, cash account to realization, that is 2300. Am I right? Next. Now in the order of payment is you can start making disposal the liabilities. First liabilities realization expenses 175, entry realization to cash, in bracket you can write realization expenses. How much is the realization expense? 175. Next in the order of payment only one liability is there, which is creditor, right? Now realization to cash means cash flow by realization also you can give a posting, don't ignore, which is 175. How much cash balance is there with you? 200 plus 2300 minus 175. I have 2325 rupees as cash in my hand. But how much amount you need to pay, make it payment to the creditors? 4,800. 4,800 amount you need to pay to the creditors. Your firm is unable to make repayment to the creditors itself. Then what you will do, you will ask the partners immediately. Your firm is unable to make repayment to the creditors na. In liquidation chapter we seen, if you are unable to make payment to any of the creditor, what you said, liquidator will ask uncalled money. In the same way, I will check the partner's capital. I will ask the partner's capital, sir partner, it is clearly given Bimal's private estate has a surplus of 200 rupees only. Am I right? Now, if you check, Bimal is there, right? Bimal, to balance brought on 550 is there. I will ask such 200. Then he will introduce such 200 rupees cash. Then entry by cash account at R2, Bimal's capital account. He introduced such 200. Partner's capital by cash. Then in cash to Bimal's capital. To Bimal's capital. Now, how much cash balance is there with me, right? 2325 plus 200. I got 2525. I have 2525. You can pay that cash to creditors. To cash 2525. Remaining is deficiency. Remaining is pure deficiency, guys. How much? 4,800 minus 2525. 2275 is the deficit. 2275 is the deficit, guys. You can open one more account, which is deficiency account now. Which is deficiency account. Concentrate. Now, which is profit actually. We are unable to make payment to creditors means which is profit. So in creditors to deficiency means in deficiency by creditors. How much? 2275. Now you can close the partner's capital account. But before closing the partner's capital account, first you should close the realization. How much profit or loss? Loss here by Amal's capital, by Bimal's capital. I am following DDTTS approach only. So disposal, dismantling over, disposal over, takeover not there, transferring of realization profit or loss I am making now. The balancing fare, how much here? All of you. 4,800 plus 175 minus 2,300. I got 2675. Profit sharing ratio equal. So 2675 divided by 2 means 133.8 for one person, 133.7 for one person. Okay. In realization by partner's capital, in partner's capital by realization. So 133.8, 133.7. Now you can cross check. You can close the partner's capital. Amal, how much? 750 plus 133.8 minus nothing, which is how much, guys, here? For Amal, I'm talking Amal. To balance carried down 2088. Now you can check about Bimal, guys. You can check about Bimal. 200 plus 1337 minus 550. Sorry. That's where wrong balance is coming. Just a second, please, all of you. So in realization by partners capital means in partners capital 2 realization, wrong side I made a posting. Just a minute. 1338, 1337. Yeah. Now you can cross check, all of you. Close the partners capital account. Amal, buy balance carried down. That is how much you are getting. How much you are getting? 1338 minus 750, which is 588, right? Which is 588. Just a second. Here, how much? 550 plus 1337 minus 200. Here I got 1687. What is the meaning of this, sir? Don't put buy balance carried down. This is actually debit balance. Sir, buy balance carried down means two balance brought down only, right? What this balance is, I will ask partners. So debits are more, credits are less. I will ask partners. Already partner Bimal introduced 200. He unable to introduce any more. Amal estate is private estate, unable to repay its private debts. That's why Amal cannot introduce anything. So that's why this 588, 1687, I unable to recover from the partners. I'll make it transfer to deficiency, which is loss actually. So I can make it transfer to deficiency and I will close partners capital accounts. I'll close partners capital accounts. Now in partners capital accounts, by deficiency, in deficiency account, two partners capital. That is to Amal and Bimal's capital. How much, guys? Make it total here. 588 plus 1687 2275. So now the deficiency account also got closed. Now if you check, realization account got closed, cash account, while making a creditors payment to the creditors itself, cash account closed, but simultaneous entry not passed. Creditors to cash means in cash by creditors 2525. At that point of time itself, cash account got closed. Okay, so cash account is over. Creditors account closed by transferring to deficiency. Partners capital accounts closed by transferring to deficiency. Deficiency account getting the same profit, getting the same loss. Deficiency account got also closed. The same fact I mentioned before doing the problem. Sir, we are unable to repay certain portion of the liabilities, which is profit to you. We are unable to recover certain portion of the partner's capital, which is loss to you. The profit and loss, we can make it transfer to deficiency. So the profit can be nullified with the loss. That's why the deficiency account also got closed. So that means in case of all partners insolvent, the only caution you should need to take is don't transfer all the liabilities to the realization. Make it separate the creditors, because we are unable to make it repay to the all creditors. That's why the portion of the creditors unable to repay, you can make it transfer to deficiency. In the same way, the portion of the partners capital we are unable to recover from the partners, the debit balance of the partners capital we are unable to recover, you can make it transfer to deficiency. Then deficiency account got closed, such creditors account got closed, such partners capital account also got closed. Then all ledgers closed. This is the concept of all partners insolvent. In bracket mentioning, which is all partners insolvent. That's it, guys. So we are not found enough time to discuss about the piecemeal distribution. So the only pending issues in part number 1, the only pending issues, if you observe in the overview, so all partners insolvent also just now I completed. The only pending issue is two things are there. One is piecemeal distribution, another one is limited liability partnership. So the next lecture is exclusively dedicated to the piecemeal distribution and limited liability partnership. We can try to complete both the portions. Then partnership account, part number 1. So one more thing, we will complete the problems as well, right? Then partnership accounts, part number 1 officially will be completed at that point of time. Okay. So still, part 2T is more bigger than part 1. Part 2T is actually more bigger than part 1. So the partnership account itself is a large chapter. Okay, we will see the remaining 2 things under part 1 in the next video lecture. Until bye, have a nice day. Piecemeal distribution. Come here. My text. So only two more concepts are pending in part number 1 of accounts. One is piecemeal distribution, another one is limited liability partnership. Concept is piecemeal distribution. First let us check what it is, what it means. Concentrate. So during the process of dissolution, you are disposing various assets of the firm, right? Then you will make payment to the various liability holders. Do you think that in practically liability holders will wait till the end of realization of all the assets? No. So if, for example, creditor is there, he supplied goods to your partnership firm. Whenever you will realize a particular asset, he will start asking money. He will make so many phone calls to you. Yes, so money is having high value for business people. So rotation issues are there. That's why no one liability holder will wait till the end of realization of all the liabilities according to their preference. I mean, first we should make payment to realization expenses, then a liquidator remuneration, then partner's loan, then secured creditors, then unsecured creditors, then partner's loan, then partner's capital. So according to their preference, they will come and they will ask the money. And from your point of view also, it is unnecessary thing to hold such money till the end of realization of all assets. Am I right? But till now, for the purpose of accounting treatment, we seen the entire problem as after completion of a dissolution, how the treatment would be, we seen actually for all the past problems. But practically, the timing factor is very much important. Whenever you dispose some assets, you should make payment to the immediate liability holder. Such process is technically known as piecemeal distribution. So this concept is not about accounting treatment. You already seen how to provide the accounting treatment, how to distribute, how to close. So then this concept is all about whenever you are realizing cash from assets, then how you should need to distribute such cash among the various parties is a matter of discussion. Now, such thing also we seen na sir, such thing also we seen na, that is the order of making payment, also we known, right? So that is order of making payment is first we should give to realization expenses, then liquidator remuneration, then secured creditors, then unsecured creditors, then partners loan as liability, then partners capital. Okay, now concentrate. Sir, there is no conflict arised at the time of distribution up to partners loan. Up to partners loan, there is no conflict arised at the time of making distribution of payment. There is no conflict. But at the time of distribution, among the partners, conflict will arise. How this is possible, sir? For example, if you are incurring the realization expenditure, then just you will incur. The liquidated remuneration that is based upon the realization of assets are based on the amount making payment to the different liability holders. You will get the liquidated remuneration. We've seen in the chapter liquidation of companies, the remuneration is of two types. One is based on percentage of assets he realized or based on percentage of payments made to different parties. You will simply calculate liquidated remuneration. Security creditors, for example, 10 security creditors are there. So 10 different security creditors are there. Just you realize 50,000 from a particular asset. You can make it distribute simply according to their outstanding liabilities. Am I right? In their proportion, just you will simply make it distribute. Unsecured creditors also in the same way. Partners loan is also in the same way. But coming to partners capital, once you realize the cash from a particular asset, then how you can distribute among the partners is the matter of discussion. Because if the cash is sufficient to repay all the partners capital, then nobody is bothered about that. Then nobody is bothered about to receive the cash. But here the problem is the cash is insufficient to make repayment to all the partners capital. Now, to which partner you can contribute? Do you thought that we can distribute such cash in the ratio of PSR? Or maybe do you thought that the cash available through realization of asset is going to be distributed in capital ratio? That is the matter of discussion here. Do you understand? The piecemeal distribution, we are distributing to the various parties, but conflict is arising at the time of distribution to the partners, among the partners. How we are going to distribute is the matter of discussion. Please concentrate, all of you. To resolve this conflict, we should distribute in systematic manner, systematic and justifiable manner among the partners. So for such systematic and justifiable manner, as per the Partnership Act, two popular methods are given. One method is known as relative capital method. This is also known as surplus method as well. Another method is maximum loss method. For which purpose these methods are developed, guys? To resolve the conflict among the partners and how you should need to distribute the cash among the partners once a particular asset or a particular group of assets realized. Am I right? Now, first let me explain how the conflict is going to resolve through relative capital method. Then I am going to discuss about the maximum loss method. Consider all of you here. So let us assume three partners are there. Partner A, partner B, partner C. Their outstanding capitals 1,75,60,000. Outstanding capitals. Just I am giving certain figures here. Okay, just my mind. With what are the figure? Just it is telling that I am giving such figures. 1,75,000, 60,000. Profit sharing ratio, let me take 5:3:2. 5:3:2. Now my question is, to whom first I need to pay money? To whom first I need to pay money? For example, A is contributed more capital, sir. You can pay entire money to A. If it is your argument, then B and C will foregone. No, sir. If we contribute on the basis of profit sharing ratio, then A will get more share, that is 5 shares. B will get the next preference. C will get the next preference. But do you think that it is the correct methodology? I mean, on the basis of capital ratio or on the basis of profit sharing ratio, Is it correct to distribute? Do you thought that that is the correct distribution? No, absolutely no. If you check here, you may think that, sir, partner A contributed more capital, that's why we can give first to partner A. After that, next partner B contributed more capital, then you can give partner B. Partner C contributed very less capital, that's why we should give at last stage partner C. That is completely wrong. You know why? Partner A contributed 1 lakh for his 5 shares of profit. Per share, how much he contributed? Per share, how much he contributed? Per share, he contributed, consider it here. Per share, A contributed 20,000. Just a second. Yeah. Come here. Per share A contributed 20,000. Per share B contributed 25,000. Per share C contributed 30,000. Now you can tell me, guys, per share who contributed much more? Per share A contributed only 20, B contributed 25, but C contributed 30,000. So it is justifiable to make payment to partner C in first instance up to per share 5,000, because once we will pay per share 5,000 to C, then he will also become 30,000 to 25,000. Tell me, guys. So if you compare per share, this is 20,000 per share, here 25,000, here per share 30,000. C is per share excess than B to the extent of 5,000. B is excess than A per share to the extent of 5,000. Now once per share I will pay 5,000 to C, then C and B will be equal. Then I will start distributing B and C equally per share 5,000. After that, I will share 555. Then again, B and C will also become to A. Then A will also per share 20,000. Then B will also per share 20,000. Then C will also per share 20,000. That is the justifiable manner. Now, if you consider here, let us assume if you distribute 5,000 per share to C first, per thousand per share first. Am I right? Once you distribute 5,000 per share, total 2 into 5,000, how much? 2 shares are there now. Per share 5,000, total 2 into 5,000, 10,000 he will pay. Now this will become 30,000. You already distributed 10,000, means 30,000 will become 20,000. Now you can check per share C 2 divided by 20,000. I mean 20,000 divided by 2. It will also become, oh, how much here? Sorry, yaar. Sorry. We pay 10,000, 60 minus 10,000, 50,000 is the outstanding capital. Please all of you concentrate. Out of this 30,000 per share, if I distribute 5,000 per share, then 5,000 into 2, it will be 10,000. Then 60,000 minus 10,000, remaining capital is 50,000. Now per share for C, 50,000 divided by 2 is equal to how much? 25,000. Now B is also per share 25,000. Then C is also per share 25,000. Am I right? Now you can start distributing in between B and C. Now you can please start distributing in between B and C. Now all of you, the capital is 1,75,000 and 50,000. These are the outstanding capital. Now per share, B is also getting 25,000. C is also getting 25,000. Now up to 5,000 you can equally distribute. Up to 5,000 means here B is getting 3 shares. That is 3 into 5,000. C is having 2 shares, 2 into 5,000. Now 3 into 5,000 is 15,000. You can distribute. Here 2 into 5,000 means you can distribute 10,000. Once the distribution is over, then A will become 1 lakh. B will become 75 minus 15, 60,000. C will become 50 minus 10, 40,000. Now if you observe, A will get per share 1 lakh divided by 5 means 20k per share. Sir, B will also get 60,000 divided by 3 means he is also getting 20,000. C, if you consider 40,000 divided by 2, he is also getting 20,000 per share. That means the order of making payments are, in the first instance, up to the 10,000 rupees, first you should need to make payment to C. In the next instance, up to 25,000 rupees you are getting. You should need to distribute in between the B and C in 3:2 ratio. Am I right? This is 25,000 in the second instance. In the third instance, whatever the amount you will get after 25,000, whatever the amount you will get, you should need to distribute among A, B, C in their profit sharing ratio, which is 5:3:2. So this order is the justifiable order. Now, in case of the relative capital method or the surplus method, we are distribute cash among the partners on the basis of greatest capital. Here, greatest capital means not the highest capital. Greatest capital means capital per share who have the highest capital per share. You can call it as a greatest capital. Among partner A and B and C, partner C has the highest greatest capital per share. So that's why to that extent of 5,000, first we should need to make payment to partner C. Then once you should need to make payment to 10,000, then partner B and C having equal capital base per share, equal capital per share. Now 75,000 divided by 3, you will get 25,000. 50,000 divided by 2, you will get 25,000. Am I right? So that's why up to 5,000, excess, how much they will get? Both are 5,000, 5,000. Now 5,000 into 3, 15,000, 5,000 into 2, 10,000. Up to such amounts, you can distribute among B and C, which is total 25,000. Once if you distribute such 25,000, A will become 1 lakh total. So that is A, we are not distributing till now any 1 rupee, that is 1 lakh. B will become 75 minus 15, B will become 60,000, C will become 60, here 10,000, here 10,000, he will become 40. Now, whatever the amount you will get in further, you can simply distribute in their profit sharing ratio, which is 5:3:2. Do you understand, all of you? But just now we made in unstructured way. I will complete the problem in structured way. The same, sir, the ultimate, the output is same, but we are doing such process in a structured way. Please, all of you concentrate here. How in the structured way we are going to done, I'll show here. Just for thought process, knowing the thought process, just I did here. Just a second. I'll take eraser. So just I'm erasing the things. Okay. Come here, guys. All of you. Yeah. So first we started with outstanding capital. Then profit sharing ratio. This is known as step number 1, outstanding capital. Step number 1. This is step number 1 is outstanding capital. Step number 2 is profit sharing ratio. Step number 3, you can do step number 1 divided by step number 2. Then you will get capital base per share, which is known as capital per share. That is capital base per share. Once you get the capital base per share, you can identify the lowest capital base per share. You should multiply such lowest capital base per share with each and every profit. You should multiply such lowest capital base per share with the respect to profit sharing ratio. That is step number 4 is lowest capital base per share. Lowest. Sir, why we should need to do, sir? Just please let me allow to do up to the end. Lowest capital base per share. Lowest capital base per share into profit sharing ratio. Now 5 into 20,000, you will get 1 lakh here. 3 into 20,000, you will get 60,000. 2 into 20,000, you will get 40,000. Now you can compare outstanding capital with lowest capital base per share into profit sharing ratio. Sir, lowest capital base per share into profit sharing ratio is actually known as, the actual name is relative capital. This step number 4 is actually, we can call it as relative capital. Relative capital is lowest capital base per share into TSR. Now you can compare the capital, outstanding capital with relative capital. That is step number 1 minus step number 4, which is outstanding capital minus relative capital. You will get excess capital. You will get excess capital. So excess capital 1 lakh minus 1 lakh, here 0. Here 75,000 minus 60,000, that is 15,000. Here 60,000 minus 40,000, you will get 20,000. Now, two partners is having balances. You should continue the process till the end, up to the time one partner will only having a balance. Up to the time only one partner having a balance. Now, excess capital is over now. This is step number 5 actually. This is step number 5 is step number 1 minus step number 4. Now you can continue the same process. That is, now you can consider the outstanding capitals as 15,000 and 20,000. So just you can put it as hyphen 15,000, 20,000. You can apply the profit sharing ratio, which is 3 to capital base per share, capital base per share. Here you are getting 5,000. Here you are getting 10,000. Now, relative capital you can find out. What is the meaning of relative capital? Lowest capital base per share. 5,000 into respective profit sharing ratio. That is 5,000 into 3, 15,000, and 5,000 into 2, which is 10,000. Now you can compare this one now. From here you started now. This is capital outstanding from your point of view in the second level. Now 15,000 minus 15,000, the excess capital is nil here. 20,000 minus 10,000 here, which is 10,000. Now, sir, where is the order of payment, sir? Where is the order of payment? The excess capital you will get at the lower level. In the first instance, you should need to make payment. First instance. So in the earlier, in the unstructured way, what we get, first you should need to make payment to partner C to the extent of 10,000, right? Now also we get 10,000. In the second instance, we should take this portion. Sir, actually we have two relative capitals. If you check, two excess capitals, this is excess capital 1, this is relative capital 1. Just for understanding, I'm telling you, this is relative capital 2, excess capital 2. First, you should consider the excess capital 2. After that, you should consider the relative capital 2. This is the second you should need to make payment. So we already decided in the second instance, up to 25,000, you need to distribute among B and C in 3:2 ratio. We get the same thing. And in the next level, you should need to make payment to the relative capital 1, which is 1,60,000, 40,000. If you check here, capital base per share, here he will get 20,000. Here also he will get 20,000. Here also he will get 20,000 capital base per share. That's why in the third instance, you can make payment. Now, so just I am representing here summary of payments. Summary of payments. So total first, second, third, right? Sorry, we'll write here first, second, third. So total partners A, B, C. Sir, in the first instance, we should need to make payment to whom? C, right? You can put 10,000 here. In the second instance, B and C, B 15,000, C 10,000. In the third instance, to all the partners, 1,60,000, 40. 1,60,000, and which is 40,000. Now, for A, total is, you can write the totals here. For A, the total, whether it is sufficient or not, you can check. Here 15 plus 60, 75,000. Here total is 60,000. Now the first installment total 10,000. Second time total 25,000. And in the third instance 2 lakhs. So just I'm mentioning in which order we should need to make pay. That means up to realization of 10,000, you can give it to the only partner C. In the next instance, up to the amount of 25,000, you should need to distribute among B and C in their profit sharing ratio. In the next instant, whatever the amount you are getting, you should need to distribute among A, B, C in their respective profit sharing ratio, guys. So this is order of distribution or the summary of payments you need to follow. Now, sir, with this, what we learned, sir, with this, what we learned ultimately, with this, just we learned that whenever a particular cash mode is realized from a particular group of assets or a particular asset, how it should need to be distributed among the partners by applying the method relative capital or surplus method, by applying the method relative capital or surplus method. By applying the method relative capital or surplus method. Now, in unstructured way, what we decided, the same conclusion we get by following this procedure. Now I will open my OneNote. Please all of you concentrate here. What he's given here, let us have a look. Piecemeal distribution. Till I'm not yet discussed anything about the other method. That is, what is that method, guys? Maximum loss method. Not yet discussed anything. First only I'm discussing about the relative capital or highest relative capital or surplus method. Whatever the name you can put it as. Generally, the assets sold upon dissolution of partnership are realized only in small installments over a period of time. Certain portion we will get now. Again, if you sell the buildings, we will get something. If you sell the stock, we will get something. Like that, we will get a small installments. In such circumstances, the choice is either to distribute whatever is collected. Whatever is collected, we can distribute at the same time, or to wait till the whole amount is collected. Usually, I mean, practically, the first course is adopted. So nobody is interested for the second course because everybody is in need of money. In order to ensure that the distribution of cash among the partners in proportion to their interest in the partnership concern, either of the two methods described below may be followed in determining the order in which the payment should be made. Piecemeal distribution is all about the order in which you should need to make payment to the different partners' capital. In liquidator final statement, how you find out the order for the different parties, here also in the piecemeal distribution, in the same way, you should need to make distribute among the various parties. There is no conflict in distribution among the parties other than partners. If you check here in my OneNote, there is no problem, or there is no conflict in distribution of amount among the different parties. We'll have a clear-cut picture, but there is a conflict arised at the time of making distribution among the different partners. For that purpose only, these methods are adopted. Such methods are maximum loss method and highest relative capital method or relative capital method. Now, so here actually two different names given. I gave one more method name, that is surplus method. We can also call it as highest relative capital method only. That is either highest relative capital method or proportionate capital method. According to this method, the partner who has the higher relative capital, that is whose capital is greater in proportion to his profit sharing ratio, is first paid off. That is simply he is telling that first to whom we should need to make pay, the partner who is having more or the highest capital according to their profit sharing ratio. According to their profit sharing ratio, C has the highest capital. To such partner we should need to make first. That is known as the greatest capital. Step number 1, outstanding balances in balance sheet will be taken as the base capital. If any partner's loan appearing under asset side in balance sheet, it will be reduced from their respective partner's capital. Why, sir? Sir, partner's loan under asset side is nothing but our partnership firm give a loan to the partner. If you ask such a loan from the partner, then he is telling that you should need to pay the capital account, right? You can set off. So that means the net balance only need to be payable to the partner. At the time of distribution of cash, as a partnership firm, you can think in your mind that how much amount need to be payable to the partner. That is capital outstanding in the balance sheet minus amount he is holding as a partner's loan under assets. That is nothing but loans and advances given by our partnership firm to the partner. We will nullify with each other. The remaining amount only need to be payable to such partner. So that's why whenever partner's loan is appeared under asset side, it should be reduced from the partner's capital. For the remaining capital only, the distribution need to start. Okay. Step 2, profit sharing ratio. Step 2 is profit sharing ratio. Step 3, capital base per share, which is step number 1 divided by step number 2. Then start with step number 4, which is relative capital. Lowest capital base per share into respect to profit share. If you observe here, first I started the outstanding capital, then profit sharing ratio, then capital base per share. Lowest capital base per share into the respect to profit sharing ratio, you will get relative capital. After completion, that is then step number 5, excess capital is equal to step number 1 minus step number 4, outstanding capital number minus relative capital, then you will get excess capital. After completion of all the above steps, if there is balance at more than one partner and their balance is not in profit sharing ratio, the above steps will be repeated till the balance end up with one partner, or the balances will end at their mutual profit sharing ratio. So the procedure should be repeated till the end of the partner, till the end one partner will get the balance, or at least if more than two partners balance is appearing, such balance should be in the form of profit sharing ratio. Such balance should be in the form of profit sharing ratio. Now if you check here, more than one partner balance end, but is there such capitals are in their profit sharing ratio? Excess capitals I am talking. Excess capitals are not in profit sharing ratio. That's why you can continue the procedure till the end one partner is end up with their share, or maybe more than one partner can also end up with share, but such excess capital should be in the profit sharing ratio. Then only you should stop such procedure. Do you understand what I am telling? Okay, after knowing the order of payment, you should need to present the summary of payments. This is not the main answer. This and all is working note. Where is the main answer, sir? This is the order of making payment now. Now the cash availability, you should need to make distribute to the different parties whenever partners time is came, whenever partners time comes, then you should need to start distribute in this particular order. Do you understand? The problem is very bigger, but a lot of issues are only clerical issues. The only important issue will start here whenever the partner, whenever you are start distribution among the partners, then only the respective method of capital, respective distribution of method will coming into the picture. Do you understand, all of you? Okay. So next, one more method is there. The method is actually maximum loss method. The method is maximum loss method. I don't want to tell you the maximum loss method at this stage, but I have I given a sufficient space. So I will discuss the maximum loss method at their respective place, guys. We will do problems on the relative capital method in the next video lecture itself. So once the problems completed on the basis of relative capital method, then I will start explaining the things related to maximum loss method. Then we can do the problem on the maximum loss method also. Okay, guys, I'll meet in the next video lecture. You can all of you revise the things what we have discussed till now. Bye-bye. Now, let us see about maximum loss method. All of you, please concentrate. Let us see about maximum loss method, guys. So let me take the same example for the discussion. The same example what I given in case of relative capital method. Let us take the same example. So that is particulars. Partner A, partner B, partner C. Outstanding capital, how much? It is outstanding capital. The same balances I am taken. Here 1 lakh. Here 75,000. Here 60,000. And profit sharing ratio 5:3:2. The same example I can take up. That's it. Now this is an example actually what we taken. Now, please all of you concentrate. How the maximum loss method will work, first I will tell you. For example, you are realizing cash from a particular asset. Let us assume you sold out plant and machinery. You are getting 5,000. Let us assume you are getting 5,000 cash realization. You are getting 5,000 cash realization due to making sale of plant and machinery. Let us assume this is 5,000 realization you are getting. Now the question is how you should need to distribute such 5,000 among the partners. That is the only question, right? At each and every time of realization, we should need to work out. We should need to work out like this. What is that? Sir, if you are realized 5,000, first assumption we can presume that this is the final realization. Remaining all assets are worthless. That is not real. Just for the time being, to apply the maximum loss method, we can presume that this is the only one final realization we have. Remaining assets realization is completely worthless, even we are unable to recover a single rupee from the remaining assets. If that is the case, the entire amount is expected loss only. The entire amount, 1 lakh plus 75,000 plus 60,000, that is 1 lakh 75,000 plus 60,000 to be need to payable to the partners. Total 2,35,000 need to payable to the partners. But only I can able to pay 5,000 means the expected loss is 2,30,000. The expected loss is 2,30,000. Now, the expected loss of rupees 2,35,000 distribute in profit sharing ratio 5:3:2. Now, sorry, expect loss not 2,35,000, 2,30,000, right? Make it total, guys. Then you have an idea. If you make it total, all the partners total capital is 1,75,000 plus, that is 1 lakh plus 75 plus 60. Here it is 1,35,000 plus 1 lakh, total 2,35,000. But we are having a realization of 5,000 means the expected loss is 2,30,000. Such 2,30,000 you are going to distribute in profit sharing ratio. Now, 2,30,000 into 5/10, how much? 1,15,000. This is 1,15,000 is the loss. Here is the loss. 2,30,000 into 3/10. That is 69,000. Next, 2,30,000 into 2/10. Yeah, 2,30,000 into 2/10. How much you got? 46,000. Am I right, friends? So which is 46,000. Now all of you please concentrate. After sharing the expected loss, you can find out the balance first. Here 1 lakh minus 1,15,000, 15,000 is negative. Here you will get a 6,000 positive balance. Here you will get a 14,000 positive balance. Now the second assumption coming, please all of you concentrate. After distribution of the expected loss, if any partner who end up with a negative figure, then we can presume that such partner became insolvent. Sir, whether he is really insolvent or not, that is not at all relevant for us. So then if you take a first presumption, it is a final realization? No, but for application of this method, just we can simply presume that this is a final realization. Now in the same way, you can presume the partner who end up with a negative balance as an insolvent partner. Then apply the Garner versus Murray rule. The insolvency loss caused due to insolvent partner should be borne by solvent partners. In which ratio? Their capitals ratio. Their capitals ratio. What is the capital ratio here? 75,000 is to 60. That is 15:12. Am I right? 515 is 75. 512 is 60. 15:12 is the ratio. Now the insolvency loss of rupees 15,000 distributed in capital ratio. So whose capitals ratio? B and C. So partners who is having a positive balance are solvent partners. So capitals ratio is 15:12. Am I right, guys? Can you agree, all of you? 515 is 75. 512 is 60, right? 512 or 514 is 12 only, correct. Not an issue. Yeah, tables I forgot. That's why I'm checking. Regularly using calculators, na? Okay. So in capital ratio of 15:12. Now we can distribute this 15,000 in this ratio. Now once you distribute, this loss is vanished. Now here how much? 15,000 into 15 by 27. That is 8,333 here. Here 6,667 here. Now you can check the balances here. Now the balances here become nil. Here become 2,333. Here difference is how much? 14,000 minus 6,667. That is 7,333 positive. Again, apply Garner versus Murray rule. You can presume that the partner who end up with a negative figure, we can presume that insolvent partner, such insolvent partner loss should be borne by the solvent partner. No need to apply the Garner versus Murray. Only one other partner is there. So is the solvent partner, insolvency loss should be borne by the solvent partner. Now, insolvency loss of rupees 2,333 borne by partner C. Partner C. Now here 233, here 233. Am I right? Now you can check here the balances. Here it is again nil. Here also nil. Here it is 5,000. What is the meaning of this, sir? Sir, realization, how much we realized? 5,000. Such 5,000 you can make it distributed to partner C. That's it. Sir, you need to present the statement like this for each and every time of realization. So the first and foremost presumption is you can presume that this is a full and final realization and remaining all assets are worthless. And during the process of distribution of such expected loss, if any partner is end up with a negative figure, we can presume that he is an insolvent partner. Such insolvency loss caused due to insolvent partner should be borne by the solvent partners in their capitals ratio. Now, such process you should need to continue till the insolvency loss will vanish. That means all the partners should get the positive balances. Such you should need to continue such process. So just the assumptions I am writing here, please concentrate. This method is having certain assumptions. What are such assumptions, guys? Just now we learned this. The first and foremost assumption. Realization from that particular asset is final realization on the assumption that remaining assets are worthless. So if the remaining assets are worthless means there are no other realizations exist. Number 2, after distribution of expected loss, partner having negative balance, negative or debit balance, treated as insolvent partner. Such a loss should be borne by solvent partners in their capital ratio. So these are the 2 assumptions we need to follow at the time of conducting the problem under maximum loss method. So like this, you should need to present the statement at the time of realization of each and every group of assets at the time of each and every installment. Okay, so once if it is finalized, then the order of summary of payments, you can easily know. Then accordingly, you can simply make it distribute the amount to various parties. So this statement doesn't change. What is the statement? This statement is there now, final statement. That statement doesn't change. That is statement showing distribution of cash among various liability holders and partners. That doesn't change. The only working note earlier we made under highest relative capital method. Now you should need to check to which partner I should need to payment first. That is based upon the distribution of the loss. That is the only difference, guys. So let us take one problem for discussion. Then if you have still any myths regarding the... Hi friends, very good morning. In last class, we completed up to piecemeal distribution problems, except limited liability partnership firm. Remaining all models we covered. That is simple dissolution, Garner versus Murray rule applicability, all partners insolvent case, piecemeal distribution in case of highest relative capital method, and in case of maximum loss method. Am I right? Now this is the time to discuss about limited liability partnership firm. Once I completed that portion, I'll shift my focus on part 2 of partnership accounts. Okay, today I'm going to introduce part 2 of partnership accounts as well, along with limited liability partnership firm. Okay, come to my text, all of you. So first, before proceeding with my text, just I'll give the brief intro related to the limited liability partnership. We are not doing any problems related to LLP in this chapter. Just we will see the exclusive theory, that is provisions of LLP Act 2008. You know, in case of partnership firm, the major disadvantage is liability is not limited, which is jointly and severally. If partnership firm is unable to make repayment to their liability holders, then it is the responsibility of each and every partner to contribute such cash from their personal assets as well. But in case of company, the liability of the company itself is limited. I mean, the liability of each and every shareholder of the company is limited. That is to the extent of unpaid value only a liquidator can ask at the time of liquidation, or the maximum amount contributed by a particular shareholder is the maximum is face value. Am I right? So such thing is actually advantage in case of the company, which is actually disadvantage in case of the partnership firm. That is actually one of the reason for introduction of company accounts as well, company form of organizations in practically. Now, the limited liability partnership firm is a combo of partnership firm as well as company characteristics both. I mean, still the entity can continue as a firm, but it have a characteristics of the company. I mean, such a type of hybrid entity, we can call it as not a partnership firm, not a company. We can call it as body corporate. We can call it as body corporate. You would already learned the definition of body corporate in company law. So body corporate is a separate entity which have the existence of separate legal entity and which contains the characteristics of the company like limited liability to the extent of a capital contributed by such persons. Am I right? That means, what is the advantages of introduction of such type of entities? Now, a particular person who unable to comply, who unable to follow the compliance as per the Companies Act 2013, with very less compliance, they can start their business activities with the futures of the business. That is the major advantages in case of limited liability partnership firms. You know, our all chartered accountant firms, our all existing chartered accountant firms, either it may be a partnership firm or it may be a limited liability partnership firm. It may not be a company. So our chartered accountant are not conducted. Our chartered accountants are unable to conduct our business activities in company point of view, we can only able to continue our business either by putting a sole practice, that is sole proprietor, or partnership firm or limited liability partnership itself. And one more thing, sir, even though the entire provisions of the LLP is actually based on LLP Act 2008, but the administrating and governing provisions are within the purview of MCA, Ministry of Corporate Affairs. How a company is in generally we are incorporated by going to the MCA website, then you should need to fill certain forms. Okay, that is actually particularly known as spice forms. So in financial statements of companies for group 1 students, literally I explained all such things. Here also I attached some videos for your reference for related to the schedule 3 things actually. Okay, through that spice forms, just we will complete the incorporation procedure. In the same way, for the purpose of incorporation of LLP, we should need to go for MCA website, then where we should need to register a particular limited liability partnership firm. Just a second, I'll show that. I'll show the MCA website here. So I'm a practicing chartered accountant as well as professional. So that's why I have login ID and passwords in the MCA website, which I am opening mca.gov.in if you observe. Yeah, now if you see captcha is wrong, it is telling. Yes, now it's open, guys. Now if you check here, all of you, so what are all the different companies I'm dealing just shown here. Now if you check under MCA services, company services are there, right? In the same way, LLP services are also there. If you observe the highlighted portion, LLP services, company services, check LLP name, find LLP name, incorporation, annual e-filing of LLP, change LLP information, close LLP. So different forms also total given under the MCA services. Okay, as professionals, we are professionals, right? As chartered accountants, I have my workspace option here. So whenever I want to upload any forms with respect to my clients, I'll go to upload e-forms. I'll go to the upload e-forms, then automatically it will open. So the server is down, I think, so it is slowly opening. Okay. Yeah, if you check here, so normal forms or resubmission forms, just it is asking, I can go to the browse option, then I will attach the respective form, then I will upload here, guys. Okay, so like this, in generally, we will dealing with the Ministry of Corporate website, MCA website, in both the cases, that is in case of company compliances as well as LLP compliances. Okay, now let us see what about this limited liability partnership. What are the future or the nature of limited liability partnership, how it is different from partnership, or how it is in generally dissolute or comes to an end. Let us have a look, guys. One more thing, sir, in case of a limited liability partnership, who ultimately seen the affairs of the entity, that is, or who ultimately responsible for who are ultimately responsible for to follow the compliance are known as designated partners. So how in Companies Act 2013 Board of Directors, it is the responsibility of the Board of Directors to comply all such provisions of company law. Like this, in case of limited liability partnership firm, who are responsible for follow-up of all such compliances, that is designated partners responsibilities. Out of certain partners, out of all the partners, certain partners designated giving certain powers as well as duties. Such partners are known as designated partners, because maybe certain partners may acting as a sleeping partners as well. They are not come to the office on daily basis. That's why such partners in generally will not put it as a designated partner. We will see all such issues through our text here. Limited liability partnership. Limited liability partnership means a partnership formed and registered under a Limited Liability Partnership Act 2008. So LLP Act 2008. Nature of limited liability partnership. So he's explaining certain characteristics. A limited liability partnership is a body corporate, which is not a partnership firm, which is not a company, formed and incorporated under this act. Under this act means LLP Act 2008, and is a legal entity separate from that of its partners, actually, which is missing in case of partnership firm. So another very good feature of a company is separate legal entity. Separate legal entity means here LLP is separate from its partners. LLP is separate from its partners. But in case of partnership firm, partners and firm both are same. Am I right? So, and this is a legal entity separate from that of its partners. So that's why LLP have a separate uh, the person who is representing the LLP can make it sign, and LLP can be acting as a partner in another firm as well, or LLP can acting as a partner in another LLP as well, because which have a separate legal entity concept. Now we can treat it as a separate legal entity means as like individual, it can contribute as a partner in partnership firm, or it can be contributed as a partner in case of LLP as well. A limited liability partnership should have a perpetual succession. Perpetual succession. What is the meaning of perpetual succession? Perpetual succession means even though all the partners of LLP died, then still the limited liability partnership firm is going to continue its business activities as like company. But in case of partnership firm, if all partners died, then partnership firm need to be closed. Sir, how if all partners died, how it will be continues their business activities? So at the time of incorporation of LLP itself, they will clearly mention the legal heirs of each and every partner. Then once all the partners of LLP died, then such business is in the hands of the legal heirs of such died partners. Do you understand? Any change in partners of a limited liability partnership should not affect the existence, rights, or liabilities of the limited liability partnership. Just is telling that internally, if there is any reconstitution happen, but the existing liabilities, rights, and any responsibilities doesn't change. Save as otherwise provided, the provisions of the Indian Partnership Act 1932 should not apply to a limited liability partnership. So Partnership Act 1932 is not applicable. LLP Act 2008 is applicable. As per Section 5 of LLP Act, any individual or body corporate may be a partner in a limited liability partnership. If you observe here, another LLP can also, we can act as a one of the partner in LLP. You know how it is workouts are. LLP have a separate legal entity concept. So that's why here body corporate means another LLP can also acting as one of the partner in the current LLP. That is the point he is mentioning. I already discussed this one. As per Section 6 of the LLP Act, every limited liability partnership should have at least two partners. So for partnership firm also at least two partners. As per Section 7 of LLP Act, every limited liability partnership should have at least two designated partners. Now, if the LLP is having only two partners, such two partners should be designated partners who are individuals. Designated partner should not be a body corporate. Designated partner is an individual, and at least one of them should be a resident in India. Sir, why only individual can be appointed as a designated partner? Because designated partners having certain responsibilities. Sir, if you appoint a body corporate as a designated partner, if such party is not comply the provisions, how you can punish that body corporate? Am I right? So that's why it is clearly mentioned in the act that only individuals can only be appointed as a designated partners. Okay, come below. Liabilities of the designated partner. What are the liabilities of designated partner? As per Section 8 of LLP Act, unless expressly provided otherwise in this act, a designated partner should be, here liabilities of designated partner given. So that's why the designated partner should be individuals. This question was already asked, guys, once upon a time in the examination. Sir, can you explain the liabilities of designated partner as per LLP Act 2008? That is the question actually previously tested in the examination. Now consider all of you. As per Section 8 of LLP Act, unless expressly provided otherwise in this act, a designated partner should be responsible Liable, these are nothing but responsibilities or liabilities. Responsible for the doing of all acts, matters, and things as required to be done by the limited liability partnership in respect of compliance of the provisions of this act, including filing of any document, written statement, and the like report persistent to the provisions of this act, and as may be specified in the limited liability partnership agreement. It is also liable to all penalties imposed on the limited liability partnership for any contravention for such those provisions. It's very simple. Why designated partners concept is introduced in LLP? Now, the individuals who are appointed as a designated partners should attain certain responsibilities. They should have certain responsibilities. The first and foremost responsibility is such designated partners should comply all the provisions of LLP Act with respect to filing of forms, returns, statements as per the MCA website. I showed previously, right, in the MCA website, we need to file so many forms now. So as per MCA, if you check, I'll put LLP forms here. Just a second. What are the different forms they need to actually file? If you check here, LLP forms download, these all are e-filing forms. These all are e-filing forms. Okay. So it is a responsibility. It is the responsibility of each and every designated partner to file all such forms. So notice for change of name, statement of accounts and solvency, annual return for a limited liability partnership. Are you seeing? Are you checking, guys? All of you, all these are highlighted portions. Okay. Intimating other addresses, notice for change in place of registered office, application and statement for contravention of something. Okay. So like this, so many forms they need to file according to their situations. That is whose responsibility actually to comply all such provisions? Designated partner responsibility. Next, whenever they contravene, whenever there is a contravention of these provisions occur, it is the responsibility of such designated partners to pay the penalty. So maybe different penalties may be imposed as per the LLP Act 2008. Who are responsible, who are liable? So that is such designated partners are liable. This is the important question already tested in the examination. Next, coming here, guys, distinction between an ordinary partnership firm and LLP Act. Sir, which act is regulating LLP? LLP Act 2008, Partnership Firm, Partnership Act 1932. Sir, partnership firm is not a body corporate. LLP is a body corporate, right? We know. Separate legal entity concept is applicable in case of LLP, but it is not there in case of partnership firm. So group of persons with no separate legal entity in case of partnership firm. Creation, sir, it is created through LLP Act. It is created through an agreement. That agreement may be oral, that agreement may be written, but it should be created through LLP Act 2008. Registration, LLP registration is mandatory. Registration is mandatory. Sir, partnership firm registration is not mandatory. Sir, if at all, if you want to register a partnership firm, where we should need to register, sir? Register of partnership firms will be there. It is very near to the normal register office where in general properties and places are going to be registered. If you check clearly, either beside or in front of such main register office, another register office will also be there, which is register of firms and trusts. Actually, trust is also going to be registered. Societies are also going to be registered there. Partnership firms are also going to be registered there. So that is registration of societies, firms, and a trust actually happening at that place. Okay, so registration is voluntary. Only the registered partnership firm show the third parties. So registration is not mandatory, but practically everyone, whenever they want to start their partnership firm, they are going to be register such partnership firm by entering into a registered deed. Actually, the deed which is on stamp paper, they will mention each and everything, right? So that stamp paper, the deed should be ultimately sent it to the register office. Then register office, if you pay certain fees, then it will be registered by the registrar. Next, perpetual cessation is possible in case of LLP. It is not possible in case of partnership firm. Liability, limited liability. Liability of each partner is limited to the extent to agreed contribution, except in case of willful fraud. Except in case of willful fraud means if any they have an intention to deceive the public, then at that point of time, the liability is not limited to the extent of their capital. According to the fraud made by such persons, it will be the punishment will be decided by the respective acts. Am I right? Sir, but liability in case of partnership firm is jointly and severally. You would already learned in Partnership Act 1932 in your foundation level. So liability of each partner is unlimited. That is simply jointly and a several liability is there in case of partnership firm. Mutual agency there in case of partnership firm. So jointly and severally means mutual agent. Each and every partner is agent to the firm as well as other partners. But in case of limited liability partnership firm, that is not possible. Each partner can bind the LLP only by this own acts, but not the other partners. That's why mutual agency is not possible in case of LLP. But here each partner can bind the firm as well as other partners by his own acts. So mutual agency is exist in case of partnership firms. Designated partners concept is there in case of LLP. It is not there. No such provision in case of 1932. At least two designated partners, such are also individuals, and out of them one should be resident. Okay, number of partners minimum 2, but no maximum limit. Here minimum 2, the maximum limit in case of partnership firm is 50. Okay, legal compliances, only designated partners are responsible for all the compliances and penalties under this act. But in case of partnership firm, all partners are responsible to comply the Partnership Act 1932. Okay. So now just winding up and dissolution. First, for namesake, I introduced here. Sir, how an LLP is going to be dissolute. Sir, how a company is going to dissolute, we already seen. Now in this chapter, the partnership firm, at the time of dissolution of partnership firm, what are the provisions I need to follow? What is the accounting treatment we need to follow? We seen how the distribution should be made. That is through piecemeal distribution and the maximum loss method and the relative capital method. All such issues we seen, right? Now, this is the thing related to winding up and dissolutions of LLP. Under section 63 of the LLP Act 2008, an LLP may be wound up voluntarily or by the tribunal. In case of companies also, it can wound up voluntarily or by the order of tribunal. When at the order of tribunal, actually a company should need to be wound up, if you really remember. Sir, if the affairs of the company are against the sovereignty and integrity of the economy, or maybe the company itself is incorporated with an intention to deceive the public or making frauds, or the company is defaulted in filing their annual returns for a consecutive period of 5 years, or it is just an equitable basis, then only NCLT, where tribunal means National Company or Tribunal, actually close, right? Now let us see when voluntary liquidation is happen, when tribunal is make a call for winding up. Under section 64, LLP may be wound up by the tribunal. He is telling certain circumstances under the tribunal. If a LLP decided that it should be wound up by the tribunal, LLP itself decided, so let us make a petition to the tribunal, then tribunal will make an order for the winding up. If for a period of more than 6 months, the number of partners of LLP is reduced below 2. I mean, two designated partners are there. Maybe one partner died. Am I right? But still LLP is not come to close. So it have a 6 months time period. Then within such 6 months, you can add one more partner, then you can continue the business activity. If the LLP is unable to pay its debts, if LLP has acted against the interest of integrity and sovereignty of India, if the LLP has defaulted in filing of the statement of accounts and solvency with the registrar for 5 consecutive financial years, their annual returns, here annual returns are nothing but statement of accounts and solvency. For LLP, the additional form need to be submitted to the register of companies is solvency certificate as well. Solvency certificate means it can able to repay all their liabilities at right now itself. Okay, if the tribunal is of the opinion that it is just and equitable that the LLP is wound up. Now, last 3, 1, 2, 3. We were already discussed when the companies need to be wound up by the tribunal, if you really remember. Okay, so the remaining not 3, 4, total 4. Integrity, default in filing of the returns. Sorry, 3, just and equitable. These 3 we already seen. Now, additional 3 points is just giving that Sir, if the LLP is unable to pay its debts, or the partners is less than 2 members for more than 6 months, or LLP decided to wound up under the tribunal, here 3 new, here 3 already old. We've seen as per Companies Act 2013, the liquidation provisions where a company should need to be liquidate or winding up by the order of tribunal. Certain circumstances we've seen. So total 6 circumstances, guys. That's it. Sir, now can you please tell me the essence of LLP Act, sir? It's very easy. Please, all of you concentrate here in my OneNote. So now just we are seeing the summary of LLP Act. The summary are the provisions. Summary of limited liability partnership. Liability partnership 2008. So the act is very big. We are not seeing all the provisions, very few provisions. Just now we've seen. So number 1, LLP is a body corporate, which is not a partnership firm, which is not a company, which is a body corporate. Such body corporate need to be registered under which act? Such body corporate need to be registered under Companies Act 2000. Sorry, registered under LLP Act 2008. So the characteristics of the features of the LLP is it has separate legal entity concept. It has separate legal entity, and the liability is limited liability. Liability is limited liability. Tell me, guys. So it have minimum 2 designated partners. Minimum 2 designated partners. And such designated partners should be only individuals. Only individuals. And out of such one individual should be resident. Out of which one should be resident. Am I right? Next, apart from this, what we've seen, I think so these are the major or main provisions. Okay. Then we discussed the concept of liability of designated partners. Liability of designated partners. The responsibility of the designated partners. So this is as per section 8 of LLP Act 2008. What is the first and foremost responsibility? Compliance. Comply, I mean, I will put very simply, to comply the provisions of LLP Act 2008 with respect to filing forms, returns, statements, etc. Number 2, in contravention of above provisions, penalties, fines. In contravention of above provisions, penalties and fines need to payable. So these two responsibilities are lying with whom? Designated partners. Am I right? And one more thing we've seen, that is the difference between LLP and partnership. I don't want to discuss here. Okay. What next? That is the last scenario. That is winding up. Winding up of an LLP. We've seen, sir, such winding up may happen voluntarily. Yes, it may happen voluntarily, or it may happen through order passed by tribunal. Order by tribunal. Same tribunal, friends. Here, tribunal means national company law tribunal, only applicable in case of LLPs as well. Okay. We've seen certain circumstances, right? What are such circumstances? Can you please write one by one here? First, known circumstances I am writing here. The first and foremost one was making default. That is order by tribunal. I'm writing the circumstances in case of order by tribunal. Making default for filing returns. For filing returns. Making default in filing returns for continuous period of 5 years. It is against the affairs are against the sovereignty and integrity of the country. Sovereignty and integrity of country. So these all are common. We know already. We already learned such things under Companies Act 2013 itself. That is in the chapter Liquidation of Companies. And one more thing. What is that, guys? So affairs are fraudulent in manner. So now the new conditions here, if less than 2 partners for greater than 6 months, less than 2 partners are there for greater than 6 months. Am I right? Next, just they decided to wound up through tribunal. So one more is there. What is that, guys? There's also a new one. Okay. What is that? One thing I forgot. What is that? Unable to pay its debts. Simply unable to pay its debts. So these all are the situation in case it is ordered by tribunal, may be wound up. Am I right? So these all are the situations. With this, LLP is officially completed, guys. So please all of you check for a theoretical question. There may be a scope to ask such question for 4 marks. So with this, just I am closing this video lecture. Right, friends. Now we can start with partnership accounts too. If you observe, initially at the time of introduction of this chapter, I divided this chapter into 2 parts. Part 1, dissolution of partnerships. That is simple dissolution, Garner versus Murray, all partners insolvent, piecemeal distribution, and we completed limited liability partnership as well. Now, let us start with part 2 of partnership accounts here. Come below, friends, all of you, which is partnership accounts part 2. So in partnership accounts part 2, what we are going to discuss, first I will let you know. Sir, here we are going to see 3 major issues. Number 1, Number one, amalgamation of partnership firms. So what you listen is correct only, which is amalgamation of partnership firms. Already completed na amalgamation chapter that we completed in company's point of view with the help of AS14. Here AS14 doesn't applicable, but still we will see how the accounting treatment will going to done. Will be going to made. We will check here amalgamation of partnership firms. Next, conversion of partnership firm into company or the sole proprietor. Maybe anything is possible. So conversion of partnership firm into company or sole proprietor, anything is possible. Next, sale of partnership firm to another entity. Again, that entity is a sole proprietor, or maybe that entity is another partnership firm, or the other entity is a company, maybe anything is possible. Now, if you observe amalgamation of partnership firm and a conversion of partnership firm into company or sole proprietor, or sale of partnership firm to another entity like sole proprietor or partnership firm or company, whatever the case may be, if you observe in entire three concepts, there we need to provide accounting treatment in two types of books. That is how we seen in case of amalgamation, or in case of absorption, or in case of external reconstruction. How we are seeing the accounting treatment in only two different types of companies books. Here also we are going to provide the accounting treatment in two different entities books. One is selling entity, another one is purchasing entity. One is selling entity, another one is purchasing entity. Always, whether it is amalgamation of partnership firm or conversion into company or proprietor or sale of partnership firm to another entity, always the selling entity is a partnership firm. Always, for our accounting treatment purpose, always the selling entity is a partnership firm. Now, in case of amalgamation of partnership firms, the purchasing entity is also a partnership firm. The purchasing entity is also a partnership firm. Now, coming to here, conversion of partnership firm into a company, the purchasing entity is a company. Do you agree? Or if it is conversion of partnership firm into sole proprietor, then the purchasing entity is a sole proprietor. So the purchasing entity is a sole proprietor. Then coming to the last situation, so right, in case of sale of partnership to another entity, the purchasing entity may be a sole proprietor or a partnership firm or a company. Am I right? But only two different types of entities are there. One is selling entity, another one is purchasing entity. In all these cases, selling entity is always partnership firm. The purchasing entity may be different. Either it may be a company, or either it may be another partnership firm, or either it may be a sole proprietor. Do you agree, all of you? Now, sir, in case of amalgamation of partnership firm, what will happen, sir? In case of amalgamation of partnership firm, what will happen, sir? In case of amalgamation of companies, what is happening, or what happened? We already seen. Sir, a new company is incorporated to take over two or more companies. That is nothing but pure amalgamation. Pure amalgamation means a new company is incorporated to take over two or more existing companies. Such process we are known it as amalgamation. Now, in case of amalgamation of partnership firm also, a new firm is established to take over two or more existing partnership firms. Two or more existing partnership firms. The same concept here also. There is no difference at all. Now let us assume if you take two companies, that is two partnership firm A and Co and B and Co. Let us assume two partnership firms are there. Then these two partnership firms is liquidate, and such two partnership firms are taken over by establishing a new partnership firm, which is AB and Co. The new partnership firm is AB and Co, which is AB and Co. Now such AB and Co is new firm. We can call it as purchasing firm. And A and Co and B and Co, we can call it as selling firms. We can call it as selling firms. Now, such concept is known as amalgamation of partnership firms. That means in case of amalgamation of partnership firms, one purchasing firm will be there or two or more selling firms will be there. Do you agree, all of you? Now coming here, in case of conversion of partnership into a company, what will happen? Let us assume a existing partnership firm is there, which is A and Co. Now just they want to convert it as A Limited. The same management, there is no change in management. I mean, here in A and Co, who are contributed the capital's partners in A Limited, the same partners will be going to continue, because which is conversion. There is no other change. Only there is a conversion. There is change in legal form. Except there is change in legal form, remaining all are same to same. Here we can call it as partners capital. Here we can call it as equity share capital or the preference share capital, as the case may be. There is no change in assets. There is no change in liabilities. All are same to same. Now such A and Co is going to convert into A Limited. Such process is in generally known as conversion of firm into a company. Now here also two entities are there. One is purchasing company. This is purchasing company. This is selling firm. But two entities, selling entity, purchasing entity. Now coming here, in case of sale of partnership firm to another entity. So sale of partnership firm, let us take a company so-called as A and Co. Just a second. So here a company is there, which is A and Co. A company is there, which is A and Co. Such company is taken over by B Limited. Sir, why I used the term B Limited? Now in case of conversion of partnership into a company, there is no difference in between the partners and the equity shareholders. But in case of sale of partnership firm to another entity, there may be a difference in between the partners as well as the new equity shareholders. I mean, B Limited is altogether a new company. There is no relation. Or B Limited is an existing company which is managed by some other persons, Simply our partnership firm right now are selling our business to an unknown entity. That is the only difference. Here, which is also a selling firm, which is a purchasing company. Maybe the other entity is a firm, the other entity may be a company, the other entity may be sole proprietor. How it is different from conversion? In case of conversion, management is same, but in case of sale, the other company management may quite different. Now, in my point of view, there is no difference in accounting treatment in case of amalgamation, in case of conversion of partnership firm into company, or in case of sale of partnership firm into another entity. Do you know why? In whatever the situation, there are only two different types of entities exist. One is selling entities, another one is purchasing entities. And one more thing just I want to emphasize here. Sir, providing accounting treatment in the books of selling entity and providing accounting treatment in the books of purchasing entity is not a new concept. If you really understand the provisions of amalgamation, if you really understand the method of accounting treatment in amalgamation, both in case of selling company and purchasing company, almost partnership accounts part 2 is over. Provided you should know the basics of partnership accounts as well. Basics of partnership accounts means, sir, that is when a partnership firm going to start their business, how it will continue their business activities, how they will prepare the financials. Sir, if at all any reconstitution happen, like change in PSR, retirement of the partner, death of the partner, an introduction of the partner, what are the adjustment we need to be done? Then maybe they will do such things. After happening of such things, maybe amalgamation of firms may would occur, maybe conversion of partnership firm into company may would occur, may say be sale of partnership firm to another entity may would occur. Do you understand what I'm telling? First, my exclusively I will give focus on these provisions, that is related to amalgamation and conversion and sale provisions. Later on, I will inculcate through the problems continuation and reconstitution and such amalgamation, conversion and sale of partnership firms I will add up. Do you understand how the problem structure will look like in case of partnership accounts part 2? Okay, so without wasting much time, first let me entering into the topic amalgamation of partnership firms. So one more time I'm telling you, there is no difference. Even when I'm speaking amalgamation of partnership firms, both the entities are partnership firms. That is the only difference. So the same accounting treatment what I put up for amalgamation of partnerships, you can follow for the remaining, that is conversion of firm into company or sale of partnership firm into another entity. Now all of you come to selling firms books, the accounting treatment in the books of selling firms. Accounting treatment in the books of selling firms. Please consider, friends, here. Sir, what is the accounting treatment in the books of selling company? 5-step approach, na? Dismantling of balance sheet, PC due, PC receipt, PC distribution, final settlement to the equity shareholders. I'm not talking about accounting treatment in the books of selling firm. Accounting treatment in the books of selling company. The same accounting treatment here also followed with minor modifications, because there it is a company, it is a firm. That is the only difference, right? Now all of you please concentrate. So step number 1 here also what I will do, step number 1 here also I will do dismantling of balance sheet only. Dismantling of balance sheet. Sir, in case of dismantling of balance sheet, what you will do, sir? Assets and liabilities which are taken over by the purchasing entity, which are taken over by purchasing entity. Sir, why I'm using the purchasing entity? You know, the entity may be a firm, the entity may be a company, the entity may be a sole proprietor. In common parlance, just I'm using the word entity. So the entity is a company, or the entity is a firm, or the entity is a sole proprietor, whatever the case may be. Assets and liabilities taken over by the purchasing entity, closed and transferred to realization account. Closed and transferred to realization account at book values. Realization account at the rate of book values. You know this one already. Next, sir, for example, any assets or liabilities not taken over, what I should need to do? Assets or liabilities not taken over, what you would do? Separately open. Separately open. Simply you can open by providing a separate accounts, right? Why you are separately open? Maybe such assets and liabilities are not taken over by the other entity, na? Maybe our partnership firm will realize in the outside market. Sir, if we are unable to realize in the outside market, no worries, ultimately such assets or liabilities will be taken over by the partners as well. Do you understand? Either you can realize it in the outside market, or maybe such assets and liabilities which are not taken over by the other entities, such assets and liabilities may be ultimately taken over by partners. Anything may would occur. Okay. Sir, then partners capital, there's equity share capital. Here, partners capital, reserves and surplus, fictitious assets. There you should need to transfer to equity shareholders fund. Here you should need to transfer to partners capitals, partners capital accounts. With the respect to partners capital, you should need to distribute there. Now, please all of you concentrate. Out of here, partners capital anyway they are given with their respective partner. Then reserves and surplus and fictitious assets, in which ratio you need to transfer to partners capital? Their profit sharing ratio. You know such things, right? Because the reserves and surplus is belongs to the partners in their profit sharing ratio, which is nothing but P&L and other reserves. If anything is there, fictitious assets are also, we can simply distribute in their profit sharing ratio only. This is loss, this is gain actually. Okay, fine. Next. Sir, with this dismantling of balance sheet is over. With this dismantling of balance sheet is over. Next, consider it, guys. Like here, just I want to tell you one important point to you. Or first, let me complete the procedure. After that, I will tell you the important points after completion of steps. That is the better idea, I think so. So next, let me come to step number 2. Come to step number 2. What is step number 2? Step number 2 is purchase consideration due. Sir, what is the journal entry in case of PC due, sir? Can you please tell me, all of you? Purchasing company to realization in the books of selling companies. Now here, purchasing entity to purchasing entity account debtor to realization account. The same entries, guys. There are no change at all. I already told you, if you can understand accounting treatment in the books of selling firm in case of amalgamation, the accounting treatment is over. So purchasing entity account debtor to a realization account at the rate of purchase consideration. At the rate of purchase consideration. Sir, here purchase consideration do not have those many methods what you learned in case of amalgamation. Most of the times the PC is revealed in the firms, but if it is not revealed, you can find out by applying net asset value method. Most of the times, which is NAV method only. NAV method. Okay. Next. After step number 2, then which is step number 3? Step number 3 is PC receipt. So the purchase consideration, if the purchasing entity is a firm, you will get share in the new firm. Sir, if the purchasing entity is a company, you may will get equity shares of purchasing company, or the preference shares of the purchasing company, or debentures of the purchasing company, or cash. Anything may would occur, right? So that's why the PC receipt may be in any form. Please all of you concentrate. That is in the form of share in purchasing firm. If the purchasing entity is a partnership firm, share in purchasing firm account debtor. Or if the purchasing entity is a company, you may get equity shares in purchasing company, equity shares or preference shares or debentures of purchasing company. If it is cash is there, cash is also you can include, but I'm not mentioned here. Okay, no issue. To purchasing entity account, you can cancel the purchasing entity. That and all common, right? Now step number 4. Now step number 4. Now you need to distribute the PC distribution. How we need to distribute PC, we already know. The order you need to follow, that is first realization expenses. If any realization expenses you incurred, what is the entry? Realization to cash. Am I right? So the PC, first you need to incur for realization expenses. If any of the liabilities not taken over by the other purchasing entity, that is company or other partnership firm, then you should first make payment to secured creditors, then unsecured creditors. But before making payment to the partners capital, they are equity shareholders, but here partners capital, you should close. After that you should find realization profit or loss. Find realization profit or loss. Such a realization profit or loss you need to transfer to partners capital, right? Partners capital accounts in their profit sharing ratio. So where in case of selling company, just you make it simply transfer to equity shareholders, but here different partners may be there. So you cannot transfer the entire profit or loss to a single partner. You can make it transfer to all the partners in their profit sharing ratio. Next, come to step number 5, guys. All of you come to step number 5. Step number 5 is final settlement to partners. Sir, what you have to settle the partners finally? You have the purchase consideration in the form of share in purchasing firm, or equity shares of the purchasing firm, or preference shares or debentures. With that, you can make it simply given to partners capital right now. Now the entry is partners capital account at R2, partners capital account at R2, maybe share in the new firm, or maybe you can issue equity shares or preference shares or debentures of purchasing company. If it is the company of purchasing company account. So like this, you need to pass the journal entries, guys. This is the 5-step approach. What you followed in case of selling company, the same accounting treatment you need to follow here as well. Yeah, right. Now consider it, guys. Okay. So multiple times actually the green screen is disappearing out of my video. So that's why I changed my dress code as well. The dress color actually I changed. Now let us check. Maybe I thought of it will create a disturbance at the time of watching the lecture. So that's why I changed my dress color. Now let us try. So that is accounting treatment in the books of selling firms. We already completed. So just now we seen. But still lot to discuss here. Please consider all of you. What is that? I will explain here. Sir, you know, the difference issue is in case of company to partnership firm closure, maybe each and every partnership firm have certain internally generated goodwill, right? Certain internally generated goodwill by that partnership firm may exist. So if such internally generated goodwill is now a partnership firm is rising in their books of accounts, because now this is the time for sale of our partnership firm to another entity, that may be a company or a partnership firm. Now I should need to raise the goodwill in my books of accounts, because I will collect amount for the goodwill as well. Now I'm not only selling the existing assets, apart from the existing assets, I need to sell the goodwill also to the other party. Do you agree? Now for raising the goodwill, what is the journal entry, guys? For raising goodwill, you know, we already seen in the basics, at the time of raising the goodwill, the journal entry is goodwill account debtor to partners capital account, in their profit sharing ratio. Am I right? So goodwill account debtor to partners capital accounts in their profit sharing ratio. Do you agree, all of you? Now, once if you raise the goodwill, one additional asset is there in the books of selling firm. We know what are all the assets taken over by purchasing entity. Assets and liabilities taken over by the purchasing entity should be closed and transferred to realization account at the rate of book value. Now this goodwill also need to be transferred to realization account at book value. Now what is the journal entry? Realization account debtor, realization. All of you please apply the concentration here. This concept is little bit typical, but once you understood, for throughout the chapter you can easily appreciate. So realization account debtor to goodwill account. is the journal entry. Am I right? So the assets and liabilities which are taken over by the purchasing entity should be need to close and transfer to realization account at book values. Now, if you observe with these two entries, the net impact is goodwill here is debited, goodwill here is credited. What is the net entry? Can you please tell me, all of you, with these two entries, what is the net entry? I'll pass here the net entry. Net entry is realization account debtor. Alrighty, just a moment. Net entry is realization account debtor to partners capital account. To partners capital account. Now, this amount is goodwill amount in PSR, right? This is to the extent of the amount of the goodwill in profit sharing ratio. This is the net entry. Do we agree, all of you? On behalf of passing these two entries, you can directly make it pass realization account debtor to partners capital account, which is the net entry. Now, all of you, please concentrate. If I took realization account, let us assume here realization account is there. Now, the impact of this entry is, if this is the realization account, then the impact of this entry is realization to partners capital. That means in realization account, partners capital should need to increase. Partners capital should need to increase to the extent of the goodwill. That is the impact, right? In realization account, actually you will get a realization profit or loss. Such profit or loss, you ultimately make it transfer to whom? Partners capital only. In which ratio? Profit sharing ratio only. Now, in realization, you need to increase the partners capital. Indirectly, I'm telling that you can increase the realization profit. Tell me, guys. Sir, if you increase the realization profit to the extent of this goodwill amount, automatically there is increase in partners capital accounts as well. Sir, when there is increase in realization profit, if there is increase in credit side, let us assume if the credit side figure is increasing, then automatically you will get the balancing figure is also with incremental value. Am I right? So now in credit side in realization account, what it will be, here it will be purchase consideration is there. That is purchasing company account to realization account. You will write in step number 2, purchasing entity to realization. That means in realization, which is purchasing entity account will be there, which is at the rate of PC. In such purchase consideration, if you calculated such PC under net asset value method, net assets is nothing but assets taken over by the purchasing company minus liabilities taken over by the purchasing company. In that PC, goodwill is also taken over by whom? Purchasing entity. Goodwill is already included, right? That means to that extent of the goodwill, if you are already included in the purchase consideration, that means you are considering this entry automatically. One more time concluding. If you consider goodwill in the calculation of purchase consideration, if you consider the goodwill under the calculation of purchase consideration, automatically it impliedly speaking that you already considered this entry. That is realization to partners capital account. You already considered. How it is possible? If you already considered in the PC, then PC amount is more. If PC amount is more, that balancing figure is appeared as realization account balancing figure, which is nothing but realization account profit only. That profit will ultimately transfer to whom? Partners capitals. In which ratio? Profit sharing ratio. Sir, what you want to conclude, sir? On behalf of raising the goodwill and make it transfer to the partner's capital, again transferring such goodwill to the realization, on behalf of doing these two things, just you can simply add such goodwill to the purchase consideration. then these two entries are automatically considered. Am I right? Now I'll put the same thing here, which is very, very important. Concentrate. If selling firm, if goodwill is considered in PC calculation, then no need to raise the goodwill and transfer to realization specifically. If goodwill is considered in purchase consideration calculation, then no need to raise the goodwill and transfer to realization specifically. I mean, there is no need to, I'll add here, there is no need to specifically raise. There is no need to specifically raise the goodwill and transfer to realization account. So this is very, very important issue, guys. Just a second, I'll explain one more thing. Then you can very easily understand. Sir, goodwill issue is different from in case of selling companies and selling firms. If at all the company is having certain internally generated goodwill, if at all the partnership firm, the selling firm having certain internally generated goodwill, now it is in dissolution process. That's why it should rise the internally generated goodwill. It's their books of accounts, because that goodwill is ultimately taken over by whom? Purchasing firm or the purchasing entity or the purchasing company, whatever the case may be. Now for rising of the goodwill, the entry is goodwill account to partners capital account. Do you agree? Then the goodwill should be need to make it transfer to realization account as in the as usual 5-step approach. Assets and liabilities which are taken over by the purchasing entity should be closed and transferred to realization account. So the net impact is just now we seen, that is realization to partners capital. This should happen without passing of this entry. I'm telling the same thing is happen without passing of this entry if you consider the goodwill under purchase consideration. Now at the time of writing the PC due entry, the entry is purchasing company account to realization account at the rate of PC. Under such PC, goodwill was already considered. If you consider the goodwill in such calculation of PC, then you will derive the realization profit as realization to partners capital only. Once you consider such goodwill under PC, to the extent of the goodwill amount, there is increase in the realization profit. Am I right? That is nothing but there is to the extent of increase in the rise of goodwill in the partners capital accounts through realization profits. If goodwill is considered in PC calculation, then no need to specifically raise the goodwill and transfer to the realization account. Such all things are already made. Once if you consider that goodwill under the purchase consideration, sir, if you really remember problem number 5, do you remember problem number 5? What is that? Just a moment. In problem number 5, actually, one company is taken over the existing partnership firm. We already done that one. Yeah, YTR Private Limited. YTR Private Limited is taken over the partnership firm, including the goodwill as well. How you will get this purchase consideration? You know how you are getting this purchase consideration? We calculated the purchase consideration. Where it is? Just a moment. Where I calculated the purchase consideration here. Please consider this. In the purchase consideration calculation, I already included the goodwill. Do you remember, guys? Problem number 5, we already completed in the previous lectures. Sir, in calculation of PC, I already considered the goodwill here. That means in this purchase consideration 85,500, already goodwill is included. That means in realization account been by YTR Limited, in this 85,500, already goodwill is included. That's why I not raised the goodwill specifically through partners capitals. If you check here in partners capital, there is no buy goodwill account anywhere. And one more thing, I not transfer such goodwill to the realization as well. Now raising the goodwill, that is making credit to the partner's capital and make transfer such goodwill to the realization, automatically considered when you included such goodwill under PC calculation. That is the reason why actually I not to transfer goodwill to the realization, as well as I not to transfer such goodwill amount, that is rising of the goodwill amount to the partner's capital account. Do you understand? Do you agree? That is very much important point. That special points creates a lot of difference in between selling company dissolution and selling firm dissolution. Closure of the books of accounts in the selling company and closure of books of accounts of the selling firm, that makes difference, guys. Okay, fine. So that means, sir, what we should need to do, sir, here, sir, which accounting treatment you followed in case of in the books of selling company, the same accounting treatment you can follow in the books of selling firm without having any second thought. But the only one caution you need to do, in case of rising of the goodwill, no need to rise the goodwill again, make it transfer to the realization. On behalf of doing such things, you can simply consider such goodwill under the purchase consideration. Automatically such entries impact is considered. Do you agree? Okay. So except this, there is no difference, guys. Next, come to the next issue, all of you. Now, in the books of purchasing entity, in the books of purchasing entity, sir, what is the accounting treatment in the books of purchasing entity, sir? What is the accounting treatment you followed in case of amalgamation in the nature of purchase? The same accounting treatment you need to follow here. The same accounting treatment you need to follow here. That is amalgamation in the nature of purchase. I'm talking in the books of purchasing company. What is the first and foremost entry? May I know? What is the first and foremost entry? Business purchase account debtor. Business purchase account debtor at the rate of purchase consideration to their liquidator of selling company. Here maybe the liquidator may be appointed by the selling firm, or if there is no liquidator, you can directly write to selling firm account. To selling firm account. Am I right, guys? Tell me, here business purchase account data on behalf of liquidator, just I am writing directly selling firm account. That is at the rate of PC only. Now you can write off the business purchase account by incorporating assets and liabilities, right? By incorporating assets and liabilities, you should need to by incorporating assets and liabilities, you should need to cancel the business purchase account. You should need to cancel business purchase account. Now the entries, consider all of you. Assets taken over at an agreed value. Assets taken over at the rate of agreed values. Account debtor to liabilities taken over at the rate of agreed values to, you need to cancel business purchase to business purchase account. Now, please consider all of you here. Sir, we should consider here all the assets. We should consider here all the assets which are taken over at the rate of agreed value, not at the book value of the selling firm, at the agreed value. We should consider all the liabilities which are taken over at the rate of agreed value. Now, assets taken over at the rate of agreed value minus liabilities taken over at the rate of agreed value is nothing but NAV, which is also PC. Business purchase is also at the rate of PC. Now the accounting entry is exactly matched to the total of the debit aspects equal to total of the credit aspects. There PC greater than NAV, PC less than NAV, scope is there. But here the only one PC we are applying is under NAV method. If PC is under NAV method, then there is no goodwill, no capital reserve, right? So that's why the PC we only calculated, if you observe here, the PC we only calculated by applying the NAV method. That's why the purchase consideration is equal to the NAV. Business purchase is at the rate of PC. Now this is at the rate of NAV. Now NAV is equal to PC. There is no further goodwill or capital reserve is arised. Do you understand? Now, please all of you concentrate. Here one important item just I want to tell you. Sir, under assets, one of the asset is there goodwill, right? Under asset, one of the asset is goodwill. Just in bracket, I'm mentioning one of the asset is goodwill. Am I right, guys? Now this business purchase is nothing but purchase consideration need to be payable, right? Now ultimately in the I will tell you it later. First I will close the journal entries. Again the goodwill issue I will explain it later. Just a moment. How here I explain the goodwill. In the same way I will explain the impact of goodwill in the books of purchasing firm at last. First let me complete the remaining normal entries. The remaining entries are third one. You can make it pay to the selling firm, that is selling firm account debtor to equity share capital if you are issuing the equity shares, if it is company, or you may issue preference share capital, or you may issue debentures if it is company. If your entity is also a purchasing firm, you may issue your partner's capital, your share. I mean partner's capital. Just you may issue partner's capital account. Now all of you please consider it, guys. Here now this is a casual entry. You know, in the books of the purchasing company also, you may would pass this liquidator of selling company account to equity share capital, preference share capital, debentures, cash, what you are paying, just you are just giving, you may pass the entry. Now I'm establishing the goodwill, or I am discussing the goodwill issue. Now under assets taken over at the rate of agreed value, one of the asset is goodwill. Am I right? Now under such goodwill, the amount is already included under the purchase consideration as well. That is under the business purchase. Now if you check all of you, sir, business purchase here debit, here credit, close, right? Selling firm here credit, here debit. What is ultimately happening through all these three entries? I'm telling you, all these three entries combinedly, what is happening? The combined entry for all these three entries is combined entry. What is the entry? The combined entry is assets taken over at the rate of agreed value to liabilities taken over at the rate of agreed value. For example, if my entity, purchasing entity, is a partnership firm, let us assume for the time being, to partners capitals, right? To partners capitals. Concentrate. To partners capitals. Now all of you concentrate. This is the combined entry of all these three entries. Sir, how this entry came, sir? Business purchase cancel. Selling firm cancel. Then the net entry is assets taken over at the rate of agreed value to liabilities taken over at the rate of agreed value to partners capital. Now, what is this partners capital? You know, what is this partners capital? You know, in selling firm books, certain partners capital is outstanding na, at the end of the closure. That is before making settlement. Before making settlement to the partners, final settlement to the partners, just you should give something to the partners, right? Which is nothing but outstanding balance under the partners. For example, two partners are there, A and B. A, how much outstanding? B, how much outstanding? You need to see. To the extent only you should need to pay to A. To the extent only you should need to pay to B. Now, this partners capital is there here, right? Assets taken over to liabilities taken over at the rate of agreed value to partners capital. Such partners capital is nothing but outstanding balances as in selling firm. Before settlement. Sir, before making settlement, how much balances are there in individual partners? If you combine that, then you will get the partners capital. Or if you put it individually, you will get the same amount. Do you agree, all of you, that one? First of all, Sir, why you are telling all these issues, sir? Already entries is over now. Entries are over, but still, once I will explain the significance of discussing this concept, you can understand. Now, consider, guys. So now one of the assets here is goodwill. One of the asset here is goodwill. You know, if goodwill you included under assets means under this partner's capital, you also included such goodwill under which ratio? Profit sharing ratio. You are including such goodwill under the partner's capital in which ratio? Profit sharing ratio. For the time being, just I am putting certain figures. Please consider all of you. Let us assume goodwill is 1 lakh. So profit sharing ratio between A and B is, let us assume 3:1. PSR. Just for the time being, I am putting A and B are there. Profit sharing ratio is 3:1 between A and B. That means in the partners' capitals also, this amount of 1 lakh goodwill is in between there. A for 75,000, B for 25,000. Remaining also there. But with respect to goodwill, I am talking goodwill account data to A's capital, B's capital is there for 75,000, 25,000, right? Now I am dividing such goodwill portion only here. I am dividing such goodwill portion only here. Sir, if you divide such goodwill portion, what is the entry? Goodwill account data to A's capital to B's capital, which is 1 lakh, which is 75,000, which is 25,000. Now concentrate. If in the books of the selling firm, sorry, we are in purchasing firm books, right? If in the books of the purchasing firm, if partners in the purchasing firm decided, not to show the goodwill in the books of accounts, that is up to their right? If they want, they will continue the goodwill like this. If they want, they will continue the goodwill. Why? Because right now the goodwill is a purchased goodwill. As per AS 26, they can recognize the purchased goodwill. If they want, they can continue such goodwill as it is. That is goodwill to A's capital to B's capital. They can continue that. But if they don't want, then they should cancel such goodwill, right? If they don't want, they should cancel such goodwill. If the purchasing company, partners decided not to show such goodwill in their books of accounts, then what I should need to do? I should cancel the goodwill. How I can cancel the goodwill? You can cancel the goodwill to goodwill account. Now, just let us assume in the new partnership firm, A and B ratio is not 3:1. Their ratio will become, let us assume 1:4. Sir, this is old PSR. This is actually as per the selling firm books PSR. Now in the new books, A and B is, let us assume 4:1. Just for the time being, I am telling you, which is in the new firm books. Sir, because while compared to the old form, definitely the terms and conditions in the new form will change. You know how it change actually? If it is in the case of amalgamation, in A and Co only 2 partners are there. Let us assume B and Co 2 partners are there. Then in AB and Co maybe 4 partners would be there. That's why the profit sharing ratio might be changed, obviously. Okay, just I'm taking an example of the same partners are continuing, 2 partners, but there is change in the profit sharing ratio. Let us assume. So that means goodwill was there in rising in the old profit sharing ratio. Now I should cancel in the new profit sharing ratio. A's capital account debtor, B's capital account debtor. In the new profit sharing ratio, which is for A 80,000, for B which is 20,000, goodwill should need to be cancelled with 1 lakh. This know how, you know, sir, rising of the goodwill and cancellation of the goodwill. Actually, the goodwill not raised by you. Goodwill actually who raised are the selling company books. Actually, goodwill raised. How it was raised in case of selling company books? By adding it in the purchase consideration. He also not directly raised goodwill to partners capital, realization to goodwill he not made, but he did all such things simply by making such goodwill add into the purchase consideration. Now goodwill is raised by the selling company. That goodwill is incorporated in the books of the purchasing company. Now the incorporated goodwill don't want to show in their books of accounts. That's why I am cancelling such goodwill by debiting the partner's capital in the new profit sharing ratio. Now concentrate. Sir, on behalf of incorporating the goodwill and canceling the goodwill, you can pass another entry as well. What is the net entry here from the here? On behalf of writing these two entries, you can write one net entry. What is the net entry, guys? All of you, please let me know. A's capital account debtor. Ina Bina. A is credit 75,000, debit 80,000. That is A's capital account debtor 5,000 to B's capital account debtor to B's capital account 5,000. This is the net entry, right? Do you agree? Now consider all of you. If in the new purchasing firm, or in the purchasing firm, if the partners decided that not to show goodwill in their books of accounts, not to incorporate the goodwill in their books of accounts, then on behalf of incorporating and canceling, you can directly pass the entry gaining partners capital account at R to sacrificing partners capital account. Gaining partners capital account at R to sacrificing partners capital account. Do you agree? On behalf of passing these two entries, I can adjust the goodwill through partners capital accounts. Now, in the books of purchasing entity, what the accounting treatment we followed in generally, the same accounting treatment we need to follow. That is business purchase to selling firm or the combined entry. Actually, with these three entries, the combined entry actually is assets taken over at the rate of agreed value to liabilities taken over at the rate of agreed value to partners capital accounts. That is the net entry, which is a combination of three entries, right? So on behalf of these three entries, I can pass only one single entry, that is assets taken over at the rate of agreed value to liabilities taken over at the rate of agreed value to partners capitals. Now, what are these partners capitals? Partners capitals is nothing but outstanding balances as in the selling firm before settlement to the partners. With that balances you need to show here. But I don't want to incorporate all the assets except goodwill. I will incorporate all the assets. Except goodwill, I will incorporate all the assets. That means assets taken over at the rate of agreed value except goodwill. To liabilities taken over at the rate of agreed value to partners capital. From here partners capital to the extent of goodwill portion also I want to remove. Now the goodwill portion I will make it separate entry. Do you understand? For the goodwill portion I will make it separate entry. Now if the new firm partners or the purchasing firm partners just they want to continue the goodwill, just they want to continue to show such goodwill in their books of accounts, then at that particular point of time no need to segregate actually. If the purchasing firm, they want to continue such goodwill in their books of accounts, I can include here itself, I can pass like this only. This is the final entry. But if the purchasing firm partners, they don't want to show the goodwill account in their books of accounts, then you make it separately. Then you can pass the cancellation entry. On behalf of doing such two things, you can make it pass through the adjustment entry as well. That means simply, if the partners of the purchasing firm, they want to decide to show continue the goodwill which was acquired from the selling firm, then they can pass only single entry. That is assets taken over at the rate of agreed value including goodwill to liabilities taken over at the rate of agreed value, all the liabilities to partners capital, the balances which are exactly as per the balances in the selling firm before making settlement. That's over, that's fine, issue is fine. But if partners want to decide not carrying the goodwill, not incorporating such goodwill in the books of accounts, then the goodwill portion need to be eliminated from the assets taken over at the rate of agreed value to liabilities taken over at the rate of agreed value, then to partners capital. From partners capitals also you should need to reduce the goodwill portion. Then if partners want to decide the adjust such goodwill through partners capitals, then the entry is gaining partners capital account that are to sacrificing partners capital accounts. On behalf of making separate and cancellation, you can pass a one net entry which is gaining partners capital account that are to sacrificing partners capital account. That's it, guys. If you understand such concept, that is more than enough to do any problem. Now if you observe in the books of selling firm, the crucial point is goodwill rising. What we learned in case of goodwill rising? On behalf of rising the goodwill and make it transfer to the realization, it is better to add such goodwill in the PC calculation. Then automatically rising of the goodwill and transferring of realization happen. It's very simple. Now in the books of purchasing entity, by clubbing these three journal entries, we can pass only one single journal entry. If purchasing entity want to continue the same goodwill acquired from the selling firm, then there is only one entry. All assets, including goodwill taken over at agreed value to liabilities taken over at the rate of agreed value to partner's capital, the individual balances of partner you should need to carry with the outstanding balances as appear in the selling firm before making the final settlement. Because you don't know at this point of time, sir, how much I can make to the partner A, sir, how much balance is outstanding in A, how much payment I can make to B, sir, how much outstanding is there in the partners B. You should need to check. Am I right? Next. No, sir, if partners don't want to show the goodwill in the books of accounts, sir, then at that point of time, what you should actually need to do at the time of incorporation of assets, you should not incorporate the goodwill. At the time of writing the partner's capital under credit side, you should not include the goodwill portion and such a partner's capital account as well. Why? Because the goodwill and partner's capital just now you are putting outside. We are segregating from the remaining assets. Now, on behalf of incorporating in the old ratio and a cancellation in the new ratio, we can adjust the goodwill adjustment through their partners capital accounts. We can adjust simply through partners capitals, then automatically goodwill got adjusted. Do we agree, all of you? Okay, sir, how many times are, if I continue the same thing in n number of times, still you have much more ambiguity in your mind with respect to the goodwill portion. First, let us take one practical problem, then all the myths, whatever you have in your mind, automatically vanish, guys. So that means the accounting treatment with respect to the selling firm or the purchasing firm, which is not a new accounting treatment, except the portion of the goodwill. If you freely understand the concept of goodwill, then it's very simple to crack the problems with respect to amalgamation or conversion or sale. Okay, now come to my material, guys. Hello friends, how are you all? Hope you all are doing good. So, most wanted chapter for all the students. I know you are eagerly waiting for uploading. So this is the time for discussion of the chapter Consolidated Financial Statements. So before starting with this chapter, just I want to provide a small information exclusively regarding to this chapter. Consolidated financial statements, the topic itself is very big topic, very huge concept actually involved in this chapter. But the entire conceptual things related to consolidated financial statements is not covered through CA Inter syllabus. Very limited portion of consolidated financial statements only covered in CA Inter advanced accounting portion. Why I am emphasizing that fact before entering into the topic itself? So many students have a myth that the chapter consolidated financial statement is very big chapter. Sir, the remaining portion, what you are not learning at this stage, you would have learned in CA final syllabus. And there in CA final, you are seeing the consolidated financial statements based upon Indian accounting standards, that is Ind AS, not as per existing accounting standards. So that's why very limited discussion we are going to do due to constraints in the syllabus coverage. Okay, fine. That is more than enough. But even though that syllabus is very limited, for coming to CA inter level, it is look like a huge syllabus only. Okay, fine, right. So now I don't want to discuss anything about the text at this stage. First, let me give in detailed introduction for the chapter Consolidated Financial Statements. So now let us start our discussion with introduction. Can you please tell me, anyone, what is the meaning of consolidated financial statements? What is the meaning of consolidated financial statements. So most of the times in other chapters, in the other syllabus, maybe the other faculty may tell that, sir, if a company is having one or more subsidiary companies, then holding company will prepare, along with their standalone financial statements, it should also need to combine the financial components of their subsidiaries as well. Such financial statements are in generally known as consolidated financial statements. Am I right? In layman, most of the times you would aware that maybe in other subjects or maybe in teaching methodologies of other faculties as well, right? But what exactly the meaning of consolidated financial statements? Now I'm going to discuss here. Concentrate. Consolidated financial statements are simply financial statements of group companies. Financial statements of group companies. Yes. Consolidated financial statements are also financial statements of which companies, not a single company, which is a combination of companies under a single group. Under a single group. Then the next question coming into your mind is, sir, which companies are known as group companies? Which companies are known as group companies? Sir, group companies means a company who is having controlling power in the other company. I mean, holding company, and one or more subsidiary companies. One or more subsidiary companies. So group companies means either it is holding company or one or more subsidiary companies. Now, one more important thing you need to know here, subsidiary company includes associate and joint venture only for consolidated financial statements. I'm talking only for consolidated financial statement point of view. Subsidiary company includes associate and joint venture. I mean, if a company is having subsidiary, one subsidiary or more than one subsidiary, and the same companies also have associate, or the same company is acting as a joint venturer for other venturer companies. Now, the holding company, along with their standalone financial statements, it should prepare the consolidated financial statements after taking the components of the financials from subsidiary companies as well as associates and joint ventures. Such financial statements are popularly known as consolidated financial statements. Okay, this is only pure meaning just now I discussed, sir, but without knowing reason for preparation, whatever you learn, such things are completely waste of time from my point of view. So without knowing the reason for preparation, how it should be prepared, it is completely waste of time, right? So first we check now simple meaning. Now we are checking why we need to prepare. That is reason for preparation. Reason for preparation of CFS. So in shortcut, I am using regularly CFS. Please all of you habituate for the terminology. Now, reason for preparation of consolidated financial statements. Sir, you know, in case of holding subsidiary relationship, what will happen in generally? Let me take one example for better understanding. For example, H Limited is a company which is a holding company, S Limited is another company which is a subsidiary company. Am I right? There are two companies are there. One is H Limited, another one is S Limited. So in between H Limited and S Limited, there is one relationship exists, that is holding and subsidiary relationship, right? So H Limited is a holding company. H Limited is a holding company. S Limited is a subsidiary company. The relationship is a holding subsidiary relationship. How that relationship will exist when a company is known as holding company, when a company is known as subsidiary company? Subsidiary company is a company in which the other company controls the composition of the board of directors. Either it controls the composition of the board of directors, control in the composition of the board of directors. So what is the meaning of control in the composition of board of directors? The entire board will follow the decisions of the holding company. Holding company will involve into the operation and financial decisions of the subsidiary company. The board of directors decision are completely depending upon the decisions taken by the holding company H Limited. Then H Limited is said to have control on the composition of the board of directors. And one more thing, it is in the hands of the holding company to appoint any board of directors or to remove any such board of directors. So if such characteristics are satisfied, then in generally we are said to be holding company have control on the composition of the board of directors. Do we agree, guys, all of you? Okay. So this is one scenario of getting holding and subsidiary relationship. Another scenario is, majority of voting power. Majority of voting power is in the hands of H Limited. Then the other company is known as subsidiary company. Hope you already know such facts in your, you learn such things under Companies Act 2013 itself. You already learned such things under Companies Act 2013 or in our some accounting standards like AS 18 in case of disclosure of what is that? Related party disclosures. We already discussed such issues. Am I right, guys? Okay. Now, sir, what is the meaning of associate? Associate means a company is having substantial interest in the other company, or it holding greater than 20% of the voting power in the other entity. Then we can call it as investor and associate. You already named joint ventures and venture relationship. Okay, just leave it. One more thing. Before explaining the reason for preparation of consolidated financial statements, I want to tell you one more thing. In this chapter, we are only going to see one type of consolidated financial statements relationship, that is holding and subsidiary only. Holding and subsidiary only we are going to see. Holding and associate, I mean investor associate consolidated financial statements, we are not at all discussing. Venturers and joint venture consolidated financial statements also we are not at all discussing. Sir, if such two things are not at all discussing, then combination problems will not come. Combination means holding subsidiary plus investor associate plus venturer joint venture. Such combined problems also we are not going to see. I already told you very narrow scope, only holding and subsidiary relationship consolidated financial statements only we are going to see. Is it okay, guys? Now come back. Sir, what is the reason for preparation of consolidated financial statements? Now, the entire affairs of the subsidiary company is in the hands of holding company, or whatever the profit or loss achieved by the subsidiary company, for that holding company is the cause. Am I right? So because holding company involves in the decision making of the subsidiary company, that means the majority stake in the subsidiary company, is in the hands of the holding company. It is the responsibility of the holding company to provide the financial information to the users of the holding company by considering the financial statements of the subsidiary companies as well. Because the real financial result of holding company or the real financial position of the holding company is not only depending upon exclusive holding company affairs, it also depending upon affairs of the subsidiary company. So group as a whole, how much financial result we achieved and what is the financial position, I need to clearly visualize to the users of the financial statements, because based upon the overall performance of such group, investors of the holding company want to take appropriate decisions on making further investments or withdrawal of the existing investments. And the market price of the holding company will also depending upon the results of the subsidiary companies as well. Do you understand? In practical way, if I want to tell you to visualize the things in the better manner, you know the group called Reliance Industries Limited, right? RIL is a holding company. RIL having various subsidiary companies. So just let me googling that. So please come here. If you check here, RIL related subsidiary companies. So now just he is giving only major subsidiaries, not all the subsidiaries. The subsidiaries that make Reliance Industries successful, just he is giving certain subsidiary companies. Just have a look. Geo Platforms Limited, Reliance Retail Limited, Reliance Life Science, Reliance Logistics, Reliance Clinical Research, Reliance Solar, Network 18, Relicord, Reliance Geo, Reliance Industrial Infrastructure, Reliance Aeros Production, LYF. So many other companies are also there. Here he only given major subsidiaries of the Reliance Industries Limited only he is giving. Am I right? Come back, guys. Reliance Industries Limited doing multiple business activities. It have their place in retail sector. It have their place in petroleum products. It have their place in textile market. It have their place in telecommunication system. It have their place in whatnot. I mean, tell me guys, some other products related to Reliance Industries Limited. Yes, oil related activities, it have their place, and it have their place in, I mean, broadband network. That is broadband network also they entered, right? Then so it have their vast and huge hands in all and around all the industries. Am I right? Okay, come back. Now, to know the real performance of the RIL group entirely, you should combine the financial statements of each and every company and put together in the form of consolidated financial statements. Then users of the financial statements will look into such consolidated financial statements. Then they will take the appropriate decisions. That is the actually backbone of the decision making by a particular investor. So in generally, investors are not only taking the decisions simply based on the price fluctuations. Sir, price decrease na invest. Sir, at the time of increase of the price, we will get profits. That is actually doing the layman people. So how in generally the financial people who are having the good knowledge about the financials, first what they will check, they will analyze the financials. Now, such analysis is possible for a group through preparation of consolidated financial statements. That is the reason why in generally people are going for preparation of the financial preparation for consolidated financial statements. Not only that, through preparation of consolidated financial statements, entity has certain advantages as well. I will let you know what are the different advantages company have through preparation of consolidated financial statements. You know the intrinsic value per share, right? Intrinsic value per share. You would already seen such things under amalgamation chapter. Sir, Intrinsic value is nothing but net asset value of the per share. Net asset value per share. Net asset value per share means total of the assets minus total of the liabilities at market values. At market values. Now, out of the total of the assets, you are having certain investments which are made invested in subsidiary companies. Are you visualizing the things? You are investing certain shares of the subsidiary company which are investment in subsidiary. Now, what is the value of investment in subsidiary? It is depending upon the worth of the subsidiary company. If you know the intrinsic value per share in the subsidiary company, then you can apply such value of investments is nothing but intrinsic value of the subsidiary companies. That means the real intrinsic value of the holding company will only knows if you are able to calculate the intrinsic value per all the subsidiary companies. That means the intrinsic value of the holding company decides or depends. The intrinsic value of the holding company depends on the intrinsic value of all the subsidiary companies along with the performance of the holding company. So that is one of the advantages to know the realistic intrinsic value per share of the holding company. By not considering the intrinsic value of the subsidiary company, if you are valuing the intrinsic value of the holding company, you may derive the wrong value. You may get the wrong value. So that is possible through preparation of consolidated financial statements. Next, one more. Sir, consolidated financial statements are also help highly. Consolidated financial statements are also help highly to know the profit or loss in the overall picture. Sir, current year I attained 5 crores profit and my subsidiaries attained 15 crores profit. Now, what is the overall profit of the group? What is the overall performance of the entity? Such thing also we know through preparation of consolidated financial statements. Okay, we see such all are advantages through our text. So let us have look into our text, guys, without wasting much time. Sir, consolidated financial statements, CFS are the financial statements of a group presented as those of a single enterprise. So which resulted consolidated financial statements are financial statements of a group companies which are presented as a single entity, which are presented as single entity. Such group companies, if you are presented as a single entity, how the financial statements will look like? Such financial statements are known as consolidated financial statements, where a group refers to parent, that is holding, and all its subsidiaries. Here, subsidiary includes associate and joint venture as well. Only for the consolidated financial statements, we include subsidiary, we include associate and joint venture as in the definition of subsidiary. Okay. Purpose of preparing the consolidated financial statements. Parent company need to inform the users about the financial position and the results of the operations of not only of their enterprise, that is not only of that individual enterprise, but also of the group as a whole. For this purpose, consolidated financial statements are prepared and presented by a parent or a holding enterprise to provide the financial information about the parent and its subsidiaries in a single economic entity. I discussed already. Sir, what is the meaning of holding company? What is the meaning of subsidiary company? I already discussed it through this small diagrammatic representation. I don't want to read once again. Just you can see the subsidiary company. Holding company means the company which hold in the subsidiary company is nothing but holding company. That is the definition actually given. Holding company in relation to one or more the companies means a company of which such companies are subsidiary companies. Simply a company which hold or which invested in the other companies are known as holding company. Come to the subsidiary company. Control the composition of the board of directors. Subsidiary company as a company in which the holding company controls the composition of the board of directors or exercises or control more than one half of the total share capital, either its own or together with one or more of its subsidiary companies. Maybe directly you can own or indirectly through of your other subsidiaries also you can own. We've seen already such type of relations under related party disclosures. I don't want to make a comment here again. So the controlling power you may have directly, or maybe certain portion you hold, maybe the remaining portion you can hold with your subsidiaries as well. That is having directly controls or indirectly controls. Anything we can call it as controlling power. I already discussed. Next, one more thing, guys. Sir, for example, H Limited hold in S Limited to the extent of 90% of the share capital. I mean, S Limited share capital is 5 lakhs. Out of such 5 lakhs, 90% is held by H Limited. That is to the extent of 4,50,000. Remaining 50,000 worth of share capital is held by outsiders. Such outsiders are known as minority interest holders. We are the majority interest holders. Majority interest holders means holding company. Minority interest holders means other than holding company, outsiders who invested in the equity shares of subsidiary company are known as minority interest. Now, minority interest, it is the part of the net results of the operations and that of the net assets of the subsidiary. Simply, I can put net assets of the subsidiary attributable to interest which are not owned directly or indirectly through subsidiaries by the parent. Simply is giving what is the meaning of minority interest? It is the interest other than owned by the subsidiary. It is the interest in the net worth of the subsidiary other than owned by the holding. That is simply, I told it as held by outsiders other than subsidiary. Okay. Next, just leave it. 1 second, guys. Just I will check the advantages. Just give a moment, please, all of you. Yeah, here it is there. Please, all of you concentrate. So the reason for preparation we've seen. Now certain advantages I'm going to explain here. What are the different advantages a company will get through preparation of consolidated financial statements? A single source of document. The consolidated financial statement is a single source of document. Then the users of the financial statement can get an overall picture of the group. I told you the overall picture of the group we can simply know through preparation of consolidated financial statements. Intrinsic value of the share. So the intrinsic value of the holding company will also depending upon intrinsic value of other subsidiaries and associates and joint venture. That's why we know the true value of the holding company in the consolidated financial statements only. Intrinsic value of the holding company can be calculated directly from the consolidated balance sheet. Acquisition of a subsidiary. For example, now in this case, let us assume holding company, that is H Limited, want to acquire the S Limited. As per my example, H Limited hold 90% in S Limited, right? Now in S Limited, I know the minority interest portion as well. Remaining 10% is related to minority portion interest. So if H Limited wants to acquire S Limited, how much amount I can able to pay to the minority interest, I can easily assess. Sir, no need to pay the entire amount as a purchase consideration because H Limited is already having the controlling interest. Almost 90% belongs to H Limited only. Now H Limited, if it will pay the remaining 10% portion of amount to the minority interest, then H Limited can easily acquire the subsidiary limited. I mean, through preparation of consolidated financials, H Limited can easily know a fact that how much amount we can need to pay to the minority interest for the purpose of acquisition of subsidiary limited. The minority interest data of the consolidated financial statement indicates that amount payable to the outside shareholders of the subsidiary company at book value, which is used as the starting point of bargaining at the time of acquisition of a subsidiary by the holding company. We know the book value of minority interest. That's why we can easily simply bargain with such minority interest holder at the time of acquisition of such company. Next, evaluation of holding company in the market. The overall financial health of the holding company can be judged using the CFS only. Sir, we cannot judge the performance of a holding company based on the results of the holding company. Maybe the holding company results are very poor, but the subsidiary companies are performing in outright the benchmark performance they are giving. Then the overall group is performing very well, even the holding company is failed in their operations. Do you understand what I am telling? So that is the reason why the overall performance of a group only the people in generally will see at the time of making investment in such shares. I mean, maybe certain subsidiary company, maybe operations are very low. Let us assume the telecommunication sector is in the recession period. Let us assume, or the technology, I mean the software company, one of the subsidiary is in the recession period. but still that financial statements not only depicting, by seeing the results of such financial statements, it does not depict the true and fair picture of the group as a whole. If you check the overall financial statements results only, then you have a good idea whether the group is performing well or it is badly impacted. We can easily know. Okay, come back, guys, all of you. Now till now we discussed that what is the meaning of consolidated financial statements, why it should need to be prepared, what are the advantages of preparation of consolidated financial statements. Am I right, guys? Now, what are the different components involved under the consolidated financial statement? Let us have a look. Now I am checking components of CFS, components of consolidated financial statements. Consolidated financial statements contains consolidated financial statements contains consolidated P&L, consolidated balance sheet, consolidated cash flow statement, consolidated notes to accounts and explanatory statements. So in generally, financial statement comprises of P&L, balance sheet, cash flow statement, right? And notes to accounts are also form part of financials. Now everywhere I added simply the word consolidated. Consolidated P&L, consolidated balance sheet, consolidated cash flow statement, consolidated notes to accounts. In this chapter, we are going to learn except consolidated financial cash flow statement. Remaining all things we are going to see. Except consolidated cash flow statement, we are going to see consolidated balance sheet, consolidated P&L, and consolidated notes to accounts. Whenever we are seeing balance sheet and P&L, it is automatically we are going to see consolidated notes to accounts as well. Is it okay, guys? All of you. Next. So just now we've seen different components what we are preparing under the consolidated financial statements. Next, before checking with the accounting treatment, still please let me allow to discuss certain provisions of the Companies Act 2013. Now, this is not related to accounting treatment. This is not related to accounting treatment. This is related to compliance part. As per the provisions of Companies Act 2013, a company who have subsidiaries or associate or joint venture should need to prepare the consolidated financial statement. Should need to prepare the consolidated financial statement. Now, these are the provisions of Companies Act 2013. Provisions of Companies Act 2013 with respect to compliance part. So a company who have subsidiary or subsidiaries or associate or associates or joint venture or venturers, then such company should need to prepare consolidated financial statements along with standalone financial statements. So at that point of time, such company should need to prepare their own financial statements as well as consolidated financial statement also. Next, sir, you know already once in generally at the time of preparation of standalone financial statements, What are all the different compliance procedure you need to be adopted? That is, board of directors will approve such financials. Then after that, along with the financials and audit report on such financials, it will be sending to the shareholders for attending the general meeting. Then general meeting will discuss on such financial statements. After completion of the general meeting, we should need to file the annual returns to the register of companies. We know already such compliance procedure. Now, the holding company or the parent company, along with the standalone financial statement, it should include the consolidated financial statements also as form part of financials. The board of directors should also approve the consolidated financial statements. Now, at the time of sending such financials to the shareholders, along with standalone financials, it should also combine the consolidated financials. Then shareholders will discuss on CFS as well in the general meeting. Then as part of the annual returns, then such company should need to prepare the annual return in AOC 4 form. AOC 4, you know, already I already explained AOC 4 and MGT 7A. AOC 4 is nothing but every company should need to file the financial statement with the ROC in the prescribed form, which is known as AOC 4 CFS. A company who should need to prepare the consolidated financial statement, then such company should need to file AOC 4 CFS. Okay, that is nothing but annual return. Along with this, they should also need to provide AOC 1, which relates to salient features of subsidiary companies. So what are all the different companies you are involving? What are the features of such subsidiary company? What are the different business activities conducted by such subsidiary company? How the affairs are maintaining in such subsidiary companies? You should provide one more form, which is AOC 1 form. For which companies? For those companies who should need to prepare the financials as per the Companies Act 2013. Do you understand? I'll show you here for better understanding. I'll open my MCA login. Just a second. So now if you check under MCA services, under eForms companies form download, just I am finding AOC 4. Now if you check form for filing in the highlight portion, form for filing consolidated financial statements and other documents with the registrar for NBFC. This is for NBFC, AOC 4 CFS NBFC. Now come down here where it is. Yeah, here you can come to the second highlight portion, form for filing consolidated financial statements and other documents with the registrar. This is AOC 4 CFS. Just now I discussed now. So form for filing consolidated financial statements and other documents with the registrar. After completion of the annual general meeting within 30 days, that form should need to be filed by each and every company. So these all are related to the compliance part as per the Companies Act 2013 with respect to consolidated financial statement. Next question coming into my mind. Please all of you concentrate. This is provision number 1. This is provision number 2 related to annual return. Provision number 3 I'm discussing. Sir, you told you if companies have subsidiary or associate or joint venture, then they should need to prepare the consolidated financial statements. Even though company have subsidiary or associate or joint venture, in certain circumstances, there is no need to prepare the consolidated financial statements. That we can call it as exclusions or exceptions. Exclusions or exceptions for preparation of CFS. For preparation of CFS. Consider guys. Sir, in which circumstances there is no necessity to prepare the consolidated financial statements? In which circumstances there is not necessary to prepare consolidated financial statements, guys? You know already that situation, but specifically you may not recognize that. Sir, all of you concentrate. Now I have totally 6 companies. Let us assume A Limited is there, B Limited, C Limited, D Limited. Or let me put the 4 companies, not an issue. So I have totally 4 companies are there. This is A, B, C, D. How the relationship will be, in between these companies? A is having majority in voting power. That is, let us assume greater than 50% of the voting power. B is also holding greater than 50% voting power. C is also holding D limited greater than 50% in the voting power. Now for C limited, D limited is a subsidiary company. For C limited, D limited is a subsidiary company. Now this company is having subsidiary na. This company is having subsidiary na. Even though this company having subsidiary, C limited no need to prepare CFS. No need to prepare CFS. Sir, here you told company who have subsidiaries or associates. This company is having a subsidiary, but actually it need to prepare the CFS as per the provision. But now if you check the exclusion, if that company is actually holded by another company, which is B limited, then it is the responsibility of the B limited to prepare the CFS. Then again, B limited will also check, okay, I have 2 subsidiaries, C limited and D limited, fine. But my company is holded by A limited, then the responsibility will goes to A limited. Then who should need to prepare the financial statements? Here also no need. Here A limited should need to prepare consolidated financial statements. This is the first and foremost exclusion. That means B limited and C limited are excluded from the preparation of consolidated financial statements, even though such companies having the subsidiary companies. The reason is such companies are ultimately held by another parent company. So at that point of time, there is no need to prepare the consolidated financial statements. Such fact you already know. Number 2, as per Companies Act 2013, company is having subsidiary or associate or joint venture. But if the company equity shares are not listed in stock exchange, either in India or in foreign countries. That means, as per the Companies Act 2013, only for listed enterprises, actually this consolidation is mandatory. I'm telling that exceptions means Companies Act 2013 is not obligating to don't prepare the financial statements. So just it is telling not mandatory. So the mandatory, it's not required compulsorily, but still, sir, my company equity shares are not listed in the stock exchange. Can I prepare the consolidated financial statement, sir? Absolutely. Who will object you? So exclusions or exceptions means, sir, definitely you should not prepare the consolidated financial statement. That is not the intention of the provisions of the Companies Act 2013, which is not mandatory. If they want, they can prepare. So if their equity shares are, their securities are not listed in the stock exchange, either in India or foreign exchange, that is not mandatory to prepare the consolidated financial statement. That is the 2 circumstances as per the Companies Act 2013. Such provisions are also as per Companies Act 2013. Now come here, guys. Sir, but whenever a company want to prepare their financials due to mandatory requirement or due to the voluntary requirement, when the mandatory requirement is there, even such exceptions are applicable. Even though if they want to adopt the consolidated financial statements voluntarily, they can prepare. Whenever a company wants to prepare CFS, either on the basis of mandatory requirement or on the basis of voluntary requirement, they should need to comply their respective provisions as per accounting standards. Please concentrate. Now I'm explaining the provisions of accounting standards. Sir, in case of consolidated financial statements, holding and subsidiary relationship is 21 is applicable. Investor and associate is 23 is applicable. Joint venture and venturers AS 27 is applicable. But we are not discussing anything about investor and associate and joint venturer and venturers. That's why our discussion is majorly AS 21 provisions. But even though we are not dealing specifically the AS 21 provisions, we are applying the provisions of AS 24 at the time of consolidation procedures in between holding and subsidiary. Now coming here, what is the first provision I discussed? Whenever a company decided to prepare, whenever a company decided to prepare CFS due to mandatory requirement as per the statute, due to mandatory requirement as per statute means as per Companies Act 2013, as per statute, or maybe it is excluded as per the Companies Act 2013, but still they are voluntary want to prepare due to mandatory requirement as per statute or voluntary requirement. Should need to comply the provisions of AS 21. I'm only talking about holding and subsidiary. Comply provisions of AS 21 mandatorily. That is mandatorily we should comply the provisions of AS 21. I mean, sir, in case of voluntary requirement also, I'm preparing the consolidated financial statements voluntarily on voluntary basis. But still, if you are prepare the financial statements on voluntary basis, still you should need to comply the provisions of AS 21 mandatorily. That means, what is the objective of insertion of this provision in AS 21? I will tell you. Sir, whether the preparation of consolidated financial statements is mandatory or voluntary, that is irrelevant for me. But whenever a company want to prepare the consolidated financial statement, it should adopt the provisions of AS 21. That is the background background story of insertion of this provision. Hope you got it. Next, coming to point number 2, guys. Sir, as per AS 21, certain exclusions are given. As per AS 21, certain exclusions are given at the time of preparation of consolidated financial statements. You know, exclusions or exceptions means in the following cases. So following cases, no need to prepare CFS. Now all of you please concentrate. As per Companies Act 2013, such company need to prepare the CFS mandatory, let us assume. Now such company is coming under this exclusion. Then no need to prepare the CFS. I will tell you what are such exclusions, then you can understand very easily. Just a second. Right, consider it, guys. In which circumstances, as per AS 21, a company cannot consider such subsidiaries into the preparation of consolidated financial statements, or if the such subsidiary having only one, if such holding company having only one subsidiary, then no need of preparation of consolidated financial statements. Now I am checking if a company is having more than one subsidiary, then in which circumstances a subsidiary cannot include in the preparation of consolidated financial statements, or if the consolidated if the holding company is having only one subsidiary, then no need to prepare consolidated financial statements as well. That is nothing but exclusions. We are seeing such exclusions as per AS 21. Number 1, control is in temporary nature. Control is in temporary nature. That is, holding company going to dispose investments held in subsidiary. that is holding company going to dispose investment held in subsidiary in near future. In near future. Now concentrate. Control is temporary in nature. Now holding company controls the composition of board of directors or may have voting power for more than 50%. Now such control is temporary in nature. Temporary in nature means the investment held by holding company in subsidiary company is only the pure temporary. Only the pure temporary basis. Sir, in which circumstances it is in generally happening, you know? For example, holding company holds, that is made investments in the shares of subsidiary, which are held it as a current investment, let us assume. Or my company is an investor company. Now such shares are, I'm treating as a stock in trade. For all the investors companies, the shares which are, the investments which are made in different companies are simply they are treating as pure stock in trade. That means if the holding company is an investment company, then I will treat such investments made in the subsidiary company as stock in trade. At that point of time, I can resell such investment in very near future. At that point of time, such a subsidiary company I cannot consider in the process of consolidated financial statements. Do you understand? That is, control is in temporary nature. Holding company going to dispose the investment held in subsidiary in near future. Next, coming to point number 2. Subsidiary operates in severe long-term restrictions. Severe long-term restrictions due to which it impairs the ability of transfer of funds to holding. The ability of transfer of funds to its holding company. Now concentrate. To holding company. That is more than enough. Sir, subsidiary operates in severe long-term restrictions. Sir, what is the meaning of this severe long-term restrictions? I can give here a beautiful example. Please all of you concentrate. This was not at all explained in accounting standard also. Actually, I also learned such explanation in US GAAP. In US GAAP, it was explained in very beautiful manner. Subsidiary operates in severe long-term restrictions. For example, I invested in the equity shares of subsidiary company. Such a subsidiary company is in the liquidation process. Such a subsidiary company is in liquidation process. Whenever a subsidiary company initiated the liquidation procedure, then the entire affairs of the company are in the hands of whom? Liquidator. Then once the liquidator is the master chef of the kitchen, I mean, if such liquidator is captain of that company, then all the powers, then all the rights are vested with such particular liquidator only. Then at that point of time, holding company unable to control. Holding company unable to control the affairs of the subsidiary company, even though it have the controlling interest. Why? And whenever the liquidation process is initiated in a particular company, then the shareholders of such company are known as contributories. Shareholders will lose their rights as well as their duties at that point of time. Board of directors also will lose their rights as well as their duties also at that point of time. Am I right? So that's why if subsidiary operates in severe long-term restriction means up to the completion of liquidation procedure, it doesn't have any controlling ability. So once liquidation over, company is winding up, then control is zero actually. So due to which it impair means it reduce the ability of transfer of funds to the holding company. Ability of transfer of funds to the holding company. Yes, during the liquidation process, at the end, at the final stage, if any surplus is having in the hands of the liquidator, then liquidator will start giving funds to the holding company. So due to which we are unable to transfer funds to the holding company, at that point of time, you cannot consider such subsidiary company in the preparation of the consolidated financial statements. Do you understand? Now here the exclusion is nothing but, so in the following cases, no need to prepare CFS, or such companies, such subsidiary companies not considered in preparation of CFS. Maybe if the holding company having more than one subsidiary, then particular subsidiary company we are not considering. If such holding company is having only one such subsidiary is satisfies these situations, then we cannot prepare the consolidated financial statements at all. We no need to prepare the consolidated financial statements at all. Do you agree, all of you? Okay, fine. Now, if you observe my discussion, we started our journey with the meaning. Sir, the meaning of CFS is nothing but prepare the financial statements of a group companies by treating it as a single entity. So reason for preparation of consolidated financial statements, maybe it give the true and fair picture of the group as a whole. So various advantages also I told you, to know the real intrinsic value per share, it is only possible. Am I right? And what are the other reasons we are seeing for the preparation of CFS? The overall picture of the status of a group we will know through preparation of consolidated financial statement, and the users of the financial statements can easily take the appropriate decisions by seeing the group performance rather than seeing the individual performance. Next, after that, I discussed different components of the financial statements: consolidated financial statements, consolidated P&L, consolidated balance sheet, consolidated cash flow statement, consolidated notes to accounts. Then I discussed about the provisions of Companies Act 2013 with respect to the compliance. A company who have subsidiaries or associate or joint venture should need to prepare the consolidated financial statements along with standalone financial statements. At the time of preparation of annual returns, they need to prepare AOC 4 CFS form. We checked that one through MCA website actually. So along with the annual returns, they should also need to provide AOC 1, which provides salient features of the subsidiary company. Sir, certain exclusions or exceptions are given as per the Companies Act 2013. Now, which satisfy the criteria, then no need to preparation of consolidated financial statements. Even though my company is having subsidiary, associate, or joint venture, our company is having ultimate parent company. Our company's interest is held by any other company, then no need to prepare the consolidated financial statements. In the given example, B Limited, C Limited, no need to prepare. Sir, not listed in the stock exchange either in India or at any foreign country, then at that point of time, there is not mandate to prepare the consolidated financial statements. Then we see in the provisions of Accounting Standard 21, whenever a company wants to decide to prepare the consolidated financial statements due to mandatory requirement as per the statute or the voluntary requirement, it should comply the provisions of Accounting Standard 21. Certain exclusions we've seen: if the control is of temporary in nature, that is holding company is going to dispose such investment in the near future. The holding company is going to dispose the investments in near future, then at that point of time, you should not, you no need of considering such subsidiary in the preparation of consolidated financial statements. The reason is, if it is temporary in nature, means they are seeing such investments as a stock in trade, or maybe they are seeing such investments as a current investment. At that point of time, no need to consider such subsidiary into the preparation of CFS. And the subsidiary operates in severe long-term restrictions, due to which it impairs the ability of transfer of funds to the holding company. That means maybe the subsidiary company is in the process of liquidation. At that point of time, the controlling power is missing by the holding company. That's why we may not consider such subsidiary company in the preparation of CFS. Hope you got it right. So now just I will confirm the content just now what we discussed in my OneNote. I don't want to read the entire text here. Just I will confirm one by one point, guys. Relevant provisions of Companies Act 2013. Company having one or more subsidiaries or associate companies, in addition to the standalone financial statement, they should need to prepare the consolidated financial statements of a company. Am I right? And such a CFS, which shall also be laid before the annual general meeting. I already told you, along with the standalone financial statement, CFS also laid down in the annual general meeting in front of shareholders. Okay. Then the company shall also attach, along with the financial statement, a separate statement containing AOC1, which explains the salient features of the financial statements of the subsidiary. I already told you. So actually, it will prepare the annual return of AOC 4 CFS. The general companies which are not preparing the CFS, simply they will prepare AOC4, but the company which need to prepare the consolidated financial statement, they will adopt AOC4 CFS. Am I right? So such two things I already shown here. If you check here, two different forms are there. Form for filing of statement and other documents with the registrar, AOC4 is there. Here, form for filing consolidated financial statement, AOC4 CFS is there. Both are different. AOC4 is filed by those companies which will not prepare the CFS. AOC4 CFS will be prepared by those companies which we are going to prepare CFS along with standalone financial statements. Come back. So the consolidation of financial statements of the company shall be made in accordance with the provisions of Schedule 3 of the Companies Act 2013 and the applicable accounting standards. So how you are prepare the standalone financial statement, in the same manner you need to prepare the same Schedule 3 format. There is no change at all. Exemption from preparation of CFS, we already checked. If it is a wholly owned subsidiary or it is a partially owned subsidiary. Now my company having certain subsidiaries. Now my company is owned by another company. Right now I am also acting as subsidiary to another company. My company is a wholly owned subsidiary. That means my company is having a holding or parent company. Then at that point of time, even though I have other subsidiaries or other associates, no need to prepare. It is a company whose securities are not listed or in the process of listing on any stock exchange, whether in or outside India. No need to mandatorily prepare the CFS. It is ultimate or any intermediate holding company files CFS. Sir, ultimate or intermediate, these 2 points are same. Sir, ultimate parent company, anyway it will prepare financials. Then why I need to prepare the financials? Because I have another holding company, even though I have another subsidiary, but I have another holding company as well. At that point of time, I no need to prepare the CFS. My holding company will prepare the consolidated financial statements. Am I right? Next, coming to AS21 provisions. AS21 prescribes the accounting principles and procedures for preparation and presentation of consolidated financial statement for a group of enterprises under the control of a parent. AS21 is mandatory. If an enterprise presents the CFS, in other words, the accounting standard does not mandate an enterprise to present consolidated financial statements. I mean to say, AS21 never provides that you should need to provide consolidated financial statement. But AS21, once applicable, once a company want to prepare the consolidated financial statements, such company should mandatorily apply the AS21. So it is clearly given that the accounting standard does not mandate an enterprise to present CFS, but if the enterprise want to prepare the CFS based on the voluntary requirement or based on the compulsory requirement as per the statute, it should need to comply with the requirements of the statute, or otherwise it should prepare the CFS as per AS21. We already discussed. Okay. Certain exclusions. Control is intended to be temporary because subsidiary is acquired and held exclusively with a view to its subsequent disposal in the near future. So maybe we are treating the investments in subsidiary as current investment or stock in trade. It operates under severe long-term restrictions which significantly impairs its ability to transfer funds to the parent. We already seen such one. Maybe the subsidiary company is in the process of liquidation. That's why it's unable to transfer funds to the holding company. At that point of time, we may not consider the subsidiary into the consolidation procedure. Now, sir, if consolidation procedure, in such case, how the investments we are going to treat? AS13 will be applicable. Sir, if AS21 is not applicable, means for such investment, which standard is applicable? AS13 accounting for investment is applicable. In consolidated financial statements, investment in such subsidiaries should be accounted for in accordance with AS13 accounting for investments. AS13 accounting for investment is applicable. That is the point clearly he is specifying here. Okay. Come down. Where an enterprise owns a majority of the voting power by virtue of ownership of the shares of another enterprise, and all the shares are held as stock in trade and are required and held exclusively with a view to their subsequent disposal in the near future, the control by the first mentioned enterprise is considered as temporary. Just he is giving explanation here when the control is treated as temporary. I already explained when the control is treated as temporary. If the company is an investor company, then such company may treat the investment held in the subsidiary as stock in trade. At that point of time, we may treat that the control is only in temporary in nature. Then we may not consider the subsidiary in the preparation of consolidated financial statements. Am I right? So I discussed the part of advantages. We see the different components of CFS as well: consolidated balance sheet, consolidated P&L, consolidated cash flow statement, and notes and statement and explanatory schedules. Now the only pending thing is consolidation procedure, which is the accounting treatment. Sir, what are all till now we discussed, which is not at all related to the accounting treatment? So the introduction part we deal basically in lecture number 1. Just now I dealt the pure introduction part, guys. Okay, sir, the real accounting treatment, the consolidation procedure, are going to start from the next video lecture. Until bye, have a nice day. Hi friends. In last lecture we seen the entire introduction part to the consolidated financial statement. This lecture is purely dedicated to accounting treatment, that is simply consolidation procedure. So please all of you put the heading consolidation procedure, and please all of you allocate me approximately 1 hour to 1.5 hour. What exactly happening in case of consolidated financial statements, I'm going to reveal through this session. Okay, this is consolidation procedure. So I will take one illustration for better understanding in generally how the consolidation process is going on. Okay, two companies are there. From starting onwards, we are mentioning only two companies. That is, one is H Limited, which is a holding company, and another company is S Limited, which is a subsidiary company. Yeah, first let me build the balance sheet of subsidiary company. After that, we come back to holding company balance sheet. So, which is S Limited, subsidiary company. In S Limited, equity share capital exists for 5 lakhs. Let us assume total amount is 5 lakhs. Number of shares, 50,000 equity shares at the rate of 10 rupees each, which is nothing but 5 lakhs. Then under reserves and surplus, so general reserve is there. General reserve is there for 1 lakh. Profit and loss account exists for 50,000. Statutory reserve is exist for another 50,000. Total 2 lakhs is the reserves and surplus balance. So remaining all other liabilities, just I'm writing here, all other, I mean outside liabilities. I can put it simply, outside liabilities. You can put it as 8 lakhs, guys. Okay, so total of the balance sheet is here 15 lakhs. I mean the same way here, coming to the assets. So you can consider here total assets. Simply you can consider here total assets is also 15 lakhs. You know one thing, right? Total assets means assets consist of non-current assets, current assets, another PPE. Okay, investments. What are the different things? Loans and advances, long-term loans and advances, and under current assets, inventory, trade receivables, current investments, cash and cash equivalent, short-term loans and advances, other current assets. So everything will be there under assets. The total is 15 lakhs. Just I mentioned like this. Now coming to holding company, you can consider holding company here. This is the holding company. Now, first and foremost one, I'll start this with investment in equity shares. Investment in equity shares of S Limited, because to get holding and subsidiary relationship, certain investment we should hold, right? So how many number of shares you hold it, sir? Let us assume we hold it 40,000 equity shares. I purchased at the rate of 12 rupees per share. Let us assume I purchased at the rate of or 15 rupees at share, not an issue. I purchased at the rate of 15 rupees per share. That is 40,000 into 15, how much? So cost of investments, guys, I purchased, that is cost price is different from face value. Face value actually 10 rupees, but I purchased such investment, or I acquired the investment at the rate of 15 rupees per each. 40,000 into 15, that equal to cost of investments is nothing but 6 lakhs. Okay, so now here equity share capital exists. Here let us assume equity share capital is 10 lakhs. So we have the reserves and surplus. Here let us assume general reserve we have for 1,50,000, and we have the profit and loss account for 1 lakh, and we have the statutory reserve for another 1 lakh. So total here 3,50,000, right? Then you can put it as other liabilities. Other liabilities is 13,50,000 minus 20 lakhs. You can put 6,50,000. Okay, so total 10 plus 10, 20 lakhs here. Here you can write the other assets. The total other assets, it is total equal to 20 lakhs. This is a typical balance sheet just I taken for discussion, which is 14 lakhs. Now consider all of you. So like this, two companies information they should give for the purpose of preparation of consolidated financial statements. Now, out of the consolidation procedure, first what I am going to discuss, first I will discuss consolidated balance sheet. Our major discussion in the entire chapter is related to consolidated balance sheet. At the end of the chapter, we will see the consolidated P&L. So once consolidated P&L balance sheet is over, the chapter is over. Actually, we are not at all seeing anything related to consolidated cash flow statement. Balance sheet P&L is over means automatically notes to accounts also we will need to discuss. But consolidated cash flow statement we are not going to discuss in this particular chapter. Come down. Now, first, whenever you want to start doing preparation of consolidated financial statement, first you need to check one thing. Sir, holding company invested in equity shares of subsidiary company. No doubt about it. In how many number of shares it make investment? In how many number of shares it invested? Out of existing 50,000 shares, it invested in 40,000 shares. That means holding interest, how much? Holding company interest. So I'm writing here, holding company interest. You can tell it as in terms of percentage. That is 40,000 shares divided by 50,000 shares. How much, guys? Which exactly 80% is the holding interest. That means out of the net worth of the subsidiary, 80% belongs to whom? Holding company. Then belongs to the outsiders. Net worth of the subsidiary belongs to the outsiders. We can call it as minority interest. You know already, right? Which is known as minority interest. Minority interest portion is how much? Which is 10,000 shares are held by the outsiders. That is equal to 20%. First, you need to identify this. Okay, sir, identified. Now, all of you, please consider it here. except equity share capital and reserves and surplus, which is nothing but net worth of the subsidiary, except net worth of the subsidiary, remaining all assets and liabilities. And assets and liabilities, you can make it simply add a line by line item, except net worth of the subsidiary. This is nothing but net worth of the subsidiary, right? Except this net worth of the subsidiary. And one more thing, I forgot to tell you. This is the cost of investments, right? Except this net worth of the subsidiary and cost of investments, remaining all are simple line by line addition in case of consolidation procedure. You know, right? Sir, consolidation means you are adding the assets of subsidiary company with the assets of holding company. You are adding liabilities of the subsidiary company with individual liabilities of the holding company. Then you should need to prepare a consolidated balance sheet. Such a simple procedure. Consolidation means adding. Put together, you can simply add it. For example, subsidiary company PPE, we have the balance of let us assume 5 lakhs. Now in holding company PPE also we have, let us assume 10 lakhs. 10 plus 5 lakhs PPE, we can put it under 15 lakhs in the consolidated balance sheet. In the same way, liability also we can put it in the same way. We will add it, we will make it present in the consolidated balance sheet. Am I right? Now, the remaining items are net worth of the subsidiary and investments in the holding company. Now, all of you, please come here. I will come to net worth of the subsidiary here. Net worth of subsidiary. So net worth of the subsidiary, total it having two different components majorly, right? What are such two different components? Let me know. One is equity share capital. One is equity share capital, or you can simply call it a share capital. One is equity share capital. Another one is reserves and surplus. Reserves and surplus. Am I right? If you check, net worth of the subsidiary contains equity share capital and reserves and surplus. Now, each component of the reserves and surplus, we can divide it into two parts, friends. Each part of the reserves and surplus, we can divide it into two parts. One is capital profits. Another one is revenue profits. One is capital profits, another one is revenue profits. Sir, what is the meaning of capital profits? What is the meaning of revenue profits? Sir, general reserve, how much portion is related to capital profit? How much portion is related to revenue profit? In P&L, how much portion is related to capital profit? How much portion is related to revenue profit? Sir, statutory reserve, how much portion is related to capital profit? How much portion is related to revenue profit? Now, to split the entire reserves and surplus into capital and revenue, first you should know what is the meaning of capital profit. Capital profits are those reserves and surplus exist as on acquisition of investments by holding company in subsidiary company. Those reserves and surplus exist as on date of acquisition of investments. Those reserves and surplus exist as on date of acquisition of investments by holding company in subsidiary company is known as capital profits. Right, consider it, friends. So the reserves and surplus of holding company, the reserves and surplus of surplus company, I'm so sorry, I'm completely in different mode. Reserves and surplus of subsidiary company is going to divide it into two parts, that is capital profits and revenue profits. Capital profits are those reserves and surplus exist as on date of acquisition of investment by holding company in subsidiary company and continue to exist as on date of consolidation. So simply speaking, for example, here in the given case, H Limited held 40,000 equity shares as investments in subsidiary company, right? Now, this balance sheet is as at 31st March 2021. Let us assume this balance sheet is also as at 31st March 2021. But these investments are acquired by H Limited in S Limited. Let us assume as on, let us assume these acquired as on 1/7/2020. So these investments are acquired as on 1/7/2020. Now, as on 1/7/2020, how much balance of reserves and surplus had by the subsidiary company are technically known as capital profits. Capital profits are those reserves and surplus exist as on date of acquisition of investments by holding company in subsidiary company and continue to exist as on date of consolidation. For example, sir, in this general reserve, as on 1/7/2020, how much reserve exists, sir? Just for example, let us take 75,000 for the time being. Sir, current year profits were, or let us assume the P&L account, not current year profits, sorry. Out of this P&L, 50,000 already exist as on 1/7/2020 to the extent of 20,000. Okay. Sir, statutory reserve is not at all exist as on 1/7/2020. So these are figures as on 1/7/2020. Just I am telling you this information only for understanding. So that means what are the total reserves and surplus exist as on date of acquisition? That is 75 plus 20 total. 75 plus 20 total equal to 95,000. So now the capital profit as per my example is 95,000. Now, revenue profits are those reserves and surplus. Those reserves and surplus occurred after date of acquisition. So simply, those reserves and surplus occurred after date of acquisition of investments. Or we can call it as revenue profits. Here in the given case, after date of acquisition, now out of 1,75,000 is there as on 1/7/2020 means after 1/7/2020, how much we actually transferred to the general reserve? That is 25,000 we transferred plus profit and loss account. That is after 1/7/2020, maybe we are getting profit of 30,000 already there, 20,000. That's why after 1/7/2020, maybe we are getting 30,000 profit. That is plus 30,000. And statutory reserve also we created just right now, that is plus 50,000. So total reserves and surplus related to the revenue profits is 1,05,000. Do you agree, all of you? So that means the reserves and surplus, the entire reserves and surplus of the subsidiary company, we are going to divide it into capital profits as well as revenue profits, guys. Now, sir, out of the net worth of the subsidiary, this total net worth of the subsidiary, is it belongs to holding company? No, it is not belongs to the holding company entirely. To that extent of 80% is only belongs to holding company. Remaining 20% is belongs to the minority interest. I mean, in the equity share capital of 5 lakhs, if it is there na, this is equity share capital of 5 lakhs is there na. In such equity share capital, holding interest is 4 lakhs, minority interest is 1 lakh. In the capital plus revenue profit, that is total of reserves and surplus. That is total of reserves and surplus. Out of the total of reserves and surplus, again 80% belongs to holding company. That is 2 lakhs into 80% means 1,60,000, and the remaining 20% belongs to minority interest. Now first let me split all of you here in between the holding interest and minority interest. Now here holding interest is 80%. 5 lakhs into 80% means 4 lakhs, and the minority interest is 5 lakhs into 20% is 1 lakh. So first, please, all of you listen carefully. You can understand everything. You can understand everything, but some time should be required. What are all such all things, sir? There are no connections at all. Simply you are telling. So please just allow me to explain the things first. Then I'll connect each and every dots. Then you can easily understand. Okay. Capital profits. Out of the capital profits also, you can split into holding interest and minority interest. So holding interest, how much? Minority interest, how much? That is 95,000 into 80% is holding interest, which is 76,000. Remaining, that is 19,000 is minority interest. The same way, in case of revenue profits also, holding interest how much, minority interest how much, you can check. That is 1,05,000 into 80%, 84,000 is holding interest, 21,000 is minority interest. Am I right, guys? Now, sir, please all of you concentrate. In case of consolidated financials, I mean to say, in case of consolidated balance sheet, what we are doing, simply we are adding line by line addition of assets of both the companies and liabilities of both the companies, except the net worth of the subsidiary and investment of the holding company, we not yet decided. But we know one thing, out of the entire net worth, only we know only our portion is 80%, and the remaining 20% portion is belongs to minority holders. Then you may would have a doubt that, sir, if our company portion is 80%, then you should need to include 80% of assets and 80% of liabilities only, right? Why? Because out of 50,000 shares, if we are acquiring only 40,000 shares, then existing holding company assets and liabilities should be combined with 80% worth of assets and 80% worth of liabilities only, na? But we are combining 100% worth of assets and liabilities of the subsidiary company with holding company assets and liabilities. How it is possible? What we will do, we will include the 100% of assets and outside liabilities for consolidation purpose. At the same time, we will record that amount payable to the outsiders as a liability. Amount payable to the outsiders is nothing but minority interest. Now the portion of the outsiders in equity, share capital and reserves and surplus, we can call it as minority interest. At the time of preparation of consolidated balance sheet, we consider the 100% assets and 100% liability of the subsidiary. That is the reason why we are showing minority interest as a liability. You mean, if you don't want to show the minority interest in the consolidated balance sheet, you would have considered only 80% of assets and 80% of outside liabilities only in the CBS. That's absolutely fine. But right now you are considering the 100% worth of assets and 100% worth of liabilities. As a result, 20% of assets and liabilities belongs to the minority interest. Now you are showing that such 20% interest under the heading minority interest. You can treat it as a separate line item in the consolidated balance sheet. Do you understand this one first? Sir, now minority interest portion is how much, sir? That is net worth of the subsidiary minority portion is 20%. You already know, you can very easily calculate that. That is 5 lakhs plus 2 lakhs, totally 7 lakhs. 7 lakhs into 20%, I am getting 1,40,000. If you add all this minority interest, you also getting only 1,40,000. Please check, guys, here. If you're not believing my words, this is 1 lakh. This is 90,000. This is 21,000. What is the total amount of minority interest? Therefore, total amount of minority interest is equal to 1,40,000. Absolutely fine, sir. Now, this minority interest, what we will do? This minority interest, we will show it as a separate line item. Separate line item in consolidated balance sheet by treating it as a liability. By treating it as a liability. So that's why we can add 100% worth of assets and 100% worth of liabilities. Do you understand? We understood, sir. Now the remaining portion is 80% is there now. 20% is already shown in the minority interest. Remaining 80% portion is there now. Such 80% portion is there under equity share capital and a capital profits related to holding interest, related to the revenue profits, related to holding interest. So out of the net worth of the subsidiary related to the holding company interest, in share capital 4 lakhs, in capital profit 76,000, in revenue profits 84,000 is there. Now I completed the minority interest. Now I'm start doing workouting holding interest. In holding interest share, holding interest share in net worth of subsidiary. In net worth of subsidiary, I have total 3 shares. One is share in share capital, another one is share in capital profits, another one is share in revenue profits, another one is share in revenue profits. Now consider all of you. The share in holding interest share in net worth of the subsidiary with respect to share capital and capital profits, with respect to share capital and capital profits put together, and it should be compared with cost of investments. It should be compared with cost of investments. All of you please concentrate. We will compare with cost of investments. And the revenue profits are there, na? Revenue profits are there, right? Such revenue profits you can add it to reserves and surplus of holding company. Reserves and surplus. You can add it, sorry, you can add it to reserves and surplus of holding company in consolidated balance sheet. What about all this, sir? Now the share in share capital 4 lakhs. So in the subsidiary company share capital, our worth is 4 lakhs. In the capital profits, our share is 76,000. Up to the date of acquisition, what is the worth of subsidiary just now I'm working? Sir, the real date of acquisition of investment is 1/7/2020. As on such 1/7/2020, what is the worth of the subsidiary? We are paying 6 lakhs. How much benefit you are getting from the subsidiary? The benefit we are getting from the subsidiary is to the extent of equity share capital 4 lakhs, to the extent of the capital profits we are getting 76,000, which is known as share in net worth of the subsidiary up to the date of acquisition. Share in net worth of the subsidiary up to the date of acquisition. To get such net worth up to the date of acquisition, we are paying 6 lakhs. Now all of you can tell me, sir, to get the benefit of share capital, 4 lakhs, plus to get the benefit of the capital profit 76,000, how much you paid actually? I paid 6 lakhs. I paid total 6 lakhs. You know, now all of you can apply the logics here. The cost of investment, you can treat it as PC, and the amount you are getting, you can treat it as net worth as a NAV, which is nothing but NAV. The NAV of the subsidiary company, you are getting only 4,76,000, but you are paying as a PC 6 lakhs. The purchase consideration is more than NAV. Then the concept will leads to goodwill, right? And the concept will leads to goodwill. Concentrate. If cost of investments is greater than share in share capital and capital profits as on date of acquisition. then we need to recognize goodwill. No, not like that. If cost of investments is less than share capital and capital profits as on date of acquisition, then we can treat it as a profit situation, which is capital reserve. You know, all of you, which is not a new concept. We've seen in n number of chapters, like amalgamation. We've seen amalgamation of companies, amalgamation of partnership firms. Our last topic is amalgamation of partnership firms only, where the purchase consideration is paid, which is cost of investment as on date of acquisition. And the benefit we are getting, share in share capital plus share in capital profits. What is the meaning of capital profits? Reserves and surplus exist as on date of acquisition and continue to be exist as on date of consolidation. Such reserves and surplus actually exist as on date of acquisition. The total worth we are getting as on date of acquisition is nothing but share in share capital plus share in capital profits. That benefit you are comparing with the PC you are paying. If PC is more than the benefit getting NAV, then which is the goodwill situation. If the cost of investment is less than the share in share capital and capital profits as on date of acquisition, then which is treated as capital reserve. Sir, technically, the goodwill or capital reserve is known as cost of control. Cost of control. What is the meaning of cost of control, sir? To get the controlling power in such company, how much excess you paid, that is nothing but goodwill. To get the control in such business, how much profit you enjoyed, which is nothing but capital reserve. So the cost of control is excess amount you paid over the benefit you are getting, or maybe excess benefit you are getting over the investments you paid. Do you understand? Okay, sir. Now come to revenue profits. All of you come to revenue profits. What about the revenue profits? Those reserves and surplus had by the subsidiary company after date of acquisition, or maybe those reserves and surplus exist after date of acquisition. Now in this case, after date of acquisition, after 1/7/2020, 1 lakh minus 75,000, 25,000 general reserve is there. P&L 50 minus 20, 30,000 is there. Statutory reserve entirely after only we done. That is as on 1/7/2020, statutory reserve is 0, means entirely after 1/7/2020. That is 50 plus 30, 80, 80 plus 25. Total 1,05,000 revenue profits we have. Am I right? Out of the 21,000 you already sent it to minority interest. Now remaining holding interest portion of the revenue profits, how much? 84,000. Such a holding interest share in the revenue profits, you can add it to the reserves and surplus of the holding company in consolidated balance sheet. You mean for this general reserve 1,50,000, I should add 25,000, the difference. For this P&L 1,00,000, I should add the difference 30,000. For the statutory reserve of 1 lakh, you should need to add the 50,000. Now, if you really prepare the consolidated balance sheet here, please all of you concentrate here. Now I'm preparing the consolidated balance sheet. How it will look like, you can see here. Consolidated balance sheet as on 31st March 2021, right? All are simple line by line addition. All are simple line by line addition, except these items, right? Except these items. Now first, you can add line by line addition items. Assets 14 lakhs, here 15 lakhs, total 29 lakhs. So assets 29 lakhs. How we are getting? So the assets of the holding company is 14. Assets of the subsidiary company is 15. 14 lakhs plus 15 lakhs, 29 lakhs. Sir, what about investments in equity shares of S Limited, sir? This was already nullified now at the time of comparing, at the time of knowing the cost of control, what we made, we are comparing the cost of investment with share in net worth of the subsidiary. Then the cost of investment and share in net worth of the subsidiary cancel with each other. Then only we are getting either goodwill or capital reserve, right? In this situation, we get goodwill or capital reserve. That one also I will put here. In this situation, we got goodwill actually. How much excess we paid? 6 lakhs minus 4 lakhs 76,000. That is excess we paid 1,24,000 as goodwill, guys. Do you agree? In this situation, I'm telling you, current situation, we are getting a goodwill of 1,24,000. Now, investments will not come. Investment already gone while comparing with share in net worth of the subsidiary. Now you are getting goodwill amount. Such goodwill you can return here. Apart from the line by line addition of assets, you can write the cost of control, which is nothing but goodwill. Such goodwill amount is 1,24,000. Do you agree, all of you? Okay, fine. Next, coming to the liabilities, guys. First, all of you. Here, outside liability 8 lakhs. Here, other liability 6,50,000. What is the total? 8 lakhs plus 60,000, 14,50,000. So now just here I am writing outside liabilities. How much? This is, sorry, 6 plus 8 lakh, 14,50,000. Simple line by line addition. 6 lakhs plus 8,50,000. We got 14,50,000. Next. Sorry, made it reversed. 8 lakhs plus 6,50,000. The total is correct, which is 14,50,000 only. Now, we should need to incorporate minority interest now, because we considered the 100% assets of subsidiary company, 100% portion of the liabilities of the subsidiary company, but only we acquired 80% portion now. Because of considering the 100% portion, you should need to record minority interest as a separate line item, where I will record in the balance sheet actually. Sir, actually this consolidated balance sheet I need to prepare based on schedule 3, but for understanding, first I'm preparing in the T-shape format. Then while coming for the main problems, I'm going to prepare the CBS in schedule 3 format only. Now, all of you please consider minority interest, where we are going to represent actually after presentation of share capital and reserves and surplus, and before presentation of non-current liabilities in schedule 3 format, you should need to present the minority interest. How much minority interest we got? We already calculated that total of the minority interest is 1,40,000. You can write it. You can very simply calculate the minority interest. How you can calculate? Out of this total 2 lakhs plus 5 lakhs, 7 lakhs, only 20% belongs to the outsiders. Such 20% is nothing but 7 lakhs into 20%. 7 lakhs into 20%, which you got 1,40,000. Am I right? Now, you can write the equity share capital first here. You can write the equity share capital first here. Sir, can I add equity share capital of holding company with selling company? No. The equity share capital of the selling company already considered in the cost of control. Please check, guys. Certain portion of equity share capital, if you check certain portion of equity share capital, go to the minority interest. And the remaining portion of the equity share capital is used for calculation of cost of control. Is used for calculation of cost of control. That's why there is no equity share capital of the subsidiary. Just you can only show the equity share capital of holding company, which is how much? 5 lakhs or 10 lakhs? Check here. I think so. 10 lakhs. How much? Yeah, 10 lakhs. Next, come to the reserves and surplus. Come to the reserves and surplus. Sir, can I consider the reserves and surplus of the subsidiary in the holding company? You should only consider the revenue profits of the reserves and surplus, because the capital profits of the reserves and surplus already went to the calculation of cost of control, and related to the minority portion, you already calculated under the minority interest. Under the reserves and surplus, minority interest, minority interest already went to minority interest liability. Now the remaining portion of the reserves and surplus related to the holding interest, you are divided into 2 parts now. That is capital profits and revenue profits now. Now related to holding interest, capital profits holding interest already went for calculation of Calculation of cost of control. Under this cost of control, capital profits included na. Only the revenue profits are there na balance. The revenue profits you can add it to the reserves and surplus of the holding company in consolidated balance sheet. Am I right? Now you can consider the revenue profits one by one. 1 lakh minus 75,000, which is 25,000. So general reserve 1 lakh 50 plus 1 lakh 50 plus share in revenue profits 25,000, which is 1 lakh 75,000. Next, come to P&L. P&L opening balance how much? 1 lakh. Here 30,000. 20,000 is there as on 1/7/2020. The profit after 1/7/2020 is only 30,000. So 1 lakh plus 30,000, 1 lakh 30,000. So 1 lakh plus 30,000, which is 1 lakh 30,000. Next, come to the statutory reserve. SR is nothing but statutory reserve. Here opening balance how much? 1 lakh. The entire 50,000 is there after 1/7/2020 only, because as on 1/7/2020 statutory reserve is nil. That's why entire statutory reserve is acquired after 1/7/2020. So 1 lakh plus 50,000 is 1 lakh 50,000. 1 lakh plus 50,000 is nothing but 1 lakh 50,000. Am I right? I considered all right. Now you can make it totals of the consolidated balance sheet. Let us have a look whether it is tallied or not. Friends, just a second. Don't make it total, please. Don't make it total. Just a small correction. What is that? If you check out of the equity share capital reserves and surplus, only 80% belongs to holding interest, remaining 20% belongs to minority interest. That means in capital profits and revenue profits, also 80% belongs to holding interest, 20% belongs to minority interest. Now revenue profits belongs to holding interest only, I can add it here. So here actually I wrote the correct one. So now holding interest share in net worth of revenue profits added to the reserves and surplus of holding company's consolidated balance sheet. But I am adding the entire amount, sorry. So now out of this 25,000, you should only add your interest. That is 25,000 is the revenue profit now. 25,000 into 80%, which is 20,000 only you can add here, which is 20,000. The same way here on behalf of 30,000, you can only add 30,000 into 80%, that is 24,000. Here also on behalf of 80,000, you can only add 50,000 into 80%, because entire revenue profits is not belongs to you. Certain portion of revenue profits belongs to minority interest. I already included in such 7 lakhs revenue profits already there. Do you understand? So now you can please tell me, all of you, reserves and surplus, modified reserves and surplus, how much? 1,70,000 here, 1,24,000 here, 1,40,000 here. So just a small correction. At the time of explaining the things, I explained correctly, but just now in the flow, just I wrongly added. You can make it total. Now it is absolutely tallying. 29 lakhs plus 1,24,000 here, 31,24,000. Here also I'm getting 31,24,000. You can check if you want. You can add here 10 lakhs plus 1,70,000 plus 1,24,000 plus 1,40,000 plus again 1,40,000 plus 14,50,000. So I got exactly 31,24,000, guys. Please check it. Sorry, I got exactly in both the cases 30,24,000. 30,24,000. You can make it total from your sides. So 30,24,000 here, here also 30,24,000. So in the calculator, I got exactly 30,24,000. Now consolidated balance sheet tallied, right? Sir, here what magic you done, sir? Nothing is great. Simply you added the assets of subsidiary with assets of holding, liabilities of subsidiary with liabilities of holding. Here actually I combinedly added, but in case of the problem, individually we will add line by line items. That is PPE with PPE, maybe the cash balance with cash balance, maybe inventory with inventory, like this we will add. But here combinedly I add it. One thing you need to remember, but we should not consider the net worth of the subsidiary and investment directly into the consolidated balance sheet. We will pick net worth of the subsidiary, we will pick investment in equity shares. Do you agree? Now you pick it, right? Now after picking net worth of the subsidiary, you can firstly divide it into two parts. Net worth in the subsidiary is related to the holding part, related to the minority part. Minority part put set aside completely. Minority part where you are going to present, actually you are going to present it under separate line item after presentation of reserves and surplus and before presenting the non-current liabilities under the consolidated balance sheet. Okay, fine, sir. Now after completion of the minority interest, remaining portion is only holding interest we have. Now the holding interest is divided into two parts. The net worth of the subsidiary related to the holding interest divided into two parts. Share in share capital plus capital profit is one part, and share in revenue profits is another part. Now share in share capital plus capital profit you can compare with cost of investment to the cost of control, either it is goodwill or capital reserve. And the share in revenue profits you can simply add it to the reserves and surplus of the holding company. So just I will put such thing under the diagrammatic representation. Please all of you concentrate. This is the consolidation procedure what we are doing just now. Here I am explaining in very simple mode. This is the summary, guys. This is summary. What we will do, sir? Number one, simple line by line addition of individual assets and liabilities, except, tell me all of you, except net worth of subsidiary. You know, net worth means share capital plus reserves and surplus, and investments in holding company. Now come to point number two. You can first take net worth of the subsidiary here. You can take net worth of subsidiary, right? So net worth of subsidiary means, in bracket just you mention, which is share capital plus reserves and surplus. Am I right? You know, under the reserves and surplus, two types of reserves and surplus is there. One is capital profit, another one is revenue profit. That is different story. I don't want to put that story right. I don't want to put such story right now. So just capital profits, revenue profits are there. Now share capital plus the total reserves and surplus. Share capital and total reserves and surplus, that is nothing but net worth of the subsidiary. Such net worth of the subsidiary you should going to divide it into minority interest portion, or that is holding interest portion, and a minority interest portion. Am I right? Sir, minority interest portion is directly goes to consolidated balance sheet. This is where we present after reserves and surplus, but before non-current liabilities. As a separate line item, we will show. This is in consolidated balance sheet as a separate line item. We will show. Now come to holding interest. In holding interest, what we have? We have share capital plus capital profit is one portion. Revenue profits is another portion. Now I am divided into two ways. One is share in share capital plus share in capital profits. Capital profits is one portion, and the share in revenue profits is another portion. Now share in share capital plus capital profit, we should need to compare with Cost of investment, na? Cost of investment also you left, right? You are not included in the line by line addition of items. Now such share in share capital plus capital profit you can compare with cost of investments. Now you will get either goodwill or capital reserve. Such goodwill or capital reserve we can consider in the CBS. Such goodwill or capital reserve we can consider in the consolidated balance sheet. Absolutely. Next, share in revenue profits. Share in revenue profits we can simply added to reserves and surplus of holding company in consolidated balance sheet. Except the second point, remaining all are simple line by line addition. That means people in generally thought that consolidation is very difficult process. Consolidation is very much lengthy. Lot of things I need to do. No, for consolidation, what you need to do, how to add the things, simple line by line addition, and share in, that is total net worth of the subsidiary, and investment, make it separate. Now the net worth of the subsidiary is split into two parts: minority interest, holding interest. Minority interest completely shown under a separate item in the CBS. Now come to share in net worth of the subsidiary related to the holding interest. Now it is have total three components. One is share capital, capital profits, revenue profits. Share capital plus capital profit should be compared with the cost of investment to get the cost of control, either goodwill or capital reserve. And revenue profits, share in revenue profits, you can directly add it to the reserves and surplus of the holding company in consolidated balance sheet. Am I right? Then what is the meaning of revenue profit? What is the meaning of capital profit? I clearly explained here. Capital profits are those reserves and surplus exist as on date of acquisition of investment by holding company and subsidiary company, and such reserves and surplus are continue to existing as on date of consolidation itself. Now, out of the reserves and surplus existing as on date of consolidation, how much reserves exist as on date of acquisition, you should need to find out. Such reserves and surplus are known as capital profits. It includes maybe general reserve, it includes maybe statutory reserve, it includes maybe P&L. Here, the capital profits means those reserves and surplus which are exist as on date of acquisition. Revenue profits means those reserves and surplus acquired or occurred or acquired after date of acquisition of investments. Then such reserves and surplus you can make it present under the revenue profits. Just a second. Occurred or acquired. So hope you understand the basic consolidation procedure. Am I right, guys? All of you. Now, sir, the thing what we made in my illustration, this is the illustration I taken for understanding the things, right? But for our examination purpose or our classroom purpose, I don't want to do consolidation in this way, because this is completely an unstructured way. Even though you understand everything, you understood everything, this is completely an unstructured way. I mean to say, how in case of amalgamation, I developed a 5-step approach. How in case of partnership accounts, how I developed a DDTTS approach. So like this, for consolidation also, I developed one approach, guys. That approach is known as 4C approach. That approach is known as 4C approach. So I don't want to introduce the 4C approach right now itself. We are going to discuss the 4C approach in the next class itself. So please be all of you aware that what are the things we discussed in the today's class, the same thing, just I will make it into a proper structured manner, then we will check here. Do you agree, all of you? Fine. So in the next class, we will start with the 4C approach. Until bye, have a nice day. Hello, soldiers. In last class, we started with the concept of consolidation procedure. Consolidation is simple line by line addition of assets of holding company with assets of subsidiary company, and liabilities of holding company with liabilities of subsidiary company, except investments in holding company and net worth of the subsidiary company we can't consider as it is. Am I right, guys? One more reason why we are adding 100% assets and liabilities of subsidiary into the consolidated balance sheet. The reason I already told you, we are going to show to that extent of outsiders interest, that is minority interest, separately as a liability. If you are showing such minority interest as a separate liability in consolidated balance sheet, then you can add 100% worth of assets and 100% worth of liabilities into CBS. Am I right? Now, sir, coming to the net worth of the subsidiary, in such net worth of the subsidiary, we have two components. I mean, that net worth belongs to two parties. One party is minority interest holder, other party is holding company interest part. So now the portion in equity share capital and reserves and surplus with respect to the minority interest, you can segregate and split it and make it transfer to minority interest account. It is shown after reserves and surplus, but before presenting the current other, non-current liabilities as a separate line item. In generally, we will make it shown. Am I right? Now, coming to the holding interest portion of the net worth, we are divided into two parts. Holding interest of the net worth, that is share in equity share capital and share in capital profits we will put under one part, and share in revenue profits we will put under other part. Now the share in share capital and share in capital profits we may compare with cost of investment to know the cost of control. If the cost of investment is more than the share in share capital and share in capital profits, then which is the goodwill situation. Otherwise, which leads to the capital reserve situation. That goodwill or capital reserve, again, we are going to show under consolidated balance sheet. Now, the share in revenue profits we may combine with reserves and surplus of the holding company in the consolidated balance sheet. You may have one doubt, sir, why capital profit in generally you are considering for knowing the cost of control? Why revenue profits you are showing under the consolidated balance sheet? I will tell you a simple logic here. What is the meaning of capital profit? The reserves and surplus which are exist as on date of acquisition and continue to exist as on date of consolidation are known as capital profits, right? That means those reserves and surplus which exist as on date of acquisition means we are paying in the form of investments. We are paying money in the form of investment to the subsidiary and getting the benefits of share in equity share capital, and the share in reserves and surplus exist up to the date of acquisition. So that's why to know really how much profit we enjoyed or how much loss we get due to making investments as on date of acquisition, to know such profit or loss on date of acquisition, just we are comparing share in share capital plus share in capital profits with cost of investment. That is the reason why in generally capital profits are included while evaluating the cost of control. What is the meaning of cost of control? Cost of control is nothing but whether we are deriving profit or loss due to acquisition of investment as on date of acquisition. Do you understand? Now, once after acquired, what are all the different profits earned by the subsidiary company? Such profits are all our revenue profits. You can include it into the consolidated reserves and surplus. That is along with reserves and surplus of holding company. Just you can combine. You can show it under consolidated reserves and surplus, guys. Hope you understand why capital profits considered on the cost of control, why revenue profits carry forward to the consolidated reserves and surplus. Next, I told you at the end of the previous lecture itself, even though in a layman approach, we made a consolidation, but for examination purpose and for classroom environment while resolving the problems, we are following 4C approach. We are following 4C approach, summary also given in the last day. Now, let us start this lecture by discussing 4C approach. This is consolidated balance sheet, consolidated balance sheet, 4C approach. What is this 4C approach is all about? So this is not as per academics of or the text of ICAI. This 4C approach is altogether, it is new invention. I mean to say, it is my creativity. That's it. So 5-step approach is also my creativity in amalgamation. DTS approach is also my creativity. Here 4C approach. Sir, why you are building all such approaches? You know, so people, it is very hard to find out the correct solutions in the examination, because here and there they may bother about with tensions. Maybe sometimes clerical issues will also come in. To recollect the things, it is very difficult task, and to store the knowledge which you earned during while watching the lectures, it's very highly difficult task. So that's why if I put in a proper structurized form, you can simply recollecting the things. So that is the main agenda of pooling these approaches. Okay, come here. Sir, under the 4C approach, first C belongs to cutoff data. First C belongs to cutoff data. In case of cutoff data, what we will do, from the given information, you need to cut certain information. What is such information? Percentage of holding interest, percentage of minority interest, date of acquisition, date of consolidation, percentage of holding interest. Now, in the earlier illustration, we seen holding interest at 80%, minority interest is 20%. Date of acquisition is as on 1/7 when we acquired, as per the previous illustration, as on 1/7/2020 we acquired, and the date of consolidation we made as on 31st March 2021. So like this, after reading the information, you need to cut the data. That is date of acquisition, date of consolidation, percentage of holding interest, percentage of minority interest. Then after cutoff data, you need to classify the reserves and surplus of the subsidiary company. Simply, you need to classify the reserves and surplus of the subsidiary company into capital profits and revenue profits. Reserves and surplus. Each and every reserves and surplus you can consider. General reserve, capital profit how much, revenue profit how much. P&L, capital profit how much, revenue profit how much. Then statutory reserve, capital profit how much, revenue profit how much. That is all. Simply I'm putting here general reserve, capital reserve. Okay, profit and loss account, statutory reserve, all whatnot, everything, statutory reserve, etc. You can simply divide it, each reserves and surplus into capital profits, and revenue profits. You already seen what is the meaning of capital profit. Those reserves and surplus exist as on date of acquisition and continue to exist as on date of consolidation. Those reserves and surplus exist as on date of acquisition and continue to exist as on date of consolidation are known as capital profits. Come to the revenue profits. What is the meaning of revenue profits? Those reserves and surplus arise after those reserves and surplus arose after date of acquisition. Those reserves and surplus arose after date of acquisition and continue to exist as on date of consolidation. You should clearly consider individual reserves and surplus. How much capital, how much revenue for each and every reserves and surplus. That is nothing but classification stage. After classification, under the 4C, the next step is charts presentation, guys. Charts presentation. So charts presentation. So this is the first time you are come acrossing this 4C. So, but once you habituated to such 4C approach, you will enjoy the session like anything. So under charts preparation or charts presentation, the first chart is chart A. Chart A is related to minority interest. Chart A is related to minority interest. Now all of you concentrate how we are in generally preparing the minority interest chart. I'll explain here. We'll start with particulars. This is particulars. Total holding interest, minority interest. What is this all about, sir? Now, here we will calculate how much amount belongs to the minority interest. Apart from that, we will also calculate, we will also segregate the holding interest portion as well. Even though namesake, the chart is minority interest, the main agenda is calculation of minority interest. Along with this, we will also segregate holding interest as well. So always total is 100%. In the above illustration, we took holding percentage is 80%, minority interest is 20%. So just for the time being, I'm mentioning the above example, holding interest is 80%, minority interest is 20%. Am I right, friends? Now here. Just a second. I will apply the same 4C approach. I will apply the same 4C approach for the above illustration, not an issue. Just for everywhere, I'll put the previous illustration figures. Percentage of holding interest, how much we got? 80%. Percentage of minority interest, 80%. Date of acquisition, 1/7/2020. Date of consolidation, 31st March 2021. Just I applied. Okay. So here actually I'm not having a space. I thought of so at the initial stage itself, I don't have that thinking ability. So let us apply the same illustration to the 4C approach. So anyway, not an issue. Just give a second. I'll rub this charts presentation. Will made it below. Just a second. Don't worry, we'll present the chart presentation. But first, let me apply each and every step to the above illustration. That's the better idea, right? Yeah, fine. So now everything erased, guys, here. Now let me apply classification stage here again. Under the classification stage, you can take each and every reserves and surplus. So we have different reserves and surplus in the illustration. That is subsidiary company reserves and surplus. If you take general reserve is there, P&L is there, statutory reserve is there. Now please consider all of you first with general reserve. You can consider general reserve. So general reserve total, how much is there? General reserve total, guys. If you check general reserve total is 1 lakh as on 31st March 2021, which is 1 lakh. So now come here, general reserve is 1 lakh, which is as on 31st March 2021 as on date of consolidation. Now I'm segregating such general reserve into two parts. One is capital profit and other one is revenue profit. So capital profits, that is simply up to 1/7/2020 up to the date of acquisition. How much, guys? It is clearly given by me, just that figure is 75,000. So the remaining portion is revenue profits. Revenue profits means from 1/7/2020 to 31st March 2021. So the balancing figure is 25,000. Do we agree, all of you? So I clearly told the general reserve which is exist as on 31/7/2020 is 75,000. Okay, next come to P&L and a statutory reserve in the same way. You can split that. First, let me split the profit and loss account. So the profit and loss account balance as at 31st March 2021 is 50,000 given by me. Next, you can split into capital profits, revenue profits again. So we already completed the problem, but the same problem I am applying the 4C approach. That is the only difference. Capital profits. So as on date of acquisition, that is up to 1/7/2020, or simply as on, sorry, this is not up to, as on 1/7/2020. Here also in bracket, if you want, you can write as on 1/7/2020. How much, guys? I clearly told you which is 20,000. Now the revenue profits related to P&L. So from 1/7/2020 to 31st March 2021, the remaining figure 50 minus 20 is 30,000. Next, one more is there, which is statutory reserve. The statutory reserve opening balance nil. That's why you can directly consider that the statutory reserve is only revenue profits. Statutory reserve. So total, which is there, 50,000 acquired. Such statutory reserve is acquired after 1/7/2020 only. It is clearly given. So which is treated as capital profit. Which is treated as capital profits. Is it okay, guys, all of you? Now come to step number 3, all of you. Come to step number 3. So that is charts presentation. Just now I already wrote, and again I rubbed it. Charts presentation. So under charts presentation, first we are going to discuss about chart A. Is A, chart A. Chart A is related to minority interest. Chart A is related to minority interest. Now, what are the different columns actually we made here? Particulars, total, holding interest, minority interest. These are the totals, guys. So particulars, total, holding interest, minority interest. So please, all of you apply here. Total is 100%. As per the above illustration, holding interest is 80%, minority interest is 20%. Now let us start with share capital. Now all of you please concentrate. I told you, even though the chart is related to minority interest, now what is my agenda under first chart A? The entire net worth of the subsidiary, I'm going to split in between holding interest and minority interest. The entire net worth of the subsidiary contains share capital, capital profits, revenue profits, which is nothing but total of reserves and surplus. Now I am starting with share capital of the subsidiary, which is share capital in subsidiary, that is in S Limited subsidiary. Now how much share capital we have? Total 5 lakhs. 5 lakhs into 80%, which is 4 lakhs. 5 lakhs into 20%, which is 1 lakh. Next, come to reserves and surplus. Under reserves and surplus, what is the first one? Capital profits. Reserves and surplus, actually we divided into two parts, capital profits and revenue profits. So under second C, classification, we already classified into capital profits and revenue profits. You can check one by one: general reserve, P&L, statutory reserve. Capital profit is how much, revenue profit is how much. Now the first and foremost thing is general reserve. General reserve. So total is 1 lakh. Out of that, holding interest is 75,000. Sorry, Capital profits general reserve is how much? Not 1 lakh. General reserve capital profit how much? 75,000. 75,000. Such 75,000 it can segregate into 80%, 20%. 75,000 into 80%, you got 60,000 here, 15,000 here. Next, after general reserve, P&L. Sir, P&L capital profits how much? 20,000. P&L capital profit is 20,000. Now 20,000 into 80% is 16,000. 20,000 into 20% is 4,000. Next, after profit and loss account, one more is there, statutory reserve. One more is there, which is statutory reserve. So if you check here, the statutory reserve 50,000 is entirely capital profits. Total is 50,000. And so entire 50,000 is capital profits. That's why we are writing here 50,000 into 80% is 40,000 holding interest. 50,000 into 20% is 10,000 is minority interest. Still, minority interest is not at over. Now you can work out revenue profits. Sir, in revenue profits, only two components are there, which is general reserve, P&L. Which is general reserve, P&L. Because statutory reserve is entirely related to capital profits only. General reserve. So related to revenue profits is 25,000. Because 75,000 capital, revenue is 25,000. Then 25,000 into 80%. Which is 20,000. Holding interest 5,000, minority interest. You can simply split into 80-20. Next, profit and loss account. So 50,000 is as on balance sheet date. That is 20,000 is capital profit, 30,000 is revenue profit. So 24,000 is here, 6,000 is here, guys. Now, the minority interest column, if you can make it total, the minority interest column, if you can make it total, then you can get total minority interest need to shown in the consolidated balance sheet. So which is total minority interest to be shown in consolidated balance sheet. That is after reserves and surplus, before non-current liabilities. How much? Can you please check it? That is 1 lakh plus 15,000 plus 4,000 plus 10,000 plus 5 plus 6, 11,000. So total 1,40,000 we got. If you observe in consolidated balance sheet, we already prepared now. So there we already made the minority interest 1,40,000 in very simple manner. Capital 5 lakhs, reserves and surplus 2 lakhs, total 7 lakhs into 20%, which is 1,40,000. Now we are split it into too many ways. Now, all of you please concentrate. What about the holding interest, sir? What I can do the net worth of the holding interest? The net worth of the holding interest is divided into two parts now. One part is share capital, share in share capital plus share in capital profits. This is that part, right? Share in share capital plus share in capital profits is one part. Share in revenue profits is another part. Am I right? Share in revenue profits will go to consolidated reserves and surplus. We are adding these revenue profits. Share in revenue profits, we can add it to the reserves and surplus of the holding company in consolidated balance sheet. But the share in share capital and share in capital profits is useful for calculation of cost of control, which is goodwill or capital reserve. Am I right? Now you can add this 4 lakh plus 60,000 plus 16,000 plus 40,000. That is how much I got? 5 lakh 16,000. Now, if you concentrate here in the old procedure, we are comparing 4 lakhs plus capital profit, which is 4,76,000. Just a second. Sorry, friends, statutory reserve is pure revenue profit, not capital profit. I wrongly entered in capital profit. That's why we are getting different figures. So just a second. If you check in my example, what I given? So if you check here in my example, statutory reserve is not there as on 1/7/2020, is only there as on balance sheet date, means total is revenue profit. Sorry. So this 50,000 belongs to revenue profit, not capital profit. Let me add this here. But there is no change in the minority interest. No worries. So here statutory reserve is there. Statutory reserve, which is 50,000. Here it is 40,000. Here it is 10,000. Now you can rub this actually. So wrongly considered under capital profits. So which is pure revenue profits. Okay, come back guys, all of you. Now, sir, now you can make it total. You will get correctly, which is 4,76,000, right? What is the total of holding interest in capital, share capital, as well as capital profits, which is 4,76,000. The same amount you got earlier. Please check here. The same amount you got earlier. Here you are comparing 4 lakhs plus 76,000, which is 4,76,000 with 6 lakhs. That means share in share capital plus capital profit. Now you are getting, which is 4,76,000, which is useful for knowing cost of control. Just I'm mentioning here. No need to mention. For the time being, I'm mentioning which is useful for cost of control. Cost of control. So now the revenue profits, the share in revenue profits related to the holding interest. What I should need to do, again, I'm mentioning for this also, what I should need to do, considered under consolidated reserves and surplus in CBS. Am I right? Okay. So with this chart A presentation is over, guys. Next, all of you come to chart B. You know the title of chart B? Chart B is related to calculation of cost of control. Calculation of cost of control. Chart B is related to cost of control. Sir, how you will get cost of control? You should need to compare two components, na? That is particulars, amount rupees. You need to compare cost of investments. I mean, first you can consider this directly. Sorry, you can first consider this directly, which is share in net worth of subsidiary related to share capital and capital profits. Related to share capital and capital profits, how much we got? 4,76,000. It should be compared with cost of investments. I directly mentioned the cost of investment in the problem, which is 6 lakhs. Am I right? Now, cost of investments is more than the share in net worth of the subsidiary. That's why, which is the goodwill situation. Since cost of investments is greater than share in net worth, which is how much we got, guys? 1,24,000. Otherwise, what we can call this, if cost of investments is less than share in net worth, we can treat it as capital reserve. But this is not that case, just I'm mentioning. Chart B is over, guys. Next, let me go to chart C. What about chart C, sir? Chart A, we've seen minority interest. Chart B, we've seen cost of control. Chart B, we've seen cost of control. Chart C is related to just a second. Chart C is related to mutual owings, guys. Mutual owings. But till now, I didn't discuss any single point related to mutual owings. But mutual owings is not a new concept. You would have learned already the concept of mutual owings in the chapter amalgamation of companies, amalgamation of partnership firms also we've seen. What is the meaning of mutual owings? One company sells goods to another company. Am I right? Then for seller, the other company is a debtor. For purchaser, the other company is a creditor. Now, during the amalgamation, both the companies are going put together. In case of amalgamation of partnership firms, also both the partnership firm financial statements are put together. Now, in the case of consolidation, also both the company's financial statements you are making put together. Then creditors are nullifying with debtors, right? Then creditors are nullifying with debtors. Then the net figure, the net difference only you can show it under the consolidated balance sheet. Do you understand? To that extent of the mutual owings will be nullifying with each other. So still the difference only you can show it under the consolidated balance sheet. If at all mutual owings are there. In the present problem, there are no mutual owings exist, but how we are going to show, just I'm mentioning here, concentrate, particulars, which is, let us assume trade receivable and trade payable is there. This is only for example purpose, not for the current illustration. There are no mutual owings. Now, holding company trade receivables you should need to write. Trade payables also you should need to write. Less subsidiary company, sorry, not less, add. In case of consolidation, what we are doing? We are adding the trade receivables of holding with subsidiary. After that, you can reduce the mutual owings. Subsidiary company trade receivables also you can consider. Subsidiary company trade payables also you can consider. Then from the total, you need to reduce mutual owings. You need to reduce mutual owings. So such mutual owing should be ultimately, we need to reduce from both the assets as well as liabilities. Sir, if there are no mutual owings at all, then you can simply ignore that. Now, in this illustration, there are no mutual owings. Just for example, I'm telling you, the total trade receivables of the holding company, just let us assume, which is 5 lakhs. The trade receivables of the subsidiary company, let us assume 2 lakhs. The trade payables of the holding company is 3 lakhs. And for subsidiary company, which is 3 lakhs. Now what happened? Holding company sold goods to the subsidiary company. Then for holding company, subsidiary company is a debtor. For subsidiary company, holding company is a creditor. Am I right? Then what is the journal entry you need to pass at the time of preparation of consolidated balance sheet? So that is the worth is 1 lakh. Let us assume the worth is 1 lakh. Now the entry is you need to cancel trade receivables as well as trade payables. Nah? Then entry is trade payables account debtor to trade receivables, which is 1 lakh. Entry trade payable account debtor to trade receivables account. If you assume the intercompany owings is 1 lakh. If intercompany owings is 1 lakh, then this is the journal entry. That means trade payable debit means you need to reduce from the total trade payables. In CBS, anyway, you are adding both the things. You are also added both the things. From here, you are reducing the mutual owings. In the same way, trade receivables also, you will add anything 5 plus 2, 7 lakhs. From there, you are reducing such 1 lakhs. So like this, you should in generally do the adjustment for mutual owings, guys. Okay, hope you understand. This is the adjustment entry for mutual owings. But for the current illustration, it is not applicable. But anyway, just I represented. Next, chart number D is, that is chart number D is consolidated reserves and surplus. So you will know once the total is completed, why we are dividing into these many charts and all such issues you can easily understand. Sir, what is the meaning of consolidated reserves and surplus? How much balance of reserves and surplus I can show in the consolidated balance sheet, which is nothing but consolidated reserves and surplus. Can you please tell me, all of you here? First, we will start with reserves and surplus of holding company here. Holding company having general reserve. Holding company also have P&L. Holding companies also have statutory reserve. Am I right? Now, if you start with holding company balances one by one, holding company, which is H limited. So let us have a look here. Existing holding company reserves and surplus. Here it is there. 1,50,000, 1 lakh, 1 lakh. So 1,50,000, 1 lakh, and here also 1 lakh. This is the existing balance in the holding company. Now you add a revenue, share in revenue profits of the subsidiary. All of you please check. We already wrote here 20, 24, 40 considered under consolidated reserves and surplus, which is revenue profits. So share in share capital plus capital profit already considered for calculation of cost of control. But share in revenue profits you need to include under the consolidated reserves and surplus, and it should be presented at the time of presentation of consolidated balance sheet. Am I right? So now 20, 24, 40, 20,000, 24,000 is the P&L, statutory reserve is the 40,000, which is share in revenue profits. Share in revenue profits related to subsidiary company. Now you can add total here. How much you are getting? 1,50,000 plus 20, 1,70,000. Here 1 lakh plus 24,000, which is 1,24,000. Which is 1 lakh plus 40,000, which is 1,40,000. Now, for example, while evaluating the cost of control on behalf of goodwill, if you derived the capital reserve, such capital reserve also you need to present here, because such capital reserve also you need to shown under consolidated reserves and surplus, right? That is in consolidated balance sheet, you should shown under reserves and surplus. So that's why in cost of control, if you derived the capital reserve, you should need to consider under chart D itself. That means what are all the different reserves and surplus you need to show under CBS, just simply you can put here. And one more thing, this goodwill where you should need to show, this goodwill you can need to show under CBS, consolidated balance sheet, can show under intangible assets. Okay. So with this, all charts are over, guys. Now I started presenting the charts in point number 3, where chart A related to minority interest, chart B is related to cost of control, chart C is related to mutual owings, chart D is related to consolidated reserves and surplus. Sir, only we completed 3 C's na. First C, cutoff data. First C, cutoff data. Second C, classification. Third C, charts presentation. What about the fourth C, sir? The fourth C is nothing but consolidated balance sheet. Fourth C is nothing but consolidated balance sheet as on 31st March 2021. Now all of you please consider it, guys, here. So in the normal schedule 3 format, how it will be: serial number, particulars, note number, amount rupees. Normally we are preparing the balance sheet like this only, right? Now here we should start with equity and liabilities. Equity and liabilities. So under equity and liabilities, just a second. Under equity and liabilities, we may start shareholders fund. Shareholders fund. Under shareholders fund, A is share capital, friends. A is share capital. So under equity and liabilities, number 1 shareholders fund, under that A is share capital. Now, all of you please concentrate. In case of consolidated balance sheet, we are not taking over the share capital of the subsidiary. We will only consider the share capital of holding company. You know the reason. The share capital of the subsidiary minority portion goes to the minority interest, and the holding interest portion is considered for the purpose of calculation of cost of control. So that's why you already know holding company share capital is how much? 10 lakhs. So you can make it present the same thing here, which is 10 lakhs. There is no note number. Next, B, reserves and surplus. In bracket, you can mention simply chart D. Chart D is only nothing but consolidated reserves and surplus. For that purpose only I presented the charts. So in bracket, you can mention chart D there. So what is the total of reserves and surplus? So individual I already given here, but if you want, you can provide separate note number actually. And the note number, general reserve is how much, P&L is how much, statutory reserve is how much you need to present actually. Can you please tell me what is the total? 1,70,000 plus 1,24,000 plus 1,40,000. So total I got 4,34,000. So total I got 4,34,000. That for the time being, I'll make it mentioned in the brackets. But in the examination, you need to present by putting a separate note number. Then individually, you can need to present that. Then reserves and surplus is also over. Shareholders fund is over. Next, coming to liabilities. Sir, here there is no classification of non-current liabilities, current liabilities. Simply I given that, which is outside liabilities. But actually, you should need to present non-current and current. But here I directly given, right? Now, outside liabilities. Simple line by line addition, guys. Simple line by line addition. Here already there, the consolidated balance sheet, you can check here. So outside liabilities, oh, sorry, I forgot the minority interest. Okay, I'll present it. No worries. 6,50,000 plus 8,00,000, which is 14,50,000. Just a second. The second component is not the outside liabilities. Third component I'll put. Third component is other liabilities or outside liabilities. Outside liabilities. Which is how much, guys? 8,50,000 plus 6 lakhs. We got total is 14,50,000. I told you we need to show the minority interest before showing the non-current liabilities and after the shareholders funds. So you need to present the minority interest as well. Minority interest we already calculated under chart A. In bracket, you can mention chart A. Sir, minority interest is how much? Chart A, minority interest is 1,40,000. Minority interest to be shown in CBS, which is 1,40,000. 1,40,000. Now shareholders fund over, minority interest over, outside liabilities over. Then you can make it total of liabilities. So total of liabilities, how much you get? Just put it in the same figure. We get 30,24,000. We get 30,24,000, which is 30,24,000. So right, which is total is 30,24,000 is the total of liabilities. In the same way, you can start doing assets. So assets is very much easier. You should not consider investments. So just you can consider total assets and goodwill. Total assets other than goodwill. You can present like this. Because I gave a draft illustration, I not mentioned each and everything. So in case of assets other than goodwill, how much you are getting? 29 lakhs, 14 plus 15, which is 14 lakhs plus 15 lakhs, which you got 29 lakhs. Then goodwill is there now, which is cost of control. How much you derived the cost of control? Under chart B, in bracket, you can mention under chart B. So goodwill, how much, guys? 1,24,000, which is 1,24,000, which is 30,24,000. Now the same illustration we done in normal way, and I completed the entire problem in the structurized way. So now The 4C approach is all about cutoff data. In cutoff data, you should identify the date of acquisition and date of consolidation. Then percentage of holding interest and percentage of minority interest you need to mention. Then under the classification stage, each and every reserves and surplus of the subsidiary company, you should need to divide it into capital profits and revenue profits. Capital profits are those reserves and surplus existing as on date of acquisition and continue to exist as on date of consolidation. So after date of acquisition or post to the date of acquisition, what are all the different reserves and surplus you will earn? Such reserves and surplus are known as revenue profits. Then after making classifying capital into revenue, capital and revenue, you should need to start presenting the charts. Chart here is related to minority interest. You should start with share capital of the subsidiary, then capital profits, then revenue profits, which you already classified under the classification stage. Such things you should need to divide it into holding interest portion, minority interest portion. Chart A, even though is related to the minority interest calculation, along with the minority interest calculation, you are also showing the holding interest portion under share capital, under capital profits and revenue profits. Now, the total of the minority interest will go to the consolidated balance sheet. That is after shareholders fund and before non-current liabilities. You should need to present as a separate line item. Now, related to the holding interest portion of the share capital and holding interest portion of the capital profits, holding interest portion of the share capital and holding interest portion of the capital profit put together, you can use it for the purpose of calculation of cost of control. Am I right? So such cost of control may be goodwill or capital reserve, which in generally we should need to do under the chart B as a cost of control presentation. Do you agree, guys, all of you? Now, the holding interest portion of the revenue profits will be utilized for the purpose of knowing the consolidated reserves and surplus. That's why under chart D, while presenting the consolidated reserves and surplus, you should need to add the holding company reserves and surplus with subsidiary company share in revenue profits. The total reserves and surplus you should need to be presented under consolidated balance sheet. Next, coming to the next chart, which is chart B, which is related to the cost of control, you should compare with share in net worth of subsidiary related to share capital and capital profits with cost of investment. If cost of investment is more than the share in net worth goodwill, which can be shown in the consolidated balance sheet. If cost of investment is less than the share in net worth, then you derive the capital reserve. Such capital reserve where you can shown. Don't directly take it to the CBS. First, you can add in the consolidated reserves and surplus. Add in the consolidated reserves and surplus under chart D. From where it will directly goes to the CBS only. So ultimately, it should be shown under consolidated balance sheet, guys. Okay. Chart C mutual owings. If at all any mutual owings are there, then you can first add the total of such particular assets, total of such particular liabilities, then you can simply reduce the mutual owings. Then coming to chart D, which is the consolidated reserves and surplus, you can take the holding company reserves and surplus individually first, from where you can add the share in revenue profits of the subsidiary, then you will get total reserves and surplus to be shown in the consolidated balance sheet. And the final one is chart 4. The final one is 4C, which is the preparation of consolidated balance sheet as on 31st March 2021. So how the 4C approach in general we are applying, I simply explained through that illustration. Okay. Sir, but still the concept is not at over. Please be all of you hold. Now you just simply known how in generally we can prepare the consolidated balance sheet. But still lot of important points or lot of adjustment I need to explain. Please be all of you hold for some time. Still your concentration level should be required for approximately 30 minutes. Once if it is over, then you can complete any problem which is asked in the consolidated balance sheet. Yes, friends. So till now, we've seen the basic consolidation procedure with respect to 4C approach, how we need to adopt, we check, and the draft preparation of consolidation, the draft preparation of consolidation, that is unstructured way also we've seen, right? But I don't want to directly going to the adjustments. Some important adjustments are there, I told you, right? So I don't want to go to the direct adjustment. But before that, let us have a look about our text. What is given? So we've seen the entire theory in lecture number 1 itself. In lecture 2, we discussed about that basic consolidation procedure. In this lecture, we started 4C approach. So consolidation procedure, rule 6 of the company's accounts rules 2014 states that manner of consolidation of financial statements of a company shall be in accordance with the provisions of Schedule 3 of the Act and the applicable accounting standards, that is AS 21. Simply consolidation should need to be conducted by applying Schedule 3 provisions plus AS 21 provisions. Okay, fine. Then coming to consolidated balance sheet. While preparing the consolidated balance sheet, assets and liabilities of the subsidiary company are merged with those of the holding company, which is simple line by line addition. Share capital, reserves and surplus of subsidiary, which is popularly known as net worth of the subsidiary, are apportioned between holding company and minority shareholders. So minority shareholders shown under balance sheet as a separate line item. These items, along with investments of the holding company in the shares of subsidiary company, that is investment in holding company, are also separated, which is not separately shown in the consolidated balance sheet. Now, the net amounts resulting from various computation of the above items is minority interest, which is shown under CBS, after reserves and surplus, but before non-current liabilities. Cost of control. How we will get the cost of control? That is holding interest share in net worth of the subsidiary. Net worth of the subsidiary. That is classified into share capital plus capital profit. Such a share capital plus capital profit you can compare with cost of investments, you will get the cost of control. And then the net worth of the subsidiary revenue profits, you can make it transfer to the consolidated reserves and surplus. Here it is given holding company share in post acquisition profits. Post acquisition profits means revenue profits of the subsidiary company added to the appropriate concerned account of the holding company are entered in the consolidated balance sheet. Am I right? The same discussion in the layman approach I also discussed before seeing 4C approach. Then come to 4C approach, cutoff data, classification, charts, consolidated balance sheet. Under charts, chart A, chart B, chart C, chart D. Chart A is related to minority interest. Chart B is related to cost of control. Chart C is related to mutual owings. Chart D is related to consolidated reserves and surplus. Now come here, come to the cutoff data, guys. All of you, we will check percentage of holding interest, percentage of minority interest, date of acquisition, date of consolidation. After reading the problem, first you need to identify such information. Then come to classification stage. The reserves and surplus of subsidiary will be divided into two parts. Each component of reserve and surplus will be separately segregated. That is capital profits. We can call it as pre-acquisition profits. That is before acquisition of investment by holding company in subsidiary. What are all the different reserves and surplus contained by subsidiary? We know it as pre-acquisition profits or capital profits. Revenue profits is nothing but post-acquisition profits. Reserves and surplus which exist as on date of acquisition and continue to be exist as on date of consolidation is known as capital profits. Those reserves and surplus which arose after the date of acquisition and continue to exist as on date of consolidation known as revenue profits. Simply, before acquiring investment reserves and surplus, after acquiring reserves and surplus, just you are segregating. Then charts preparation, computation of minority interest. Even though the title is computation of minority interest, we need to segregate the net worth of the subsidiary both for holding as well as minority. We'll start with equity share capital in subsidiary company, then capital profit for each and every specific reserve to holding and minority. Then this portion is useful for calculation of cost of control in the next chart, that is chart B. Then you will check with the revenue profits. Then total of the column is nothing but minority interest. Such minority interest, you can show it under the consolidated balance sheet. Am I right? Now these revenue profits, you can be added in the chart to D to know the consolidated reserves and surplus. Now he is given certain notes. Let us have a look. Minority interest represents the claims of the outside shareholders of a subsidiary. Minority interest should be presented in the consolidated balance sheet separately from liabilities and the equity of the parent shareholders. That is, it is presented after the shareholders fund as a separate line item in the consolidated balance sheet. Actually, some more provisions I need to discuss about minority interest, but this is not a right time. I will discuss as an adjustment. Okay, just leave it. This is such adjustment actually, but for the time being, you can ignore, guys. I will tell you this is at the time of dealing the adjustments. Okay, that is adjustment means advanced things. Next, calculation of cost of control. So cost of investment, you should need to compare with parent share in the equity of the subsidiary as on date of investment. Then if A greater than B, A greater than B means cost of investment is greater than share in net worth of the subsidiary, then which is goodwill situation, otherwise capital reserve situation. The goodwill is coming under consolidated balance sheet. capital reserve will be added to chart 2D while evaluating the consolidated reserves and surplus. Such consolidated reserves and surplus balance you can show under consolidated balance sheet. Come to mutual holdings. The particular asset or the particular liability of both holding company and subsidiary company, you need to add it. Then you can reduce such mutual owings. Then you will get net balance shown under the consolidated balance sheet. Then come to chart 2D, that is consolidated reserves and surplus. Existing balance in holding company. First, you need to consider add holding interest in revenue profits. What is this holding interest in revenue profits? Here you have na holding interest in revenue profits. Such revenue profits you can add it here. Then you will get consolidated reserves and surplus to be shown in consolidated balance sheet. Then you will start preparing the CBS, consolidated balance sheet. Hope you understand. Till now only we made the discussion, right? Now all of you come for advanced issues or adjustments or the special issues, whatever the case may be. Number 1, special issues. I'll put the heading special issues. So these are highly important. The faith of the problem is completely depending upon the ability or the capability of a student, whether he can understand these special adjustments. If he can able to, if he can able to understand the special issues, then he can easily crack the problem. That much of a simple logic here we can get through the special issues. Okay, so the simple logic I can made it as a conclusion. So come back, all of you, to the special issues. Number 1, I will discuss things related to stock reserve. Things related to stock reserve. Please concentrate. Stock reserve is not a new concept to us. Stock reserve is not a new concept. Multiple chapters we actually seen the concept of stock reserve. We discussed in the chapter amalgamation. We are going to we seen under the departmental accounts under the group 1 also the concept of stock reserve if you are the group 1 student. Am I right? Now again we are checking the concept of stock reserve. Sir, what about the stock reserve here, how it will impact? Now let us have a discussion. For the purpose of discussing the stock reserve impact, so the transactions between holding company and subsidiary company divided into 2 parts, that is upstream. First let me put downstream transaction, and upstream transaction. Downstream, upstream. Sir, what is this downstream and upstream, sir? Just a moment, you know everything, but the names are just different. Nothing is great here. Sir, downstream means, downstream is nothing but holding company selling goods, holding company selling goods to the subsidiary company. Holding company selling goods holding company selling goods to the subsidiary company. Such transactions are known as downstream transaction. Downstream transaction means holding is upper, subsidiary is lower. The upper portion to lower portion, the flow is there, the fall is there. That's why which is known as downward fall. So goods are sold by holding company to the subsidiary company. Now all of you please concentrate the discussion. Let us assume for the current year, holding company sold 1 lakh worth of goods to the subsidiary company. Holding company sold 1 lakh worth of goods to the subsidiary company. How the holding company is selling goods to the subsidiary company, you know, by adding 20% profit on such sale. by adding 20% profit on such sale. That means in holding company, the entry is debtors, that is subsidiary company account debtor, subsidiary company account debtor to sales account, which is 1 lakh here, 1 lakh the credit aspect. Then what is the entry passed in the books of subsidiary company? Can you please tell me, all of you, what is the entry in the books of subsidiary company? In the books of subsidiary company, the entry is purchases account debtor, purchases account debtor to holding company, which is 1 lakh, 1 lakh. Now I will tell you the first and foremost impact. Now I will tell you the first and foremost impact due to recording of these transactions, which is arising of a mutual owing. In the books of holding company, subsidiary company is shown as debtor, which is a trade receivable. In the books of subsidiary company, holding company is a creditor, which is a trade payable, which is a trade payable. Now, you know the impact is in mutual owings under chart C. In mutual owings under chart C, I should consider the total trade receivables of holding and subsidiary as well as total trade payables of holding and subsidiary. From that, I need to reduce the mutual owings 1 lakh from holding, 1 lakh from subsidiary. Do you agree? Next, the second one. The first one, the first adjustment in chart C, that is mutual owings need to reduce from holding and subsidiary companies. So simply right, mutual owings need to reduce. That's it. Okay, just a second. That is more than enough. That is chart C, right? In which consolidated balance sheet. Then in consolidated P&L. So till now we don't discuss anything about consolidated P&L, but I get a chance to explain one thing here under the consolidated P&L. What it is, you know, sir, holding company transferred such sales to the P&L, right? Subsidiary company also transferred such purchases to the P&L, right? Now, the intercompany transaction of sale and purchase with nullify with each other. I mean, while preparing the consolidated P&L, you should also do line by line addition of revenues, line by line addition of expenses. Then you should add sales of holding company, sales of subsidiary company, from which you need to reduce the intercompany transaction of 1 lakh. In the same way, you need to add purchases of holding company, purchases of subsidiary company. From the total, you need to reduce this intercompany transaction. Do you understand? So mutual, I mean, intercompany transactions of income and expenditure need to reduce from total sales and total purchases. That is the adjustment need to be do in consolidated profit and loss account. Do we agree, all of you? But downstream transaction we are discussing not for this purpose actually. For these and all are known adjustment, we already known. But downstream transaction, for which purpose we are discussing mainly stock reserve. But till now I didn't explain anything related to stock reserve, right? Now all of you concentrate. What I want to explain things related to downstream transaction. Now, the goods which are sold by holding company to the subsidiary company is lying in the, let us assume such goods are lying in the closing stock as on date of consolidated balance sheet. That means for the financial year ending, let us assume all the goods are lying in the closing stock of subsidiary company. Even single rupee is not sold by the subsidiary company to the outside party. That means in subsidiary company, all of you please concentrate. That means in subsidiary company, if I take the balance sheet in subsidiary company, if I take the balance sheet here, which is there under closing stock, right? At the rate of 1 lakh, which is there at the rate of 1 lakh. Now, during the process of consolidation, what will happen, you know? During the process of consolidation, this is a holding company, right? So for holding company also, it has certain goods, right? In their own balance sheet, guys, in their own balance sheet, it has certain goods. That means holding company also having it their own closing stock. Now, during the process of consolidation, at the time of preparation of consolidated balance sheet, at the time of preparation of consolidated balance sheet, what I should need to do? I should need to include this closing stock and this closing stock, and I should need to represent the total closing stock. For example, let us take the closing stock of the holding company is 5 lakhs. Just this is for example. Then you need to include 5 lakhs plus 1 lakh, 6 lakhs. But the problem is this 5 lakhs is at which rupee, you know, at the rate of cost. Tell me, guys, because holding company is selling goods to the subsidiary company by earning 20% of the profit on the sale price. Means if let us consider sale price is 100, then profit is 20, then this closing stock is at the rate of 80 rupees and this closing stock is at the rate of 100 rupees. Sir, it is selling such goods by adding 20% profit on selling price. Now, if selling price is 100 means such selling price is 100, then the original cost for the holding company is 80. Now, can you combine the different values of the stock? This stock is valued at 80, this stock is valued at 100. Can you combine? As per accounting standard 2, inventory should be valued at cost or NRV, whichever is lower. Once coming to the consolidated balance sheet, there is no difference between holding and subsidiary, both are same. Now for our company, cost is 80 and the NRV is 100. Do you recognize at NRV at that point of time? Now, can you please tell me, all of you, as per accounting standard 2, stock is valued at cost or NRV, whichever is lower. Sir, cost or NRV, whichever is lower means cost is at 80 rupees worth, NRV is at 100 rupees worth. Just I'm telling, whichever is lower means you need to record at 80 rupees worth. Sir, you need to eliminate unrealized profit lying in the closing stock here. You need to eliminate unrealized profit, which is 20 rupees. Unrealized profit lying in the closing stock. Am I right, guys? Now, what is the journal entry in the books of subsidiary to reduce that? First, before adding here, before adding the 6 lakhs, first I need to change the 1 lakh to the original cost, which is actually 80,000. I need to change. For this 20,000, I need to reduce. For this, I need to reduce 20,000. Now, if I need to reduce the 20,000, what is the journal entry? You should reduce the stock due to which the loss is incurred. So asset worth is decreased means which is loss. Then the journal entry is in the books of subsidiary. I am telling you, in the books of subsidiary, which is actually wrong, guys. We should not add like this, which is actually wrong. So in the books of subsidiary, first you should need to pass one entry, which is profit and loss account data to stock reserve account. P&L account data to stock reserve account. How much? 20,000. Now, after passing this entry, then the stock will become 80,000, right? Now you can add 5 lakhs plus 80,000. Now, how you are going to represent here, please consider all of you. In consolidated balance sheet, closing stock of holding company, 5 lakhs, subsidiary company, first you can take 1 lakh minus stock reserve, which is 20,000. Then you will get, just a second. Then you will get 80,000 then you can add total 5,80,000. So this is the correct approach of recording the closing stock in consolidated balance sheet. Earlier was wrong method. That means you need to pass this journal entry as an adjustment for creation of stock reserve. For creation of stock reserve. For creation of stock reserve in the books of subsidiary company, you need to pass the journal entry P&L account data to stock reserve account. Do you understand, all of you? Sir, now what is the impact in our 4C approach due to which? Due to passing this entry, what is the impact on our 4C approach? Which is P&L of subsidiary. Which is P&L of subsidiary. Where actually the P&L of subsidiary exists? The P&L of subsidiary exists in classification stage. If you check here under the classification, we have the profit and loss account. That means before going for classification itself, you need to reduce to the extent of amount of the stock reserve here. That means if at all any unrealized profit lying in the closing stock is exist, just a moment guys, one second. This is not in the books of subsidiary. I'm so sorry. This is in the books of holding company or subsidiary company, because goods are sold by whom to whom? Holding company to subsidiary company, right? If goods are sold by holding company to subsidiary company means to whom it is unrealized profit? Holding company. I wrongly used the word subsidiary previously. Don't mind, don't confuse. If I am selling the goods to you, then I am realizing the profit, right? Then which is unrealized profit for me? Then in the books of the holding company, I need to pass the entry profit and loss account data to stock reserve account. P&L account data to stock reserve account. You should need to reduce the stock in subsidiary company. You need to record the loss under P&L account. Do you agree? Now in consolidated balance sheet, there is no difference between subsidiary and holding for me. Now this P&L is related to holding, not subsidiary. I'm so sorry. Where is the P&L of holding company? Where is the P&L of holding company? The P&L of holding company is there under chart D, consolidated reserves and surplus. The holding company P&L is there. From here, first you need to reduce unrealized profit lying in the closing stock. Do you agree? Next. Sir, where I need to reduce the stock, sir? The stock reserve we need to reduce now. The stock reserve I will generally reduce from mutual owings. Even though this is not a mutual owing, what I will do, please concentrate. The impact of this is, number one, reduce stock reserve amount. That is, reduce unrealized profit. Reduce unrealized profit of holding company. Sorry. Reduce unrealized profit lying under closing stock. Reduce unrealized profit lying in closing stock from chart D, consolidated reserves and surplus. From chart D, consolidated reserves and surplus, under that holding company P&L, I should need to reduce. Am I right? Now, in another way, where I should need to reduce the stock. Now I reduce the P&L, I given the impact of debit aspect. Where I should need to give the impact of credit aspect, that is stock reserve. Now you can consider the chart D. You can consider the chart D. Under chart D, stock, you can take the stock value of holding company and subsidiary company. You can consider the stocks of both the companies. From here, you can reduce stock reserve, less stock reserve. Then you will get stock to be shown in consolidated balance sheet. Do you understand? So that's why the adjustment need to be done in case of downstream transactions. The adjustment need to be done in case of downstream transactions with respect to stock reserve is, we need to reduce from the consolidated reserves and surplus under chart D, as well as we need to reduce from the chart D, even though it is not a mutual owing, the stock reserve amount we need to reduce from the stock. How the mutual owing transaction we are going to done in the same way. After adding both the stocks, we will simply reduce the stock reserve value. The remaining stock holding we can need to show under the consolidated balance sheet. Do we agree, all of you? So this is respect to downstream transaction. Downstream means holding company selling goods to the subsidiary, which is unrealized profit for holding company. Unrealized profit for holding company means which is there under chart D, as well as after combining both the stocks, you should need to reduce the stock reserve from chart C under mutual owings. This is the impact of stock reserve need to be considered under 4C approach if the transaction is downstream transaction. Next, come to upstream transaction. All of you quickly. Upstream transaction. Subsidiary company selling goods to holding company. That is nothing but upstream transaction, right? Here, subsidiary company selling goods to holding company. Now let us take the same issue, subsidiary company selling goods. I will put like this, 50,000 worth to holding company, not 1 lakh. You can take 50,000. So this concept is same. That is now in the subsidiary company books, it will record holding company account data to sales account. In the books of holding company, it will record purchases account data to subsidiary company. That and all possible. The same adjustment. This is not related to stock reserve. This is related to intercompany or the mutual owings. Now, holding company, subsidiary company, we need to adjust. What is the first adjustment? In consolidated balance sheet in chart C. So mutual owings, I need to adjust. What I need to adjust? Trade. This is nothing but trade receivable. This is nothing but trade payable. That means there is no difference in adjustment. If you see, this is also same adjustment. This is also same adjustment. Then in consolidated P&L also there is no difference. In consolidated P&L also there is no difference. What you should need to do? Total sales you can include. You can reduce the intercompany transaction. Total purchases you should include. You should need to reduce the intercompany transaction. Simply intercompany transactions, revenue and expenses need to reduce. Am I right? Okay. Next, I will let you know exactly what we are doing in the consolidated P&L by taking a problem as well. Now, the main story is related to stock reserve here. Now, the main story is related to stock reserve here. Let us assume the goods which are sold by subsidiary company to the holding company lying in the closing stock, entirely. Now, subsidiary company is selling by adding 20% profit on selling price. By adding 20% profit on selling price. Sir, earlier on 1 lakh, the stock reserve is how much? 20,000 we got. Right now, the stock reserve is how much, you know? 20% profit means 50,000 into 20%. Now the stock reserve is 10,000. Now all of you concentrate. Now I'm discussing about the stock reserve. Here I discussed about the stock reserve, right? The same way. Sir, now what is the impact, sir? So this is now subsidiary company, guys, not a holding company. You can consider this it as a holding company. Now goods are sold by whom to whom? Subsidiary company to holding company. That means here only closing stock is there, right? Which is 50,000. Am I right, guys? To whom which is unrealized profit? Subsidiary company. Again, it will pass the same entry. Entry is same. P&L account data to stock reserve account. The amount is 50,000 into 20% is 10K here, 10K here. But whose P&L this is? To whom which is unrealized profit? Who is selling goods? Subsidiary company. That means for subsidiary company, which is unrealized profit. Now, the subsidiary company P&L account means where it is there. Under classification stage, it is there. Under classification stage, if you check, P&L account balance exists here. Am I right? Now, under this P&L, before making the classification, out of this 50,000, you should need to reduce to the extent of the amount of stock reserve. Now, this impact is, the first and foremost thing impact is, need to reduce from P&L under classification stage. That too, you may have a doubt. Sir, from P&L, I need to reduce from capital profits or revenue profits. One thing you need to understand here, sir, you need to reduce from capital profits or revenue profits means when actually that sale is occurred really. Sir, if the sale is occurred before the date of acquisition, the sale is occurred before the date of acquisition, then you can need to reduce from the capital profits. No, sir. The sale is occurred after the date of acquisition, then you need to reduce from the revenue profits. That and all clearly, if it is given, then you can reduce from the respect to capital profits or revenue profits, you will know. But before classifying the capital profits and revenue profits, you need to check the profit and loss account is balance is how much. From the respect to capital profits or revenue profits, depending upon the date of actual sale, you need to reduce. Next, what about the stock reserve, sir? Again, the same thing where I should need to adjust the stock reserve under chart C. Under chart C, I will add the stocks of both the companies, holding company, subsidiary company. Both the company stocks you should include first. From here, you should reduce stock reserve. Then you will get stock to be shown under the stock to be shown under the consolidated balance sheet. You will get under the consolidated balance sheet how much stock value I should need to show. Do you understand? Now, please come back, all of you. Now, if exclusively I need to explain about the stock reserve, then the explanation is very simple. If the transaction is a downstream transaction, that means goods are sold by holding company to the subsidiary company, then which is unrealized profit for the holding company, you need to reduce the P&L of the holding company. The P&L of holding company is present under the chart D under the consolidated reserves and surplus, you need to reduce. At the same time, you need to adjust the stock under chart C as a mutual owings. First, you need to include both the company stocks, then reduce the stock reserve, then you will get the stock to be shown under the consolidated balance sheet. If it is related to the upstream transaction, goods are sold by subsidiary company to the holding company, then at that point of time, which is unrealized profit to the subsidiary company, you need to adjust the P&L account of the subsidiary company. Where the P&L account of the subsidiary company exists, which is exist under classification stage, that is from the appropriate either capital profits of P&L or the revenue profits of the profit and loss account, you need to reduce such unrealized profit. Then you will get the correct capital and revenue profits at that stage itself. And in the other level, the stock should need to be adjusted under chart C mutual owings. You can add both the company stocks. You can reduce the stock reserve. Then you will get how much amount of the stock need to be shown on the consolidated balance sheet. This is the first and foremost issue related to the stock reserve. I will open here, concentrate. Important adjustment, not related to dividend. Just come here, come below. Yeah. Unrealized profit in inventories. Unrealized profit in inventories, which is technically known as stock reserve. Downstream transactions, goods sold by holding company to the subsidiary company. Upstream transactions, goods sold by subsidiary to the holding company. Up, holding is big, subsidiary to holding means upward step. Sir, holding company to subsidiary company means downward step. Okay. Now, for holding company, which is unrealized profit eliminated from holding company's P&L in full under chart D from consolidated reserves and surplus. It need to be adjusted from inventories as well. In chart B mutual owings, you need to include the total stock and you need to reduce. Then coming to upstream transaction, under the classification stage, you need to reduce from P&L of subsidiary. Unrealized profit eliminated from subsidiary P&L before the classification itself. Corresponding decrease in the inventories, you should need to given again under chart C under the mutual owings by clubbing both the stocks and reduce the stock reserve. Am I right? This is the essence of the case what we discussed. In case of downstream transaction, the whole profit is earned by the holding company. Therefore, whole unrealized profit should be adjusted from the unsold inventory and consolidated profit and loss account only in respect of the percentage of the shares held by the parent. Consolidated P&L means which is consolidated reserves and surplus, which is chart D. Adjusted from unsold inventory means which is under chart C under the mutual owings by adding both the stocks. In case of upstream transaction, that is goods are sold by subsidiary to the holding. Since the goods are sold by subsidiary to the holding company, profit is made by the subsidiary company, which is ultimately shared by the holding company and the minority holders, which is important. Sir, in the classification stage, whether you are getting revenue profits or capital profit, that reserves and surplus have a right on both the holding interest as well as minority interest. That's why in such transactions, before the classification stage itself, you need to reduce from the profit and loss account. Then the impact will goes to both minority shareholders and holding interest shareholders as well. So it is clearly given in such a transaction, if some goods remain unsold at the balance sheet date, the unrealized profit on such goods should be eliminated from subsidiary P&L before classification and deducting the same from the unsold inventory under chart C, mutual owings. Do you agree? Which are very much important, guys. What the discussion I made entirely related to downstream and upstream, not only related to the stock reserve, I also dealing with intercompany transactions impact in the CBS and consolidated P&L, as well as stock reserve impact both in the company, that is both in case of upstream transactions and downstream transactions. Okay, sir, still almost 3 to 4 adjustments are remaining. So please, all of you, revise the adjustment what we made regularly. Just they are adding in the problem these adjustments. If you know these adjustments, then you can easily crack the problem. Nothing is there in the consolidated balance sheet. So please, all of you, revise the content. Then remaining adjustment I will continue in the next lecture. Until bye, have a nice day. Hi friends. In last class we discussed 4C approach completely. Am I right? There is 4C approach starts with cutoff data. First, we will represent date of acquisition, date of consolidation, and percentage of holding interest and percentage of minority interest. Then each portion of reserves and surplus of the subsidiary is classified into capital profits and revenue profits. Capital profits are those reserves and surplus exist as on date of acquisition and continue to exist as on date of consolidation. Revenue profits is nothing but those reserves and surplus arose after date of acquisition and continue to exist as on date of consolidation. Am I right? Then after the classification stage, you should need to present the charts. Chart your minority interest. Even though the title represents the minority interest, here we are going to segregate the entire net worth of subsidiary, how much it belongs to holding company, how much it belongs to the outsiders, which is nothing but minority interest. So that's why we start with share capital of the subsidiary divided in between holding and minority interest. Then capital profits also you can divide in between holding and minority, as well as revenue profits. Then the total of the minority interest is need to be presented at the time of preparation of the consolidated balance sheet after reserves and surplus, but before represent the non-current liabilities. And the portion of the holding portion of share capital and capital profits we can use it for knowing the cost of control. Such portion we can compare with cost of investments in the next chart, that is chart B. So the portion, holding portion of revenue profits, or we can simply add it to the holding company reserves and surplus while preparing the consolidated balance sheet. So that's why such a revenue profits we may transfer to chart D for the preparation of consolidated reserves and surplus. Am I right? So chart A entirely useful for minority interest, for cost of control, for chart D consolidated reserves and surplus as well. This is important chart. Next, come to chart B. Just we can compare the cost of investment with share in net worth of the subsidiary related to share capital and capital profit. If cost of investment is greater than the share in net worth, which is goodwill, otherwise capital reserve. Either goodwill, if we occur the, if in that situation goodwill is occur, then we will show under intangible assets in CBS. If capital reserve is occur, we can carry forward to chart D under the consolidated reserves and surplus. From there, we can simply transfer to the reserves and surplus under the consolidated balance sheet. Next, chart C, mutual owings. Chart C is mutual owings. That is, if at all a company is having intercompany transactions due to sales and purchases, then there may be chance of occurring debtors, creditors, bills receivable, bills payable, loan receivable, loan payable. What are all such different things are occurred? Then we can add the total of assets, add the total of liabilities. Then we may reduce the mutual owings. And come to chart D, which is consolidated reserves and surplus. First, you can consider the holding company reserves and surplus. Then you can add share in revenue profits of the subsidiary company. Then you will get the total reserves and surplus to be represented under consolidated balance sheet. Okay, then you can prepare the consolidated balance sheet, which is simple line by line addition of assets and liabilities, and how you should need to adjust the remaining things I already explained. That is, except the net worth of the subsidiary and the investment in the holding company, remaining all are simple line by line additions. Remaining components we already covered through different charts and different notes. Okay, then I started the discussing things related to special issues or adjustments. So stock reserve concept, I spared very good time for explaining the things related to stock reserve. I hope you are enjoyed that session as well. That is the last lecture, right? So the transaction may be either downstream transaction or the upstream transaction. Downstream transaction means goods are sold by holding company to the subsidiary company. Upstream transaction means goods are sold by subsidiary company to the holding company. It's all together to which company which is unrealized profit. The company who sold the goods to the other party, for such company is actually which is unrealized profit. Now, if the goods are sold by holding company to the subsidiary company in case of downstream transaction, then which is unrealized profit for holding company. That's why the entry is P&L to stock reserve. It need to reduce their profit as well as stock also. That means the P&L of holding company will be available in chart D under consolidated reserves and surplus. You need to adjust there, and we need to adjust the stock after adding the stock of holding company and the stock of subsidiary company. From there, you can reduce the stock reserve under mutual owings. Even though it is not a mutual owings, just we are habituated to represent under the mutual owings head, which is chart C. Next, coming to upstream transaction, goods are sold by subsidiary company to the holding company, which is unrealized profit to the subsidiary company. So subsidiary company P&L is there under classification stage. Before making classification of capital profits and revenue profit, you need to adjust the profit and loss account. Then accordingly, you need to derive the remaining capital and revenue profits. In the same way, the stock should be adjusted under, chart C, that is under mutual owings. We should add both the company stock and reduce the stock reserve. Am I right? Sir, apart from the stock reserve concept, in case of sale of goods, intercompany mutual owings is there. That is debtors and creditors, you should nullify in the mutual owings. And as well as at the time of preparation of consolidated P&L, the sales and purchases will nullify with each other. That is the total purchases and total sales of both the companies considered. And from purchases as well as sales, you need to reduce the same amount. Am I right? That point also I explained. Now, please all of you concentrate. This is a time for dividend, guys. This is a time for explaining things related to dividend. Just a second. So dividend. So dividend portion is very much important, guys, which plays a crucial role while doing the problems. So the next adjustment is dividend. Now, sir, first I will explain in very layman approach. Concentrate. So not related to holding and subsidiary. I'm not at all talking anything about holding and subsidiary relationship. I'm not talking in consolidated financial, how the dividend plays crucial role. I'm not explaining that. First, I will tell you what is the accounting treatment for dividend. First here I'm explaining accounting treatment for basic accounting treatment for dividend. Concentrate. So you can write here basic accounting treatment. So the company which declares the dividend, company which declares the dividend, what is the accounting treatment in that company? In that company, the accounting treatment is very simple. You know, dividend is in general declared from free reserves of such company. The entry is free reserves account data. We need to decrease the free reserves. There is a reduction to the extent of dividend under free reserves, that is either P&L or general reserve, to dividend payable account. You need to create a liability. Then dividend payable account data to bank account. On behalf of passing two entries, you can pass only one entry, which is free reserves account data, free reserves account data to bank account. That is the company which declares the dividend. That is the normal journal entry. Now, the company which receives the dividend, for example, a company who invested in such a company who invested in shares of such company, that is simply company which receives such dividend. Company which receives such dividend. What is the accounting treatment? That is depending upon whether the dividend is pre-acquisition dividend or post-acquisition dividend. You know such concept under investment accounts chapter itself. In group 1, in investment accounts chapter, would already seen the accounting treatment related to pre-acquisition dividend, and post-acquisition dividend. But once again, just here I want to take a chance for explaining the things. Please concentrate. What is the meaning of pre-acquisition dividend? Pre-acquisition dividend is nothing but before acquiring investments by the company in the other company. Before acquiring investment, let us assume I am acquiring the investments in the company as on 1/4/2021. Just let us assume as on 1/4/2021, I acquired investments in the shares of other company. And the other company declared the dividend as on 10th April 2021. As on 10th April 2021, the other company declared the dividend. Then can you please tell me the entire dividend as I received as an investor, because right now the shares are in the hands of investor in my company. Now I will get the dividend, right? The entire dividend is pre-acquisition dividend. Why you know the entire dividend is pre-acquisition dividend? Sir, the other company declared such dividend out of pre-acquisition profits. I mean, I'll give you example, no worries. Pre-acquisition dividend is nothing but dividend declared by the other company from pre-acquisition profits. From pre-acquisition profits. What is the meaning of post-acquisition dividend? Dividend declared by the other company from post-acquisition profits. From post-acquisition profits. Now, what is the meaning of pre-acquisition profits? What is the meaning of post-acquisition profits? Pre-acquisition profits is nothing but profits of the other company before the date of acquiring investment by the investor. Post-acquisition profits are nothing but profits of the other company after the date of acquisition of investment by the investor. I'll give a small example here. Concentrate. Let us assume two companies are there, company A Limited and company B Limited. Now, B Limited invested in equity shares of A Limited. As on which date? Just I want to continue the same example. It invested in equity shares. Invested in equity shares of A Limited as on 1/4/2021. Let us assume. Now, A Limited declared the dividend. A Limited declared the dividend. as on 10/4/2021. Now, A Limited declare the dividend as on 10/4/2021 means this is which year dividend, that is related to the year 2021 year dividend. Because the practical applicability of the dividend, once the financial statements are finalized and it is ultimately approved by board of directors, then board of directors will propose the dividend, which is known as proposed dividend in the board meeting, then which is ultimately declared by the shareholders in the general meeting. That means unless otherwise the general meeting is conducted, or up to that time, the company is unable to in generally declare the final dividend. Here the dividend is nothing but final dividend. Now, as on 10/4/2021, it declares the dividend means the company A Limited will declare from which year's profit? 2021 profits. From 2021 year's profits, A Limited declared the dividend as on 10/4/2021. Now, can you please check, all of you, 2021 profits is it pre-acquisition profits or post-acquisition profits in B Limited point of view, in investor point of view? Now, I acquired as on 1/4/2021 means the entire profits of 2021 are, in this case, pre-acquisition profits, completely, which are pre-acquisition profits. Now, the dividend which I received on such shares as an investment, we can call it as pre-acquisition dividend. Do you understand? Now, in the same example, let us assume I was acquired such shares. I was acquired or I invested in equity shares of A Limited as on 1/4/2020 itself. As on 1/4/2020 itself, I made the investments. Let us assume. Now, in that case, again, I received a dividend as, again, the declared dividend as on those investments, declared dividend as on 10/4/2021. Now, again, can you please check here? Now they are declared dividend from 2021 profits. Now the 2021 profits are, is it pre-acquisition profits or post-acquisition profits? I acquired as on 1/4/2020 itself. That means all the profits after 1/4/2020 is post-acquisition profits to me. Now I am getting dividend on such investment, which is known as post-acquisition dividend. Hope you understand clearly what is the meaning of pre-acquisition dividend and post-acquisition dividend. Now, I'm not talking with respect to consolidated financial statement. This is a general parlance. You would have already learned such things under the chapter investment accounts in group 1. Now, if the dividend is a pre-acquisition dividend, then what is the accounting treatment? All of you, the accounting treatment is such dividend is reduced from cost of investments. Reduced from cost of investments. I'll write full page. I reduced from cost of investments. Sir, if the dividend is post-acquisition dividend, then what I should need to do? Credited to profit and loss account. Credited to profit and loss account. Already such accounting treatment, right? Again, I don't want to explain why we need to reduce from cost of investment, why we are creating P&L. Sir, in generally, income is created to P&L, but why in case of pre-acquisition dividend, reduce it from cost of investments? The reason is, at the time of acquisition of such investments, we don't know how much dividend actually foregone by the other party. Do you understand? For example, here in the second case, or in the first case, if you check, I acquired as on 1/4/2021, right? At the time of acquisition itself, if I know A Limited how much dividend is payable, if A Limited how much dividend is declared, then I should need to compensate. The dividend amount also to the other party. At the time of acquisition of investments as on 1/4/2020, if I would know how much amount dividend is in generally actually declared by A Limited, then the other party from which I am purchasing the investment, right? Then the other party will expect, along with the cost of the investment, the dividend foregone. How much amount dividend foregone, that amount also he will expect. Am I right or wrong? Do you remember the concept of cum interest and ex interest in case of fixed income bearing securities? at the time of purchasing debentures, the other party will expect, along with the cost of debentures, he will also expect interest from the last date of payment to up to date of purchase. In the same way, the other party will also expect dividend related issue, because you are acquiring as on 1/4/2021, but you are getting the entire dividend as on 10/4/2021. Only 10 days you are holding, but 1 year dividend you are getting here. So that is actually lost to the other party. That's why the other party will also ask to compensate the dividend as well. That's why we already paid that amount. At the time of acquiring these investments. Now that amount portion which related to the dividend, which was already included in the cost of investments, now at the time of receipt of such dividend, we can treat it as pre-acquisition dividend, and we are reducing from the cost of investments. So that logic also I explained. What the method or what the concept we are in generally telling for pre-acquisition dividend at the time of investments chapter, the same thing I already explained. So why the pre-acquisition dividend is in generally reduced from cost of investments? It is actually already included in the cost of investment. At the time of purchase of investments, we already paid the dividend portion to the other party, but at the time of acquisition, we don't know how much portion is included under such cost. But at the time of receipt of dividend, we know exactly how much amount of the dividend was included in such cost. Right now, we are reducing from cost of investments. So the post-acquisition dividend is related to the revenue profit. We can make it related to P&L. Do you understand the basic concept of dividend? This is not related to consolidated balance sheet or consolidated financials. This is the basic accounting treatment of dividend. So the company which declares the dividend, free reserves to bank. The company which receives the dividend, if it is pre-acquisition dividend, which is reduced from cost of investments, means what is the journal entry? Can you please tell me the journal entry, guys? I know this is the journal entry. In case of, in case of the company who issues the dividend, but what is the journal entry in case of the company who received the dividend if the dividend is a pre-acquisition dividend? I'll pause here, concentrate. The entry is bank account debtor to investments account. This is the journal entry, guys. Bank account debtor to investments account. This is the journal entry. Sir, in case of post-acquisition dividend, what is the journal entry, sir? In case of post-acquisition dividend, the journal entry is bank to P&L. Bank to P&L. Actual entry bank to dividend, dividend to P&L. Here also bank to dividend, dividend to investments. That is the bank to investment account here. Here it is bank to P&L. Do you agree, all of you? One second. So these are the journal entries, guys. Now, please all of you put aside the concept of dividend. You know the declared company, free reserves to bank, the received company, if it is pre-acquisition dividend, bank to investment, if it is post-acquisition dividend, bank to P&L. That's over. Now come to the real concept of dividend in case of consolidated financial statements. Now I'm explaining the concept of or adjustment of dividend. Adjustment of dividend in case of consolidated financial statements. This is very much important, guys. Concentrate. So for example, first let me talk about the adjustment of dividend with respect to consolidated financial statements in declaring company point of view. Declaring company. Or let me write one by one, then you can understand in which company point of view it is. So adjustment of dividend in case of consolidated financial statements. Now let us assume subsidiary company not yet declared, or subsidiary company declared the dividend, but not yet adjusted, Subsidiary company declared the dividend, but not yet adjusted in the books of the subsidiary company. Then what is the entry we should need to pass? So the journal entry, the company in which who declares the dividend, the entry is free reserves to bank. The entry is free reserves account debtor to bank account. Super. Now subsidiary company declared the dividend but not adjusted, right? Now we are adjusted by passing the free reserves account debtor to bank account. Now coming to holding company, all of you, coming to holding company. For a holding company, the declared dividend may be pre-acquisition dividend or maybe post-acquisition dividend. It may be pre-acquisition dividend or maybe such dividend is such dividend may be pre-acquisition dividend or such dividend may be post-acquisition dividend. Holding company is the company which receives the dividend. Now subsidiary company declared the dividend but not adjusted free reserves to bank account. For example, if it is already adjusted, no need to pass any entry. No need to pass any entry. Now holding company, if it is a pre-acquisition dividend. Now holding company not adjusted till now. Let us assume holding company not adjusted till now related to pre-acquisition. Not adjusted till now. Now what I should need to do? If it is not adjusted till now means I need to adjust right now. What is the adjustment? Bank account debtor to investment account. I need to reduce from investment now. In the same way, if it is post-acquisition dividend, if it is the post-acquisition dividend, they are not adjusted till now. Not adjusted till now. Then again adjust here. What is the problem? What is the adjustment here? Bank to P&L account. Bank account debtor to P&L account. Super. Now, coming to the next case, they are adjusted. They are wrongly adjusted. They are wrongly adjusted by treating it as a post-acquisition dividend. Actually, it is pre-acquisition dividend. They are wrongly adjusted by crediting to P&L. They are wrongly adjusted by crediting to P&L. Sir, which is a pre-acquisition dividend? They are wrongly adjusted by crediting to P&L means what happened actually? What they made? They are passing a wrong entry actually. Wrong entry they passed. What is the wrong entry? Bank account debtor to P&L. This is the wrong entry they made. But what is the correct entry? You know the correct entry, right? Correct entry is bank account debtor to investment accounts. This is the correct entry. Am I right? So this entry they passed, but this entry need to be passed. Now what I should need to do? I should pass the rectification entry here. I should pass the rectification entry. What is the rectification entry? Can you please tell me, all of you? The rectification entry, they already debited the bank. Yes, that's correct only. But on behalf of crediting investments, they created P&L. Unnecessarily, they are created P&L. Nah? You should need to debit that P&L. P&L account debtor. They are not creating the investment. Nah? Now you should need to credit the investment. Now the rectification entry is P&L account debtor to investment account. Do you agree, all of you, this one? Now, in the same way, coming to here, in the same way, just a second. If you come here, post-acquisition dividend wrongly adjusted. Wrongly adjusted. What is the correct adjustment? Actually created to P&L, but wrongly adjusted as reduction from investment. Reduction from cost of investments. Now again, in the same way, if you thought they passed the wrong entry, what is the wrong entry? Bank to investment. This is the wrong entry actually. What is the correct entry? Correct entry is bank to P&L. What is the rectification entry needed here? The rectification entry. So they need to debit the bank. Yes, exactly debited. But they need to create it to P&L, but they unnecessarily created the investment. Now you can debit the investment. That is investment account that are to profit and loss account. This is the rectification entry. Do you agree, all of you? Now come here. Sir, for example, holding company adjusted correctly, then there is no entry. If holding company adjusted correctly, then there is no entry. Now all of you concentrate. Now the adjustment of dividend in consolidated financial statement, subsidiary company declared the dividend but not adjusted. Then you can adjust by passing the entry free reserves to bank account. Subsidiary company declared the dividend and adjusted the dividend also. No entry, already adjusted, right? No entry. Okay. Now coming to the holding company, which is the company who is receiving such dividend is a pre-acquisition dividend. If the company is not adjusted till now, you can adjust as a reduction from cost of investment, which is bank account data to investment account. No, the adjusted, but which is a wrong adjustment, wrongly adjusted by created to P&L. Now, if they're wrongly adjusted by making created to P&L, you need to debit the P&L, you need to make it the correct by reduction of investment. That is, P&L account should be debited and investment account should be created, which is a rectification entry. Now, coming to the post-acquisition dividend, not adjusted till now, then bank to P&L. So wrongly adjusted as reduction from cost of investment, then you should increase the investment. Unnecessarily, they decrease the cost of investment cost. Now you increase the investment. They are not creating the P&L. You should make the P&L investment accounted up to profit and loss account. Do you understand, all of you? Now, if holding company either related to pre-acquisition dividend or related to post-acquisition dividend, they adjusted correctly. No need to do anything. If they adjusted correctly means pre-acquisition dividend reduced from cost of investment. Then we no need to do anything. Post-acquisition dividend, they correctly adjusted. No need to do anything. So that's why in my chart, for correct adjustment made by their respective companies, I not at all considered. In such point of view, we no need to pass any journal entries. Is it okay? Now all of you consider here. Now in my 4C approach, what is the impact? Now I'm telling you, in my 4C approach, what is the impact? If subsidiary company declared the dividend but not adjusted, I need to reduce the free reserves. Free reserves of the subsidiary company, where it will be there? Subsidiary company free reserves will be there under classification stage. Under classification stage itself, I need to reduce to the extent of the dividend declared by the subsidiary company. To the extent of the dividend declared by the subsidiary company. And one more thing, you should need to check that from which year profits it is declaring the dividend. The subsidiary company, from which year profits it is declaring the dividend. For example, if it declares the dividend after acquisition of investments, then it should need to reduce from revenue profits. If it declares the dividend before acquisition of investment profits, before acquisition of investment by holding company and subsidiary company having certain profits, out of such profits, if the subsidiary company declared the dividend, then it should reduce the capital profits. Because in subsidiary company, the reserves and surplus are divided into two parts. That is capital profit, revenue profit. Now the declared dividend, from which reserves I need to reduce? From capital profits reserves, from revenue profits reserves. That is completely depending upon you are reducing after acquisition of profits. I mean, if you are declaring the dividend after acquisition of profits, you are declaring the dividend from before acquisition of profits. That is, if after acquisition of profits, if you are declaring the dividend, then you are reducing the revenue profits. So that is before acquisition of profits, I am declaring the dividend, I should reduce the capital profit. Now I will put the same thing here. Please concentrate. Now what is the issue I am telling here? I don't have enough space. Please let me write here. So what I want to explain, dividend declared from post acquisition profits by the subsidiary, then which is reduced from revenue profits. Sir, which profits you utilized for declaration of the dividend? If you utilize the revenue profits, reduce the revenue profits. No, not like that. If dividend, I'll write here. If the dividend declared from pre-acquisition profits. Pre-acquisition profits means before acquire the investment by holding into subsidiaries, certain profits had by the subsidiary company. Out of such profits, if subsidiary company declares the dividend, then we can reduce from capital profits. So both the things should need to occur before classifying. I mean, in the classification stage, both the things should need to occur in the classification stage itself. I hope you understand the 4C approach. The 4C approach impact for declaration of the dividend. Am I right? Now coming here, holding company. So the company which receives the dividend, the company which receives the dividend, which is a pre-acquisition dividend, they're not adjusted till now. You need to adjust bank account data to investment accounts. Where investment accounts are there in our 4C approach, under chart B, while calculation of cost of control, I need to compare cost of investments. I need to compare the cost of investment with share in net worth of the subsidiary. Where from the cost of investment, I need to reduce pre-acquisition dividend. I need to reduce the pre-acquisition dividend. Then the correct cost of investment I will get. Then the share in net worth I can compare. Then I will get the correct cost of control, goodwill or capital reserve. Do you agree? So that's why here just I mentioned in chart B, from cost of investments, need to reduce. So this is actually bank balance. We need to include it under. So for bank balance, there is no impact. I will tell you the reason. For bank value, sir, can I increase? No need to increase. For subsidiary company, bank balance decrease, and the holding company bank balance increase. For subsidiary decrease and holding increase. There is no difference in the total bank balance of holding and subsidiary if you're clubbing. So that's why for bank balance, you can simply ignore. Only for reduction of investment only you can need to be done under 4C approach. Do you agree? Now in the same way, sir, wrongly adjusted by credited to the P&L. They unnecessarily wrongly adjusted. Now I should need to do this rectification entry now. What is the rectification entry? I should need to debit the profit and loss account. Where is the P&L account of holding company? P&L account of holding company is there under chart D, consolidated reserves and surplus. Under consolidated reserves and surplus, I need to reduce the profit. Unnecessarily they include under P&L account, as well as I need to reduce the cost of investments in chart B. In cost of control, from cost of investment, I need to reduce. Here from consolidated reserves and surplus, I need to reduce. Do we agree? If it is wrongly adjusted to P&L account. Now come here, which is post-acquisition dividend, not adjusted till now, bank to P&L account. Where is the P&L of holding company? Under chart D, you can add this. P&L is credit, add. P&L is debit, less. That's it. Now wrongly adjusted as reduction from cost of investment, unnecessarily wrongly reduced. Now you should add back the investment. Under chart B, you should add back to P&L. Now on behalf of crediting the so actually they need to credit to P&L, but on behalf of creating the P&L, they reduce it from investment. Now you should need to credit now. Under chart D, consolidated reserves and surplus, you should need to add back. That means whenever such adjustment will takes place, you should need to remember the journal entry. Once the journal entry is coming to the picture, then if P&L is debit, minus. If P&L is credit, plus. Which P&L? Holding P&L or subsidiary P&L? If it is holding P&L, go to chart D. If it is subsidiary P&L, go to classification. Sir, unnecessarily reduced the cost of investment, you should add back under chart B. Sir, unnecessarily credited to the P&L, you are reduced from chart D. So like that, n number of multiple things you can create here. Do you understand? The base concept is very easy. The base concept is Whenever a subsidiary company declared the dividend, you should need to reduce the free reserves of such subsidiary company under the classification status. But from revenue profits, I need to reduce, from capital profits, I need to reduce. It is all depending upon from which profits you are declaring the dividend. If you are declaring the dividend after acquisition profits, then you need to reduce the revenue profits. If you are declaring dividend from before acquisition of profits, then you can reduce from capital profits. That is related to subsidiary company, the company which issues the dividend. Now coming to the holding company, the company which receives the dividend. The company which receives the dividend, it may be a pre-acquisition dividend or it may be a post-acquisition dividend. If the dividend is a pre-acquisition dividend, if it is not adjusted till now, you should reduce from the cost of investment under chart number B. Then you can calculate the correct cost of control. So wrongly adjusted by created to the P&L, unnecessarily they are created to the P&L, then go to the chart D, you are added, you are unnecessarily created means you should need to reduce the P&L, as well as you should need to reduce from the cost of investment. From chart B also you should need to reduce. So in chart D reduction, in chart B also reduction. Now coming to the post-acquisition dividend, we are not adjusted till now. You can make it create to the P&L under chart D by adding such a profit, by adding such dividend. Wrongly adjusted as reduction from cost of investment. Now you need to increase the investments as well as you need to increase the P&L. Chart B increase, chart D increase. Like this you need to do. But don't buy hard, guys. If you buy hard, you never apply such things to the problem. Please, all of you, try to understand the concept. Once the concept is built in your mind, so nobody can erase that. Okay. Next. So the next issue is still issues are there. Please, all of you, bear with me. Or before going to the next issue, first let me check the same content through our text. I beautifully designed completely by giving different diagrammatic representation here for the dividend. So the dividend may be pre-acquisition dividend or post-acquisition dividend. If the dividend is a pre-acquisition dividend, still now not accounted by the subsidiary company, you can account it now. First adjusted in subsidiary, then adjust in the holding company. What is the adjustment in the subsidiary company? That is reduce the reserves and surplus. Am I right? Reduce the reserves and surplus and classification stage. That is reduce the pre-acquisition profits of the subsidiary before classification. When, if they declare such dividend from, pre-acquisition profits. So why I in generally put this one? In generally, dividend is declared from pre-acquisition profits. So we cannot presume like that. So let us assume if the dividend is declared from before acquisition of investment, then this case is applicable. No. So dividend is declared from after acquisition of profits. Then what should I need to do? If it is after, I didn't give here actually in the diagram, which is missing. After acquisition of profits, if the dividend is declared, then what should I need to do? I should need to reduce from revenue profits. So that's why before acquisition of profits, then I should need to reduce from capital profits. Otherwise, I should need to reduce from revenue profits. Okay. Next. Now coming to the holding, sir. Subsidiary is not adjusted, holding is also not adjusted, then accounted as reduction from cost of investment in the holding company books as well. So our diagram is much more better in that diagram which is given in the text, a single diagram which represents entire thing. Okay, so which is only talks about pre-acquisition dividend. Next, accounted by the subsidiary company. Already subsidiary company accounted. Then no need to provide anything in the subsidiary company. Now, is it accounted by holding company? Not accounted by holding company. Let us assume not accounted by the holding company till now. Same adjustment, adjusted the same at the time of consolidation, that is accounted as reduction from cost of investment. We already seen we should need to be reduced from the cost of investment. Not adjusted till now, should need to reduce from the cost of investment. So wrongly adjusted. If correctly adjusted, no need to do anything. Adjusted correctly, na? If it is already adjusted, no need to do anything. If wrongly accounted by crediting to the P&L, then you should need to pass a rectification entry P&L to investment. You should need to reduce from the P&L. You should need to reduce from the cost of control as well. Here chart to D, here chart to B. Is it okay? Fine. Now the same thing which I explained in the post-acquisition dividend, here I made, guys, which is related to post-acquisition dividend. I don't want to take it consideration for one more time. So the same thing related to post-acquisition dividend. So not adjusted till now, make it create to P&L, chart D, you need to increase under consolidated reserves and surplus. Wrongly adjusted as reduction from cost of investment. Increase the investment, increase the P&L. Increase the investment, increase the P&L. Okay. Hope you getting pre and post equation dividend. So the diagram which I given in my OneNote is much more clear than diagrams which is given in text. Okay, not an issue. So the next issue is revaluation adjustment. So which is very, very important. Please all of you concentrate here. Double concentration required for understand of revaluation adjustment, but which is very much easy. First, if you realize what facts are occurring there, then you can easily understand. First, all of you don't put your efforts on understanding of the concept. First, put your efforts on knowing the transaction. What is the real transaction? What is ongoing? If you know such transaction, then you can think about the concept. Do you understand? Okay. Now, first I'm explaining the transaction. What will happen? By taking a small example, let us assume this year is 2020-21. This year is 2020-21. Holding company acquired investments. Holding company acquired investment in subsidiary company as on 1/7/2020. Let us assume as on 1/7/2020 they acquired, which is date of acquisition. And the date of consolidation is 31st March 2021, which is date of consolidation. Do you agree, all of you? Now, let me take a PPE, which is machinery. Let us take only one thing is there, which is machinery. So the machinery here exists, the machinery as on 1/4/2021. 1/4/2021, the machinery book value is 1 lakh. I'll write here. So the machinery as on 1/4/2021 book value is 1 lakh. Okay. So let us assume they are following SLM method of depreciation. SLM method of depreciation at the rate of 10% per annum. Now just ignore the consolidation and all other issues. Now, as on 31st March 2021, can you please tell me in the normal course, if the companies prepare their own standalone financial statements, then it will represent the machinery at which value? That is book value 1 lakh minus normal course of depreciation for 12 months. 1 lakh into 10% is, it will reduce the 10,000. Then 1 lakh minus 10,000 equal to 90,000. This is the carrying amount as on balance sheet date. This is the carrying amount as on balance sheet date. Do you agree, all of you? Now, as on date of acquisition, holding company make investments in subsidiary company. Am I right? Holding company invested in the equity shares of the subsidiary company. Now we are talking all this about a subsidiary company. All this talking about subsidiary company. For example, if subsidiary company made revaluation as on 1/7/2020, then the revaluation profit exists as on 1/7/2020 belongs to capital profit. But if the same revaluation is going to occur as on balance sheet date, then it will be treated as revenue profit. Am I right or wrong? But what happens? I will tell you what happened. As on date of acquisition, let us assume the machinery in the outside market, the price is much more increasing. The price is the real scenario as on 1/7/2020, the real value of the machinery, let us assume as on 1/7/2020, the market value of the machinery is, the market value of the machinery in the outside market is, which is 1,20,000. Just let us assume which is 1,20,000. Then, to be frankly speaking, we need to provide revaluation as on 1/7/2020. But due to certain technical difficulties as per our accounting standards, we will apply the concept of revaluation as on balance sheet date only. While preparing the standalone financial statements, when you will apply the concept of revaluation as on balance sheet date, which is subsequent measurement, either you may follow cost model or revaluation model as per accounting standard and property, plant and equipment. Am I right? If you really prepare the consolidated financial statements, you would consider such revaluation adjustment only as on balance sheet date. But now you are in the process of consolidated financial statements, right? You are in the process of consolidation. So that's why you need to consider all the assets or liabilities, real market values. Is there any excess fetching? Is there any downward revaluation? Is there any upward revaluation possible? Is there any downward revaluation possible? You need to check as on date of acquisition. Then you should need to compare the book value as on date of acquisition with market value of such particular property. Then if any upward revaluation is there, such a revaluation profit you should consider under capital profits. If you are having any revaluation loss, such a revaluation loss also you can treat it as capital profit. Yes, capital profits means reserves, means not only positive balance, which also includes negative balance. Now all of you please concentrate. As on date of acquisition, I need to compare book value of machinery with the market value of machinery. Do you know what is the book value of machinery as on 1/7/2020, which is as on 1/7/2020? Do you know the book value of machinery? The book value of machinery is not 1 lakh, which is as on 1/4/2021. The book value of machinery is 1 lakh minus 1 lakh into depreciation for 3 months. You need to reduce. That is 1 lakh into 10% into 3/12, which is the book value as on 1/7/2020, which is how much, guys? So 10,000 into 4, that is 2,500. 1 lakh minus 2,500 means, which is 97,500. Am I right? Can you please cross check? Yeah, depreciation is 2,500. 1 lakh minus 2,500, 97,500. Now, what is the market value of machinery as on 1/7/2020? I already told, which is 1,20,000. Now you can compare 97,500 with 1,20,000. Now there is a upward revaluation is possible. Now there is a upward revaluation, then which is a revaluation profit, or I can treat it as revaluation reserve. Balance how much? The difference 22,500. Now such a revaluation reserve is belongs to whom? Subsidiary company. Absolutely, we are in the books of subsidiary company. Now such revaluation reserve exists as on date of acquisition. What are all the different reserves exist as on date of acquisition? We can treat it as capital profit. Under the classification stage, such a revaluation reserve you can be treated as capital profit. Under classification stage itself, you can treat it as capital profit. If you get the loss also is a capital profit, which is capital loss, maybe that is capital profit or capital profit positive figure or capital profit negative figure. Okay, this thing is over. Still the discussion is not yet over, which is very much important. Concentrate. Now as on 2021, as per consolidation procedure, what is the book value of the machinery after revaluation? After completion of revaluation, as on 1/7/2020, the book value of the machinery is 1,20,000, because you made the upward revaluation of 22,500. Now the book value as on 1/7/2020 after upward revaluation is 1,20,000. Now all of you please concentrate. For this portion of 9 months, you need to provide depreciation at the rate of 10% for 9 months on 1,20,000. But at the time of preparation of the standalone financial statements, you consider the depreciation for this 9 months. You consider the depreciation for this 9 months on the basis of book value 1 lakh at the rate of 10%. That means right now there is a necessity to create excess depreciation on to that extent of revaluation profit on this 9 months. Now during the process of consolidation, I need to provide depreciation on 22,500 excess. Am I right or wrong? Now here from 1720, just a second, from 17/2022 31st March 2021. I'll change the color just a moment. I forgot. Yeah, on 1/7/2020 to 31st March 2021. In the standalone financial statements, this is, I'm talking, consider all of you, in standalone financial statements. Standalone financial statements means not in consolidated financial statements. At the time of preparation of their own financial statements, it created depreciation for 9 months. That is on 1 lakh it created. That is on 1 lakh into 10% into 9/12, which is how much? 7,500 it created. Am I right? But now in case of consolidated financial statements, I need to create the same 9 months, not on 1 lakh. I need to provide depreciation on 1,20,000, which is 1,20,000. Am I right? So that means, just a second, please. Right, on this 9 months, 1,20,000. On 1,20,000, I need to provide depreciation. That is 1,20,000 into 10% into 9/12, which is how much? 1,20,000 into 10% into 9/12. I got 9,000. Am I right? Which is 9,000. That means due to the procedure of this is not on 22,500. Just simply I'm writing on this 9 months. Just a second. On this 9 months, we should provide depreciation based on revalued figure. Okay, you can write like this. Fine. Now concentrate. So on standalone financial statements for 9 months, you provided the depreciation of 7,500. You already reduced this 7,500. You reduced this 2,500 already reduced, which is the carrying amount 90,000 in the standalone financial statements. But due to consolidation, right now you need to provide depreciation on the revised figure, which is 1,20,000. Then you're getting 9,000. Now what I should need to do, during the process of consolidation, excess amount of depreciation need to charge to P&L by passing the entry depreciation account debtor to machinery account, to depreciation account debtor to machinery account. That is how much right now? 1,500 in excess, only excess portion only 1,500. Now all of you please concentrate here. As on, I'm talking as on, still the discussion is not yet over. Just please let me allow to discuss further. As on 31st March 2021, the issue is now at which value I need to represent this one, which is the revalued figure 1,20,000 minus depreciation for 9 months. You can ignore the remaining 3 months. Why? Because the in between the year, the PPE is revised, the PPE is revalued. Such upward revaluation is taken as opening balance. Then the depreciation for 9 months, which is 9,000. Now 1,20,000 minus 9,000 is equal to how much? 1,11,000. But earlier in the standalone financial statement, which is represented at 90,000. That's why you need to add how much? 21,000 you need to add to the machinery. 21,000 you need to add to the machinery. Am I right? So this is the carrying value of the asset in CBS. Carrying value of asset in consolidated balance sheet. Now, sir, what is the conclusion, sir? After completion of all these things, what you are trying to telling to us? Due to consolidation, total three things are occurring. One is you are finding the revaluation profit or loss as on date of acquisition. If it is a profit or loss, whatever the case may be, which should be treated as capital profits under classification stage, due to either upward revaluation or maybe the downward revaluation, there is a chance of occurring excess of depreciation, or maybe there is a chance of occurring deficit of depreciation as well. If it is upward revaluation, excess amount of depreciation, or if it is the downward depreciation, or there may be a chance of deficit in depreciation is also possible. In general, I'm telling either excess depreciation or maybe deficit, but not in this case. Just let us leave. Either excess amount of depreciation or maybe deficit amount of depreciation is also possible. That is due to the excess amount of depreciation. Due to the excess amount of depreciation, you are debiting the more amount to the P&L. What is the net entry P&L to depreciation? This depreciation should be need to charge to P&L. Now the net entry is, which is, just I'll write the complete net entry. Just a moment. The net entry is profit and loss account debtor to depreciation. Profit and loss account debtor to depreciation. That excess is 1,500. So due to which the profit and loss account of the P&L account of subsidiary company is going to impact, but which profit? Revenue profit. That's why it should be reduced from revenue profits. The excess of depreciation reduced from revenue profits. Or maybe if it is a deficit of depreciation, you can add back to the revenue profits. This is the second adjustment. And the third adjustment you should need to be done. So please ignore the old carrying amount. Now you should need to find out the old carrying, new carrying amount. That is after revaluation, the figure is 1,20,000 here. You need to reduce the depreciation for 9 months. Then 1,20,000 minus 9 months, you will get 1,11,000. Such 1,11,000 you should need to represent under the consolidated balance sheet. To simply put in a small diagram for better understanding. So the conclusion is due to revaluation adjustment. Conclusion is revaluation profit or loss as on date of acquisition treated as capital profits, capital type of profits, or pre-acquisition profits. You can call it as pre-acquisition profits as well. The name of capital profits, another name is pre-acquisition profits. Okay. Now, the second issue is due to revaluation, there may be a chance of occurring excess depreciation, or maybe there is chance of occurring deficit amount of depreciation. We can be adjusted. Why I'm using the word adjusted? If it is excess depreciation you need to provide, you need to reduce. If it is deficit of depreciation is there, to that extent you should add back. Adjusted to revenue profits in classification stage, in classification. Now, as on CBS date, as on consolidated balance sheet date, carrying value of the asset, carrying value of asset to be shown in CBS is nothing but revalued revalued amount of the asset, that is revalued amount minus depreciation on such revalued figure. Depreciation on such revalued figure for the period after revaluation. For the period after revaluation only you should need to work out. You should reduce such depreciation. Then you will get carrying amount to be shown in consolidated balance sheet. This is the carrying amount I should need to shown. So this is the conclusion part. That means whatever the adjustment already occurred in the preparation of standalone financial statements, first you already considered, not for the consolidated financials, you already considered, sorry, in opening machinery is 1 lakh. Now the depreciation for the 12 months, 10%, which is 10,000, the carrying amount, you put it already 90,000. That was already happened. Now such information is giving for the consolidation. Now this is the original subsidiary company information. Now you are taking such subsidiary company information for the purpose of consolidation. Now you are imagining on your mind that as on date of acquisition, any revaluation is going to occur. Is there any chance of occurring the revaluation? Yes, let us assume there is a chance of occurring revaluation. Then it is upward revaluation or downward revaluation. That is revaluation profit or revaluation loss. You can consider under capital profits. Now, additionally, you are considering the capital profits. One thing is sure. Next. Sir, due to the upward revaluation or downward revaluation, is there any chance of occurring excess of depreciation or deficit of depreciation? Yes, sir. Then excess of depreciation or deficit of depreciation, this period after date of acquisition period is related to revenue profits period time. Now under the classification, I need to adjust the excess of depreciation is a reduction, the deficit of depreciation is an increase in the revenue profits. Fine. Now as on date of consolidation, now the figure for the purpose of consolidation, the machinery you should consider revalued figure minus depreciation after revaluation. Then you will get the carrying amount to be considered for consolidated balance sheet. Do you understand? Okay. Sir, with this, we totally discussed actually 3 adjustments. Very important 3 adjustments we discussed. So under the special issues, the first and foremost adjustment is the stock reserve. I'm recollecting the things. If the transaction is a downstream transaction, goods are sold by holding company to the subsidiary company, then which is unrealized profit for the holding company. Then from chart to D, you need to reduce such unrealized profit, as well as in chart to C, in the mutual owings, after adding both the company stock, you should reduce the stock reserve. Now, if the transaction is upstream transaction, then goods are sold by subsidiary company to the holding company, then subsidiary company P&L is impacted. So which is unrealized profit for the subsidiary company, but in the classification stays. Now, from the profit and loss account, you should need to reduce such unrealized profit. In the same way, while presenting the chart C, you are adding both the company stock and you are reducing the stock reserve. Am I right? Next, come to the second issue, that is dividend issue. So the basic treatment first I told, company which declares the dividend, entry is reserves to bank. Company which receives the dividend, if it is pre-acquisition dividend, bank to investment. If it is post-acquisition dividend, bank to P&L. Now, coming to the consolidated financial statements, if subsidiary company declared the dividend but not adjusted, then I need to adjust under the classification stage itself free reserves to bank account. But one thing you need to remember, is it subsidiary company declared the dividend after acquisition of profits, from out of the profits after acquisition, then you should reduce from capital profits. Sorry, you should reduce from revenue profits. Am I right? So after acquisition of profits are nothing but revenue profits now for subsidiary company. No. Subsidiary company declared the dividend from those profits before acquisition of investment by the holding company, then which are capital profits, then there is a reduction in the capital profits. Simply, if you are reducing from the before acquisition of profits, you should need to reduce the capital profit. If you are declared the dividend from out of the profits of after acquisition, then you need to reduce the revenue profits. Now coming to the company which receives the dividend, not adjusted till now. If the dividend is a pre-acquisition dividend, simply reduce it from the cost of investment under chart C. While knowing the cost of control, from the cost of investment, you need to adjust, then you know the real worth of the cost of investment. No, wrongly adjusted by creating to the P&L. Now you should need to reduce from cost of investment. First, you should made it correct it. and wrongly you made it, nah, that one you should rectify it. Unnecessarily you are created to the P&L. Now you should debit the P&L. Under chart D, you should reduce the P&L. I mean cost of investment reduction under chart B, under chart D. So under the consolidated reserves and surplus, the profit and loss account need to be reduced. Coming to the post-acquisition dividend, not adjusted till now, bank to P&L. So the P&L of the holding company is there under consolidated reserves and surplus. Chart D, you can simply add it. So wrongly adjusted as a reduction from cost of investment. Unnecessarily they reduced. You can add back the cost of investment, as well as you should need to create to the P&L that is under consolidated reserves and surplus. You should need to add back to the profit and loss account. That's where chart B adding and chart D adding. This is things related to dividend. Am I right? And the last one is revaluation adjustment. Now, whenever revaluation takes place as on date of acquisition, which is virtually not takes place, I'm talking in any company, the revaluation is not occurred in between the financial year. The existing principles of accounting or the standards of accounting not accepted for that. This is only a special case occurred in case of consolidation. As on the date of acquisition, first you can visualize the things. If there is any chance of occurring revaluation profit or loss, how much it would be. Such profit you can consider as a capital profit. Now, due to the revaluation, there may be a chance of occurring excess amount of depreciation or deficit amount of depreciation. If it is upward revaluation, excess amount of depreciation. If downward revaluation, deficit amount of depreciation. Such profits, such a excess or deficit depreciation will impact the revenue profits, because after acquisition, what are the profits achieved by the subsidiary company? We can call it as revenue profits. If it is excess depreciation, you can reduce. If it is deficit of depreciation, you can add under the classification stage under revenue profit side. Now, as on date of consolidation, we should not carry the old figure. We should calculate the new carrying amount. We should calculate the new carrying amount as on consolidated balance sheet date. That is revalued amount minus depreciation for the remaining useful life. Then you will get the correct carrying amount to be shown in the consolidated balance sheet. This is the revaluation impact for preparation of consolidated financial statements. That's it, guys. So almost very important adjustments we've seen in this lecture. I don't want to give much pressure to your mind. So today in this lecture, just I want to take you one illustration, and remaining things I will discuss in the next video lecture. Please concentrate. Let me take up the first problem, which is problem number 1. Just give a moment. Yeah, here it is, my material. Come to all of you, problem number 1. Sir, still something I need to discuss actually. Something I need to discuss, but without discussing all such issues, just for the time being, I'm taking problem number 1 for discussion. Or can we take up in the next class directly? As your wish, can you please tell me? So almost your mind, I already put in the 2 different adjustments which are very important, right? Okay, I'll do one thing. For tomorrow's class, we will take up very good number of problems, almost 4 to 5 problems we will do. The next lecture is purely dedicated for the problems. I am not telling the entire problems, only the basic problems. Just now we can see based on the concept which we learned. In the next video lecture, first I will revise the content till now what we have discussed. Then I'm entering into the problems. Okay, until bye, have a nice day. So hope you enjoyed entire marathon. I gave my level best to cover the whole syllabus. Approximately, I covered 80% of 120 marks. As I told you, 80% of 120 marks. That is more or less, it will be 70 to 80 marks of your attempted marks in the examination. So the leftover chapters are very few: ESOP, buyback of equity shares, and with respect to accounting standards, six accounting standards I left. But one thing is sure, guys, after watching all these lectures, your confidence towards examination will be enhanced like anything, and you may have much more clarity on the content or concept where you already learned in the regular course. That regular course, whether you taken in the Shrestha or not, that doesn't matter, because a lot of technicalities I discussed in the classroom environment, and the way of presentation of amalgamation chapter, or the partnership accounts, or the consolidated financial statements, and the way of thought process you should need to build in your mind, it is quite different. from the other institutions as well as other faculties. Please, all of you adopt the same procedure and also give the respective working notes in the examination. Definitely, you will end up with colorful scores, guys. Okay. All the best for your examination. Have a good day. Bye bye.